Greetings to everyone watching this advanced accounting marathon. Prayers from my side for your success in the examination that you're preparing for. Here you can see on the screen our index. I have divided all the three modules as per ICA only. Module 1 is in green, module 2 is in red, and module 3 is in blue. And in this marathon revision, we'll be following the same order what is there in the ICI module. So without wasting much time, let's begin with chapter 1, which deals with Introduction to Accounting Standards. And in the beginning of the chapter, I'll tell you what is it that you can expect from this chapter in the exam. And I'll also tell you what is it that I would want you to personally revise a couple of times. So from this topic, the questions in the examination are highly unlikely, but that doesn't mean you skip. You need to pay a little bit of attention, not on the initial part, but on this part, that is roadmap for implementation of Ind AS. If in case they do want to ask a couple of 2 markers or 1 marker question or a short note question based on turnover limit, this is the area where you might get the question. So let's begin. When we talk about accounting standards, the origin of accounting standards arises because of GAAP, generally accepted accounting principles. What is it that people usually accept to encounter a situation in the account that arises? That's what we call as generally accepted accounting principles. In our country, GAAP is 2. 1, authoritative standards. Second one, commonly accepted list. Authoritative standard means they initially started as GAAP, what people can follow as a choice. But over a period of time, now it's been told with authority that this is what you have to do. It's not an option, but it is an obligation on the accountant to follow this. That authoritative standards is accounting standards. But still, there are a lot of things which are still GAAP, which are still accepted by people mutually to do. People doing accounting follow the same thing in the situation. But is it because some authority is asking us to do? No. It is just that people have picked it as a method of accounting. And this is what we followed in preparation and presentation of the financial statement. In our country, the generally accepted accounting principles are 2. One is AS, I mean to say the authoritative standards. One is AS, accounting standards. Other one is Ind AS, Indian accounting standards. Accounting standards is what is usually followed in the non-corporate setup by non-corporate entities as well as corporate entities to an extent. Beyond an extent, if their net worth exceeds a certain point, then Ind AS is being made applicable to them and they follow Ind AS. The funnier way of remembering it is CA inter syllabus is accounting standards, CA final syllabus is Ind AS. Companies which are really big will have Ind AS. Companies which are not so big will still continue to follow accounting standards. In the global outset, internationally, generally accepted accounting principles are IFRS, International Financial Reporting Standards. These arise from international accounting standards. So initially there used to be something called as international accounting standards, and these international accounting standards over a period of time have been now reformed to IFRS. And this IFRS Indianized version is Ind AS what we follow. So AS is the Indian accounting standards what is followed by all non-corporate entities and corporate entities which are small. Beyond a point, if your net worth exceeds a point, then you become a bigger entity where you don't have a choice of following accounting standards, but you are forced to follow Ind AS. Ind AS is Indianized version of IFRS. So there were 2 bodies, one which was called as IASC, International Accounting Standard Committee, which from 1st of April 2001 became IASB, International Accounting Standard Board. That along with IFRS regulates IFRS. But that's not what we need to be much worried about. Talking about Ind AS, when is it Ind AS applicable to a company? When is Ind AS not applicable to a company? See, the roadmap for implementation started in 2015. In 2015, it was told that voluntarily any entity which wishes to follow accounting standards, which wishes to skip accounting standards and start following Ind AS can follow. So voluntary option was given in the year 2015. But from 1st of April 2016, it was made mandatory. To whom is following Ind AS mandatory? For listed entities and the entities which are in the process of getting listed. What do you mean listed? Your securities are listed and traded in stock market. It can be equity, it can be debt, it can be in India, it can be outside India. So if your securities are listed or in the process of getting listed, you no longer have an option. You have to mandatorily comply with Ind AS from when? 1st of April 2016. This was one of the conditions. The other condition is based on net worth. If in case the net worth of your business, meaning assets minus liabilities or share capital plus reserves of the entity, if this net worth is more than 500 crores, then you don't have the liberty of following accounting standards. You are now forced to follow Ind AS. From when? 1st of April 2016. And they also mentioned that any group entity is also forced to follow Ind AS. Meaning you are the holding company, to you Ind AS is applicable from 1st of April 16. Your subsidiary, your associate, your venture, your holding company will also come under the same bracket of Ind AS. because later we need to do group consolidation. It cannot happen that one entity follows AS, another entity follows Ind AS. So if it is applicable to one company in the group, it is applicable to all the companies in the group. Mandatorily they have to follow Ind AS. There is only shift from AS to Ind AS. There is no shifting back from Ind AS to AS just because your net worth fell lesser than 500 crores. Got it? Then this is phase 1, where it was applicable to listed entities or the entities in the process of listing or net worth more than 500 crores, parent, associate and joint venture of the same. From 1st of April 2017, everything remained same. They brought down the net worth criteria from 500 crores to 250 crores. Meaning, previously entities with 500 or more than 500 net worth had to follow Ind AS. What if an entity had 300 crores of net worth? To them, Ind AS was not applicable in 1st of April 2016. But starting from 1st of April 2017, to them also it's now mandatory, and all their associates, subsidiary, joint venture also. This is for entities other than banks, NBFCs and insurance companies. The additional thing that's included in our material is for implementation of Ind AS to NBFCs, scheduled commercial banks, RRB, excluding regional rural banks and insurance companies. This is something that's newly added. So this is what we try to understand now. Can we focus on this part now? Let's talk about NBFCs. Whatever we discussed previously, from 1st of April 15 voluntary, from 1st of April 16 for net worth more than 500 crores, from 1st of April 2017 for net worth more than 250 crores. That is for other than NBFCs, banks and insurance companies. For NBFCs, the limit is different. 1st of April 15, voluntary option was not there for NBFCs. 1st of April 16, listed and in the process of listing 500 crores, not applicable for NBFCs. The limit came only in 1st of April 2018. In 2018, it was told that it is mandatorily applicable to all the entities, whether listed or not listed, subject to net worth criteria. If you are an NBFC and if your net worth is more than 500 crores, to you mandatorily Ind AS is applicable from 1st of April 2018. And once it's applicable to you, your parent, your subsidiary, your joint venture and associate is also under the same bracket. I hope you guys got it. Then from 1st of April 2019, they told listed or in the process of listing and net worth more than 500 crores, previously what we discussed, and if it is an unlisted entity and its net worth is more than 250 crores or more but less than 500 crores, they also came into the bracket. So they told if your net worth is more than 250, less than 500, you are also under the bracket of Ind AS. Initially it was more than 500 in 2018. From 2019, 1st of April onwards, even if your net worth is more than 250 crores, you come under the bracket of Ind AS. I hope you got it. This is with regard to our non-banking financial corporation. Then there is couple of other things. What is applicable for standalone and consolidated? You can take that slightly relaxed way. Now let's see the scheduled commercial banks. Initially the plan was to make it applicable from 1st of April 18. Later they told that we'll postpone it. In 5th of April they told let's postpone it to 1st of April 2019. And in 2019 also it didn't become applicable. 22nd March 2018 they told that we are postponing the applicability of Ind AS to regional rural banks excluded, meaning other than that scheduled commercial banks. They told we'll tell you when it is applicable. But is it being made applicable? No. After that there is no notification. So as of now, should scheduled commercial banks follow Ind AS? The answer is no. I hope you guys got it. It was initially planned to be 1st of April 18. Then they postponed to 1st of April 19. Later they told I will tell you when you have to follow. Then they didn't tell anything. Similar thing happened with insurance companies also. To insurance companies, is it applicable? MCA told we'll make it applicable from 1st of April 18. Then they told we'll make it applicable from 1st of April 2020. Within 2 years. Then they told in 2020, no, now not applicable. I'll tell you when it is applicable. Then you follow. Right now, no. So tell me, for other than NBFC, other than bank, other than insurance companies, when is Ind AS applicable? 1st of April 15, voluntary. 1st of April 16, net worth more than 500. 1st of April 2017, net worth more than 250. This is not covering NBFC, banks, insurance companies. Let's talk about NBFC, banks and insurance companies. NBFCs from April 18, if net worth more than 500. From April 19, if net worth more than 250. What about scheduled commercial banks? 18 they told 19, 19 they told they'll tell later, later they didn't tell anything. Insurance companies, same thing. 18 they told in 2020, 2020 they told I will tell you when you have to follow. So right now Ind AS is applicable to companies other than banking and insurance companies. To NBFCs is it applicable? Yes. I hope you understood the Ind AS applicability. So whenever Ind AS is applicable, it's not part of CA syllabus. Why? Ind AS is part of CA final syllabus. Next thing that you'd have to notice, what are accounting standards? We've read this in foundation, we'll revise this in inter. It is written policy documents issued by government, expert accounting body or other regulatory body covering the aspects of recognition, measurement, presentation and disclosure. And the standard setting process can be taken lightly, and benefits. It brings in standardization, it brings in reliability, it brings in comparability, it brings in uniformity. But accounting standards at no point of time can override law. It cannot override law. It has to work within the jurisdiction of law. It reduces the number of options, but it doesn't give you clear-cut option to follow. At the end, even if we have accounting standards, it will still leave us with two options many a times, either this or that. AS12, you can either follow deferred government grant approach or you can adjust against the asset. AS2 tells either you can follow first in first out or weighted average method. It will still leave us with options. It will reduce the options, but it will not round it down to one. You guys understood? This is with introduction of accounting standards. I want you to focus on the applicability part, but because maybe if in case they're asking some case law based question, they can ask you an MCQ on this applicability portion. When is it applicable? To whom is it applicable? So be little aware of that, but can't expect more than 2 to 4 marks at max. Don't hold me responsible if in case the prediction goes wrong. I'm just giving you a heads up as to what might happen if my prediction goes right. Let's go to the next topic. Framework for preparation and presentation of financial statements. Usually one of the most ignored topics, but one of the repetitively asked topics in the exam, and I would very strongly recommend you not to skip this. Do revise this topic. The reason is easy, and questions, if it comes 4 marks, 6 marks, you can walk through. And sometimes you get questions on this topic. If you have not done this topic, you won't even know that question is from this chapter. Last time in May 24 or Jan 24, there was one question on framework for preparation of financial statements where they asked you to prepare balance sheet and PL when the organization is not a going concern. People who read the topic knew that it is from here. People who had skipped this topic didn't even know that that question is from this chapter. That's the biggest thing that can happen to you. You don't know the answer to a question in the exam, okay. You don't even know which chapter it comes from, that's little scary. So don't get into that kind of a situation. Yeah, can we touch this topic? But before I touch, I'll tell you what is it that I want you to focus when you're revising this chapter later in the day or the day before exam or the week before exam. Please do solve questions on 2 topics. One is capital maintenance. Do questions on historical capital maintenance, current purchasing power, physical capital maintenance. It is very similar yet different. So clear-cutly keep some acronym or keep some logic in mind to identify between 3 methods. When they ask physical capital maintenance, you should not write purchasing power in the exam and come. That's the commonly done mistake. Usually after the evaluation of the papers and then after the result, in the student journal that you get at home, there's one column that is written by examiners. It says examiners comments. In that examiner's comment, common comment for framework based question is students have failed to understand the question. Students have failed, meaning they would have asked you to prepare capital maintenance under physical capital maintenance system. You would have written the answer under current purchasing power. You come back and then say, hey, I have written answer, I should get full marks. How would they give unless you write the answer what they ask? So practice questions on capital maintenance, first part. Second point is to prepare for some questions where you have to prepare balance sheet and PL when the organization is going concern, when the organization is not a going concern. What are the 2 topics on which I want you to practice questions? 1, capital maintenance. 2, financial statements when it is going concern, financial statements when it is not a going concern. I hope everyone keeps this in mind. Very good. Let's proceed. Whenever you prepare financial statements, the definition of the word financial statements will include balance sheet, statement of profit or loss, cash flow statement, and notes and other significant accounting policies. This is prepared with an intention that the user gets enough data to take decision. Users are investors, employees, government, and lenders, borrowers, suppliers, creditors, public, everyone. And whenever we prepare financial statements, this will read again in AS1 also. It is based on 3 fundamental accounting assumptions. What are the 3 fundamental accounting assumptions? Number 1, going concerns. Number 2, accrual. Number 3, consistency. You don't have to disclose these 3 policies. It is always assumed that entity is following going concern, meaning entity will survive the next year. Entity is following accrual concept, meaning they're recording the transaction when it happens, though it is not settled in cash. And it follows consistency, meaning policies followed in previous year, policies followed in this year are consistent. It's not like you changed it overnight as to a different policy. These 3 are assumed to be followed. If you don't follow any of these 3, you have to make mandatory disclosure that this accounting policy, which is fundamental assumption, is not followed. And focus needs to be given slightly extra on going concern. When the organization is going concern, you will show all assets and all liabilities at the transaction value. Assets at original cost, transactions liabilities at transaction value, the value at which the benefit was taken from that person. Whereas the moment the going concern concept fails, there is a question mark on going concern assumption, meaning you think you will not survive to another balance sheet date. Everything changes. Assets will no longer be written at cost. Assets have to be written at realizable value. At what value will you write assets? Realizable value. Liabilities will no longer be written at the transaction value. Liabilities have to be written at settlement price. At what value will you write liabilities? Settlement price. I hope you understood. Expenses and incomes doesn't change, but you have to do this. Let's say I have an asset, land. I bought it at 1 lakh rupees. In my balance sheet, I will record it at 1 lakh. What if the market price of the land has become 1 crore? Still, I will record the land in my balance sheet at 1 lakh. Why? We follow historical cost concept. And I'm assuming that my business is a going concern. Let's say this year, when I'm preparing balance sheet, there is a threat to going concern. My business will not survive. Then what do? I'll prepare balance sheet and P&L not following going concern. Then in my balance sheet, I will no longer record land at 1 lakh. I'll record land at 1 crore. When I increase the value of the land from 1 lakh to 1 crore, 1 crore is because 1 crore is realizable value. The moment I sell it, I'll get 1 crore rupees. You might question, sir, but isn't this against conservatism? If the business is going to continue, then you will try conservatism, periodicity, money measurement, everything. And there is no going concern. Conservatism, you put it in the dustbin, record the asset at 1 crore, 99 lakh will become income in P&L account, though the land is not sold. You understood first example? Second thing that you should notice with regard to liabilities. Let's say there are some liabilities. Liability value is 1 lakh. I'll write that liability at 1 lakh in my balance sheet. This is a liability of loan which I need to settle after 5 years. But if in case there is no going concern, I will not be there for 5 years. I might have to settle immediately. Not everyone is happy collecting the money immediate. You pay the 1 lakh rupees after 5 years, or 5 years you pay interest. Because you are preponing and then paying that 1 lakh immediately now, the person to whom you owe money will say, I will charge you penalty of 5%. If you pay me after 5 years, it's 1 lakh. If you pay it to me today, you need to pay 1 lakh 5,000. Then that liability in my balance sheet should not be recorded at 1. It should be restated to 1 lakh 5. When I restate my liability to 1 lakh 5, liability is increasing by 5,000. As 5,000 will become expense in P&L. So all that I am trying to tell you is restate assets and liabilities to settlement price or realizable value. Any increase decrease will go to statement of profit or loss. One point where you might end up doing silly mistakes is deferred expenditure. When I have incurred expenditure of 1 lakh and I believe the benefit of this expense is for 5 years, not allowed as per AS 26, but let's say entity which is not following accounting standards, 1 lakh is the expense, they want to write that 1 lakh over 5 years, or standard in some case allows us to do deferring that expense. So first year I'll write 20,000 to P&L, second year 20, third year 20, fourth year 20, fifth year 20. And out of 1 lakh, when I write 20,000 to first year PL, 80 will be in balance sheet. If my business is going to continue for second, third, fourth, fifth year. If in case my business is not a going concern, first year I need to write full 1 lakh to P&L. There is no space to write 80,000 to balance sheet. Why do we write 80 to balance sheet? We expect to write part of that 80 to P&L in year 2. But when we expect no second year balance sheet PL, write full 1 lakh to P&L in first year only. That's something that I would want you to note. This question in the study material with going concern, without going concern, please do practice. One of the question was there in May 25 or Jan 25? May 25? Jan 25 exam. So you can try solving that question as well on this topic. Then the next one is measurement principles. We discussed measurement principles for an asset is when you record it at the value at which you bought, historical cost. When you record it at the value at which we can buy now, today, for current cost. If in case you sell it, what value you get today? Realizable value. The cash flows that will generate from this in the future, if it is discounted to today's date, present value. I bought this phone 2 years ago for 50,000 rupees. That is historical cost. Same model, if I have to buy today, it will cost me 40,000 current cost. If I sell this old phone today, I'll get 25,000 realizable value. I give this phone on rent for next 2 years, I will earn rental income of 10,000 first year, 10,000 second year. I'll discount it at 10%. 10,000 into 1 by 1.1 to the power 1, discounting 0.909 for first year, 0.826 for first year. Second year, I multiply and then I total them, the discounted cash flow will become my present value. You have 4 measurement principles to value any asset. It's up to you. You can measure them in any of the value, but you would have to measure them to record in books of accounts. By this, we finish the first part of your framework chapter. Walking down to the second part of the framework chapter, capital maintenance. This is what I told. I wanted you to be little more conscious about. Capital maintenance is a very simple concept. It says that capital of an entity should not come down. Last year you were doing business at one level. This year you can do business at a slightly higher level or at the same level. You should not reduce the level. So you can withdraw the profit that you earn as drawings. You cannot withdraw more than the profit that you earn. When you start business with 1 lakh capital and you earn 20,000 profit, your drawing should be 20 or less. You cannot withdraw 30,000. When your opening capital is 1 lakh, you earn profit of 20. 1 lakh 20 is the capital. If you withdraw 30,000, closing capital will become 90. And it's matter of time. First year to second year, capital reduced by 10. Second year to third year, it will reduce. Third year to fourth year, it will reduce. One fine day, your capital might become 0. That should not happen. Capital maintenance as a concept says, this much capital you have to maintain. Beyond that, if it is there, you can withdraw. If it is not up to that level, don't withdraw. So what are the methods to identify this? 2. 1. Financial capital maintenance. 2. Physical capital maintenance. 1. Financial capital maintenance. 2. Physical capital maintenance. What is financial capital maintenance? This can be further computed using 2 things. 1. Historical cost. 2. Current purchasing power. 1. Historical cost. 2. Current purchasing power. Under historical cost, what we do is, I will think at the beginning of the year, I had bought 10,000 units to sell. Each unit was 10 rupees. So 10,000 units into 10 is how much? 1 lakh. That is my opening capital. Capital is represented in terms of units. And I'll come to the end of the year. At the end of the year, I need to maintain 10,000 units. Beginning of the year, how many units of capital did I have? Inventory, 10,000 kgs. At the end of the year, how much inventory should I have? 10,000 kgs. What was the rate at the beginning? 10. What I'll take closing rate also 10 only. I'll do 10,000 into 10. Closing capital has to be 1 lakh. Opening capital was 10,000 kgs into 10, 1 lakh. Let's say I've sold them for 1 lakh 20. Now I have 1 lakh 20,000 rupees cash with me. In that, how much capital should I maintain? 1 lakh. How much can I withdraw? 20. Can I withdraw 21? If I withdraw 21, capital will not be maintained at 1 lakh. Capital go below 1 lakh. That is historical cost. The second one is current purchasing power. Under current purchasing power, what I do is, I will take average price indices. The industry which I belong to, I might belong to IT, I might belong to automobile, I might belong to FMCG, I might belong to another different category. I will check which category do I belong to. Let's say I belong to FMCG category. In FMCG category, the basic inflation rate says 125. What does 125 means? If last year some product was 100 rupees, this year it has become 125. That is the basis. It is not one product. All the products, they have together seen the inflation and they are telling. What are they telling? 125. If they use the word 125, which means base is 100. Anything which was 100 last year has now become. So opening capital was how much? 10,000 units at rupees 10 each, which is 1 lakh. Now 1 lakh was the capital when the base was 100. Now the base has become 125. So how much capital should I maintain? 1 lakh divided by 100 multiplied by 125. You'll get how much? 1 lakh 12,000, 1 lakh 25,000. I have to maintain capital of 1 lakh 25. I have to maintain capital of, let's say my initial capital was 1 lakh units, 10,000 units of 10 each. I have sold them for 1 lakh 20. Now I have got how much? 1 lakh 20,000 rupees with me. I have to maintain how much capital? 1 lakh 25. My capital is already less than 1 lakh 25. Can I withdraw? No, you should actually bring in additional capital of 5 if you can. What if I had sold 1 lakh rupees worth of inventory for 1 lakh 30? So 1 lakh 30 is the cash available. Maintain should be 1 lakh 25. So how much can I withdraw? 5,000 can be withdrawn. I hope you understood current purchasing power. Current purchasing power is based on average price indices. This I am telling you with experience. Commonly misunderstood is current purchasing power with physical capital maintenance. Average and specific people confuse. Please don't get confused. Not you, many people before you have done this mistake. For current purchasing power, what do? We take average. We take average. Now, physical capital maintenance, what do? We take specific. We won't take basis 100, 125. Specifically for the product that I am dealing, closing rate is 2. On 31st of March, what is the rate? They'll tell, sir, for the product that you are selling, closing rate is 13 rupees. What is the rate? 13 rupees. Beginning of the year, how many units did I have? 10,000 units. At what rate? 10. 10,000 into 10, 1 lakh was capital. I want to maintain 10,000 units at the end of the year. Per unit rate, 13. 13 no closing rate. 10,000 into 13. I want to maintain 1,30,000 as my capital. When I sold that 1 lakh rupees units, let's say I realize 1,40,000 cash. I have to maintain 1,30,000, 10,000 I can withdraw. I hope you understood. So what do we do under historical cost? Opening rate itself is taken for the closing date. Opening rate to closing date. Current purchasing power, average rate. Physical capital maintenance, specific rate. We'll identify capital to be maintained. We'll identify capital to be maintained. If the capital to be maintained ginta jasti capital, our capital, closing capital is more than the capital to be maintained, excess can be withdrawn. If our capital is lesser than capital to be maintained, you cannot make drawings. Further, you have to actually bring in additional capital. Understood? The way the answer is presented in the material might look little tricky, but you revise this concept what I just told now, and then you see the questions, you will be able to do. This is anyways not required, but because I took up this concept, I'll ensure that I'll show one small example to you people. I want you to see this example. Can you see this example? 1st of April 2025, I have how many units in my godown? 5,000 units. At what rate? 10. On the closing date 31st of March 2026, how much capital should I maintain is capital maintenance. We need to give this information so that the user understands how much drawings can he make or how much additional capital should he bring in to maintain the business at not higher level, not below, but at least at same level. Got it? I won't show the answer. I am showing only the question, and I want all of us to try and guess the answer here. We will first follow historical cost method. Which method are we following? How do we do it? At the beginning of the year, how many units did I have? At what rate? On the closing date 31st of March, how much capital should I maintain? 5,000 units. At what rate? 10 only. How much capital should I maintain? Very good. 50,000. How much capital should I maintain? Very good. Next. What is the next method that I mentioned here? Current purchasing power. Here what do we take into consideration? Average price indices. Let's see what is the average price indices. What is the average price indices? 125. Meaning, if something was 100 on 1st of April 2025, that is for the year 24-25, if it was 100, for year 25-26, it will actually become 125. What is the opening capital? 5,000 units at 10, 50,000. Divide that by 100, multiply it by 125. Divide it by 100, multiply it by 125. 50,000 divided by 100 into 125. 62,000. 62,500 is the capital to be maintained. If you have more than 62,500, make drawings. If it is less, bring in additional money. I hope you understood. By this we finished which method? We finished current purchasing power. Then shall we do physical capital maintenance? Here what do we take? Specific. Specifically what was the rate? 12. You need to maintain same 5,000 units. But now at 12. 5,000 into 12. 60,000 should be closing capital. I will show the answer slightly different from how it is presented in the material, but the answer is same. Sir, would they give marks if we present like how you are teaching? Absolutely yes. I will write what is closing capital. They have given in the question. How much is closing capital of the entity? How much is closing capital of the entity? 50,000. Those who are practicing at a later stage watching this on YouTube, if in case you want the question, you can take a screenshot at this point. This is the question. And the answer, the way we present it is this. Closing capital 50. They have told. Opening capital at opening rate 50,000 units. Sorry, 50,000 is 5,000 into 10. To be maintained 5,000 into 10. So you need to compare this capital to be maintained with the closing capital. How much is closing capital? 50. How much is to be maintained? 50. Can I make any drawings? Is there a need to bring additional capital? Second, current purchasing power method. Closing capital right now is 50. We maintain it at average price indices 125 by 10. How much should be maintained? 62,500. Is there any drawings allowed? No, already there is shortage. Already there is shortage. They would have to bring additional capital of 12,500. Understood? That's current purchasing power. And under physical capital maintenance method, closing capital right now is 50. But when we multiplied it with that 12 rupees per unit, capital to be maintained is 60. Is there any drawings allowed? Should I bring in additional capital? Yeah, of course, 10. So this is how we present everything in one table. But you can do it like ICA style also. This is ICA style. Only rate capital already there, capital to be maintained. Capital, closing capital is 50, to be maintained 50, no permissible drawings. Closing capital 50, capital to be maintained 62,500. Withdrawable money is minus 12,000, meaning you cannot withdraw, you have to keep. And physical capital maintenance here. I hope this made sense to everyone. Okay, this is ICI style of answer. Historical cost, current purchasing power and capital maintenance, ICI style. Is this accepted? Yes. But if you don't want to take a chance, do this table and then write this also. Higher chances are of asking this in a case study based question. In the last 2-3 attempts, there was no question on capital maintenance. They can ask anytime. September 25, Jan 26, May 26. So nobody knows. I hope even I would know, but even I don't know. In fact, you will get to know before me, because you will write the exam at 2 o'clock. You will tell me at 5:45. Only then I get to know. Why 5 to 5:45 you need to do discussion with your friends now, as to which question did he skip, which question did you skip, what did you get right, what did your friend get right. By that we finished chapter 2. Can we move to chapter 3? Let's now start with chapter 3, applicability of accounting standards. Highly likely for September 25 and Jan 26 exam. How can you say that? Because there's been an amendment. In the RTP September 2025, they've given something new in this unit. So because they've told it, this is highly likely. Sir, amendment means what happened now? This has become easier. Previously, whenever you did applicability of accounting standards, I used to use this chart. If you remember, we did this chart. Now this chart has become simpler. I'll explain you what is it and how is it become simpler. You can remember very less things. You remember we did one lengthy big question. This question is no longer valid. This question has become 2. We did A to N. Now I have not redefined that question yet, but when I do it, it comes to A to F or G. That's it. It won't be more than that. I'll begin this topic. Let me help you understand. Applicability of accounting standards is a topic which is very vital in the practical life, because you are a businessman who started business. Should you follow all accounting standards? CA inter exam only, you might not read all accounting standards. As a businessman, are all accounting standards are applicable, or all accounting standards should be followed? No. What MCA, Ministry of Corporate Affairs, does is, it will divide all the corporate entities into 2 categories. Small and medium company, non-small and medium company. For non-small and medium company, meaning big company, all accounting standards are applicable. Who's dividing this? MCA. As per Companies Act 2013, companies are divided into 2 categories. What are the 2 categories? One, non-small and medium company. Second one is small and medium company. For non-small company, all accounting standards are applicable. For small company and medium company, some accounting standards not applicable. Some accounting standards are applicable, but within that accounting standards, some paragraphs are exempted. You don't have to follow this paragraph. Now, AS 20, you don't have to follow diluted EPS. AS 28, you don't have to do discounting of the future cash flow to find the recoverable amount. You don't have to do impairment in AS 28, bottom down, top down, not required. You do only straight down approach. So they've given some exemptions. You can skip certain paragraphs of one standard. Like you do know some chapter you do, in that chapter some concepts you skip. Like that they've told some are exempted. You don't have to do some chapters. Some relaxed, meaning standard is applicable. Within the standard, some paragraphs are not there. So as per MCA, companies are divided into 2 categories. SMC, small. Non-SMC, big. For non-SMC, meaning big, all accounting standards are applicable. For SMC, what is not applicable? AS 17, they don't have to follow. Sir, that's my favorite standard. Not applicable. What is relaxed? In AS 15, AS 19, AS 20, AS 28, AS 29, some paragraphs are not applicable for small companies. Sir, should we mug this up and remember? Not necessary. Not necessary. You just need to know some are exempted, some are relaxed. Later, what about non-corporate entities? MCA cannot have jurisdiction on non-corporate entities. That's where ICI comes. ICI, Institute of Chartered Accountants of India, which regulates the accounting practices for non-corporate entities mainly in the country, used to divide non-corporate entities into 4 categories. Level 1, level 2, level 3, level 4. Then there were different limits. They've told no more level 1, level 2, level 3, level 4, only 2 companies. One, MSME and large entities. Ashte. MSME and large entities. Ashte. And this large entities as per ICI, and non-small companies as per MCA are same. And small and medium companies as per MCA and MSMEs are same. You don't even have to read two different limits. Same limits. If it is non-SMC, it is large entity. If it is SMC, it is MSME. You understood? ICA also mentions, if it is a large entity, all accounting standards are applicable. If it is large entity, all accounting standards are applicable. And if it is MSME, certain standards are not applicable. What standards are not applicable? 3, 17, 18, 20, 21, 23, 24, 25, 27 not applicable. 10, 11, 15, 19, 22, 26, 28, 29 applicable. But there are some exemptions within that standard. And 21, 23, 25, 27 along with 14 is actually not applicable but might become applicable based on the situation. Now you are an MSME. To you, prima facie, 25 is not applicable. 21, 23, 27, 14 not applicable. But you are preparing interim report. Now you are a small company. You should shut up and sit. You want to prepare financial statements once in 6 months. Then follow AS 25, interim reporting. AS 25 says, till the time you are doing annual financial statements, me and you, we don't know each other. But bro, if you are preparing financial statements for a period lesser than a year, I and you are friends. You have to follow what I say. You can't do how you want to do. You should do what I tell only. So AS 25, mandatorily applicable if you do interim reporting, whether you are small or you are big. You are a small entity. Mind your business. Why did you buy more equity in that company, more than 50%, making it your subsidiary? When you made that company your subsidiary, though you are a small company, I am going to be there telling you things you have to follow. Who's telling this? AS 21. AS 21 says, if you are a small company, stay a small company. If you acquire more than 50% shares in some other company, you become holding, that becomes subsidiary, I become applicable. Same with 23. If you hold 20% or more in another company, you become investor, they become associate, I become applicable. 23. 27, joint venture also will become applicable. If you have 50% and someone else has 50%, you jointly own. So prima facie, 21, 23, 27, 25 not applicable. Amalgamation, 14 also not applicable. But if the situation needs, whether you are a small entity or you are a large entity, they obviously become applicable. I hope everybody understood. Till now, this was not there. Now it has been newly added, special applicability of 18 and 28. Till now it used to be like this. This level company applicable, this level company not applicable. Now they have given different limits for 18 and 28. If the turnover of a company is greater than 50 crore, if the borrowing of a company is greater than 10 crore, to you AS 18 and AS 28 is applicable. If your turnover is 50 or less, borrowing is 10 or less, then 18 and 28 is not applicable. So large entities, no question, all standards are applicable. To not large entities, to MSMEs, is all accounting standards applicable? No. Some are exempt, some are relaxed, some are based on situation. Some standards, like two standards, 18 and 28, will be applicable for an MSME if it is an MSME with greater than 50 crores turnover or greater than 10 crores borrowing. If it is an MSME with less than 50 crores borrowing, less than 50 crores turnover or less than 10 crores borrowing, then to it 18 and 28 is not applicable, freshly added. So they might, I'm not telling you will, might ask a question. It's that big 3-4 pages in your first page or first few pages of RTP. I've summarized it into only this much. If you read this much, it will be good. Then let's go to our last chapter. How do we decide whether it is SMC, non-SMC? How do we decide whether it is large entity or MSME? This is the criteria. If the entity is listed or in the process of getting listed, then what is it? Large company. Large company. If the business, what you do is banking, NBFC, insurance, financial institution business, you are a large company. You cannot be small. So number one criteria, listed or in the process of getting listed, equity or debt, India or outside India. Then second one is business. If you're doing big business, banking, insurance, NBFC, financial institution, you are a big company. You can no longer call yourself small. Third one is based on turnover. If your turnover is more than 250 crores, big. What if turnover is exact 250? Small. Less than 250? Small. Last two conditions. Last one is easy. Last but one is borrowings. If your borrowings is greater than 50 crores, large and big. If your borrowings is 50 or less, small. I hope you understood. And if your holding subsidiary or associate is large, you also become large. So if your subsidiary is large company, you are small, you also become large. If your holding is large, you are small, you become large. Everyone will get pulled to the higher level. Everyone will get pulled to the higher level. I hope you people understood this part. Okay? When you talk about turnover, you need to take turnover of previous accounting year. You get what I'm saying? If you're talking about today, previous 31st March and year ended, whatever is it, for that period turnover. And when we talk about borrowings, it is for any day during the last year. Let's say last year, throughout the year, my borrowing is 40 crores. Only one day, it became 51 crores. Then, you end up becoming a entity which is non-SMC. All accounting standards will become applicable. So, borrowings, it is any day during the previous year. Turnover, it is for that entire previous accounting year. And turnover doesn't include other income. Turnover doesn't include other income. Borrowings will include public deposits. Borrowings will include public deposits. I hope you understood. So this is the new update. Remember this. I'll show this on the screen for a couple of seconds so that if anyone would want to take, anyways the PDF will be shared. If anyone would want to read it once again. This is the first change and this is the second change. This is one thing that everyone has to do. If you have any friends with whom you are preparing or attended classes together, if they are reading from the old notes, please do tell them to not refer this video. Anything would do. Anywhere, any video, or at least refer RTP September 2025 for this small change. Do inform them. Anyways, what I would do is I'll take this part of the clip out and upload one separate 5 minutes video amendment for September 25 so that it's easy for you to also to recall, revise sometime or share it to someone. I hope applicability of A's part amended. You guys are clear? Can we now move to chapter 4? Chapter 4 talks about accounting standards. Wow, finally we're starting with some accounting standards. But chapter 4 still talks about theory only. Accounting standard 1, disclosure of accounting policies. The probability is very less. Even if in case the question comes, it should be on right what are the fundamental accounting assumptions or right what is the considerations for selecting the accounting policy or anything of that sort. Can you guess whose size is that? Yeah, Rajinikanth. Why just like that? Not because of Puli movie. The book what people also have already has Rajinikanth eyes. Yeah, didn't know? Yeah, Rajinikanth that is. So the point was about to ask guess who it is, but anyways, good guess. Thank you. Talaiva. Let's begin accounting standard 1, disclosure of accounting policies. The standard only requires you to disclose the accounting policies what you already followed. It doesn't tell you do this, do this. It tells whatever you done, please tell, disclose. No? So accounting policy is accounting principles and methods of applying those accounting principles. What is accounting policy? Accounting principle and methods of applying that accounting principles. Example, valuation of inventory, valuation of fixed assets, treatment of government grant, ways of creating provision, methods of computing goodwill. All of these are accounting policies. Whenever you are picking accounting policy, you need to keep two things in mind. Primary consideration, secondary consideration. Primary, first thing, true and fair view. Whichever accounting policy will depict the right understanding of the financial statements, we have to pick that. You have three options. You know, if we follow this, financial statements will look the correct way for decision making. You need to follow this. Ignore other two. That's the first thing. What if you feel like, no, first method, second method or third method? All the three methods will give true and fair view. Then consider secondary consideration. Secondary consideration is three things. 1, prudence. 2, substance over form. 3, materiality. Prudent. Whichever method is more prudent, whichever method ensures that the assets are not overvalued, liabilities are not undervalued, incomes are not overstated, expenses are not understated. Example, conservatism. So keeping that in mind, pick the accounting policy among three. Second point, I'm going to say in secondary consideration, second point, substance over form. Pick such a method which will ensure that accounting reality will win over legality. When it is fight between reality and legality, what to pick? Reality. Don't pick over legality, pick reality over legality and do the accounting the way it's needed. Last one is materiality. Materiality says disclose all events, whatever has happened. Let them decide what is material, immaterial. And consider material things when you pick the method. When you have 3-4 options, pick such a method which will disclose all the material information separately. So this is the consideration for selection of accounting policy. And like we discussed previously, there are three fundamental accounting assumptions. What are they? Going concern, accrual, consistency. All three of them have to be followed. You do have to disclose when you follow. Do you have to disclose when you don't follow? Yes, disclosure has to be made when you don't follow them. When you follow them, there is no need for any disclosure. I hope you understood. Now, consistency says that you should follow same accounting policies now from one year to another. There is an exception to consistency. RCB. Exception to consistency is when the law requires you to change, requirement of statute. When the accounting standard requires you to change. Why? Accounting standard only has changed. Change in accounting standards. B, for the sake of better presentation. These are the three reasons because of which you are allowed to change your accounting policy. Should you change your accounting policy? You should keep it same from year to year. If you want to change, when can you change? Three situations. 1, requirement by statute. C, change in accounting standard. B, better presentation. Better presentation doesn't mean window dressing. Better presentation means this method is a better method over this. Not this method gives higher profits over this. Not higher profits. Method which is more apt. Method which is more accurate. Method which will depict better financial results for decision making. Not higher profits for decision making. I hope you understood. That's it. Very sweet, cute little standard, accounting standard 1, which is disclosure of accounting policies. Now we'll move to chapter 4, unit 2. Chapter 4, unit 2 is accounting standard 3, cash flow statement. But we will not do cash flow statement now. See, so far we've come till here. We're done with this, we're done with this, done with this, done with this. This we will do it along with chapter 11, unit 2. When we do chapter 11, unit 1 is preparation of financial statements. Unit 2 is cash flow statement. We'll do it there. So that's the reason why I am skipping this. So what will we do next? Next we'll do AS 17, segment reporting. Can we head to AS 17? Which is chapter 4, unit 3. What does chapter 4, unit 3, which talks about segment reporting, tells? It says that good, you are doing business. Good, you are selling multiple products. Good, you are giving multiple services. I'm very happy you are also working in multiple locations. But this P&L what you have given to me as profit of full business. I somewhere think, though full P&L is showing profit, some branches show more profit, some branches show loss, together net is showing profitable. I want to know how is each branch performing. Or I know together your P&L is showing profit, but I believe some of your products are highly profitable, some of your products are loss making. On the net they show normal profit. I want to know product wise profit. That case, the entire business is cut into small segments and we prepare financial statements not for the full business as a whole, but for each segment. That becomes segment reporting. The objective of segment reporting is for better decision making. Always the way forward is not one step front. Sometimes way forward might be one step back. To make higher profit, I might not announce another product. I might not open another branch. Sometimes to make profit, I might have to shut down one branch. To make profit, I might have to discontinue one product. Discontinuing a product or discontinuing a branch might lead to higher profit in certain scenarios. I'm telling might. We don't know. How do we get to know? We need to prepare a report. So an entity can divide itself into segments either based on business or based on geography. When I divide my business based on, when I divide my financial statements based on business, that is based on the product I offer or based on the service I offer, it becomes business segment. If I divide it based on the geographical location I work, it becomes geographical segment. Now, as an online model, if the Yeshas Academy divides its business into CA segment, CS segment, CA online segment, CS online segment, international courses segment, if we divide and then prepare our PL this way, that becomes business segmenting. If we do Jainagara branch, Sheshadripura branch, Chennai branch, Hyderabad branch, if you prepare P&L based on the branch, that becomes geographical segment. Should an entity divide itself into business segment or geographical segment? Their choice. Whatever they think is more significantly impactful for decision making. Sir, what if they are not able to decide? Very simple. Here you write product A, product B, product C. Here you write business 1, business 2, business 3. You want to say, sorry, geographical location 1, location 2, location 3. You can prepare a matrix, both considered. Up to you. You guess, you get what I'm trying to tell? Some entities do that. Tatas do both. They do business and geography. It's up to you. Now, business segment is based on product and service. See if you can see product and service, bold and underline. Geographical segment is based on economic environment. For this economic environment or for this business segment, do you have to prepare a separate report? Now you write entire business revenue from operations, entire business other income, entire business expense, entire business assets. Do you have to prepare one separate statement for that segment? Depends upon the fact whether it is a reportable segment or not. A business segment or a geographical segment will become reportable segment. A business segment or a geographical segment will become a reportable segment if it falls under one of these four conditions. What are the conditions? T, R, A, M. You can call it TRAM, you can call it MART, you can call it ALT, M, whatever you want to. But condition remains same. T for turnover. T for if the turnover of that segment contributes to 10% or more, then it is reportable segment. If turnover of that segment is 10% or more of the total turnover, it is reportable segment. Next one, result. If the profit from this segment or loss from this segment is greater than or equal to 10%, it is reportable segment. If the assets from this segment is greater than or equal to 10%, reportable segment. Or M, management discretion. The management of the entity feels that I want to show this separately. Yes, turnover is not more. Yes, the result is not big. Yes, the assets are not more. But I think one fine day this will become a very big business part. I want to show the financial results. I want to show the operating results. I want to show the assets and liabilities of the segment separately. Can I pick? Yes. So it's based on T, R, A, M. T, turnover. R, result. A, asset. M, management discretion. Now, when we say turnover, we mean to say internal, external together. If they just give turnover, take it. But what if they said segment A, segment B, segment C, segment D? Internal turnover, external. Internal means one segment has sold to another. External. How do we check 10%? Take internal, external, total, identify total turnover. Total turnover of segment A divided by total turnover of the business. Then we'll arrive at one percentage. If that percentage is 10 or more, reportable segment. If it is less than 10, not reportable segment. I hope you all understood. Similarly, we say result. Result is something cautious, so you should be careful. Whenever there is result, don't take just like that, okay, total of profit and then profit would be total profit. No, no. First, segregate all the segments into profit making, loss making. Segregate them into profit making, loss making. Then take the total of the profit making segments, total of the loss making segments. Totals are available. Whichever is higher will become the denominator. Numerator, you write the individual segments result. And in this computation, ignore that loss as minus symbol. Don't put minus. So whatever segments are there, segregate them into profit making, loss making. Take the total. Total profit, total loss. Whichever is higher. Let's say it is total loss. Don't say minus 100. 100 is the denominator. Common denominator. For profit making segment also 100 denominator. For loss making segment also 100 denominator. Identify percentages. If the percentage what you find is greater than or equal to 10%, reportable segment. Less than 10, not reportable segment. We'll come to that later. Then we'll come to asset criteria. In asset criteria, we'll take all assets, current assets as well as non-current assets, and then check whether this segment assets is 10% or more of the total assets. I hope you understood. And lastly, management discretion. Management discretion, any entity can become reportable. Couple of other points to note. Whenever we talk about internal, external, we'll take the directly attributable revenue for that segment as well as allocated revenue for that segment. Whenever we take assets, we will take directly related assets to that segment, operating assets or anything, but we will exclude tax assets in this computation. Deferred tax asset or advanced tax, provision for tax, that should not be considered in this asset criteria. I hope you understood. Now we'll see one quick example question. In the PDF that I share, this answer won't be there, but I would just want you to see this here. Observe, this is the profits given. There is some 1, 2, 3, 4, 5 segments. Result 5, minus 11, 8, 2, minus 1. What do we do? First segregate them. Profit making, loss making. Profit making segments are goods, spares, warranty. Loss making segments are service, replacement. Once you segregate them, Take the total of profit making segments, total of loss making segments. Total of profits is 15. Total of loss is whichever is higher becomes 15. 15 is common denominator. So for goods segment, we'll do 5 by 15. For service, 11 by 15. For spares, 8 by 15. Warranty, 2 by 15. Replacement, 1 by 15. Do this, you get percentage. That percentage has nothing to do with negative. It's all modulus. Okay. 33.33, more than 10, reportable. 73.33, more than 10, reportable. 53.33, more than 10, reportable. 13.33 warranty, more than 10, reportable. Replacement 6.67, not reportable. I hope you understood. This is the tricky part. Turnover is easy. Turnover, they just give turnover for each segment. You just take the total and then find. Asset is easy again. Asset is also not very difficult. They will give assets, divide the assets of that segment by total assets. Now when I say there, you would have to check conditions. Is it turnover plus result plus asset? You should fulfill all the three. One of the three. Let's say one segment. Based on turnover, it is reportable. Based on asset and result, not reportable. What do we do? Reportable. Based on result, it's reportable. Turnover and asset, not reportable. Reportable. One of the conditions trigger adruno, reportable only. We are not waiting for it to fulfill all three conditions. Even if it fulfills one condition, that's good enough for it to be called as a reportable segment. Everyone understood? Now that you understood this, I'll take you on to the next point. Next point is this. See this? If in case you identify a segment as a reportable segment based on those three conditions, and you have the data of internal and external revenue separately, after you identify, order is important. Remember, first you do MART based and you identify reportable segments. Then for reportable segments, take their external revenue. Take their external revenue. Let's say 5 segments are there. In that 3 are reportable. These 3 segments, external revenue you add. Divided by total external revenue. Meaning external revenue of 3 reportable segments divided by total external revenue. When you do that, you get some percentage. No, that has to be 75% or more. Meaning minimum of 75% revenue which is external should be depicted in reportable segments. If it doesn't come to 75%, then we have to pick one other segment as reportable segment. Which one? Management's discretion, not our ethic, but it has to be picked. Shall I help you understand this? We'll see one question quickly. Come on. Look at this. This is the question that I would want you to see. I have shown the question with answer. Whatever is in red is question. Whatever is in black is answer. Okay. Now I have shown question with answer because I don't mind solving. In the regular class we do. But if I solve it now, this becomes regular class. Meaning it won't get over in the time that you are expecting to get over. Okay. Have a look. A, B, C, D, E. 5 segments. Internal revenue, external revenue given. We'll take the total revenue for consideration first. First focus on only this. How much is total revenue? You guys should respond. How much is total revenue? For segment A, can I say it is 40 by 495? I'll get 8%. For segment B, 45 by 495, 9%. Both are not reportable. For segment C, 125 by 495, 24% reportable. For segment D, 150 by 495, 30% reportable. For segment E, 140 by 495, 28% reportable. Did you understand which segments are reportable, which segments are not? C, D, E. 3 segments are reportable. These 3 reportable segments, external revenue pick madi. 80, 10, 120. 80, 10, 120. Take 80 plus 10, 90. 90 plus 120, 90 plus 120, 210. Can I say external revenue from reportable segments is 80 plus 10 plus 120, which is 210. Divide 210 by 240. How much do we get? 87 point. So 87.5% of the total external revenue is by reportable segments. Do I have to pick one more segment as reportable? No. Only C, D, E are reportable. That's it. End of the story. But what if this percentage had come not to 87.5, it had come to 73.75? Then one among A, B has to be picked as reportable segment such that external revenue from reportable segment comes to 75%. Which one among A and B? Not our headache. Management discussion. But should they pick? Yes. Sir, they picked A, but after including A, it still didn't come to 75. Then pick B also. Let's say external revenue here comes to 60%. How much percent? 60%. Let's say A and B, if you see, if you take only A, it still doesn't come to 75. Then they would have to pick B also. Sir, if I pick only B, then it will become 75. Preferably, you would have to take B, but you want to do A and B also, do it. All the segments are reportable. Did you understand this? One last point in segment reporting before we conclude. If in case only one segment becomes reportable, there are 5 segments, only one segment reportable, don't do segment reporting. Don't. Why? That entire balance sheet PL is that segment only. You don't have to show it separately. You understand? When there is a team scorecard, one person has scored century, everyone is 0, 0, 0, 0. You don't have to show his scorecard separately. Team scorecard is his scorecard. Don't. Leave it. So if it is single reportable segment, what should we do? There is no need to do segment reporting. But one point. There are 5 segments. Only one segment is reportable based on assets, revenue, turnover, assets, result, turnover. But management by discretion has picked one segment as reportable. Then do it. Do reportable, do segment reporting. Understood? Everyone? Then last point, continuity principle. Let's begin with chapter 4, unit 4, which is accounting standard 18, related party disclosure. This is a theory based standard, actually disclosure based standard. In our exam there cannot be practical questions with numbers and computation in this. So is there a possibility of questions from this? Yes, they would ask, and it's a lottery if in case they ask. You just have to tell whether it is a related party or not a related party. Yeah, so whenever it comes, it's nice and lucky. There is a possibility of question in case studies also on this topic. Yeah, let's focus on this. The objective of this standard is not to restrict a related party to have a transaction. Standard in no place tells you should not have a transaction with a related party. You can have a transaction with your related party, but tell that they are your related party when you have transactions. You understand? So the disclosure has to be made for related party relationship, related party transactions, and outstanding balances for related party transactions. I hope you guys got this. Now let's understand who is a related party. Related party is a party who at any point of time during the reporting period can control or can have significant influence in your financial or operating decisions. If they can exercise control on your business, or if they can exercise significant influence on your business, either your financial decision making or in your operating decision making, so then they become your related party. And vice versa, if you can exercise control or significant influence on somebody, you become their related party. It cannot happen like I am your related party but you are not my related party. No, if I am related to you, you are also related to me. What is a transaction with related party? What is a related party transaction? It is exchange of resources or obligations or expense incurred or income earned. Any transaction with a related party is a related party transaction. I will focus on the word control, then we'll focus on the word significant influence. What do you mean when you use the word control? Ownership, directly or indirectly. One company has more than 50% in other company. Control. One company has more than 50% in other company, not directly, but through subsidiary. I have a subsidiary, that subsidiary is having you as a subsidiary, meaning I have 60% in one company, that company has 60% in your company, equity. So you are my subsidiary, not directly, but indirectly. Don't apply your law logic here. I have 60% in one company, that company has 60% in you. I have 60% of 60% in your company, 36%. No, that is law. This is accounting standard. In accounting standard, when I have 60% in one company and in that company if it has 60% in your company, I basically call you my subsidiary. I don't have 60% of subsidiary. No, 60% what is there in your company by them, that belongs to me. I can direct to my subsidiary and I can ask my direct subsidiary to direct instructions to you. So you are also becoming my subsidiary. You understood the first part? Next one, composition of board. If I don't have more than 50% in your company's voting, but in your company there are 5 directors, in that 4 directors are directors in my company. So what should happen in your company will be decided not in your board meeting, it will be discussed in my board meeting, and those 4 directors will come and then just tell the decision to you. Your board meeting is information, my board meeting is decision making. So because I control the composition of your board of directors, I exercise control on you. And if in case I have the power to vote in your company 20% or more and I have the power to direct because of the statute, then I no longer have significant influence. I actually have control over you. You would have usually read, no, sir, if you have more than 20% or 20% influence, you have more than 50%, it is control. If I have more than 20% control in your, you would say, stake in your company, voting rights, by way of statute, I've been given power to direct or control your company. Then you are my subsidiary. I have control over you, not just a influence. Let's say I have invested only 22% equity in your capital in your company, but I have given one agreement, both of us have signed. For me to invest 22%, you should not take 1 rupee from anyone without asking me. Done so is being controlled by Reliance, but Reliance does not have 50%, they have only 22-23%. But the kind of agreement that they have is done so cannot raise even 1 rupee of debt or even 1 rupee of capital without Reliance permission. It has to be Reliance. You have to take it from Reliance, or you have to take it when Reliance says take it from somebody else. Now Dunzo wants money, but Reliance doesn't let them take money. So basically Dunzo is like, I have how much equity as Reliance? 22-23%. But I have the power to direct, control financing decisions in this example. Or let's say I have control or power to direct your operating decisions. Still, I have control over you. I hope everybody understood this. Very good. What do we have after control and significant influence? Next one is associate. Who is an associate? If I have significant influence over you, I become investor, you become associate. If I have more than 50% stake in your company, I become holding company, you become subsidiary company. I hope you understood. KMP, the next word. Who is KMP? Key management person. Any person who has authority and responsibility to do what? To plan, to direct, to control the activities in the company. I am CEO in the company. Is CEO a related party? Standard doesn't tell. Standard doesn't use the word CEO. Standard tells KMP. I am a person. I have the authority to plan the operations of the company, to direct the operations of the company, to control the operations of the company, to plan, direct, control the decisions in the company, or to have responsibility for this. Then I am a KMP. I am company's related party. Any transaction between me and company is a related party transaction requiring separate disclosure. And relative. Relative is also a related party. Who's relative? KMP is relative. So who are relatives? Father and mother is a relative. Brother and sister is a relative. Spouse and children are relatives. So nam chikaman maga, dodapun maga, cousin, brother and all. No. It is father, mother, brother, sister, spouse and children. Don't try to ask your income tax, sir, what if my spouse is another person's spouse, that spouse and that person's spouse as children? No, don't complicate relationships. India, simple. Brother, sister, mother, father, spouse, children. Spouse and children. Brother from another mother, no. Is like my friend, no, is not friend, is brother from another mother, no, not considered. Okay, now let's see related party relationship. See, I as a person, I have control over this company. I am a related party. No, I don't have control, but I have significant influence. How do I have significant influence? I have more than 20% stake. In that company, 30% shares nande. So I have significant influence. I am related party. I have 60% shares in that company. I am related party. I don't have shares in that company, but I am taking decision in that company. I have planned. I have power to plan, direct, control. I am managing director, whole-time director. Then also I am related party. Understood? And not just me, my parents, my siblings, my spouse, my children, everyone will become related parties. 4 of them. Got it? Then the next thing is related party relationship with regard to company. Let's keep human beings aside. Let's talk about artificial persons. So we're talking about this company. This is our reporting enterprise. This is our reporting enterprise. I have a subsidiary company. Is it my related party? Why? I have control over this company. I have a common company under control, meaning I have a holding company. That holding company has another subsidiary company. So I and my subsidiary company are related parties. I and my holding company are related parties. I and my holding company is another subsidiary company. We both are under common control of holding company, so we both are also related parties. I and my subsidiary, are we related parties? I and my holding company, are we related parties? I and my common subsidiary, meaning my holding company is one more subsidiary company, related party. What about my holding company is holding company? Related party, ultimate holding company. What do we call it? Very good. See, we have my holding company has control over me. Me and my holding subsidiary are under common control of this company. On this subsidiary, I have control, and this ultimate holding company has indirect control over me. All of us in this links are related parties. All of us. Understood? Next, let's see investor and associate. I have 20% or more equity in another company. That is my related party. Then joint venture. I and another company together have 50% stake commonly in another company. So we have not control, we have joint control. Sir, what is difference between control, joint control? Control is when you have more than 50%. When you have control, nobody else can have control over that company. Why? You have 51%. Others cannot have no 50%. Sir, what if both of us have 51, 50? Then your maths teacher died. Why? Total is 100. No. When you have 51% of the equity, others can have only 49. Can your subsidiary be someone's associate? Yes. Can your subsidiary be someone's subsidiary? No. In a way, yes. Who? Your holding. But for them, it's not subsidiary, it is sub-subsidiary. But anyways, you guys are getting what I'm trying to tell. Got it now? So when you have 50, someone else can also have exact 50. You got it? So to this company, both of you are equal. So both of you jointly have control over that company. One person does not have more, one person does not have. Joint control. In this case, we call it joint control. Here we apply AS 23 for accounting. Here we apply AS 27. Here we apply AS 21. I hope you are understanding. Yellow color consolidation, blue color associate 23 and green color 27. 18, 21, 23, 27 are very well connected. Yeah, but there are parts of 18 which are not there elsewhere also. Come on, let's see the next part. Next, this is slightly interesting. Careful. On this questions can come. That one funny question is there in ICA study material on this. Okay. I have control over a company. Meaning that company have 50% stake. I and that company are related party. I have one sole proprietorship. This sole proprietorship and this company are also related parties. When I have control over this company, significant influence in this company, or I am a KMP in this company, any of this, control, significant influence or KMP, this company is my related party. I am a related party to this company, and because I am a sole proprietor in this business, I am partner in this business, I am KMP in this business, this and this are also interrelated. This and this are also related parties. That's what I'm trying to tell you here. Everyone got this? Pakka? Very good. Then the next thing is who are deemed to be not related parties. Throughout I told no who are related parties, I'll tell you who are not related parties. I am common director in two companies. Just because there is one director common in two companies doesn't make those two companies related parties. Unless I have the power to direct control in this company and the power to direct or control this, both the places I should have power. Then it is common. If I am just another director, there are 5, 6 directors, there are 10 directors, I am also one among them. Just because I am director in both companies, they don't become related parties. I hope you understood. Then simple, no. Become director in two companies, now they will mess up. They would have to show all transactions between them. No. Then next one is, this is the entity. This entity is buying all its inventory from one single supplier. One African supplier is giving all the goods. Just because he supplies 100% of the goods to me, he and me, do I become related parties? Look at my color, look at his color. Not being racist. I'm just trying to tell you, we are not holding subsidiary, joint venture, associate, nothing. No power, no direction, no controlling. He can't exercise. He might indirectly be able to control me because all my inventory comes from him. That being the case, you cannot call him and me as related parties. Me here is not individual. I am a company reporting enterprise. You understand? Sir, why did you tell that? Later will tell, no, I am racist. I am not. Artificial person. Okay, then I sell all my goods to one single customer. If this customer stops buying, I don't know whom to sell to. Yes, I am dependent on this party, but we are not related parties. To have related party relationship, there should be something other than this buying of goods, selling of goods. Should have power to direct, control or monitor, equity share capital holding, composition of board of directors. Those are the criteria. Not that I am dependent on you for inventory. That's not the criteria. Might be the sole supplier, might be the sole customer. Still, they are not related parties. You don't have to disclose that transaction separately under ACT. Got it? Then you might be dependent upon certain government bodies or some trade unions or public utilities like electricity supply board, water supply board, all of these things. They are not your related parties. Just because electricity board gives me free electricity, I think we are having some kind of, no, that's not good enough. Just because you are having I think every month I pay electricity bill. I feel nothing. You feel electricity only. That is not necessary. That is not good enough to call it related party. I think this bank and I have too much of, in fact, I pay interest every month. Doesn't matter. That is bank's business to give loan. Bank gives loan to you. Bank gives loan to 919 other people also. That way bank has relationship with everyone. That's not how. They appoint someone called relationship manager to everyone. You sorry. Bank appoints something called as relationship manager. For 100 account holders, one relationship manager. They throw out, sir, do you have any problem with the account? No. That way, just because they maintain that at the personal level doesn't mean that it's a related party. Bank's business is lending loans. Bank's business is accepting investment. Lending loans, accepting investment doesn't make it a related party. But what if the bank has 30% stake in your company? Then it becomes a related party transaction. Then if the bank gives you loan, bank cannot say, I gave loan to everyone, I gave loan to you. No, you gave loan to others, but you gave loan to me. Giving loan to others is different from giving loan to me. Because you hold 20% stake in my company, there is a very high probability that you might have given loan at lower rate of interest. You might condone even if I don't pay interest to you. So there is a very high possibility. So it is still a related party transaction. You understood what I'm trying to tell? However, there is an exception. If in case disclosing a specific transaction under related party transaction, if it is going to arise questions on NDA, non-disclosure agreement, or know your customer documents, bank would have collected a lot of documents based on KYC. They cannot say this is a related party and disclose all the information. No. If NDA or KYC is there as per the statute, though it is a related party transaction, disclosure is not required considering NDA. Not you cannot say every transaction has NDA. I've invested money in you, but I'll sign one NDA. You don't disclose it to anyone. That doesn't work. It should be based on the statute that NDA agreement is. If it is valid, then it can be considered that though it is a related party transaction, it need not be disclosed separately. I hope you understood. Tell ya. Very good. Then state controlled enterprise. If there is any state controlled enterprise like BHEL, BEML, BSNL, MTNL, with these entities, if you have related party relationship, no need to disclose. Why? They are not trying to hide anything. They are trying to be very transparent. It's a public sector enterprise. There is no inside profiteering happening there. Then there is no applicability of AS 18. Why? BML and BSNL might be related. MTNL and BSNL are related. Do they start showing all the transactions separately? No. Here they make more profit or here they make more profit. Both of it will go to government only. So there is no need to apply related party relationships for state controlled enterprises. And when there is conflict of KYC, know your customer or know your client documents, as well as NDA, non-disclosure agreement. And last point to note, listen to this carefully. Whenever there is related party relationship for certain period of the year, not the full year, then at the end of the year, they are still considered related parties. Let's say April, May, June, related party. July to March, not related parties. On 31st of March, when you prepare financial statements, it is prepared from April to March. During that April to March period, at least some days, were they related parties? Yes. So what should they do? Should they prepare, should they disclose? Yes. Sir, but as on 31st of March, they are not related parties. During the year, at any point, if they are related parties, it has to be disclosed that they are related parties. Point number one. But transactions during the related party relationship period only should be disclosed. Let's say there are two related parties. They had transactions throughout the year. But April to June, they are related parties. July to March, they are not. Are they related parties on 31st of March balance sheet date disclosure? Yes. But are they holding related party relationship? No. Should we disclose transactions? Yes. Entire year transactions? No. Only April, May, June. During that related party relationship period, whatever transactions happened, only so much has to be disclosed. So what is the disclosure requirement? Name of the related party, relationship with the related party, nature of the transaction, amount of transactions, amount written off, amount balance, everything has to be disclosed on the balance sheet date. This year, 25-26, April, May, June related party. After that, no. 31st of March 2026 should disclose. 31st of March 2027, no need. Why? From 1st of April 26 to 31st of March 27, throughout there was no related party relationship. So no need to disclose. I hope everybody got it. Very good. Let's quickly go to the next standard. Any doubts that you would have on this? So please do revise study material based questions on this. Wouldn't take much time. One of the easy, funny standards, and you can finish it quick. Let's go to 4.5. Chapter 4, Unit 5. Age 20 earnings per share. One of the first good number based standards. As per accounting standard 20, earnings per share, we have to disclose two things in our statement of profit or loss. One, basic EPS. Two, diluted EPS. One, basic EPS, 2 diluted EPS. However, diluted EPS is not applicable to all the companies. We discussed in applicability part also. Another thing is diluted EPS, even if your company is a large company, to you it might not be applicable unless you have potential equity shares. I'll explain that part later. To begin with, EPS is very simple. Total profit of the entity is there. Total number of shareholders is there. You are trying to tell how much of the profit belongs to each shareholder. We'll take the net profit available to equity shareholders, divide it by number of shares. That's how we arrive at earnings per share. We'll take net profit available to equity shareholders, divide it by number of shares, and that's how we arrive at earnings per share. I have a question to begin with. Whenever we say net profit available to equity shareholders, let's say there is profit after tax of 1 lakh. Tax is already deducted. There is preference dividend of 10,000. Now, for identifying EPS from profit after tax, should I deduct preference dividend and then take in the numerator, or should I take it before deducting preference dividend? I should take it after deducting preference dividend. When we say EPS, it is to equity shareholder, it is not to preferential. Everybody understood? It is to equity shareholder, not to preferential shareholder. If my profit after tax is 1 lakh, if my preference dividend during the year is 10, deduct that 10. Only 90,000 is available to equity shareholders, and that will be numerator. Point number 1. Point number 2. Listen to me carefully. We have transferred 15,000 rupees to general reserve. Okay. Now from this 90, should I deduct 15 and then divide by number of equity shares, or should I take it before deducting 15,000? I should take before deducting. Sir, but I can't give dividend I've transferred. I'm not talking about dividend per share. I'm talking about earnings per share. Earnings is very different from dividend. So if we have 1 lakh as profit, 10,000 is preference dividend. From 1 lakh deduct 10,000 preference dividend. Dama 90. If you are allocating 15,000 to general reserve, may it be statutory reserve, may it be CRR, may it be DRR, may it be any other mandatory reserve, I don't care. After paying preference dividend 75,000, divide it by number of shares to find EPS, then you transfer it wherever you want. I don't care. I hope you understood. This is usually ignored adjustment, but must know adjustment. Second adjustment in the numerator. Am I making sense? Okay. Second important adjustment in the numerator is pretty simple. Let's say there are cumulative preference shares. What do you mean by cumulative preference shares? Preference shares for which dividend, if it cannot be declared in the current year, it will be declared in the year of profit. If the profits are not sufficient, or if there is no profit, dividend can be postponed to the later year. They don't have to give dividend this year. Let's say there is loss this year. Next year, they'll give previous year dividend and current year. They'll give 2 years dividend. If they have such kind of a right, what do we call those preference shares as? Cumulative preference shares. Now, this year, I have profit of 1 lakh. How much profit? After tax, before preference dividend. Preference dividend is 10,000. But it is in arrears for last year also. And this year I made profit. Last year I did not. Please tell me, in the current year, from 1 lakh rupees profit, would you deduct 1 year preference dividend before computing EPS, or would you deduct 2 years preference dividend before computing EPS? Think. How many of you think 1 year? How many of you say 2 years? Usually the logic makes you feel like 2, no? But the answer is 1. The reason is pretty simple. You say, sir, but they're giving 2 years dividend. Yeah. They're giving 2 years dividend. They're only paying 2 years dividend in current year. Cumulative right condition is like this. Let's say there is an year in which they make loss. Year 1 they make loss. They will announce dividend saying that it will be paid in next year. So in the previous year, loss of 50 minus 10,000 dividend, profit available to equity shareholders is minus 60,000 divided by, let's say, 10,000 shares. Minus 6 is previous year CPS. In previous year, even if there is loss, you compute EPS. Earnings is not always positive. Earnings can be negative. So EPS can be negative. In the last year, when the earnings is 50,000 minus, 10,000 preference dividend will be deducted from that minus 50, making it minus 60. Then they'll divide by number of shares and then they'll find EPS. In the current year, you might pay dividend for 2 years for preference, but still deduction is only 1 year. From the current year profit, you deduct 1 year dividend of preference dividend, and then you get profit available divided by number of shares. Identify earnings per share. I hope you understood. On this topic, there are no questions in your study material anywhere. CA inter level, there's been no questions asked. Study material cover to cover a period you don't get, but is this part of the standard AS 20? Yes. Can there be question on this? Someday. I can't tell you today, I can't tell you tomorrow, someday. CA inter paper is not difficult. There is one question or two questions that will come every time, which is not there in the study material. Question is not there in the study material, but concept is there. On the concept, they'll ask the question. And what do we say? We say paper is difficult. Why? Because we read that book and then we went for the exam. You got it? So that's the difference between paper being called difficult, paper being called doable. So you should know these things which are there in the standard, but on which question is not given in the study material. When you prepare for this, when others keep complaining the paper to be difficult, you will silently write the answer and walk out with a smile. Not with attitude, but with smile. Okay, let's get back. When we look at numerator, earnings available to equity shareholders, I told you, you need to deduct interest, you need to deduct tax, you need to deduct preference dividend for only current year. That's how you get numerator. Numerator is happy and comfortable. There's no problem with numerator. I hope you are right. Read this. Preference dividend will get added. Will get added in case of loss. That previous year mein loss will become more. Loss of previous year is 50,000. Preference dividend 10,000. So numerator will become 60,000 for last year. Loss of 60,000. I hope you understood. Then arrears of preference dividend for earlier years is not adjusted. Only current year dividend is deducted from the profit to find EPS. Then appropriation of any reserves is not to be adjusted. I hope you understood the numerator clear. Can I go to denominator? In financial management, EPS is very easy. They'll give you number of shares, you take it. But in accounts, we don't take things prima facie. We need to ask ourselves, yes, I agree, this is the number of equity shares that is there. But was this the number of equity shares that is there throughout? No. Beginning of the years, there were different number of shares. During the year, some shares have been issued, some shares have been bought back, some shares have been redeemed, some shares have been bonus issue given, right issue, several things have happened. And at the end, we have certain shares. What to take? We should not take shares at the end of the year. We should not take shares at the beginning of the year. We should not take simple average of the shares. We should take weighted average number of equity shares in the denominator. What should we take? Weighted average number of equity shares. When I mention weighted average, weight is given to what? Two things. One, time. Two, value. One is time. Two, value. Time means certain number of shares are there for certain number of months only. You should take time based weight. Value, certain number of shares are 10 rupees, certain number of shares are 8 rupees. We need to give value. 10 and 8 also should be represented in the denominator. 10 rupee share and 8 rupee share are not same. 10 rupee share is counted as 100%. 8 rupee share is counted as 80%. Multiply 100% with number of 10 rupee shares. Multiply 80% with number of 8 rupee shares. Take the total. That's how we find weighted average number of equity shares. Now, what would I do? I'll show an example and I'll show the theoretical statement. I'm not going to solve, but I'm going to show an example with the numbers, just for you to match that theory what we read. Focus on the first one. Fully paid up share to be taken at 100% value. Fully paid up share to be taken at partly paid up share to be taken at the percentage paid up if those partly paid up shares are eligible for dividend. I'll repeat. There is a 10 rupees share, 10 rupees paid up, take it in the denominator, there is no problem. There is a 10 rupees share, 8 rupees paid up, and the company has mentioned that shares in their company are not eligible for dividend till the time they become fully paid up. What have they mentioned? Shares in their company are not eligible for dividend till the time the shares become. Then what do? In that case, those 8 rupees shares, 10 rupees share, 8 paid up are never part of our denominator till the time they become fully paid up. I have 10,000 shares of rupees 10 each fully paid up. I have 10,000 shares of rupees paid up. 5,000 shares of rupees 10 each, 8 paid up. Denominator will take only 10,000. This 5,000 shares you ignore. Why? They mentioned no, these shares are not eligible for dividend unless fully paid. What if they don't give that condition? They say they are also eligible for dividend. Then this 10,000 shares into 100%, 5,000 shares into 80%. You take the total. That becomes denominator. I hope you understood this. Quickly read these two lines. Fully paid up to be taken over at 100% value. Partly paid up, percentage paid up to full value. Partly paid up equity shares are considered only if not eligible for dividend, then considered as potential equity shares, but they are not considered in basic EPS. I hope everybody understood. Let me show this part to you. I'll explain it to you with the help of an example. This example won't be there in the PDF that will be shared later, but you can see this example. I'll tell you which question we will do for those who have the material. We'll do this question, AQ5 in our book. Okay. For those who are watching it on YouTube, this is the question for you to take a screenshot of. Yeah. What is the question? How much is the profit available? 10 lakh. What is the profit available? 10 lakh. We have 10,000 shares of rupees 10 each fully paid up. We have 10,000 shares of rupees 10 each, rupees 8 paid up. We have 10,000 shares of rupees 10 each fully paid up. We have 10,000 shares of rupees 10 each, rupees 8 paid up. When we have to find denominator, no, here two things have to be kept in mind. Number one, these 10,000 shares which are partly paid up were issued on 1st of October, not on April. These first 10,000 shares are there from April to March. This 10,000 shares only came in October and they're there till March. Additionally, these 10,000 shares which were issued in October, they are not fully paid up. They are only rupees 8 out of 10 paid up. What to do? Very simple, yeah. Opening 10,000 shares are there, no, take them for 12 months, 100%. Then this issued 10,000 shares are there, no, don't take for 12 months. Take from 1st of October to 31st March. October, November, December, January, February, March. How many months? 6 months. And don't even take full 100%. They are 80% paid. Do 10,000 into 6 by 12 into 80%. 4. Denominator will become 14,000. There's another way to do, but do the first one. Not the time to explore and learn two methods. Right? 14,000 in the denominator, numerator 10 lakh. You do 10 lakh by 14,000, 71.43 is EPS to be disclosed. Will we disclose 2 EPS or 1 EPS? 1. Why? There is only one class of shares. Shares of 10. Yeah, I agree. Some of them are partly paid up. But today or tomorrow, I will ask for 2 rupees. I will collect 2 rupees. They will also become fully paid up. So, think and tell me, how many EPS will we disclose in P&L? Only 1. That brings us to the next question. When will we show 2 EPS in P&L? When there are 2 different class of shares. When there are 2 different class of shares. Have a look at this second part. Different nominal value. Some equity shares are 10 each fully paid up. Some equity shares are 5 each fully paid up. I am not telling you 10 rupees share, 5 rupees paid up. Nominal value 5, paid up 5. 10 rupees shares are nominal value 10, paid up 10. In this case, there are 2 different classes of equity shares. We will have 2 EPS. How many EPS? 2 EPS. What do we do? To compute, no, we will find 1 EPS and then make it into 2. What to do? We have 10,000 shares of rupees 10 each fully paid up. We have 10,000 shares of rupees 5 each fully paid up. Either convert this into this or convert this into this for time being. 10,000 shares of rupees 10 each. If I convert it into rupees 5 shares, it will become 20,000 shares of rupees 5 each. 10,000 shares of 10. 10,000 into 10 is how much? 1 lakh. 20,000 shares of 5, 1 lakh. Now 20,000 shares of 5 equated, time being. 10,000 shares of 5. Together it is 30. 30 will be taken in the denominator. And we will find EPS. When we find EPS, that EPS is for shares of 5. For them it is correct. For these people it is not. For them, 2 equity shares will become 1. So add up 2 EPS to make it 1. That's how will be EPS for 10 rupees share. That's how it will be EPS for 5 rupees shares. Alternatively, you can do one more. Rather than converting 10,000 shares of 10 to 20,000 shares of 5, keep this as 10,000 shares of 10. These 10,000 shares of 5, make them into 5,000 shares of 10. Then total denominator will become 15. 15 you take in the denominator and then find EPS. You will find EPS of shares of 10. For this it is correct. For this, divided into 2. So divided by 2. I hope you understood. Read that statement. Whenever there is different nominal value, what should we do? Equate it to common nominal value. How to do? Let me show a question. This is the one. There you go. Question is AQ3. You have it in your class notes. For those who are watching it on YouTube, you can take a screenshot of this because we're going to discuss the answer of this. So, how much is profits available? 10 lakh. There are 2 classes of shares. 10,000 shares of rupees 10 each. Another 10,000 shares of rupees 5 each. There are 2 classes. What will I do now? First, I'll equate them. Let's focus on this method. Okay, let's not see the other side. Let's see only this side. What do? I'll take 10,000 shares of 10 each as 1 lakh. Another 10,000 shares of 5 each as 50,000. 10,000 shares of 10 each 1 lakh. 10,000 shares of 5 each 50. Together that becomes 1 lakh 50. 1,50,000 is the total value. I'll divide it by 10. I'm equating everything to be shares of 10. If all the shares were of 10 rupees, how much will it become? 15. Understood? So I will divide 10 lakh by 15 and find EPS as 66.67. 66.67 is the EPS if the shares are of rupees 10. But we have both classes shares, no? For 10 rupees shares it is 66.67. For 5 rupees share it will be half. 66.67 into 5 by 10. Half. into 1 by 2. It will come down to be 33.33. It will come down to be 33.33. Did you all get this? Say something.
Yes, sir.
Very nice. You could have done alternative also. Instead of converting them to shares of 10, you could have converted them to shares of 5. Please don't judge based on the speed. This speed is assuming that you people have read everything once. Okay, let's go. We have just done with different nominal value. Next, let's understand bonus issue, share split, consolidation. Bonus issue is different, share split is different, consolidation is different. All the three are different scenarios, but EPS in all the three circumstances is same. What is bonus issue? Bonus issue is free shares issued to existing shareholders of the company. What is share split? Share split is one share of the company being split into multiple. 100 rupee share is split into 10 shares of 10. That is share split. What is consolidation? 10 shares of 10 each have been combined into one share. That is consolidation. Opposite of share split is consolidation. Giving free shares is bonus issue. They are not same. Let's say you have one share of rupees 10. I give you one more share of 10 free. The nominal value of the share in your hand is 10. I give you one more share of 10 free. That is bonus issue. Share split is that one share of 10 what you have with you. I will cut it into two shares of 5. What is it? Split. What is consolidation? You will have 10 shares of 10 each with you. I will merge them into one share of 100. Consolidation. Common thing in all the three cases is there is no 1 rupee received, there is no 1 rupee given. There is no cash involved. Is there cash involved? It is just within the shares the composition is changing. So whenever bonus issue, share split or consolidation happens in the year, irrespective of the date on which it happens, take it for full 12 months. Year starts in April, year ends in March. Year ends in, let's say the bonus issue happens on 1st of January. Only 3 months now after bonus issue. Before that there were 10,000 shares. After bonus issue, let's say there are 15,000 shares. 5,000 shares were given away as bonus. When you compute EPS, you usually do 10,000 into 12 by 12. 5,000 into 3 by 12. Usually that's what your mind says. That's not what you should do. Because you don't receive cash. It is reserves taken and put it into capital. Those shareholders were there in the form of reserves. Now it is being capitalized. So 15,000 shares is to be taken for 12 months. You will not do 10,000 into 12 by 12, 5,000 into 3 by 12. No. 15,000 into 12 by 12 or 10,000 into 12 by 12, 5,000 into 12 by 12. Those shares were issued on 1st of January. It is computed for full year. Whether it is bonus, whether it is share split, or even if it is consolidation, we compute it for full period. We compute it for, everybody understood this? We don't just stop there. Now let's say this year from April to December, how many shares were there? 10. In January, I issued 5,000 shares additionally, bonus. It became 15. 31st of March when I compute EPS. April to March profit divided by 15,000 shares. Am I right? For full year. Previous year, EPS would have been computed considering 10,000. And that becomes a comparative for comparing with the current year EPS. That comparative is incorrect. So what do we do? Original EPS of the previous year is keeping 10,000 shares in the denominator. We need to restate that to current year by dividing the previous year profit with current year number of shares. That becomes restated EPS. Restated EPS is only for comparison and decision making purpose. In the previous year balance sheet, there will be original EPS in the previous year PL. In the current year PL, for previous year column, we show original EPS to compare with the previous year, and I give restated EPS to compare it with current year profits. I hope everybody is getting it. Let's see a quick question on this. I'll show you what to do. Bonus issue. First one is EPS with reserves. Second one buyback. Third one different class. Partly paid up, partly paid up. Stages of call. One moment. Stages of call. Bonus shares. See this. How much is the profits for previous year? Current year 10 lakh. Previous year 8 lakh. For those who are watching it recorded, you can take a screenshot. This is the question that I'm just discussing now. So the profits are 10 and 8. And previous year throughout there were only 10,000 shares. Current year there were 10,000 shares till 1st of July. On 1st of July I have given 2,500 shares as bonus. Current year I have given 2,500 shares as bonus. When I do this, how do I find my EPS? Last year is simple, 8 lakh by 10. Current year 10 lakh divided by, what is denominator? You feel like taking 10,000 into 12 by 12. and 2500, not 12 by 12, from July to March. Don't do that. Take 12,500 into 12 by 12. Even when you compute time-based average, though the bonus issue happens on 1st of July, you need to take full 12 months. You need to take full 12 months. So you do 2,500 into 12 by 12, 2,500, 10,000 into 12 by 12, 10,000, 12,500 shares is the denominator. I have given a point here. Current year, consider full year for wins irrespective of the issue date. At every question, we have written all enough realize. If you write it at one place and then read also, it will be very handy. Okay, 12,500 will come in the denominator. How much is the profit? 10 lakh. How much is denominator weighted average number of shares? 12,500. You please divide. What do we get? 80 is EPS. Current year 80 is EPS. Previous year 8 lakh divided by 10,000. What is current previous year EPS? What is previous year EPS? What is current year EPS? I'll tell you the problem. Now if you compare previous year to current year, you will say previous year also 80, current year also 80. So there is no progress in the company. Is it so? No. Previous year profit is 8 lakh. Current year profit is 10 lakh. Profit has increased by 2 lakh. Do 2 lakh by 8 lakh? 1/4, 25% increase in the profit. But EPS is not showing it. Someone takes decision based on EPS. They will take wrong decision. No, that's not correct. So what should we do? We should restate our previous EPS considering the denominator as not 10,000 but 12,500. Now do 8 lakh by 12,500. 64. Last year EPS is 64. This year EPS is 80. How much is increase in EPS? 16. Do 16 by 64. 1/4. 25% increase. So profits increase by 25. EPS has to show increase in 25%. In the last year PL, what will be EPS? 80. In the current year PL, we will show 80 as original EPS. We will show 64 as restated EPS. Meaning it was 80. It is restated to 64 only for the purpose of comparison. Only for the purpose of. Did everybody get this? This with regard to bonus issue. Then let's go to the next one. Am I going very fast? Okay, I hope you people are getting this. Let's go to the next adjustment for weighted average number of equity shares. This is my favorite. Right issue. What is it? Right issue. Right issue, how we do is slightly different from how it is there in the study material. There you do right factor. I don't want you to do right factor. That you do one fraction multiplication to the number of shares. Don't do that. When you do that, you are only mugging up a formula and you are not understanding the logic behind it. I want you to decode right issue into this way. Bonus issue is issue of free shares. Right issue, is it issue of free shares? Answer is no. This is crucial part, important for the next 2 minutes. Right issue is issue of shares, not free. But is it at the market price? No. Let's say the market price of a share is 150. That's the price at which anybody can buy in the market. If the company offers right shares, it cannot offer at 150. It has to offer at a price lesser than 150. Just mentioning, right issue is issue of shares to existing shareholders of the company. What is right issue? Issue of shares to existing shareholders of the company. Why does the company issue shares to existing shareholders of the company? To help them maintain their percentage of holding. Let's say somebody has 20% stake in the company, somebody has 30, somebody has 18, somebody has 40. If I ignore you and give the shares to others, 20% will become 18, 18 will become 15, 4% will become 2%. Your percentage holding in the company will reduce. So in order to ensure that you can maintain your percentage of holding, company offers the existing shareholders to buy the shares in the company to maintain their proportion. When they offer, it will be at a price slightly lesser than the market price. That's right issue price. So when they offer at a price slightly lesser than the market price, there is an element of bonus. Why? Are they offering it to everyone? No, to our shareholders. So to our shareholders, I am offering something less. So there is an element of bonus. We need to identify how much is bonus element, how much is cash element. Cash element is like any other normal issue. Take it for the date of issue to year end. Bonus element, though it is issued at the middle of the year, take it from the beginning till the end. I'll repeat. Whenever there is right issue, cut it into two parts. Some shares are given free. Some shares are given for full consideration. Usually right issue is given for slightly lesser than market price. But I am dividing it into two parts. Some shares are given free. Some shares are given for full consideration. Shares given for full consideration, full period. Shares given for free. Shares given for free, full period. Shares given for consideration, from the date of issue. For this, we need to find theoretical ex-right price. What is theoretical ex-right price? Price in the market after right issue. What is theoretical ex-right price? Price in the market after right issue. How do we find it? Very simple. Number of shares that we held before multiplied by cumulative market price. I'll repeat. Number of shares that we held before multiplied by cumulative market price. That's one side. Plus number of right shares multiplied by right issue price. I'll repeat. Number of shares held before multiplied by cumulative right price. That's one side. Other part is number of right shares multiplied by right issue price. Numerator. In denominator, number of shares held before plus right shares. If you do it, you will get the theoretical ex-right price. The price that should prevail after right issue. Then what to do? Take number of shares, number of right shares multiplied by right issue price, you will get total value. Divide that by theoretical ex-right price. Whatever answer you get, that is cash consideration. Balance shares are given free. I'll repeat. Number of right shares multiplied by right issue price, you multiply. You will get the consideration. That is the consideration received. Divide that by theoretical ex-right price. When you divide, you get number of shares. For those shares, you received cash. Balance shares are given free. For shares given free, treat it like bonus from the beginning till the end. For shares given for cash, from the date of issue till the end. Read this right issue element. I'll show you how to do it in terms of a question. Please read it once. Could you read? I think it will make more sense when we see a question. Can we see an example? We'll do it. Don't worry. This is the question. I expect you to click a screenshot if in case you're watching this recorded back at home preparing for your exam. This is the question. Now I'll tell you what to do. Now, how many shares were there at the beginning of the year? Everyone respond. 10,000. How many right shares are given? 2,500. Cumulative market price is the price before right issue. Cumulative right price. How much is it? 20. What is the right price? I am a company. I am offering you 2,500 rights. How much money should you give me to buy that shares? For each share, you would have to give me 50. Right now in the market, what is the price? That is the reason when I offer it at 15, you tend to take. If I offer at 22, you'll be like, oh, I'll buy it from the market only at 20. Why should I come to you? Now, when you come to me and then you buy, for 4 shares you hold, I'll give you 1 share. Am I right? Your 4 shares are what value? 20. 1 share what I give is at what value? 4 into 20. 4 into 20 everyone. 1 into 15. 4 shares that you have is at rate of 20. 1 share what I am giving is at rate of 15. 4 into 20, 80. 1 into 15, 50. Divided by 5. 95 by 5. 19. What is 19? Theoretical ex-right price. The moment you buy my shares in the market, the price per share will become 19. Price per share will become, why? You bought it at 15. You try to sell now in the market because it is at 20. You want to sell and then make profit. Market doesn't let you book. It will average the price to 19 such that you cannot make profit by sale. Because now the supply has increased, price will drop in the market. It will drop till what? 19. Theoretically, it should drop till 19. If it drops below 19, some other reason. If it doesn't drop till 19, some other reason. Theoretically, it should drop to 19. Everybody understood? What did I do? How many shares did you have? How many shares did you have? 4. How many rights will I give? 4 shares at what rate? 1 share is given at what rate? 15. 4 into 20, 80. 1 into 15, 15. 80 plus 15, 95 divided by 5. 19 is the price in the market after right issue. But I am offering it to you at what rate? 15. Okay, why did I give it to you at 15? Because I have soft corner towards you because you are my existing shareholder. How many shares am I offering? 2,500. For 2500 shares, you pay 15 rupees, do 2500 into 15. You will give me 37,500 rupees. If I would have given you at fair value 19, how many shares should I give? 37,500 divided by 19. 1970. 1970. 73. I should have given you 1973 shares for the cash that you gave. You gave me 37,500. If each share is in the market at 19, I should have given you 1973 shares. But how many shares did I give you? 2,500. Do 2,500 minus 1973. 527 shares I have given it to you free. 527 shares I have given it to you free without collecting cash. Now when you compute weighted average number of shares, for 527 shares, take 12 by 12. For 1973 shares, take from 1st of October to 31st March. This is the logic. But we don't want all that. We will do adjusting factor. But why? Don't know. Study material they have done. Exam also we will do. And when you do that in the exam, there is a high tendency of forgetting things because you are mugging up something without logic. Logic will be remembered. Logic doesn't need recall. Can be recalled very easily. But if you mug it up, recalling will become little difficult. And revising entire syllabus the day before exam is the major reason why people find it difficult. It's not because they don't understand. It's because revising everything the day before exam is very difficult. Now let's see the same thing what I thought you know. What did I do at first? At first, I computed theoretical ex-right price. How did I find theoretical ex-right price? 4 shares before bonus, before right issue at 20, 80. 1 share right issue at 15, 15. 80 plus 15, 95. 95 divided by 5, 90. Theoretical ex-right price is 19. Observe, theoretically right is at 19. But the company is offering it to you at 15. Company is offering you the share at a price lesser than the market price. There is an element of bonus. Bonus element should be taken for entire period irrespective of the date of issue. And right or cash element should be taken from the date of issue. What do we do? Number of right shares being offered 2,500. Price 15. I'm sorry. Price is 15 and the rate becomes 37,500. Am I right? Total amount becomes 37,500. 37,500 if you give at the fair value of 19 rupees per right, divide 37,500 by 19. I should have offered you only 1974 shares. I have received cash for 1974 shares, but I actually gave you 2,500 shares. Out of 2,500, I have received cash for 1974. 526 shares I have not received cash. That becomes bonus. For 526 shares, we computed for 12 months. For 1974 shares, we computed for 6 months. Did everyone get this? Say something. That's it. This is what I want you to note. Consider bonus element of right shares in variance for from the beginning of the year, irrespective of the issue date. For restating EPS also, we should consider this. We should restate the previous year EPS for this 526 shares. In the previous year's EPS denominator also, we should add 526 and then complete. Understood this? This is how you skip that adjusting factor, but still do the question logically. Okay, good. There were a couple of questions in the past, in the past examinations in AS20. You can practice that questions on this, right? And I'll tell you the reason why you should do right issue this way. When you come to do ESOP, if you observe, the way the answers are usually given in the material is right issue computation is different, ESOP computation is different. But if you do right issue like this, same logic can be applied for ESOP in diluted EPS also. In fact, it will become much simpler then, because there is no concept of theoretical ex-right price also, no? There is no fair value. Okay, proceed. Let's see right issue done. Amalgamation based questions. This is not there, but looking at the way paper is tested, where they ask these case study questions, 2-3 accounting standards overlapped. One fine day, it's matter of time, next to 2 to 3 attempts. One attempt, they'll ask one question where there is amalgamation and EPS together. A Limited, B Limited got amalgamated into forming new company called AB Limited and compute its EPS. Some 2 marks MCQ. Then you will say, IIO, I know 14, I know 20, I don't know 14 and 20 together. But you can answer. Very simple. Whenever you are computing EPS for an amalgamated entity at the end of the year, some shares will be there in that transferee company from the beginning. Some shares were issued to transferor company in the middle of the year during the amalgamation. When you're computing EPS at the end of the year for transferee company, in the denominator, how many shares to take depends upon the nature of amalgamation. If the nature of amalgamation was purchase, there is consideration. So, amalgamation-alli, whatever shares were given to transferor, those shares will be considered from the date of issue of that shares till the end of the year in denominator. However, If it is amalgamation in the nature of merger, then irrespective of the date of such shares being issued, those shares which were issued on amalgamation, compute them in the denominator from the beginning of the year. Let's say amalgamation happened on 1st of January 2025. Year begins 1st of April 2024. 31st of March 2025, when you're preparing P&L for transferee company post amalgamation, which is the number of shares that should be taken in the denominator? Because beginning of the year there were 1 lakh shares, and on 1st of January you issued 50,000 shares for amalgamation to transfer. What to take? If it is merger, though those 50,000 shares were issued in January and they were outstanding for only 3 months, take 50,000 for 12 months. However, if amalgamation is in the nature of merger, for those 50,000 shares also you take, if it is merger, take it from beginning. If it is purchase, take it for 3 months. 50,000 into 3 by 12. If it is purchase, 50,000 into 12 by 12. Basically 1,50,000 into 12 by 12. If it is merger. I hope you understood. Is there any question of this type in CA Inter ever? No. Study material? No. But someday I am expecting. When? I don't know when. Someday. Some attempt. Okay. Then that day, some other method. Come on. Let's go to convertible preference shares and convertible debentures. If there is some debenture or preference share with the right to get converted to equity share, they are not part of denominator. They have not become equity share yet. They will not be considered. The day they get converted, from that day we would have to consider them in the denominator. Did you understand this? Very nice. What about employee stock options? There is just options. Yeah. There are no obligation that we have to give shares to them. On fulfillment of condition, on payment of certain consideration, we will give them equity share. The day we give them equity share, consider them in denominator. Today, don't. I hope everyone understood. So these two are potential equity shares. They are not equity shares. Don't consider them in denominator. I hope everybody got it. Let's talk about the second part of the standard, which talks about the diluted EPS. Diluted EPS, how does it work? See, diluted EPS is not actual. It is in our imagination. There are some people who are actually not equity shareholders, but they have the potential to become equity shareholders. For example, they have convertible debentures, or they have convertible preference shares, or they have employee stock options. If those debentures or equity shares gets converted to equity shares, or if these ESOPs are issued and they exercise, they become equity shareholders. When they become equity shareholders, they sit in denominator. So when the profit is divided among the shareholders, there are more shareholders, so EPS will reduce. Do you agree with me? So the existing shareholders are scared. Oh my God, my EPS will reduce when those debentures get converted. Oh my God, my EPS will reduce when those preference shares get converted. They're thinking, is it converted? No. It might get converted next year. This year only they are scared. Then the accountant will tell, hey, nothing will happen. I will tell you, worst come scenario, how much will be EPS. Even if they get converted, what will be your earnings? You will not lose everything. You might lose something. What will be your EPS if they get converted to equity shares? That's dilutive EPS. There is convertible debenture considered in dilutive EPS. Convertible debenture is already converted to equity share. That will be taken in basic EPS, not in dilutive EPS. You understood? As of now, there is a preference shareholder. So what do? You take profit available to equity shareholders, deduct preference dividend. Then you get profit available to equity shareholders. Then you divide by number of equity shares to find EPS. If that preference shareholder is now become equity shareholder, then he will become part of the denominator, meaning you don't have to pay him preference dividends. Profits available to equity shareholders is before paying preference dividend. Why? If he is preference shareholder, I pay him preference dividend, then compute EPS. If he becomes equity shareholder, I no longer have to pay him preference dividend. Then my numerator will increase, denominator will increase. That new numerator, that is profit available to equity shareholders plus preference dividend. Number of equity shares plus preference shares converted to equity shares. When I do, I get one EPS. If that EPS is lesser than the earlier EPS, then it is dilutive in nature. If that new EPS is more than the previous EPS, it is anti-dilutive. That need not be disclosed. When should we make disclosure? Only when it is dilutive. You are all existing shareholders. You are getting 10 rupees earnings, but you are scared. People who are outside, no. If they come inside, you will get lesser earnings. I have this much profit. I'm going to share it to all of you. Right now, how much will you get? 10. If they come inside, I would have to give it to them also. Then you might receive less. No, you are upset. I won't get. I'm like, no. Even if they come, you will get 8 rupees. That is dilutive EPS. Have they come? They are there only. Telling if they come, you will still get 8. But when they come, they won't come empty-handed. They will also bring some profit, which is otherwise their share of dividend or interest. When they bring it back, my profit will increase. Number of people will also increase. Then I share. Let's say what if it becomes 11? Then you are happy. Conservatism. Don't disclose anti-dilutive EPS. Disclose only if it is dilutive. Now I'll show how to deal with this convertible preference shares. What to do? Read this first. Add back dividend. Preference dividend is there, no? Add it back to profits available to equity shareholders. Denominator, you take the potential equity shares, that is preference shares. Let me show dilutive EPS. See, if dilutive EPS is lesser than the regular EPS, disclosure has to be made. If dilutive EPS is equal to regular EPS, it is not to be disclosed. And if dilutive EPS is more than regular EPS, it is not dilutive in nature, it is anti-dilutive in nature. Understood that? Now let's look at this preference share portion. How much is profit available to equity shareholders? When I say profit available to equity shareholders is 90 lakh, it is after paying preference dividend or before paying preference dividend? After paying preference dividend. How much is the number of equity shares that they have not given? If they would have given, I would have divided it by them and to find my EPS. But there are some convertible preference shares, meaning today they are preference shares. One day they will become equity shares. They are potential equity shares. What are they? They have the potential in them to become equity shares, but as of now still they are preference shares only. Let us imagine that they are no longer preference shares. They have become. If I assume that they have become equity shares, I don't have to pay them preference dividend. This profit of 90 lakh is after paying preference dividend. See, there was some profit, I don't know how much. From that I have deducted dividend, then I have arrived at this. How much is the dividend that I would have to pay them? On 1 crore 20 lakhs, 10%, which is after paying 12, if it is 90, before paying 12, it is 1 crore 2. Right now for EPS, am I considering 90 or 1 crore 2? 90. Why? They are preference shareholders and I paid them dividend. If I convert them to equity shareholders, then numerator will be 1 crore 2. Why? Preference dividend is 0. Sir, why is it 0? Because they are no longer preference shareholders, they have become equity shareholders. Diluted earnings is 1 crore 2. I'll divide it by number of equity shares plus potential equity shares because of convertible preference shares. Got it? What I compute then? If it is lesser than the earlier EPS, dilutive needs to be disclosed separately. So how to find diluted earnings? Very simple. To net profit available to equity shareholders, add back preference dividend. To net profit available to equity shareholders, what do? Add back preference dividend. Now we spoke about convertible preference shares. What if there are convertible debentures? Remember, profit before interest and tax. You deduct interest, you get profit before tax, then you deduct tax, then you get profit available to equity shareholders. When you remove this interest, profit will increase, tax will increase. That is the reason we call interest gives us tax shelter. Okay, so when we assume that debenture is no longer debenture has become equity share, we have to no longer pay debenture interest. When we have to no longer pay debenture interest, our profit increases, tax increases. Sir, then what to do? Very simple. Profit available to equity shareholder is there, after tax. To this, add back interest. How much is interest? 1 crore into how much percentage? Okay, they have given 6 lakhs. How much is interest? But when 6 lakh is no longer supposed to be paid as interest because they have become debenture holder, 6 lakh becomes part of your income. When 6 lakh becomes part of your income, income tax department will ask me, so you give 30% of 6 lakh. 1 lakh 80 you pay. So when you add 6 lakh, deduct 30% of it and add. So how much is diluted earnings here? 85 lakh 50 plus 6 lakh minus 30%. Interest into 1 minus T. That's what you do in FM also, no? When you add back interest, you add it back net of tax. 1 minus T. So 6 lakh minus 30% is how much? Add 4 lakh 20 to 85 lakh 50. That will become your diluted earnings. You add back interest to the profit because your debenture holder is now an equity shareholder. That interest what you don't have to pay will become profit to be added to the profit, net profit. But because that additional profit has come interest, on that first you pay tax and only balance gets added. So you need to add interest net of tax. Interest into 1 minus T to be added to numerator to find the diluted earnings as the brand new numerator. And denominator is simple, that convertible preference shares, convertible debentures, assume them to be equity shares and then take it. How much ever ratio is there? 1 for 10, 1 for 4, 1 for 3, whatever. This is with regard to debentures. Last part, employee stock options. Can I discuss employee stock options last part? Before that, sometimes no, they would mention interest amount. They would mention percentage. They would mention nominal value. It will not sit correctly. Check this question. 8% convertible debentures 1 crore, but interest amount is only 6 lakh. Do 8% of 1 crore? 8 lakh, but actually interest is how? That means interest is P into T into R. No, P 1 crore, R 8%, T is less than 12 months. So meaning debentures were issued not at the April month, it was issued sometime later. So we have to take that time period. You compute interest is equal to P into T into R. 6 lakh interest at 8% on 1 lakh will be found if the time period is 9 months. So those debentures are there only for 9 months. When you take the denominator number of potential shares, take it for 9 by 12. Take it for 9 by 12. Be cautious. There is one question in the study material also similar to this, and there was one question in the old scheme before May 24 in the exam this way. We've done this in the class, but I hope you people get this part. Then let's do the last part, employee stock options. This is no different. This is exactly like how we do our right issue. You can take a screenshot of the question and you can also look at the question. Whenever you have glared at the question, let me start with the discussion of the answer. Everyone's ready? How many shares are there? 5 lakh. How much is the profit? 12 lakh. 12 lakh by 5 lakh. 12 lakh by 5 lakh. 2 point. That is your basic EPS. That is your, to find dilutive EPS, the dilution here is because of stock options. How many options are outstanding during the year? There are 1 lakh options waiting to be converted to equity shares. Waiting to be converted to equity. Do they get converted to equity shares free? No. They pay money. How much do they pay? 15. How much do they pay? But in the market, the price is actually 20. If they were not our employees, if I don't know them, they were supposed to pay 20 rupees. But because they are our employees, they now pay only 15. Just by paying 15, they get equity shares in the company. Now do me a favor. How much will employees pay? 1 lakh into 15. 15 lakh. 1 lakh into 15? 15 lakh. In 15 lakh, we are giving them 1 lakh options. But if we had given them a fair price, we should have charged 20 for each. Divide 15 lakh by 20. 75,000 shares we are collecting cash from them and then giving them. Are they potential shares? No. Cash is kotre angry potential agate. Cash is without collecting cash if we give, that's when it is potential. Out of 1 lakh options, 75,000 options are given free. Free. They are not potential shares. They will be considered in basic EPS. When? After the shares are issued. Today, ignore. How many options are we offering? 1 lakh. In that for 75,000 we collect cash, no? 25,000 options we are not collecting cash. We are still giving them. Why? Because they are our employees. So I can say out of 1 lakh options, 25,000 are potential equity shares. How much is potential equity shares? So what do? In the denominator when I'll take 25,000 for full 12 months as potential shares. How did I do it? Same. Exercise price 50, options 1 lakh, value 15 lakh. 15 lakh is the value divided by fair value 20. For 75,000 shares I collect cash. They are not considered potential equity shares. They will be considered in the denominator after the date of issue in basic EPS. But because I will never collect cash for 25,000, but I'll still issue them. I'm not issued, but I'll still issue them later. They'll become potential equity shares. This becomes part of my denominator. One last point that I want you to note when it comes to dilutive EPS is employee stock options are always dilutive, whereas other two are not always dilutive. They can be dilutive. And whenever there is a question with all three in it, we would have done question with preferences. We could have done a question with debentures. We would have done question with ESOP. There is no such question in the study material. But what if they give all three in one question? Then don't do all of them at once. Individually you check which of them are dilutive. Check the increased earnings, increased number of shares in denominator, write them in the ascending order, give them ranking, and then see stage wise dilution. The stage at which it is dilutive, you go further. The stage that becomes anti-dilutive, stop there. Because there are three varieties of potential shares in one company's balance sheet: convertible preference shares, convertible debentures, ESOP. When all three are there together, some of them might be dilutive, some of them might be anti-dilutive. decide and consider only dilutive potential shares in dilutive EPS computation, not all. I hope you understood. Such kind of question is not there anywhere, but just be mentally ready if in case it comes. By this, we have successfully completed Chapter 4, Unit 5, Accounting Standard 20. Now, we finished Accounting Standard 20, Earnings per Share. Let's now go to fourth chapter, 6th unit, which deals with Discontinuing Operation. Very cute, sweet little standard. There has never been a standard smaller than this. There can never be a standard smaller than this. Not very significant. There are no computations involved in this standard. Recently, like we were discussing, there was a 2-marker question MCQ from this. You would be lucky enough. If you are lucky enough, you might get one more. So this standard talks about discontinuing operations. When you prepare your statement of profit or loss, you write revenue from operation, other income, total income. You write expenses, you write total expense. You find profit before tax. You deduct tax, you find profit after tax. You do all that. There you show profit before exceptional extraordinary items. Then exceptional items, profit before extraordinary items, profit after extraordinary items. Then you find that is profit from continuing business. If you are doing any business which you have no intention to continue, you are expecting to discontinue that business next year. Let's say you have 4 operations. One of them you are expecting to not continue in the future. That is discontinuing operation. You need to differentiate this from the other 3. When you prepare PL, you will write P&L involving profit of continuing operations separate, of discontinuing operations separate. You in fact find earnings per share for continuing operations separately or discontinuing operations separately. Though I am discussing Accounting Standard 24, which is Chapter 4, Unit 1, Unit 6, let me take this liberty of taking you to Chapter 11, Unit 1, which actually talks about financial statements. Just for 2 minutes, come to financial statements. Here when you see statement of profit or loss, have a look at this. We say profit from continuing operations, profit from discontinuing operations will be computed separately. The reason is pretty simple. Some of the discontinuing operations will not be continued next year. That's the reason why it is discontinued. So when there is profits or losses that's coming from such operations which might not repeat next year, that you disclose separately, because people should know that this is there this year, this might not be there next year, this might not be there next year. I'm not telling you will, might not be. So disclose it separately. And you just need to know the definition of discontinuing operations, and you need to know when to disclose this discontinuing operations. Knowing these 2 is sufficient for us to proceed to the next standard. So what is the meaning of discontinuing operation? A component of the enterprise, a small part of the enterprise, by way of a single coordinated plan. There is a single plan. By that single plan, what are you doing? You are disposing it in entirety, selling that complete part to somebody. Let's say I do sales and service of automobiles. I want to sell, but I don't want to service. Service business will be completely sold to somebody, completely in one single transaction. That's a discontinuing operation by way of sale in entirety. Or demerger or spin-off. What is demerger or spin-off? Have an entity in which there is sales of automobiles, service of automobiles, together is one business. Now what I'll do, I'll break that company into 2. Merger means 2 companies coming together to form one. Demerger is dividing one company into 2. Now ITC did demerger, no? IHCL hotels into a separate company. Like that you can divide that, not IHCL. Yeah, ITC hotels, they divided it into separate part. So similarly what you can do is you can divide your business of sale of cars and sale of service of cars into 2 separate business by way of a single plan. If you're doing that, that is a discontinuing operation. If you're planning to do it next year, this year when you prepare PL, you should show continuing operations, that is sale of cars, separate. Discontinuing operations, that is service of vehicles, separately in your PL. I hope you got it. That is in Schedule 3. AS 24 will only tell what is discontinuing, what is not discontinuing operation. When should we disclose it? First. So by way of a single coordinated plan, because of sale, because of demerger or spin-off, or disposing in piecemeal. Disposing in piecemeal means all of a sudden I'm not disposing the entire business. Step by step, I will sell 10% of assets this year. I'll sell 20% of assets next year. I'll sell 30% of years in year 3. I'll sell the balance 20-30% in year 4. That way, in a phased manner. But I'm going to sell all assets in a piecemeal. Then also it's a discontinuing operation. But time bound up, then you should have one time frame. It should not be like 5 years or 10 years. Let's see where God takes. It's not like that. Clear plan. In 4 years, I'll dispose all the assets. You should have a plan. Either you sell everything by way of one agreement, create it into a separate company, or do a piecemeal by a time-based plan, or terminating through abandonment. Abandonment means that's it, over. I decided now and it's over. Tomorrow onwards, no business. Sale, no sale. Demerger, no. Now that's it. It's useless. Leave those assets. I won't even sell those assets. They'll be there only. I won't even continue the business. That is abandonment. You understood? So either by way of a single entirety plan, or by way of piecemeal, or by way of termination through abandonment, if I am going to wind up that entire component. It can be a business line, or it can be a geographical segment, it can be a branch, or it can be a product or service line. If we're going to do it, then we have to disclose it separately. When to disclose? Earliest among the following things. Number one, when should we disclose? I tell you, earliest among the following. Number one, whenever we enter into that sale agreement, or when we pass board resolution for the same, whichever is earlier. When we enter into one binding sale agreement, I am selling my entity to someone, so I entered into an agreement with that party. The day I enter into that agreement, or the day I pass a board resolution to enter into this agreement, whichever is earlier, that day I would have to disclose that I am doing this. I hope everyone understood the initial disclosure event. So they'll give 2-3 dates. You pick whichever is earlier and disclose that as the initial agreement, initial disclosure event. From that day, you need to show your operational profit separately from continuing and discontinuing. That's it. There is nothing much in the standard. No computation, nothing. Which operation is going to be discontinued? What is the revenue from that operation? What is the expense from that operation? What is the expected profit from that operation? Has to be disclosed separately. This is the end of Accounting Standard 24, which deals with discontinuing operations. Let's quickly proceed to the next one, which is Accounting Standard 25. Chapter 4, Unit 7, Interim Financial Reporting. Shall we begin? What is it that Accounting Standard 25 has to say? It says, I am not applicable till the time you are doing accounting annually. But whenever you start doing accounting for a period lesser than a year, then you would have to follow what I say. Whenever you are doing accounting for a period lesser than a year, you have to follow what I say. Interim financial reporting. That is, when the reporting is for a period shorter than a year. When the reporting is for a period shorter than a year, then you would have to follow IFR given by Accounting Standard 25. So any period which doesn't start at the beginning of the year but ends at the year end is interim financial reporting, or any period which starts at the beginning but ends before the end of the year is interim financial reporting. Financial reporting is for financial statements, balance sheet, P&L, cash flow statement, statement showing changes in equity, everything. It is preparation of financial statements for a period lesser than a year. You can prepare complete set or you prepare condensed set. AS 25 is here to tell what is the minimum things that you have to prepare and present. If you want to do 100%, then do it, no, there's no problem. But if you want to not do 100%, what is the minimum thing that you should do as per Accounting Standard 25? So whenever you prepare, you need to prepare comparative also. And this is not prepared just by choice. Sometimes it is mandatory to prepare. If in case your entity is listed in stock exchange, so it is mandatory for you to prepare quarterly reports every quarter. In a year, 4 times they prepare their financial reports, balance sheet, PL, cash flow, notes showing changes in equity. They prepare all that every time in a quarter. So when you do that, what is the comparative that you give? Usually on 31st of March 2026, if you prepare balance sheet, PL, comparative will be 31st of March 2025, previous year. But when you do it for less than a year, what will be comparative? For condensed balance sheet, comparative will be always previously completed financial year. What will be comparative? Previously completed financial year. When you prepare PL for the interim period, actually you have to prepare 2 PLs. How many? 2. What are they? Number 1, from the beginning of that interim period till the end of that interim period. Second one, from the beginning of the year till the end of the interim period. For example, you are preparing P&L statement for first quarter, April to July. Do April to July, that's it. But if you are doing PL for July to September, second quarter, you prepare one PL July to September. You prepare one PL April to September. It's called YTD, year to date, and respective comparative. For the P&L that you prepare July 2025 to September 2025, comparative will be July 2024 to September 2024. And the comparative that you prepare for April 25 to September 25 PL will be April 24 to September 24 PL. Did you understand this? For balance sheet, there is no such thing. For balance sheet, comparative is previous financial year. For P&L, 2 things. 1, current interim period. 2, YTD. And both comparative, previous year date also has to be prepared. Whatever applies to PL, same thing applies to cash flow statement. Whatever applies to PL, same thing applies to cash flow statement also. There's one question with answer. I'd want you to see this. Before that, identifying interim period. Have a look at this. If the year ending is 31st of March 2025, if you prepare financial statements from 1st of April 24 to 31st of March 25, that's not interim period. If you prepare from 1st of January 25 to 31st March 25, interim period. 1st of April 24 to 30th June, Yes, interim period. Because year ending is 31st March. You are preparing till 30th June. How about 1st April 24 to 30th September? Yes, why? Year ending is 31st March. Interim period is ending on 30th September. I would want you to see there and then try to answer. Tell me if I have to slow down a little. What if I prepare from 1st of October to 31st March? Interim period. Sir, but it's ending on 31st March. But it's not beginning in the year beginning. Year begins April. This begins 1st October. So is this interim period? Yes. I'm preparing same, yeah. 1st of October to 31st March. But 1st of October is the date of incorporation. That's complete year. That's not interim period. Interim period means it should not start in the beginning. It should be part of the year. It should not be full year. Here our year beginning is only 1st of October. Before that I was only not there. So from 1st of October to 31st March when you prepare, it is not interim period because incorporation has happened on 1st of October. After that 1st of January to 31st of March you prepare. But incorporation happened on 1st of October. It is interim period. When would it be not interim period? If you have prepared from 1st of October. Now October, November, December, 3 months is not included. You included only January, February, March. So it is interim period. What if you prepare from 1st of October till 31st December when the year is actually ending on 31st March? This is interim period report. I hope everyone got it. Tell something. Then let's see consolidated balance sheet. If you prepare, sorry, not consolidated, condensed balance sheet, that is interim financial report. If you prepare interim balance sheet on 30th September 24, comparative will be previous year end, 31st March 24. What if you prepare financial statement as on 31st December 24? Comparative will be 31st March 24, previous year end. What if you prepare condensed balance sheet on 30th June 24? Still the comparative is 31st March 24. So what is the comparative for condensed balance sheet? Previous financial year end balance sheet. Got it? Before we go to the next question, I would want you to know, you understand, no? Q1 is April, May, June. Q2 is July, August, September. Q3 is October, November, December. Q4 is January, February, March. Now see this. For Q1, if you prepare PL, I'm talking about PL. Interim statement will be 1st of April 24 to 30th June. Comparative will be 1st of April 23 to 30th June 23. If you prepare for Q2, you would have to do two things. One, Q2, July to September 24. Then YTD, April to September 24. And comparative, July to September 23, April to September 23. Similarly for Q3, which is October, November, December. Q3 interim PL will be October to December 24. YTD is April to December 24. Comparative, October to December 23, April to December 23. I hope everyone understood this. Pakka. What if I prepare it for first half of the year? First half means April to September is over. We begin only from October now. So October to March 24. Sorry, first half no. April to 30th September 24. Comparative is April to September 23. There is no YTD when the beginning is at the beginning of the year. If our accounting interim period starts at the beginning of the year, then there is no concept of YTD. Everybody got this? Very good. Then let's see the next one. Next one that I would want you to go. Before we go to the next one, I'd want you to know a beautiful point when it comes to interim period statements. When you prepare interim period statements, expenses for that interim period have to be identified, incomes for that interim period have to be identified, and then expense income we need to match to find that interim period's profit or loss. In the quest of determining interim period's expense, interim period's income to find interim period's profit, we have to remember the expense should neither be deferred nor be anticipated. Income should neither be deferred nor be anticipated. That period income should be taken in that period. Meaning you incur 4 lakh rupees as expense in first quarter. Take 4 lakh in first quarter. Don't say 4 lakh rupees expense in first quarter, second, third, fourth I won't incur. So I'll transfer little to second, little to third, little to fourth. No. Sir, my sales is more in third quarter, my sales is less in first quarter. So can I put some expense of first quarter to third quarter? No, don't do that. First quarter expense is first quarter. Second quarter expense is second quarter. Don't defer it to another quarter because the sales is more in that quarter. They will play tricks in the question. They will tell business is cyclical, business is seasonal, there is heavy sales in third quarter, there is no sales in first quarter. Don't get tricked. Income of first quarter in first quarter only. What if the company receives dividend of 4 lakhs in fourth quarter? They'll say that investment income is earned over the year. I'll write 1 lakh to every quarter. No, right? Full 4 lakhs income in fourth quarter only. When will you defer? For example, you paid entire 12 months rent in first quarter. Then you defer that to second, third and fourth. You understand? Bad debts 10 lakh rupees first quarter, full 10 lakh first quarter. Don't try to defer it to 3. When will you defer? You paid rent of all the 4 quarters, full year in first quarter, 12,000. First quarter 4,000 P&L, 9,000 deferred to second quarter. Second quarter you book 3,000, 6,000 deferred to third, 3,000 in third quarter, 3,000 in fourth. Basically, each interim period treat it like an year. Each interim period treat it like an year. If in case you are about to defer an expense between 2 years, then defer it between 2 interim periods. If you would not defer an expense between 2 years, then don't defer it between 2 periods also, 2 interim periods. Book it in that quarter only. I hope you understood. Can we charge higher depreciation in one quarter, lower no. Unless your method of depreciation is such that you take based on production units. You got what I'm trying to tell? Yeah. Let me show you a small question to revise this concept. See this. Bad debts of rupees 10 lakh during quarter 1. Accountant wants to write 1/4 of it to each quarter. Is it right? No. Entire 10 lakh should be booked in quarter 1. Grant to be received from government in Q3. In Q3 you will receive government grant. In Q1 only you want to book some amount as income. It is against stage 12. You should not pre-recognize the grant. You should receive the grant and you should have the confidence that you will fulfill the requirements and there will be no need for refund. Only then you should recognize the grant. Q3 will borrow grant to Q1 will recognize madadre tappu. Should not do that. So entire grant should be recognized in Q3. No anticipation of the grant in Q1. Understood? Then come to next one. Rent of rupees 9 lakh is for 9 months. Sorry, rent of rupees 90,000 is for how many months? 10,000 rupees per month. And you paid it completely in first quarter. Accountant wants to write entire 90,000 in condensed period. When he was supposed to defer, he told he will not defer. When he is supposed to defer, he is telling he will not defer. You like not defer, like defer tara then. So what should we do? That 90,000 should not be transferred to P&L in Q1. Divide it over 9 months. It comes 10,000 per month. First quarter as 3 months. 30,000 you write it to expense. 60,000 will defer it to second quarter. There will book 30,000 and further 30,000 will be deferred to third quarter and will book it. And you are not obligated to. No problem. Comfortable? Feeling conscious? No. You are not obligated to laugh. It's just that it's a tendency. I remember. It's okay, all good. She was honest on that. She told. Okay. Next, last one. 4 lakh rupees was incurred as a loss because of fire accident in first quarter. First quarter, fire broke out. And there is a loss. Can I say I'll defer it to next year? Hey, fire will it happen in installment? No, full fire one time. Right? Full loss in first quarter only. He wants to record full 4 lakhs in first. Is correct for once. You should not defer it to another quarter. Can you expect second quarter I somehow feel there will be fire? Can I book it? No. If you expect fire in second quarter, put one fire extinguisher. Don't book loss right now. I hope you understood. No deferring an expense, no anticipating an expense. That quarter expense should be recognized in that quarter, though the business is seasonal. I hope you understood. Next point is tax. How to book tax expense in your interim period. So you understood this recognition of expense and income. Next point is on tax. Whenever we talk about tax, we have to see tax can be slightly tricky. What if the tax is applicable to us in slab rate? Meaning not entire amount is taxable. Up to certain extent, no tax. This certain amount to certain amount, lower rate 5% or 10%, then 20, then 30. If you have slab rates, then we cannot say first quarter 0 tax. Why? Basic exemption. Second quarter 5%. Third quarter 10. Fourth quarter 30. That's not right. You cannot say fourth quarter 30%, first quarter 0%. Not fair. What should we do? In the first quarter, we need to anticipate. So you only told don't anticipate. I told don't anticipate income to write. Anticipate project the profit for second, third and fourth quarter. You have the actual profit of first quarter. Think what would be your profit in second quarter, third quarter, fourth quarter. Add everything. We get total profit. Apply slab rate. Identify tax. Total tax. Divided by total income. You get effective rate. That effective rate will be applied to each quarter. I'll show it to you how it's done. Come on. Let's see this question. Let's do slab rate first. This is the slab rate. Have a look. So quarter 1 50, quarter 2 1 lakh, quarter 3 1 lakh 20, quarter 4 1 lakh 30. We're in quarter 1, okay? 2, 3, 4 is projected. We don't know, but we are expecting this to be our profits. Tax rate is like this. Suggest tax expense for each quarter. Oh, this is brought forward loss question. Let's take one with slab. Here is a question with slab. So profit same 50, 1 lakh, 120, 130. Slab rate is up to 1 lakh 0. 1 lakh 1 to 3 lakh 10%. Above 3 lakh 20%. Sir, which finance minister announced? I announced this for our ease of understanding. Don't tell which assessment year was this. No, in accounts they'll give separately. You are not expected to know slab rates for any financial or any assessment year in accounts. Interim financial reporting, when they give, they'll give like this. Don't tell question is wrong. Up to 2 lakh 50 it's basic exemption. Don't apply your knowledge there. Tax knowledge, keep it to tax paper. Okay. Then write this same 50 plus 1 lakh 50. 1 lakh 50 plus 1 lakh 20. 2 lakh 70. 2 lakh 70 plus 1 lakh 30. Can I say total profit 4 lakh? 4 lakh rupees. So up to 1 lakh 0%. 1 lakh to 3 lakh is 2 lakhs. On the 10% 20,000. Our profit is 4 lakh. No. Above 3 lakh the profit is 1 lakh. On the 20%, 20. Can I say total tax becomes 40%? Total tax becomes, total income is 4 lakh. 4 lakh by 40. Effective rate is 10%. So from the first quarter we'll apply 10%, 10%, 10%, 10%. So total tax is same. It is not like we are doing Taratamya. First quarter less tax, next quarter more tax. No, all quarters equal 10%. But to do this, we have projected the profits for the next 3. We have no option. We have to do the same. Everybody understood? What if we have brought forward loss? Same way we did now. First, take the total taxable income, deduct that brought forward loss, take the taxable income, apply the tax rate, find the total tax, divide it by income before brought forward loss. You find the effective tax rate. That effective tax rate should be applied for each point. I'll show what I just mentioned. See, same profits 50, 1 lakh, 1 lakh 20, 1 lakh 30. 50, 1 lakh, 1 lakh 20, 1 lakh 30. These are the profits. How much is brought forward loss? 50,000. So take 50 plus 1 lakh plus 1 lakh 20 plus 1 lakh 30. Deduct 50,000 brought forward loss. 3 lakh 50. On 3 lakh 50 you apply 30%. 1 lakh 5,000 rupees becomes the tax on profit. Take 4 lakh, the profit before adjusting brought forward loss as the basis. Thank you. So take 1 lakh 5 divided by 4 lakh to find the effective tax rate. 26.25% is applied on each quarter's profit to find the effective tax for each quarter. Did everyone understand? What if, can you go to next scene? What if your financial year falls between 2 assessment years? You are not following April to March. You are following Australian year, July to June. Your year begins in July, your ends in June. So then what happens? July to March, you are in one assessment year. April to June, you are in different assessment year. Tax rates change between 2 assessment years. Finance budget will come in February. Changed. Then what to do? Then you cannot say I'll take effective tax rate. How would you know what will be the rate next time? Are you the finance minister? Not yet. Not yet is the answer. You should not say no. You never know, one fine day. Okay. So 23, 24, 24, 25 are 2 different years. No. Observe. During 23-24 tax rate is 30%. During 24-25 the tax rate is 35%. Our year is beginning in October, ending in September. This October to December, January to March. This is in the year 23-24. Here I'll apply 30%. Here I'll apply 35%. You understood? I will not find effective tax rate. When will I find effective tax rate? I'll find effective tax rate when there is brought forward loss or when there is slab rate. When do I apply effective tax rate? When there is brought forward loss or when there is slab rate. When do I not apply? When it falls between 2 different assessment years. Don't apply effective rate concept. Just compute for that year that rate. I hope everybody understood. Paka? Very nice. Is there anything that we have to still discuss in this? Change in accounting policy, change in accounting estimate. Now, whenever there is change in accounting policy in the middle quarter, we need to restate it from the first quarter. Let's say third quarter, when you're preparing interim reports, you change the accounting policy. Impact will not be given from third quarter. Impact has to start from first quarter. Why? Change in accounting policy should be given retrospective effect. Change in accounting estimate should be given prospective effect. Read this. Valuation of inventory was changed from P4 to VAM. Accounting policy change. Change it from quarter 1 and quarter 2 also. Redraft it. However, if you change method of depreciation, Prospective change. Change it from second quarter only. Why? Method of depreciation is change in accounting estimate, not change in accounting policy. So can you tell more about this? We will surely discuss when we come to Accounting Standard 5, Chapter 7, Unit 2. That will happen later. Is that okay? Good. By this, we are done with Accounting Standard 25. There is nothing in 25 that we have not touched upon. And if you have to try questions, my suggestion, please do try two varieties of questions on Accounting Standard 25. In this standard, you have to do questions, sir. Did I mention questions to be done in AS20? If I have not mentioned, please note down. One question with right issue, one question with ESOP. One question with right issue, one question with ESOP, one question with debentures as dilutive base, convertible debentures. You have three together, you might not have three together, do them. And last one, do one question where there is money called in stages, application money received, allotment made later, call made later. That question also you do. I'll tell you four varieties questions you please find and do. Question number 1, right issue. Question number 2, employee stock options. Question number 3, convertible debentures. This ESOP and convertible debentures is dilutive EPS. And the first one that I mentioned is right issue, and also do one on share application allotment call kind of one question is there. Please do that. If you tell too many, they will not do anything. And this candidate here has passed both groups of examination, still sitting here because hard clap. Yeah, stand. No, they want to see, not clap, but see. Once again, nobody has passed both groups, still sitting in marathon revision. Yeah, maybe we should have failed, but he has not failed. I don't know. I should not say that, but he is engaged. No, loves the subject so much. So for Jan 2025 exam, when we do marathon, how many of you will come? Not because you failed, but because you passed, but you still bored, don't know what to do. Like class is there, it's okay, I'll count sit types. There's nothing wrong in setting. Very good, valid point. In Accounting Standard 25, I'd want you to do couple of questions. One is tax. Do tax when there is brought forward loss. Tax question when there is brought forward loss and slab. Brought forward loss and slab. That question you do revise. And another one which questions you about accounting treatment. They've told, I've done this, is it right? Is it right? I've written bad debts, I've written dividend. There's one such question in your study material. Please do that question also. Brought forward loss and tax with brought forward loss with tax question. And one more is treatment of bad debts, dividend, and all of that. Study material question. You do these two without fail. Will you? Pakka? Very nice. Can we head to Accounting Standard 2, Chapter 5, Unit 1, Accounting Standard 2. Accounting Standard 2 talks about valuation of inventories. Inventories, what is supposed to be written in your books of accounts, has two primary purposes. Purpose number 1, determining profit. With wrong inventory, you will find wrong profit. Purpose number 2, it is an asset in balance sheet. So if you don't write inventory correctly at the correct value, your P&L damar, balance sheet also damar. So Accounting Standard 2 will help you understand how to value your inventory. This doesn't include construction based contracts which are half pending. It's not WIP inventory. Get it? This is a separate standard. We'll deal with that there. Service contracts are also excluded. Shares, debentures, what is held as stock, that is also not covered under Accounting Standard 2. Sir, but my business is buying and selling shares. Isn't that my inventory? Yes. But AS2 not applicable. Why? There is a specific standard 13. Discuss 13. We'll do that after AS10. Then for livestock, forest and agricultural produce, mineral oils, actually Accounting Standard 2 is not applicable. No standard is applicable. So AS2 will tell, I won't cover it completely, but I can tell you one thing. You should be valued at NRV. Net realizable value. Talking about inventory. There are three variants of inventory. Finished goods, work in progress, raw material. What is kept in the ready course of business for sale? Finished goods. What is in the process of being converted to finished goods? Work in progress. What is what we buy in order to be converted into finished goods? Raw material. If I am a manufacturer, I'll have all three variants of inventory. If I am a trader, I will only have finished goods. I'll repeat. If I am a manufacturer, I'll have all three variants. Raw material, work in progress, finished goods. If I am a trader, I will only have finished goods. I hope you all understood. Very good. Inventory will also include three things. What are they? Material supplies, consumables and loose tools. What is material supplies? Certain items which are not raw material but still used in manufacturing of the finished goods. Consumables, same thing, same with loose tools. Now I'll give you a better example. Let's say in our manufacturing of the entity, I'm using one machine. To that machine I put oil, to that machine I put grease. That is not part of the product, but it is still used in the manufacture. Consumable, material supplies, or it can also be called as loose tools. Spanner or some stapler or some needle used to stitch, or consumables means ink that is used to dye the cloth which is used in manufacturing finished goods. All those will become consumables, material supplies and loose tools. These cannot be considered as asset. This cannot be considered as inventory. They don't know where to go. AS2 will tell, come along with me. I'll treat you like inventory. Are you inventory? Actually, no. But it is not raw material. It is not work in progress. It is not finished goods. But treated like inventory. Treated like raw material, basically. You understood? Very good. Now, Accounting Standard 2, paragraph 5 is the most famous paragraph what all of you have read in the past. What does AS5 say? It says inventory is to be valued at, what does para 5 say? Inventory should be valued at cost or NRV, whichever is less. Why? I bought it at 100. I'm about to sell it at 120. When I buy it at 100, sell it at 120. Yes, 20 rupees profit. Don't book it right now. Right now, record the inventory at 100. When you actually sell at 120, then you book the 20 rupees profit. But I bought it at 100. I am expecting to sell it at 90. When I buy it at 100, when I sell it at 90, I'll make 10 rupees loss. Don't wait to sell. Record it now. Why? Conservative approach. How do I book that loss without selling? Very simple. I purchase the inventory for 100, trading account debit side 100, closing stock I'll write 90. So debit side total 100, credit side total 90. 10 rupees credit side will get net loss or gross loss. Are you getting it? By reducing the value of the inventory, you book loss. By increasing the value of inventory, you book profit. So Accounting Standard 2 says never increase the value of inventory. It should be recorded at the cost that you bought. Purchase account debit side you write 100, closing should be 100 or less. It cannot be more. That is the reason it is cost or NRV, whichever is less. And this has to be done item wise. This cannot be done in total. Let's say I have an item A, item B, item C. Individually for item A, cost or NRV. For item B, cost or NRV. For item C, cost or NRV. Separately I need to find. Don't take total cost of A, B, C. Total NRV of A, B, C. Total. No, yeah, not fair. So I'll show that to you. Have a look at this question. So whenever you have a question like this, second. So whenever you have a question like this, what do we do? 1 lakh 20, 1 lakh 35. Don't take total of costs, total of NRVs, and then do whichever is less. Item wise. Which is less? 120. Which is less? 110. Which is less? 75. Which is less? 250. Here 179. And then take the total. That will be the value of total inventory. So remember the point. We should do convention of conservatism. We should do whichever is less, and it has to be taken item wise and not in total. Everybody got this point? Come on, let's get back after this. Now we use the word cost. What does the word cost include? Cost includes three things: cost of purchase, cost of conversion, and other cost. Three things. What are they? Cost of purchase, cost of conversion, other costs. Cost of purchase, money that I paid to buy. Duties and taxes, GST I paid, will be included if input tax credit is not available. Will not be included if input tax credit is available. What if input tax credit is available, but I will not take input tax credit? It is available, but I will not take. Then include it in the cost. You understood? Then what else is included? Freight inwards, any other directly attributable expenses incurred to bring the goods to its location and condition. To bring that goods from the place of purchase to my shop. Any loading, unloading, packing, unpacking, freight, octroi, cartage, transportation, everything included into the cost of the inventory. And if there is any trade discount, we bargain. Sir, what sir? Look at my face, sir. How do you feel like charging so much? Charge me 10 rupees less. He agreed. So then cost is not 100. 100 minus 10, 90 is the cost. Trade discount should be adjusted against the purchase price. Then if I am a trader, no, this is my cost. End of the story. But if I am a manufacturer, I am not selling raw material. I am converting it to finished goods and then sell. Any expenditure that I incur to convert the inventory from raw material to finished goods, that is what we call as cost of conversion. This entire cost of conversion is included in the cost. Entire cost of conversion is also included. And we will also take other expenses, any expenses which are directly attributable. When we talk about cost of conversion, direct material, direct labor, direct expense is taken. Indirect expense is there, no, which is overhead. This has to be taken with caution. And I'm telling you with caution because Usually students tend to take it like your costing. No, costing is separate, accounts is separate. The perspective with which we see overhead absorption in accounts is very different from how you do it in costing. So this is an area to be focused. Even when they give a 6 marker, 8 marker, 10 marker question, if they give on this, there can be question. Worst case in accounting standard 2, if they ask a 2 marker case study question, there also this will be usually question. You can keep this in mind. Must to do a question on overhead absorption in AS2 inventory, not accounting not your cost accounting. I'll tell you how is this different. In your costing, you do something called as over absorption, under absorption. There is no concept of over absorption. When you pay 1 lakh rupees rent, you cannot book 1,20,000 as rental expense. In P&L, expense should be 1 lakh only. So we vary the number of units. So what we do is, whenever there is variable overhead, there is no problem. Varies with the level of output. Say 2 rupees per unit manufactured, write it, no problem. All this overhead absorption becomes an issue when you do fixed overhead. Fixed overhead means what? It doesn't vary with the level of output. Whether you manufacture 10 units or you manufacture 10,000 units, rent is 1 lakh fixed. Rent is 1 lakh fixed. Does it vary with level of operation? No. So 1 lakh is the total expenditure which is fixed. It needs to be allocated for each unit of inventory that you manufacture. How do you allocate? There are two options. One, you can take the actual capacity or you can take the normal capacity. What should you do? You should compare. I'll tell you the shortcut because this is marathon. Logic will keep it aside for some time. Simply take actual or normal, whichever is higher. Whichever is higher, that will become the denominator. But actually, if you want to know the concept, you should do it like this. Allocation depends upon actual or normal capacity. If actual capacity is less than or equal to normal capacity, then you should always do it based on normal capacity. If your actual capacity is more than normal capacity, then we should take actual capacity. This is what the standard is. But the summary of it is take actual capacity or normal capacity, whichever is higher, so that you will not do any over absorption. I hope you understood. This is one area where you need to be little cautious. And certain expenses are not included in the inventory cost. What? Abnormal loss, storage cost. Storage cost is after you buy the inventory, before you sell it or before you use it in production. You keep it idle. During that, any expense incurred should not be included unless such storage is part of production. If you don't store it, production will not be complete. Meaning, you bought grapes, you made wine. If you sell it immediately, it is fresh grape juice. It will become wine only when you keep it in that barrel for so long. So 5 years you stored. For 5 years, when you stored, you paid rent to watchmen, you paid salary to watchmen, rent to building, everything. That is part of the production process. Are you getting it? Whereas mango juice, you manufacture it now, but mango is not available throughout the year. So what do? You take mango pulp juice out and then you sell it over the year. So you stored it for you manufactured enough mango juice to sell over 12 months. You understand? So you manufactured in April, May, June. So you stored it for July, August, September. Is that rent of storage to be included in the cost of inventory? No. Why? You produce the supply required for next 12 months because the product is seasonal in nature. There is no need to keep it for 3 months to sell. Is it mandatory to preserve it for 3 months to sell? No. You are keeping it for 3 months. Then the storage cost is not part of the production process. It will be not added to inventory. It will be charged to PL. However, if it is part of the production, it will be added. And any normal administrative overhead and selling and distribution overhead expenditure will not be included in the cost of the inventory. I hope everybody understood. Okay, what will we do? We'll just quickly see a question on this. Come on, to ensure that we've had a good understanding. So this is the tax invoice given to us by one customer. This is the tax invoice given by one of our customers. So see the tax invoice. We bought thread. And this thread is used in the manufacture of a shirt. We will weave this thread into cloth into shirt. Have a look at it now. No, I got stone from outside then. It was there in the shoe. Side. There's too much gap. Sorry for the noise and disturbance. Marathon, no, I went running. Focus. 1,000 bundles of thread is been bought. Each bundle is 200 rupees. 2 lakh. I told him, Uncle, kadme madalva, please. Then he told, okay, pa, 20,000 kadme kudi. Then he paid me 1,80,000. And 1,80,000, once again. I told, what, uncle? Hey, Sidramaya uncle, Nirmala auntie. They added GST. You understood? Sir, why Sidramaya uncle? Finance Minister of the state. Not just the Chief Minister. The Minister who has put the maximum number of finance, state budget finance. No one has ever announced so many state budgets than Sidramaya uncle ever. You guys can't call uncle. I can call. Why? Namge friend. Yeah, namge electricity bill ella free ಮಾಡ್ಸಿದ್ದಾರೆ. Okay. ಇಲ್ಲ ಅವ್ರು ನಮ್ಮ ಕಡೆ ಬರಲ್ಲ. or from uncle friend. Okay, 4,500, 4,500 SGST, CGST. After that, goods will not come. No, when I say come, I need to incur expense. I've incurred freight of 2,500 also. Adding all of it, the bill comes 1,91,500. You tell me what is the cost of purchase when input tax credit is available? This is the question. Invoice. When input tax credit is available, I should not include this in the cost of my inventory. I will not take 2 lakh. I will deduct 20 and take 1,80,000, and I'll include this freight of 2,500. So it will be 1,82,500. Usually the tendency is to jump on 1,80,000 because we forget. Idu beda adi takshana idu beda anko angalla. You should take 1,80,000 plus 2,500 freight, 1,82,500. What if input tax credit is not available? Then I'll take 1,80,000 plus 9,000 plus 2,500. Does it come to 191,500? Yeah. It comes to 191,500. I hope everybody understood. This with regard to tax part. Answer? Yes. Question. Okay. Then let's see another one. Fixed overhead allocation. So how much is the normal capacity? 10,000 units. Usually we'll be able to manufacture how many units? 10,000. But actually we manufactured in 3 different cases. If I manufactured 8, how much? If I manufactured 10, if I manufactured 11. Total factory rent is 1,20,000. How do we identify the factory rent per unit? Very simple. Fixed overhead 1,20,000. Normal production 10,000, 10,000, 10,000. Actual production 8. So I should take normal or actual, whichever is higher. Observation. I'll take basis for the overhead. It should be actual or normal, whichever is higher. Which is higher? Normal production. Am I right? Then if normal production is the higher, then what do I do? Overhead recovery rate will be 1,20,000 divided by 10. That will become 12. Am I right? Fixed overhead divided by basis for allocation. Basis for allocation is 10, which is normal production because it is higher than actual. And total overhead is 1,20,000. Once I find 12, I will do this way. Cost to be included in inventory. How many units did I actually manufacture? 8,000. 8,000 into 12, 96,000 will be included in inventory. But actually I incurred overhead of 1,20,000. 1,20,000 minus 96, 24,000 will be charged to PL. Did you all get this? Okay. Next case, if you observe, it is equal. When it is equal, which one do I take? When both are equal, doesn't matter what you take. Take normal production. Take normal production. Basis will be 10,000. Am I right? So if you do 1,20,000 divided by 10,000, can I say you get 12? 12 is the basis. Again same. How many units did you manufacture? 10,000. How many units did you manufacture? 10,000. 10,000 into 12. 1,20,000 will be charged to inventory. And out of 1,20,000, if I include 1,20,000 in inventory, nothing is charged to PL. I hope everyone's getting it. Similarly, when we take case 3, I'll take whichever is higher. Here actually actual production is higher. That is 1,20,000 divided by 11,000, which comes to 10.91. So I'll do 10.91 into actual production of 11,000. Full 1,20,000 will be included in inventory. Nothing will be charged to PL. But in costing, what do? You'll take normal capacity and then you do 11,000 into 12, and you will charge 1,32,000 to inventory, and you will write 12,000 will be charged to P&L as income. Over absorption means negative. It will become income. Rent cannot become income when you pay. That is for cost allocation and profit fixing. This is what is happening after the sale or after the actual manufacturing. So at the policy making stage, that is right in costing. But in the executionary stage in accounting, there is no concept of over absorption of overhead. You have to take actual production or normal production, whichever is higher as the basis. I hope everybody understood this. Okay, then let's proceed to the next one. I told you abnormal loss should not be included in the inventory. What do we mean by that? See, normal loss will be adjusted to the rate per unit, increasing the rate. Abnormal loss will be eliminated from the inventory, charged to PL. Whenever there is normal loss, it is unavoidable. You can't do anything about it. It will reduce the number of units, but it will increase the value per unit. Whereas there is abnormal loss, amount is found that is charged to P&L. I'll tell you in a different way. Normal loss will be adjusted in units only. Normal loss will be adjusted in, abnormal loss will be adjusted in units and amount. Whenever there is normal loss, after normal loss, per unit rate will increase. Whenever there is abnormal loss, after booking abnormal loss, per unit rate will not change. I hope you understood. I'll show you a small treatment as to how it should be done. So this is the question. Have a look at the question. How many kgs of tomato have I purchased? 10,000. What is the rate per kg? 50. Transportation cost 2,000. Packaging cost 4,000. I bought 10,000 kgs of raw material. I received only 9,600 kgs. I received how much? So 400 kgs what happened? Loss. This loss can be normal loss. This loss can be abnormal loss. I'll repeat. This loss can be normal loss. This loss can be abnormal loss. Now, if the loss is normal, what do? Nothing. Hey, did you understand the question? Everybody? So I would write here, tomatoes 10,000 kgs, 50 rupees per kg, 5 lakh. I will add the transportation cost. How much was transportation cost? Packaging cost? I will add both transportation and packing, 2 plus 4. 5 lakh 6,000 is the cost for 10,000 kgs. How much is 5 lakh 6,000 divided by 10,000? 50.6. Now when I deduct normal loss, I actually received only 9,600, meaning 400 kgs loss, no? Because it is normal loss, it is deducted in units column only. I won't touch anything in kg and amount. I'll write same 5 lakh 6 here. Now do 5 lakh 6,000 divided by 9,600. 52.71 is the per kg rate. What happened now? Because of normal loss, number of units has reduced, but the value remains the same, increasing the cost per good unit. Because of normal loss, good units per unit cost will increase. I hope everybody got it. Say something. The next thing, what if this same loss was abnormal? Same thing, yeah. I bought tomatoes, 10,000 kgs at 50 rupees, 5 lakh. I incurred same transportation and packing cost. It became 5 lakh 6 for 10,000 kgs. That is 50.6. If the loss is abnormal, there is loss. I received only 9,600. Can I say loss is 400 kgs? I would allocate 50.6 to it. I would write the amount as 20,240. This will be charged to P&L as expense. Charged to P&L as 5 lakh 6,000 minus 2240 will become my value of inventory. Rate will remain at 50.6. Now do you understand the difference between normal loss treatment, abnormal loss treatment? If there is normal loss, per unit rate will increase because adjustment is in units only with no change in value. Understood? If there is abnormal loss, we will reduce number of units, we will also reduce the value, because of which per unit rate will not change. Everybody got this? What if it's partly normal, partly abnormal? See, I have given the case here. 100 kgs is normal. To the extent of 100 kgs, we will reduce only units. To the extent of 300 kgs, we will eliminate in units and amount. Which one to take first? First we should take normal or first we should take abnormal? Depends upon what has happened. First, there is normal loss. Normally, when you're transporting tomatoes, some tomatoes at the bottom get squashed. Then you arrived at 9,900 kgs. When you kept it in the godown, then robbery of 300 kgs happened. First normal, then abnormal. You loaded the tomatoes into the truck. Someone steals the tomatoes. First there is abnormal loss. Then there is normal loss. First to do abnormal loss treatment first, then do normal. There is no condition that first it is normal, then it is abnormal. It can be either ways. Regular class for this is actually fun. There is amazing fun thing that happens in this. Okay, let's talk about marathon now. 10th tomato, beda, takadi, 10,000 kgs, 50 rupees per kg, 5 lakh. I will add those two expenses also, making it 5 lakh 6. 10,000 kgs, 5 lakh 6, 50.6. Everyone's clear? First I will deduct normal loss of 100, because in this example, first there is normal loss of 100. Can it be abnormal loss? Yes. First, yes, there can be. 10,000 minus 100, you get 9,900 kgs for 5 lakh 6,000 only. Per kg value will increase now. 5 lakh 6 by 9,900. 51.11. Now, abnormal loss of 300 kgs will be deducted. I'll allocate 51.11 for each unit. Do 300 into 51.11. 5 lakh 6,000 minus 15,333. 4 lakh 90,667. And this will be for 9,600 units. Rate will remain at 51.11. What's this? This is abnormal loss treatment with normal loss. I hope everyone understood. So remember this, normal loss will reduce units, will increase the per unit cost rate. There is no change in the amount, there is no journal entry. Abnormal loss will reduce the number of units. There is no change in the per unit rate. Total amount will decrease, and there is always that we pass a journal entry. Abnormal loss will be charged to PL. Normal loss will be adjusted with good units rates. Everyone got it? Come on, let's go back to our chart. You understood what and all is included in cost? Next thing, valuation technique. How to value inventory? Depends upon the variety of inventory. Inventory can be sorry, ordinarily interchangeable or not ordinarily interchangeable. What do you mean when you say ordinarily interchangeable? One unit of inventory, another unit of inventory, same. This and this both do same thing, same purpose. Now in a shop I'm selling mobile phones, all the mobile phones are same. I'm selling keyboards, all the keyboards are same. One inventory, another inventory is ordinarily replaceable. There we actually follow first in first out or weighted average method considering historical cost. If you don't want to consider historical cost, you follow adjusted selling price method or standard cost. What do you mean when you say inventory is not ordinarily interchangeable? Gold shop. No two pieces of jewelry are of same rate. There you see three rings. Three rings are also not same. Each ring value is different. Now you go to Max. You ask them this t-shirt, that row, all the t-shirts will be 500. First t-shirt or second t-shirt or third t-shirt, whether it is small or XS or M or L, everything same. But gold shop, you go to Lalita Jewelers, you will ask this ring, they'll say 15,000. That ring also 15. No. Different. They will take it, they will weigh it, they will count it, add wastage, add making charges, add their profit, shaving charge, everything. They're like, this is the price. This is the price. You understand? And you ask one more ring. Again, freshly they will take it, they will adu. That you should see. Open the door, keep the ring, close the door, see the price, take the ring, take calculator, top, add, deduct, and they'll say this much. So the price keeps varying. You need to identify the rate for each unit of inventory separately when it is not ordinarily interchangeable. So we follow specific identification method. If each unit of inventory is same, there is no difference between two units. We follow FIFO, first in, first out, or weighted average method. Don't take it lightly. FIFO or VAM based questions can come in costing also, accounts also. So when something can come at two places, please practice. Don't skip. You will say, sir, easy, good, but skipping, not good. Why? It is easy, so you skip. Question comes in the exam, but you can't do. You will feel more hurt. It is okay if a very difficult question comes and you can't do. It is very sad when a very easy question comes and you cannot do. Yeah, beautifully difficult, very fast Yorker ball you get out. You're like, hey, okay, that ball anyone would have got out. You hit the ball to boundary, you think it's boundary and you're talking in the middle. Someone takes the ball and then makes you run out. Who will get out like that? Me. So you feel hurt. So it's okay if it's easy. If it is easy, do practice. Why? It's easy. If it is difficult, do practice. Why? It's difficult. So either ways, don't forget to practice. Okay, I'll quickly show a question. If you can try this, just tell me. Stock opening is how much? 100. Purchase is how much? 100. When you issue 150, if you're following first in, first out, first you issue 100 from here, then you issue 50 from here. Closing stock is opening 100 plus purchase 100. Issued 150. Closing will be 50. That 50 will be from this purchase at rupees 12. If you follow FIFO. If you follow weighted average method, then you should do 100 into 10 plus 100 into 12 divided by 200. What do you get? 100 into 10, 1000. 100 into 12, 1200. Hey, lazy people, do it. 2200 divided by 200. What do you get? 11. Multiply that with 50. 650. 11 into 50 is... Wow. Wow. Come on. My brain is braining. Why is your brain not braining? 100 into 11, 1000. 100 into 12, 1200. 2200 divided by 200 is 11. 11 into 50 units left. 650. 550. Sorry, 550? No. Okay. I did 550 into 13. Shh, quiet. 50 into 11, 550. Everybody understood this? I told you another method here. Instead of doing this, you can do adjusted selling price method. Did I mention? What is adjusted selling price? You have this in your CA foundation also in valuation of inventory, but please do it here also. Question can come. Adjusted selling price method only says that when the volume of units there is too many, value per unit is too less, it is too annoying to maintain per unit rate and per unit data. I'll repeat. When the volume of units are too many, value per unit is too less, it is too annoying to keep first in, first out and VAM method data. So what do? If we check the price, I'll get to know the MRP, selling price. And because I deal with huge number of units, profit margin will be fixed. 25%, 20%, 30%. So in that case, what I do is, I'll find the closing inventory at selling price. Eliminate the profit, I'll get cost. If not, what should I do? Every time I buy, I should write number of units, cost per unit, closing value. Every time I purchase, number of units, cost per unit, closing value. Every time I issue, did it go from this, did it go from this? I should eliminate, and I should maintain variance. Too much time taking. Simple method, very easy. Closing inventory at a selling price you find. Closing inventory at selling price, you know. Eliminate the profit margin from that. You get cost. Shall I show you a question on this? Adjusted selling price. See, opening stock is 0. Why? We are following JIT. Sir, closing stock is the end of there, no JIT. Policy changed by the end of there. Why? You couldn't implement. Illappa, beginning, first year, this year only we started business. So opening stock is 0. Purchases during the year 25,000. You have sold goods for 30. Closing stock at selling price is 10. Sir, profit margin, Kotila, we should find. If they give, it will become easy. So, if there is no opening stock, can I say whatever is sold is from the purchases only? Whatever is left is also from purchases only? So, if I have sold goods for 30, if I am yet to sell goods at selling price 10, can I say 40,000 is the selling price of goods purchased? Can I say 40,000 is the selling price of goods purchased? That's my beginning. Opening stock 0, purchases, we know 25. I know sales 30,000. I know closing stock 10,000. This is the question. Whatever is here, I have written it here. Those of you who don't have the book, you can take a screenshot here. Okay, you can come here. Now, 10 plus 30. Can I say 40,000 is the purchases at selling price? If the cost is 25, selling price is 40. If the selling price is 10, how much is cost? 10 into 25 divided by 40. Cross multiplication. You will get the closing stock 6,002. That's the closing stock. Take it. Adjusted selling price method. Similarly, you can find cost of goods sold also. Compare it with sales to find profit. If you want, you can do that. You don't want to do? Yeah, you can do that. What will be your cost of goods sold? It will be 30,000 into 25 divided by 40. What do you get? 18,750. And yeah, you can do it differently also. Or you can do opening stock plus purchase minus closing stock. Opening stock is 0. Purchases is 25. Closing stock is 6,250. You do 20 minus 6,250, you get 18,750. If anyone is finding this really fast, then I am not fast. You are very slow. Sorry. Backdrop. 30,000 is sales. Then, sorry, yeah. Comment buy matte. Buy ಏನಾಗುತ್ತೆ ಪರವಾಗಿಲ್ಲ. Quite, you don't give all hints. People will do that now. 30,000 minus 18,750. 11,250. Two people started commenting from the whole video. One guy told Sarish too fast. One guy told Sarish. One guy told something else. Both agreed. Then one guy told Sarish too slow. They both disagreed. They started fighting. I'm like, fight, not here. Then they both deleted all the comments. I'm like, hey, where are you people? Maybe they met some at the end of the street and they both are able to each other's call. Hey! Fine. No. People like to fight nowadays. Okay, done. You understood this part? Yeah. Okay. The next thing that I would want you to notice, after identifying the value of inventory, how to value raw material and how to value finished goods, or how to value raw material and how to value work in progress when the finished goods is not valued at cost. So that part. Before we go there, we'll do one more thing. That is how to value joint product and byproduct. Shall we discuss joint product and byproduct? Then joint product means what? Two products are manufactured together. Joint product. Byproduct means I have no intention of manufacturing this. I was manufacturing this. This came in the process. I was manufacturing coconut oil. In the process, that coconut coir came. That naru of that coconut. That not intended, but part of the process. I sell that to somebody. Maybe they'll use it to make rope, or they'll use it as part of their firewood. That is byproduct. What is joint product? Yeah. Joint product is I am trying to extract petrol. I get crude oil. In that I get petrol, diesel, air turbine, fuel, gas, all of it I get. All of that is part, and I sell petrol, diesel both. I won't say I'll take petrol, diesel, I will say diesel I will throw. No, both are equally important. If two products comes out of the same production process, both are material, joint product. One is material, other one is immaterial, byproduct. I'll repeat, in the process of production, two products will arise. One is material, other one is immaterial. Byproduct and main product. Both are material. Joint products. Both are material. What is it? Joint products. Then what do we do? If it is byproduct, if it is, that byproduct will be valued at NRV. Byproduct will be valued at net realizable value, and that NRV of the byproduct will be deducted from the cost of production. Cost of production 10 lakh, byproduct certain number of units, NRV is 50,000. Deduct 50,000 from 10 lakh. 9 lakh 50 is the cost of main product manufacturing. Understood? Then let's see what is joint product. What is joint product? We have total cost of 10 lakh. This 10 lakh will be allocated between both products, product A, product B. Product A and product B. In what ratio? In the ratio of sales value generated by that respective units. Let's say joint product A, joint product B. Two products will come. Joint product A's selling price, joint product B's selling price. Number of units multiplied by number of units multiplied by selling price. If you do, you get total value. That total value will find one ratio. In that ratio, you will allocate the cost of production. In one production process, 10 lakh rupees is the cost. Using that, you manufacture product A, product B. Product A 2000 units, product B 5000 units. Product A 2000 units, rate let's say selling price about 10 or 12. Product B rate is about 30. You multiply number of units multiplied by rate, you get the total value. For that value, you find one ratio. In that ratio, you allocate this 10 lakh to both of them. That is if it is joint product. I'll repeat. If it is byproduct, what do? NRV of the byproduct will be deducted from the cost of production. After reducing the cost of production, that reduced cost of production will be the cost of the main product. What to do with joint products? Very simple. Identify number of units will be produced and the rate for selling price for each of the units, sale value, find the ratio. In that ratio, split the joint production cost between both the joint products. I hope you all understand. Very good. Shall we see a small question on this? Wherever possible, I'll make you do a small question to understand, but it will be at a little faster speed. Don't judge me based on the speed. You see it at 0.75x speed. Okay now? Yes. See this is the question. If you want, you can take a screenshot. Morning someone told, sir, video quality is too low. Then after that they checked. In the video they had put that video quality as 140p. Comment, what will even comment do? You put comment in ChatGPT, not here. Then we should go to change it. But did you get this question? What is the raw material cost? Is it part of the cost? Yes. Packaging cost 1000. Yes. Transportation cost 2000. Loading, unloading, insurance and freight. ITC available, not available. So you cannot take this money back from the government. Shall I include this in the cost? 1250 also. Conversion cost. This is also part of the cost. Add madi. Add fast. How much do we get? 1,10,000. I added everything, yeah. 1,10,500 is cost of production. Now, this cost of production needs to be allocated between two products, A and B. But are A and B joint products or one of them is it byproduct? We don't know. Case 1, B is joint product. Joint product means it is material. It has market. We have an intention to manufacture product B. Then what to do? Very simple. 500 into 400. 500 units of product A will come, no? 500 into 400. How much? 2 lakh. 200 into 250. Okay. That between those sales values, find one ratio. In that ratio, allocate this 1,10,500. Look at this. Product B joint cost will be 1,10,500. A and B together. What to do? Product A 500 units, 400 selling price, 2 lakh. Product B 200 units, 250 selling price, 50,000. Can I say 2,50,000 and 2 lakh and 2,50,000 is the expected sale values? 2 lakh is to 2,50,000. 3 zeros cancel, 3 zeros cancel, 1 zero cancel, 1 zero cancel, 20 is to 5, 5 ones are 5 fours are, 4 is to 1 is the ratio. This total 1,10,500 will be allocated between A and B in the ratio 4 is to 1. Do it for product A, 1,10,000 into 4 by 5, for product B, 1,10,000 into 1 by 5. 88,400 and 22,100 is the cost for product A and product B respectively. Did everyone understand this? Sir. Then let's go to case B. Case B, what did they tell? Same to same. Only change is product B is byproduct. When it is byproduct, no allocation like this. You know what do? I will write joint cost 1,10,500. Eliminate net realizable value of product B. Because when I sell product B, I'll get this much money. That much I'll assume that my cost has reduced. How much is my NRV for product B? It's given in the question. Expected selling price is 250. 250 into 200. 50,000 will be deducted and balance will become my cost for product A. Product B will be valued at 50,000. Product B will be sold at 50,000. I'm not going to book any profit. I'll eliminate that much of the cost and I'll write that much as the value of byproduct in my balance sheet. Did everyone understand? We have last concept to do in accounting standard 2, valuation of inventory. Shall we? What is the last concept to be done? How to value raw material and work in progress. Because that para 5, whatever we learned, no. Cost or NRV, whichever is less. That is applicable for finished goods. See, this paragraph what we're discussing now is applicable only for manufacturers. It is not applicable to traders. It is applicable only for manufacturers. This is not applicable to traders. So as a manufacturer, what I would do is I would buy raw material, I would convert it into finished goods and I would sell. I have an intention to sell finished goods only. Do I have any intention of selling raw material? No. Do I have any intention of selling work in progress? What is my intention? To sell finished goods only. To sell finished goods, no intention to sell raw material, no intention to sell work in progress. So my raw material will be valued at cost. My work in progress will be valued at cost. Even if my raw materials market price drops. I buy market only raw material at 10 rupees per kg. After I buy, market price goes to 8. I don't care. Am I selling raw material? No. I'm converting into finished goods and then selling. So I bought raw material for 10 rupees per kg. NRV became 8. I will continue to value raw material at 10. Till the time my finished goods is sold at cost or my finished goods is sold above cost. Till the time my finished goods is sold at cost or finished goods is sold above cost. What if my finished goods is sold below cost? Then I'm going to make loss, no? Finished goods is sold below cost. Then I'll make loss, no? Conservative approach. I need to book it now only. At raw material stage, I have fear now. I don't want to convert it to finished goods and sell it at loss. So what will I do? I might decide to sell the raw material only. So I need to value my raw material at NRV. I need to value my raw material at, I know only where to buy raw material. I don't know where to sell raw material. Okay, if you don't have NRV, value it at replacement price. At what value will you record it? Replacement. Okay, listen to me carefully. Finished goods till the time it is valued at cost or above. Basically, it's above is not possible. When you say cost or NRV, whichever is less for finished goods, it is cost is what it's recorded at. Then raw material and work in progress also will be valued at cost. The day finished goods, when you do cost or NRV, whichever is less, and it becomes NRV. Oops. Then raw material and work in progress both also have to be valued at NRV, not at cost. It should be valued at NRV and not at cost. Sir, for raw material, NRV is not available. Replacement price is considered to be best estimated. And for WIP, what do you do? WIP sometimes it's not saleable at WIP state. You need to convert it to finished goods and then sell. Finished goods selling price minus expense to be incurred to convert this work in progress to finished goods will become your NRV. And cost though you anyways have. Compare whichever is less and then record. Yeah, quickly read this. We'll try a question. And by that we'll finish accounting standard 2 and then we'll move to accounting standard 10. That's a good place to be if we can reach till there. Can we go to the question? Cool. Let's go to the question. I hope you read that. I'll show you a small example concept to cement this whatever we just learned. This is the question. Finished goods is 1000, work in progress is 600, raw material is 200. Estimated cost of completing 450, meaning 450 has to be incurred to convert this WIP to finished goods. Understood? And replacement price of raw material is 150. If in case you want to buy this raw material again, it's available in the market at 150 only. You gave 200 to buy. We don't really care about these two things till the time this is being sold at profit or this is sold above cost. See, 600 is cost incurred. You need to incur 450 more to complete. Oh my god, 1050 agudate. We don't care. Inventory was bought at 200 raw material, but right now in the market it's available at 150 only. So what? We don't care till the time this finished goods is sold at cost or above cost. The problem starts when finished goods is not sold at or above cost. I hope you people understood the question. I've given 3 different cases. Finished goods are expected to be sold at 1100. Finished goods are expected to be sold at 1000. finished goods is expected to be sold at 900. You can take a screenshot of the question, guys, who are watching it live or record it later. Okay, good. Now let's see this. Finished goods is sold, expected to be sold at 1100. Can I say when the finished goods cost is 1000, NRV is 1100, whichever is less becomes 1000 and it's valued at cost? Because finished goods is valued at cost, raw material and work in progress will also be valued at cost. How much is their cost? 600, 200. NRV, we don't care, will be valued at cost. Because finished goods is valued at cost. Because finished goods is valued at cost. Raw material and work in progress is also valued at cost. Come to the second case. Finished goods, can I say the cost is 1000? NRV is 1000. It is still valued at cost. So no change. Our raw material and work in progress will be continued to be valued at cost only. Let's see third case. Very beautiful case. Finished goods is valued at cost or NRV, whichever is less, which ended up becoming NRV. Now everything will change. Raw material and work in progress will be no longer valued at cost. WIP. How much is the cost of WIP? It's given in the question. 600. What is NRV? I cannot sell WIP. I can sell only finished goods. For this to become finished goods, I need to incur 450 more. Once it becomes finished goods, I'll recover 1000. If I convert it to finished goods, I'll get 1000 rupees. But for it to become finished goods, I need to pay 450. 1000 minus 450. 1000 rupees is selling price. 450 is selling expense. 1000 minus 450, 550. 550 is NRV of WIP. Can I sell work in progress? Half finished goods, I'm telling someone will buy. No, they will say no buy. They will say I will buy if you convert it to finished goods. How much? I'll give 1000. How much are they willing to give? Sorry. How much are they willing to give? But to make it finished goods, I need to incur how much? 450. So to get 900 rupees, I should spend 450. So how much is my NRV? 450. How much is my NRV? How much is my cost? 600. I should book whichever is less. So I will go by 600 cost or NRV of 450. Whichever is less, I'll write it at 450. My cost is 600. When I book it at 450, I'll make 150 rupees loss. Correct or not? You know why am I booking 150 rupees loss? Because already incurred 600. If I incur 450, it will become 1050. But I'll be able to sell only for 900. 1050 is my cost. I sell it for 900. I'll make 150 loss. That I'm booking now only. I won't wait to complete and then sell and then book. Conservatism. Got it? Yeah. Again, if it's becoming slightly fast, I would request you to go back for 2-3 minutes. Bring the speed down from 1.5x to 1x and then watch. 1.5x is standard speed, no? Some people attend class online for the entire week. Sunday they come to face-to-face class. He told me in the break, sir, you talk very slow. I told, I don't talk slow. You've been seeing me at 2x speed on YouTube. That you suddenly see me face-to-face talking at 1x, you feel I'm talking real. Raw material cost is 200. NRV is replacement price, which is 150. I will record it at 150, booking 50 rupees loss. Everybody understood? The last concept, cherry on the cake for accounting standard 2, reversal. What's reversal? By mistake, if you have reduced, you should change. Not by mistake. Like you thought it is valued at, it will be sold at a lower price and you reduced it. Later, if the price goes up, you change. I'll give you an example. Inventory is cost of 100. NRV is 80. What is NRV? Net realizable value. Net realizable value is expected selling price minus expected selling expenses. It is expected, not actual. If you sell, no, there is no expectation. It's actual. Then it will become loss. You bought it at 100. You are expecting to sell it at 80. So you are expecting loss of 20. So you'll record the inventory at 20 rupees less. But next year, it can be sold back at 90 or 100, no? Then your expectation went wrong. What do? You should reverse that loss in that case. Cost of the inventory, 100. NRV, 80. You wrote whichever is less, 80. 80 will become revised cost. Next year, if the NRV becomes 90, revise it to 90. You understood? That will become profit. What if next year, revised cost, that NRV of first year is 80. Revised NRV is 120. Reverse it up to 100, not beyond 100. Why? Original cost was 100. No? So read this. If economic conditions requiring write down to cost of inventory reverse or no longer exist, then whatever you have booked as loss previously can be now reversed. And you can restate the inventory back to original cost. Come on, let me show what I just told you now. Yeah, this is the question. First year, cost or NRV, whichever is less, 100 or 90, whichever is less becomes 90. Second year, that revised cost, that is NRV of first year, is 90, no? If NRV of second year becomes 80, right again, 90 or 80, whichever is less, bring it down to 80. In second year, it becomes 95. Take it up to 95. It is original cost and NRV, not this NRV and this NRV. You understood? Case 3, you keep it to 100. You keep it to, everybody got this? Very good. By that we call end of accounting standard 2, valuation of inventory. Let's then head to accounting standard 10, property, plant and equipment. Let's now begin accounting standard 10, which talks about property, plant and equipment. PP, a base standard for several standards to follow. When you talk about accounting standard 10, it talks about when to recognize PPE, how to depreciate, how to record for retirement of PPE, which is there but not useful, not yet sold, disposal, that it is sold. In all the cases, how to do the accounting is learned here. The standard applies to all assets, but it does not apply to biological assets. Biological assets are assets with life. They are living plants and animals. So to living plants and animals, accounting standard 10 PPE is not applicable. But there is an exception. There is a specific category of plants called as bearer plants. Are bearer plants biological assets? Yes. But to bearer plants is accounting standard 10 applicable? Yes. Usually accounting standard 10 is not applicable to biological assets. Biological assets exception is bearer plant. Meaning bearer plant is biological asset but covered under accounting standard 10. When do we call an asset as bearer plant? Very simple. When it is used in production of agricultural produce. Point number 1. It gives us agricultural produce. Point number 2. It will give that produce for more than 12 months. Means not just 1 year. Point number 3. There is remote likelihood of it itself being agricultural produce. You are not agricultural produce. You will give agricultural produce. You get it? For example, a coconut tree. Coconut tree gives us coconut. Coconut is agricultural produce. It doesn't give it only for 1 year. It keeps giving for several years. There are some coconut trees which are older than people in the class. Several coconut trees. You agree with me? And the coconut tree is not grown for its wood. It itself is not agricultural produce. It will give agricultural produce. Coconut tree is bearer plant. Mango tree. You grow mango tree not for its wood. Mango tree itself is not eaten. Mango from the mango tree is eaten. And mangoes are given for more than one accounting period. That becomes bearer plant. To mango tree, to coconut tree, accounting standard 10 applicable. It is an asset. You won't just keep that mango tree, coconut tree in your backyard. You keep it in your balance sheet asset side also. However, banana plant is not a bearer plant. Why? You don't just take the banana from the plant. You take the plant also. You take the leaves also. You take the stem of it and then make palya. You take the leaf. On that leaf you keep banana chips, banana gochu and then banana palya. Everything that you eat its own produce on its own leaf. And it won't survive. And there is no possibility that you cut the banana and then leave the plant and then next year again you leave banana. No, once and then. And whatever you grow for wood, no, timber, willow, sandalwood, those are also not bearer plants. You know why? Why? You grow them for their wood. You don't grow a sandalwood tree, cut its branch and then say stem will be there. Next year it will give one more branch. No, you cut that tree only completely. You understood? So they are not bearer plants. If it gives agricultural produce for a period greater than 12 months and it itself is not agricultural produce, then you call it bearer plant. And for bearer plant, though it is biological asset, accounting standard 10 is applicable. And AS10 is not applicable to wasting assets, mining resources, all of that. It is not applicable to investment property. Why? Investment property is specifically covered under accounting standard 13, investments. We don't read investment property in Inter. We read it in Ind AS CA finally only. But it is actually covered in AS 13. For these three items, AS 10 is not applicable. What is PPE? It has to fulfill our definition criteria. It is a tangible item. It can be used for the purpose of rental, administration, production of goods or rendering of services for a period longer than a year. Then it is PPE. What is it? It is a tangible item which is used for the purpose of rental, administration, production of goods or rendering of services, and the expected use from this is for greater than a year. Then it will become PPE. Fulfilling definition criteria is not sufficient for it to be recognized in balance sheet. To recognize it in balance sheet, yes, it has to fulfill definition criteria. Further, it has to fulfill recognition criteria. What is recognition criteria? 2 points. 1, FEB. 2, RM. It should give us future economic benefit. Second one, there should be reliable measurement of its cost. Only when there is future economic benefit from this asset and you can reliably measure its cost, it's part of our PPE. Otherwise, no. We discussed AS2 just some time ago. There I mentioned 3 items. What are those 3 items? Material supply, consumables, and loose tools. I told these 3 will be part of our inventory, para 4, though they are not fulfilling inventory criteria. Similarly, there are 3 items in accounting standard 10. Spare parts, standby equipment, and service equipment. Here there is no straight away entry. You are PP. No. Standby equipment, service equipment, spare part. To be called as PP, it has to fulfill definition criteria. If it doesn't fulfill definition criteria, it is not PP. What is standby equipment? There is one big machine. To run that machine, you use some ladder. You use some crane. Standby equipment. Service equipment. There is one big machine. To repair that machine, you have one tool. Is the tool PPE? Can be. In order to call it PPE, it has to fulfill definition criteria. Do you all understand that? Then we have service equipment, standby equipment, same thing. And if there is any safety equipment that you buy for environmental safety, that is also considered as property, plant and equipment as per accounting standard 10. So what is the future economic benefit? Sustainable development ಅಂತ ಹೇಳ್ತೀವಿ. Safeguarding the nature, safeguarding the environment, safety of the employees, safety of the consumers is also necessary for survival. That is considered to be PP. I hope you understand. Then recognition of cost will happen at 2 stages. 1, initial cost. 2, subsequent cost. Initial cost means at the time where you incur. Subsequent means after you make use of the asset, in the future you might incur some further expenditure. That will also be considered to be part of PPE, but such subsequent cost doesn't have to fulfill definition criteria. It's already fulfilled definition. Initially it is recognized. Now it has to only fulfill recognition criteria. Any expenditure incurred on repairs, on all of this, usually it's not added to the cost. It's charged to P&L. However, if it can fulfill recognition criteria, if it can prove that it's going to give us future economic benefit and there is going to be reliable measurement of such cost incurred, then it will be considered to be part of PPE. We won't charge it to PL, we add it to the cost of the asset. Let's talk about subsequent recognition later. Let's right now focus on initial cost. Initial cost will include 3 things. What are the 3 things that is including? Number 1, purchase price. Number 2, directly attributable cost. Number 3, cost of dismantling. This is different from AS2. In AS2, we'll tell purchase price, conversion cost, other cost. Here we say purchase price, directly attributable cost, cost of dismantling. Cost of dismantling is something new, which is there exclusively in AS10, which was not there in AS2. I'll tell you what this is. Purchase price. Any money that you pay to buy an asset is cash price. It will be included at cash price. Interest should not be included in the cost of the asset unless it is allowed by accounting standard 10. Sorry, accounting standard 16 as qualifying asset. Now, what I would want you to know is whenever you buy an asset, let's say you give full cash and then you buy the asset, that is cash price. Sometimes you are going to buy the asset. They will tell you, Cheche, sir, don't pay full money, EMI. Then they will say, sir, no interest, 0% interest, full amount financed. 1 lakh rupees will be deducted 10,000 from your account 10 months. Now you will say the cost of the asset is 1 lakh. But you need to also check, sir, what is the price that you would charge me if I give full cash immediately? You will say, sir, if you are giving full cash immediately, we have 20%, we have 10% off, sir. I will not charge you 1 lakh, I'll charge you 90,000. But cost price is 1 lakh. They will say discount of 10 if you pay cash. Then let us say you choose to buy EMI option. Then also the cost will be actually 90 and not 1 lakh. So, but I pay 10,000, 10 times 1 lakh. You pay that. What is the cash price? 90. What is the price that you're paying? 1 lakh. You're paying 90,000 to 1 lakh, 10,000 difference extra because you're availing that credit period. So, for availing the credit period, if you pay slightly extra amount, that extra amount what you pay is interest. That extra amount what you paid is interest should be charged into PL. Interest should not be added to the cost of the asset. If you have to add interest to the cost of the asset, then that asset should be qualifying asset. And that borrowing should be specific borrowing, and that interest should be incurred during the period before the asset is ready to be put use. We'll learn it in AS16, next to next standard. But as of now, unless AS16 allows, we should not record the asset at the purchase price. We should record it at cash purchase price. For deferred credit, if there is any interest charge, that should be eliminated. See this, interest included as per AS16, same for interest in deferred price. Should we include tax? If input tax credit is not available, it will be included. If input tax credit is Available, it is not included. You will read it otherwise, no, in GST. In GST, you say if that input tax credit is included in the cost of the asset and depreciation is charged, then input tax credit is not available. I will talk, please. Okay. Whenever you pay the tax, if the tax amount is included into the cost of the asset and depreciation is charged, then input tax credit is not allowed. However, if in case it is not included in the cost of the asset, then input tax credit is actually allowed. That's how you read there. But there are several other things also that you should know in GST. That asset should be used for business purpose, input tax credit available, invoice should be available, and it should not be part of blocked credit items. There are several things that should be taken care of. One of the things is this. I hope you understood. Next step. Not every time you buy the asset, you pay cash considerations. There are certain times where you buy the asset for non-cash consideration. There are certain times you buy the asset for non-cash consideration. What is non-cash consideration? You take in exchange of another asset. Careful, little tricky, might sound very easy, but it is not. You need to always check whether there is commercial substance. What is commercial substance? Very easy. We have one asset. We exchange it to another asset. Old asset that we had, cash flows from this asset, expense incurred, income earned. If it is different from the cash flows from the exchanged asset, then commercial substance exists. If the cash flows with the old asset and cash flows with the new asset are not different, it is same. There is no commercial substance. I'll repeat. When do we say there is commercial substance? Cash flows from the asset before exchange, cash flows from the asset after exchange. If they are different, there is commercial substance. If the cash flows from the old asset, cash flows from the new asset are same, they are not distinct, they are not different, then it is no commercial substance. Whenever there is commercial substance, you have an intention to sell. You sold an asset, you bought an asset, there will be profit or loss. If in case there is no commercial substance, you exchange the asset, no profit, no loss. You can never write P&L. I'll tell you what to do if there is commercial substance. If commercial substance exists, the asset that you receive should be recorded at fair market value of the asset that you give. You understood? If in case fair market value of the asset that you give is not available, then record this asset at the fair market value of that asset is. Asset I gave, asset I received. There is commercial substance, meaning cash flows are different from both assets. The asset that I received is something that I purchased. At what value do I record this? At fair market value of the asset that I gave away. If fair market value of the asset that I gave away is not available, then record it at the fair market value of this asset. You understood? Pakka? There is a lot of questions that I can make you do on this. If you start doing questions, then we'll be gone forever. We can never come back. In the same YouTube channel, if you search for Accounting Standard 10 PP non-cash consideration, you'll get a video. You can watch that for this part. Please mark this as important. You would have to do questions on this. You can't skip. You would have to do questions on this. You can't skip. This is something important. Then any expenditure incurred till the time the asset is ready to be put to use. Transportation, installation, trial run, everything. Inauguration cost is not included. Till the time that is ready to be put to use, all costs will be considered. Once that asset is ready, you intentionally delay the utilization. During that period, initial operating losses should not be capitalized. Once it is ready, stop. You understood? What if it is partly ready? Partly stop capitalizing. Partly continue capitalizing. You would find this Wonderla amusement park question and all of this. So you need to be little cautious. Let's say 80% of the asset is ready. 20% is still getting ready. So 80% you start commercial production or 80% you start commercial purpose. For this 80% stop capitalizing. For the balance 20% you can continue capitalizing. And this 80% when you start utilizing, if you make some losses, that loss is not to be included in the cost of the PPE. It should be charged to P&L only. And the last part of Accounting Standard 10 basically talks about cost of dismantling. At the end of the useful life of the asset, you might have to dismantle the asset and then sell. You can't just throw it as garbage. If you have to dismantle the asset and sell at the end of the useful life, the cost that you expect to incur at the end of the useful life has to be anticipated, discounted to today's date and included in the cost of the PPE now. This is something slightly new, but you have to remember to do this. There are no questions on this anywhere in your study material, but questions can come. I'll show you a cute question. No, bike is different. See, cost of dismantling. Have a look at this. There is no question on this. This is based on FM. Someday if they want to ask one tricky question in the exam, it can be on this. Not usual, but tricky. When they say paper is difficult, no, that time it will be difficult because they would have put some question like this, some new corner of the standard. See this question. Okay. Sometimes questions like this can come in audit also. Asset is purchased and installed for cost of 1 lakh. Useful life is 5 years. After 5 years, to remove the asset and then throw, you need to incur 20,000 rupees. Now, discounting rate is 10%. See, at 10% for 5 years, if you discount 20,000, it comes to 12,418. Cost to be incurred after 5 years is 20. Today's discounted value, present value of 20,000 for 5 years is 12,418. Today when you record your PPE, don't book it at 1 lakh. You have to record it at 1 lakh plus 12,418. You would record the asset at 1,12,418. You understood? But 12,418 you don't have to pay. You have to pay the vendor for the asset 1 lakh. 12,418 you create provision. On that you add interest for 5 years. First year you add interest of 1,242. Second year 1,366. Interest expense will be booked, provision will be credited. If you book expense for 5 years, that provision will become 20 and that will be paid at the end of year 5. FM and accounts crossover. This is, you would have done this in FM, no? Accounting for that is year. First year you create provision for 12,418 and you further add finance cost of 1,242, charge it to PL. Second year again you create further provision of 1,366 by charging PL. Third year again 1,503. Fourth year 1,653. Fifth year again 1,880. By doing this, total provision created over 5 years will come to 20. 20 will be paid at the end of year. I hope everyone understood. Very good. Come on, let's get back to this part here. Yeah, by this we're done with this much. And to go further, we'll understand subsequent cost. Usually, subsequent cost is not taken into the cost of the asset. We have to prove that this subsequent cost is going to increase the future economic benefit of the asset, and you should be able to reliably measure this cost incurred. In the case of overhaul of an aircraft and all of that interior change of an aircraft, maintenance charges or annual inspection, those costs will be added. If not, if you're not able to prove with evidence that it will give future benefit, don't add it to the cost, charge it to PL. Then let's talk about depreciation of PPE. Depreciation is systematic allocation. Depreciation needs to start the day the asset is ready to be used. It has to stop the day asset is derecognized. Meaning like you stop recognition criteria, future economic benefit. Derecognition criteria, no future economic benefit. So the day you expect it to not give future economic benefit, stop charging depreciation. Or the day you dispose it, stop charging depreciation. And depreciation is done component wise, not item wise. You identify group of assets, buildings, depreciation together, plant and machineries, depreciation together, motor vehicles, depreciation is done together. But when you group them, that asset, though the name of the asset is same, purpose should also be same. You might use car or you might use motor vehicle for transportation of goods as well as for commute of passengers. Both are not same. If you have two motor vehicles, one is for transporting goods, one is for transportation of people, this you can follow different depreciation method, this you can follow different depreciation method. Let's say you have building, factory building, office building. Both are building, but the purpose is different. So you can follow different depreciation for factory, different depreciation for office. But if you have office 1, office 2, office 3, all the three one component, same method of depreciation. You cannot say office 1 I'll follow WDV, office 2 I'll follow one more method. No. And there are few methods of depreciation which are allowed. You can only follow straight line method, diminishing balance or production unit. You get it? Sir, I want to follow sinking fund method, not allowed. You have to follow one among these three only. And depreciation is based on historical cost of the asset, useful life of the asset and residual value. Historical cost is the money that you paid when you bought the asset. Useful life is the value, is the period for which you can use the asset. And residual value can be the value that you receive at the end of the useful life. Here, how can you tell today what is the period for which you can use the asset? It is a guess, estimate. How can you tell how much will you recover at the end of its useful life? It's just a guess again. So these two can vary. They are accounting estimates. These two can vary. They are accounting estimates. If in case the useful life changes or the residual value changes, it is change in accounting estimate. It has to be given prospective effect, meaning from the year of change you will give. Initially you thought 10 years useful life. Asset is 1 lakh. You started depreciating it 10,000, 10,000, 10,000 every year. 4 years over. 60,000 is the balance. Now you understand the remaining useful life is no more 6 years, but remaining useful life is 4 years. So you won't tell 4 plus 4, 8, first in the 8 years, no. From now, 60,000 will not be depreciated over remaining 6, it will be depreciated over remaining 4, 15,000 every year. So what change do we give them? Prospective. This is as per accounting standard 5. Estimates have to be reviewed at the end of each year, and we have to give what effect? Prospective effect. Cost of dismantling, what we initially estimated, can change. I'm telling how to change that model, but better. This you keep it out. Don't have to revise it lastly. There is no questions on this anyway, but I wanted to cover it, so I've done that. We do it in the regular class, but don't have to do it in the day before the examination. Chances are very less. Then let's see the models that we can follow for valuing the asset. Initial years, you have to follow only one model. What model? Cost model. First year always we have to follow cost model. Subsequent years, you have two options. One, cost model. Two, revaluation model. Cost model may you will record the asset at original cost less depreciation, you will get the WD. Under revaluation model, you don't take original cost. You will be like, hey, I feel the value of the asset is this. You take that revaluation model. That revalued amount can be more than the original amount, can be less than the original amount. You understand? Can be more than the WDV or can be less than the WDV, not original cost. More or less WDV. If in case you increase the asset, it is called upward revaluation. If in case you decrease the asset, it is called downward revaluation. When we do upward revaluation, PPE will be debited, credit will be given to revaluation reserve. When you do downward revaluation, asset will be credited, PPE, debit will be to P&L. Not every time we increase the value of the asset, it is upward revaluation. Sometimes you are increasing the value of the asset up, but that is not upward, that is reversal of downward. I'll repeat, not every time you increase the value of the asset, it is upward. Sometimes it is reversal of downward. Got what I'm trying to tell? If an asset of 1 lakh was revalued to 80,000 in the past by charging 20,000 to PL. This year, if I have to revalue it back to 85, it is not upward revaluation. Previously we did downward revaluation 20, now I am reversing 5,000. So usually when we do upward revaluation, we write PPE to revaluation reserve. In this case, when I do upward revaluation by 5, I will say this is not upward revaluation, this is reversal of downward. Previously I would have charged it to P&L, no? Now reverse the P&L part. You understood? Entry will be PPE debit, no credit revaluation reserve, credit P&L. Similarly, whenever you do downward revaluation, let's say the value of the asset is 1 lakh, you are bringing it down to 80. When you do that, you usually write P&L to PPE, downward revaluation. It might not be downward revaluation, it might be reversal of upward. Previously asset was 70, you took it up to 1 lakh, now you are bringing down to 80. You are correcting your old mistake. So credit PPE, but you don't have to debit P&L, instead you can debit revaluation reserve to the extent available. To the extent, sir, what do you mean to the extent available? Revaluation reserve, whenever you create, when you revalue the asset upward, there are two treatments. Number one, adjust it to the, we would say directly transfer to P&L immediately. Second option, transfer to P&L over the useful life of the asset. Usually entities follow the second approach. Now asset is 1 lakh, depreciated over 10 years. How much depreciation do we charge every year? 10. Now instead of 1 lakh, I revalued it upward to 1 lakh 10. Now what will happen? Asset will become 1 lakh 10. Depreciation every year is 11. Expense increase, no. So the 10,000 what I created upward revaluation, that will be charged to P&L as income 1. So expense 11, income 1. So impact will remain same. But that 1 is not charged to P&L credit, it is P&L reserve. Appropriation, post appropriation, not to P&L account. So after tax, we do that. I hope you understood. There are two options. So the balance in revaluation reserve, whatever is there, so much will be reversed here. If it is beyond, then we will not. I hope everybody got this part. Say something. Yeah, this is the treatment of revaluation reserve. See this? Treatment of revaluation reserve. Transfer to retained earnings. You keep it with you till the time the asset is there. The day asset is sold, that day you derecognize. Second option is transfer to P&L over the period when the asset is used. It won't be transferred immediately. It will be transferred at the end when the asset is derecognized. Sorry. Okay. Then little if you want, you can transfer to retained earnings over the useful period. I hope you guys got it. This is with regard to revaluation of the asset. Let's continue accounting standard 10 property, plant and equipment revision from where we left in yesterday's session. We were discussing revaluation. I told you that asset can be revalued upward or can be revalued downward. If we revalue it upward, we write it to revaluation reserve. If we revalue it downward, we write it to P&L. If it is revalued upward, balance returned to revaluation reserve will remain in revaluation reserve till the time the asset is there. The day we de-recognize the asset, that revaluation reserve will be transferred to P&L. Alternatively, you can transfer a portion of that revaluation reserve to P&L account every year over the useful life of the asset. When I say P&L, I mean to say P&L reserve, not P&L account, not statement of profit or loss. Let's see a small little question on this part. Have a look. There is carrying amount of 10. It has to be revalued upward by 2, making it 12. The entry will be property, plant and equipment debit to revaluation reserve 2. If in case subsequently you want to revalue the asset downward by 2500, it is not downward revaluation by 2500. It is reversal of upward to the extent of 2 and downward by 500. It is reversal of upward to the extent of 2 and downward by 500. That's where we do revaluation reserve 2000, whatever was credited here, previous upward revaluation will be reversed and only the downward revaluation of 500 will be charged to PL. It might so happen sometimes that before you do this downward revaluation of 2500, some portion of this 2000 has been transferred already to PL. So let's say here only 1500 is available in revaluation reserve. Then what do? Then you can actually only debit 1500 here, because what is available in revaluation reserve for reversal is only 1500, and 1000 will be charged to P&L, crediting PPE by 2500. I hope you understood. Upward, downward, reversal of upward. Similar things works with reversal of downward also. Next, I would want you all to come back to the point of discussion. There are several questions that we usually do in the class: upward, 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 downward, downward, upward, upward, downward, several scenarios. But I think you people are smart enough to figure it out now. Now I would want you to note the point of derecognition. What do you mean by derecognition? Derecognition is sale of asset or removal of the asset. We are no longer going to use the asset. Whenever you no longer use the asset, that is derecognition, it happens because of two things. One, there is no future economic benefit expected from the asset. Number two, it is disposed. Disposal leads to derecognition. I hope you got it. If it is one asset sold, you did your CA foundation depreciation chapter, removal of asset, same thing. We'll write bank account debit to asset, remove the asset, write the bank account difference will go to profit and loss on sale of the asset. But it becomes very interesting when you remove a part of the asset and sell, or you remove the part of the asset, it is scrap, but you don't know the cost of that asset. For example, you bought a bike and you use the bike for 5 years. After you use the bike for about 5 years, the engine needs a replacement. You remove the old engine, you install the new engine. New engine is subsequent cost to be recognized. Why? The new engine will give you future economic benefit and you can reliably estimate the cost of new engine. And bike and engine can be worked one without the other. I mean to say, not like bike will run without engine. I mean to say, bike will have a longer useful life than engine. Then engine can be replaced into the same bike. Now, when you incur expense to buy a new engine to the book value of the bike after 2-3 years depreciation, you can add the cost of engine. That's not the problem. When you add the cost of new engine is coming in the place of the old engine. Old engine has to be removed. That value has to be de-recognized from the cost. But when we initially recognize it, we wrote bike as one single asset, including the cost of the chassis and engine. There we have not split it. Later date, if we have to de-recognize the engine cost, how do we do? There's a question of this type. It was asked in one of the RTPs also, last to last attempt, and a possible question in the examination. I would want you to please focus on this question. Shall we? Have a look. Bike was purchased on 1st of April 2020 for rupees 1 lakh. Engine of the bike was seized on 31st of March 2024 and scrapped. So 2021, 21, 22, 22, 23, 23, 24. 4 years you use the bike with engine. After 4 years, bike engine has ceased and now you are replacing it with a new engine. A brand new engine was bought for rupees 30,000. That 30,000 is subsequent cost. Why? That engine is going to give you future economic benefit and there is reliable measurement cost. You know 30. So that 30 will be added to the bike cost. But when you add 30, you need to remove the value of that old engine. So you should have identified in 1 lakh rupees purchase price of the bike, how much is engine, how much is other than engine. You should have depreciated it for 2021, 21, 22, 22, 23, 23, 24. Then balance of it should have been removed. But when we bought the bike, we didn't ask them how much is the cost of the bike, how much is the cost of engine. So what to do now? We need to do it based on estimate. You understood the question now? Can I proceed to the answer? Whoever is watching it online, if you want, you can take a screenshot of the question at this stage. No. Moving on to the answer. See, we have purchased the bike for rupees 1 lakh. Depreciated for year 1, year 2. Okay, what did we say? Move this numbers a little. Yeah, we bought the bike for 1 lakh. We depreciate for first year 15, you got 85. We depreciate for second year 12,750, we got 72,250. We depreciate for 10,838, we got 61,430. Here we have to depreciate it again. It is at the end of year 2024 that the engine is getting replaced. I will deduct again depreciation 9,212. Here I am removing the old engine, adding the new engine. New engine cost I do know. How much is the cost of new engine? 30,000. But I don't know the cost of the old engine to be redeemed. How would I get to know? Here for 1 lakh I should have known the split. Once I know the split, from here I'll go on depreciating it, find the value here and then deduct it here. Because I am not aware of the value, I will follow an accounting estimate which tells us that today, after 4 years, if the engine is 30,000, what would have been the cost of the engine 4 years ago if the discounting rate is 10%? If the discounting rate is 10%, what would have been the cost of the engine? That's what we should do. How do we do? 1 by 1 plus r whole to the power n, discounting. So 30,000 divided by 1.1, 0.1 is 10%. To the power 4 means 4 years. Please do it. What do we get? 1 by 1.1 to the power 4. What do we get? You get 20,490 to be the cost of the engine. Estimated, not realistic cost. This is the estimated cost of the engine on 1st of April 2020. This is estimated cost of the engine on 1st of April 2020. Did everyone get it? Estimated cost of the engine on 1st of April 2020. Now take this to be the cost, depreciated by 15%. You will get 3,074 depreciation. If in case you choose to deduct it, you will get 17,417 as WDV. Again depreciation at 2,612, you get 14,804. Again depreciation at 2,221, you get 12,583. Again you depreciated at 15%, 1,188. What is remaining? 10,000. This is the value of the engine, WDV of the engine. If you had bought it at 30,000 rupees at the beginning, eliminate that 10,696 now. After eliminating the 10,696 worth of old engine only, we can add the cost of 30,000 to the PPE. This 10,696 is de-recognition. Are we selling the old engine? Scrapped. It will pay you 0 rupees. But PPE should be credited to the extent of 10,696. I mean to say, we need to write bike account credit 10,696. If you would have received consideration, I would have written cash. Because I did not receive any consideration, I would have written P&L account debit for 10,696 rupees. I hope everybody got this. This, my friends, is what I would want you to know on de-recognition. By this, we have done really good understanding of almost the entire accounting standard 10, property, plant and equipment. Now let's move to the next standard. Let's do accounting standard 13, investment accounting. Another beautiful standard. It's more of accounts, less of accounting standard. Anyways, that doesn't differentiate the way we do. We'll anyways do all the concepts first, and then wherever possible, let's take some examples to see the numbers. Accounting standard 13 talks about investments. Investments are assets which are held with an intention of earning dividend, interest, rental income or capital appreciation. Using this, you will earn dividend if it is an equity share preferential. You will earn interest, maybe if it is a debenture. You will earn rental income. So rental income, investment property is also investment as per AS 13. If you buy one 3 BHK flat in JP Nagar and then give it on rent, it earns you interest income. That, my friends, is investment. It is covered under AS 13, but you don't have any questions on that in your CA inter syllabus. In CA final, when you come to Ind AS, there investment property is a separate standard, investment is a separate standard. I hope you got that. So dividend, interest, rental or capital appreciation. Capital appreciation is, it might not give you dividend or interest. Over a period of time, the value of that asset will increase and will get you higher value when you sell. Capital gain is your objective, not income from other source. So in that case also, it can be considered as investment. Certain items are not covered under AS 13. AS 13 doesn't tell you when to recognize dividend income, when to recognize interest income, how to recognize rental income. That is told under AS 9. And next thing is, if you have invested some money in the form of an investment and that is given on operating or finance lease, then don't come to AS 13, go to AS 19. Last thing is, you have invested money in investments that is fetching you dividend or interest, but that investment is made in the form of a plan asset. What is plan asset? You have a liability to pay your employee a certain amount of money on their retirement. To ensure that you pay him so much money, from today you started investing some money. That investment what you make is for the purpose of capital appreciation, dividend or income, interest income. But because this investment is specifically regulated by accounting standard 15 in the name of plan assets for employee benefits, don't apply accounting standard 13 to these investments. That's what AS 13 says. Specifically excludes recognition of dividend income, revenue, dividend income and rental treatment. Next one, operating and finance lease based assets. Number 3, investment for the purpose of employment benefits. I hope you understood. Now, investment properties out of our jurisdiction in CA Inter. Let's now focus only on current investments and non-current investments. Basically, financial instruments. Investment in financial assets like shares, debentures, bonds, all of these things. Now, talking about this, in the beginning of this standard only, we have to divide any investment into one of the two categories. One, current, two, non-current. One is current, second one, non-current. Why do we have to classify them into current and non-current? Because the provisions of accounting standard 13 regulating current investments is very different from the provisions regulating non-current investments. When do we call an investment as current? When do we call an investment as non-current? The usual misconception is they think actual period of holding. If they say held for more than 12 months, non-current, held for less than 12 months, current. So is it like till first year happy birthday it is current and then after that it becomes non-current? No, it is intended period of holding. You get what I'm trying to tell? What are we talking about? Intended period of holding. If your intention is to hold it only for 3 to 4 months, your intention is not to hold it for more than 12 months, it is current investment. Sir, what I actually held for 2 years, it's okay, you keep it for 2 years. What is your intention? To sell it in short term, but you actually held it for more than 12 months. It is still considered as a short term investment or current investment. You have intention to hold it for a very long period, but by mistake you sold it in 3 months. Though you held it only for 3 months, your intention was to hold it for a longer period. This is actually a non-current investment. It is actually a non-current investment. Did you understand? We are not talking about intended, we are not talking about actual period of holding, but we are actually talking about intended period of holding. How do we value current investments? Current investments should be valued at cost or fair market value, whichever is less. Current investment should be valued at cost or fair market value, whichever is. On the other hand, non-current investments are always valued at cost. Non-current investments are always valued at, unless such decrease in the price of non-current investment is permanent in nature. If in case the decrease is permanent, then it will be valued at decreased price. Otherwise, non-current investment cost, current investment at cost or market price, whichever is less. The next question is, what and all will cost include? See, we're doing chapter 5, which deals with accounting standards based on assets. 5.1 AS2 asset definition, cost definition is different. 5.2 AS10 PP cost definition is different. 5.3 AS13 cost definition is different. There in AS2 inventory, what did you discuss? Cost will include purchase price, conversion cost, other cost. In AS10 PP, I told cost will include purchase price, directly attributable cost, any other expenditure incurred which is directly related or till the time the asset becomes ready, includes dismantling cost. But when we talk about AS13 investment, cost will include purchase price, brokerage, stamps and duties. What and all will cost include? Purchase price, brokerage, stamp and duties. Purchase price is the money that I pay to buy. Brokerage means I don't know the seller. Seller doesn't know me. Both of us are commonly known to a broker. A broker helps me meet the seller and from him I buy. Because the broker helps me meet the seller, broker will charge me a portion. To the seller I pay 10,000 rupees, to the broker I pay 1,000 rupees. My purchase price of that investment is 10,000 what I pay to the seller and 1,000 what I pay to the broker, together 11,000. I hope you got it. And after I buy it, to ensure that he doesn't say that I stole it from him, I enter into an agreement. I have given you consideration, you have received consideration, you are selling it to me. I enter into one agreement. Maybe that agreement has stamp duty to be paid. That stamp duty what I pay is also part of my cost. If I need to pay some registration charges to register that security or investment in my name, that cost is also, that part is also included in my cost. What and all is included in AS13 investment cost? Purchase price, brokerage, stamp fees, duties and several other things. I hope everybody got this. Fantastic. Remember, we need to write only purchase price. It should not include interest. It should not include dividend. It should not include interest. It should not include dividend. Now you might start asking, sir, why do we include interest? Very simple. The debenture or that specific bond, whatever you're buying, let's say it will fetch interest 2 times a year, 30th July and 31st December. 31st July and 31st December. 2 times in the year it will give you interest. And you are buying that bond from me on, let's say, 1st of September. When you buy it on 1st of September, you will become the owner on 1st of September. You will hold it till 31st of December. On 31st of December, when the company announces interest, You held it only for September, October, November, December, 4 months. Company should give you 4 months interest. And I was holding it before September. July was the last time they gave interest. August and September. Company should give me 2 months interest. Company should give me 2 months interest. Company should give you 4 months interest. Okay, 30th June and 31st December. 30th June I have received interest. July, August I have kept it with me. 1st of September I sold it to you. September, October, November, December it's with you. July and August it's with me. 2 months with me, 4 months with you. On 31st December when they give interest, they should give you 4 months interest. They should give me 2 months interest. Company is not jobless to do this. You know what company does? Company will give you full 6 months interest. You understood? You bought it from me, no? You're getting 6 months interest. But what is your period of holding? 2 months belong to me. So when I sell you the investment, I will say this much money for investment you have to give. This much money interest what I have earned, but you will receive, you would have to give me. I will collect interest from you. Now that interest what I collect from you, you will give. But is it part of your investment cost? No. You will give me 2 months interest, you will collect 6 months interest. 2 months interest given to me is expense to you. 6 months interest what you collect will become income to you. Difference, 4 months interest is your income, profit is equal to profit and loss account. Because your actual period of holding is only 4. You understood this? Very good. Then I'm going to tell you something very important now. I want you to be cautious with this part. People are watching at 1.5x, 1.75x. This is the point where you make it 1x. Did you reduce the speed? Now listen. Brokerage will be mentioned in the question sometimes as a percentage. When brokerage is given as a percentage, on what amount should you compute brokerage? Should the brokerage be computed on cumulative interest price that you pay on purchase, or should brokerage be computed on X interest price that you pay? Whatever is given to us in the question. If the question mentions cumulative interest price for a transaction, apply brokerage on cumulative interest price. If the question mentions X interest price for a specific transaction, apply brokerage on X interest price, because broker doesn't understand X interest, come interest, X interest, come interest. When he is there standing, when he looks at you both buy and sell, whatever price you quote to each other, on that he will take commission. So if you want to pay lesser brokerage and commission, you should agree X interest price on the agreement. Interest you would have to settle privately. In the question, if they give cumulative interest price, on cumulative interest price only apply brokerage. Stamp duty also can be there in the question. Okay, now I'll take you to small number of questions and I would want you to understand certain things. There are 5 things that you have to always catch hold of and learn before you do any problem on accounting standard 13. So what is it? Number 1, you need to identify the, I think I've given those 5 points somewhere here. I'll show it. Give me a minute. Should be there at the end if I'm not wrong. Last half. No, it's not there anywhere here. One second. It should be there here. Ta-da. If it's not here, then I'll tell you. Okay, it's not here. Anyways, I'll tell you, rather than spending time to finding it, it's easier to tell. I'll mention there are 5 things that you need to always catch before you start doing any problem on accounting standard 13. 5 things. Number 1, interest date. Number 1, interest date. Number 2, interest rate. Third one, year end. What are the dates on which interest is given? What is the rate at which interest is given? When is the year ending? Fourth one, is there any brokerage or stamp duty? Fifth one, are they following average cost or first in first out? Number 1, interest date. Number 2, interest rate. Number 3, year end. Number 4, brokerage or stamp duty. Is there anything mentioned in the question? Last one, is it average cost or is it first in first out? Because you solve the entire problem, write all purchase transactions, write all sale transactions, come to the end of the question and then you see, oh, brokerage 1%. Everything gone now, all purchase will change, all sales will change. You don't have time to do it again. So first only you try and catch. You solve the full problem. Then you realize your year end is 31st December, not 31st March. Full answer gone. And you assume average cost basis as first in first out or first in first out or average cost. Then your cost computation will be gone, profit or loss will be gone, and then closing balance also will be gone. So these 5 items what I mentioned now, if you don't catch them, your full answer will go for it. So remember to catch 5: interest date, interest rate, year end, then brokerage or stamp duty in the question, followed with method of averaging. Got that? Then come on, let's see this example question. Cumulative interest price, meaning on 1st of May we bought 510% debentures of X Limited at nominal value 10. Cumulative interest price is 13. What is the price at which we are paying? 13. But it is cumulative, meaning what? It will include interest. So what you would have to do is, there is brokerage also at 2%. You should always record the investment excluding interest. I told you, no, purchase price excluding interest. So what to do? Write cumulative interest price. 500 debentures into 13, 6,500. Before you adjust interest, first add brokerage at 2% to it. Then deduct the interest from the last date of transaction till the last date of interest to the date of transaction. Before this purchase, 1st of May, when was the last time company gave interest and you collected interest? Interest is given on 31st December and 30th June. Before 1st of May, you had collected interest on 31st December. Then count the period. January, February, March, April. 4 months. Compute 4 months interest on nominal value. 500 debentures into 10 rupees nominal value. Into 10%. Into 4 by 12. Did you understand 167? In the 6,500 consideration that you gave, 167 rupees you paid towards interest. Deduct that 167. You get 6,463. That, my friends, is the purchase price of investment. But the amount that you pay to your seller is 6,500. Amount that you pay to your broker is 130. Cost of investments is 6,463. Interest 167 is an expense to be recorded separately. See, cost of investments 6,463. Amount paid to seller 6,500. Amount paid to broker 130. If you open investment account debit side, you will write 1st of May to bank, nominal value of investments 500 debentures at 10, 5,000. Amount column you will write cost of investment 6,463. In the interest column you have to write 167. This cumulative interest price. If in case instead of giving cumulative interest, if they are given excluding interest, then this interest need not be deducted. Need not be deducted. You would have written 6,500 plus 130, 6,630 here. Interest will be still computed to be written in interest column, but you won't deduct it from this price. If it is included in the purchase price, eliminate it from cumulative interest price to find X interest. I hope everyone understood. Look at the same example. If it is excluding interest price, same 500 debentures at rupees 13. I'll write 500 into 13, 6,500. I'll add brokerage, but I won't deduct interest. 6,630 will become the cost. Interest is computed so that I can write in the interest column, but it is not deducted from this. This remains 6630, this remains 167. I hope everyone could make sense out of this. This is how you record a purchase transaction. Next thing I would want to focus, I would want all of you to focus is on sale transaction. Whenever there is sale transaction, you sell the investment and you get the cash. From the cash consideration that you get, again, treat interest separately. Interest is income. Other than interest amount, what you collected is the consideration towards the sale of investment. Same thing. See, how many debentures are you selling? 500. 10% debentures, nominal value 10. Cumulative interest price is 13. You are selling it at 13. And there is brokerage of 2 rupees. What you have to do here is first identify 2% brokerage on the amount. You sold 500 debentures at 13, 6,500. I hope everybody got it. For purchase, brokerage will get added. You pay money to the seller, you pay money to broker. So total money will become your cost. For a seller, you sell your debenture to a customer, buyer. He will give you money. From the money that he gives, you pay brokerage. So brokerage has to be deducted from sale consideration. From 6,500 sale consideration, deduct brokerage of 2%, which is 130. After you deduct that, you need to also deduct interest. Why? He paid 6,500 cumulative of interest. Some amount of it is your interest income. When have you last received interest? Before 1st of May. It is 31st December. After 31st December till 1st of May. January, February, March, April. 4 months interest income has to be recognized. On 500 debentures at 10 rupees nominal value at 10%. If you do 500 into 10 into 10% into 4 by 12. Whatever interest income is there will be deducted to find the cost of the investments to be 6,203. 6,203 will become the sale price. And our amount received from buyer is actually 6,500. Amount paid to broker is actually 130. Now, whenever we do purchase transaction, eliminate this interest, record it and then proceed. But whenever you do sale, you have to identify profit or loss on sale. How do you identify profit or loss on sale? Cost will be given to you. In this example, I have given that it is cost is 11. If they don't give, you need to apply first in first out or average to find. I'll teach you an example then. So please do same number of debentures. 500 into 11, 5,500 to be cost. Your sale price is 6,203. Cost is 5,500. 703 will become your profit on sale because sale price is more than cost. After you identify the sale price, please compare it with the cost to find profit or loss. I hope everybody got it. Now I want you all to draw the attention towards the concept of what exactly do we mean when we say FIFO and VAM. This is the question. I want you to take a look at the question. If you want, you can take a screenshot as well, and we'll start solving this. I want you to have a look at this question. This question will help us understand how to determine cost when the sale of investment has happened. Because determining cost is very crucial in determining profit or loss. Shall we have a look at this? Have a look. Opening balance is 100 units at rupees 11. After that, we purchased investments in 2 units, 2 sets. One 150 units at 13. Once we bought 150 units at rupees 14. And we're selling 200 units. Case 1. If in case I follow first in, first out, I have sold how many? 200 at the rate 15. 200 into 15, 3000 is the value I receive on sale. I need to compare this with the cost so that I can identify profit. How do you find cost? Very simple. We're following first in, first out. So the investments what came first will go out first. When I sell 200 units, it will be first sold out of this opening 100. But that's not sufficient. I need 100 more. Next 100 is sold out of this 150. In that 150, still 50 will be remaining. But I will sell 100 there. Can I say 100 units out of this 200 were originally bought at rupees 11 and additional 100 units were bought at rupees 30. So 100 into 11, 1100, 100 into 13, 1300. Putting them together, 2400 is the cost of acquiring the units which I sold. If I have sold it for 3000 and if my cost is 2400, can I say profit is 600? Very nice. This is if I follow first in, first out method, wherein I first sell it out of the opening balance, then I'll sell it out of the first purchase, then I'll go to second purchase. Alternatively, there's another method called as weighted average method to determine cost. If I follow this method, my sale consideration is same, 200 units at 15, 3000. But my cost computation is slightly unique. I would write it this way. Opening balance 100 units at 11, the value is 1100. First purchase what I made on 1st of May is 150 units at rupees 13, 1950. Sir, but we're selling only 200. Wait. Then we made one more purchase on 31st of August. This is again 150 units at 14, which comes to 2100. Add all the values. 5150 is the total cost for 100 plus 150 plus 150, 400 units. For 400 units, if the cost is 5150, for 200 units that I sold, what would be the cost? 200 into 5150 divided by 400. 2575 will become the cost. 3000 is sale consideration, 2575 is cost. Sale consideration is more than cost. Then we can comfortably find the profit of 425. I hope everybody understood this. This is how we compute under VAM and this is how we compute under FIFO. This is the question. FIFO, VAM. I hope everybody understood this. This is with regard to fixed income bearing securities, which will give us the fixed income every period. Beautiful point that you would also always have to remember to ensure that your answer doesn't go wrong is chronology. What is it? Chronology. In AS13, remember the chronology. Write down the transactions that has happened in the chronology and then solve them in chronology. Now, date is very important because between one purchase and another purchase, if there is interest date, interest due, after you write the first transaction, purchase, before you write the next purchase, receive interest on the investments that you had on that date. Then you write the other purchase. If in case you write the next purchase, then your number of units will change and you might write higher amount of income, which you actually not earned. So remember the chronology, opening balance, and then after that the transactions in the exact chronology sequence in which they're happening. After every 2 transactions, ask, is there interest date? Check. That's the reason when I asked you to open the ledger, I told you need to write 5 things. 1, interest date, write it there, 30th September and 31st March, 30th June and 31st December, write it there. And interest rate, mention it next to the investment. And write year end also on that ledger, 31st December, 31st March, whatever. And write whether it is VAM or simple VAM or FIFO also mentioned there only. And last part was brokerage. If there is anything, write all this, you mention it above the ledger and then only start with the investment ledger, so that you don't have to make multiple visits to question paper to solve the answer. And another point is, should you be writing the entire answer in one page? This has been tested in the past. Many students have told in the class that you can write this way. You don't have to write all debit credit in one page squishing it. You can write debit items in one page. In the next page you can write credit items, but you cannot use margin. Cannot use margin. First option. Second option is, instead of writing in the paper like this, you can change the alignment like this and also write accepted. In the past, people have written debit in one page, credit in one page, they've got marks. They've written debit, credit like this, they've still got marks, provided their answer is right. Then, sir, you told I wrote, I didn't get marks. I told you will get marks, provided you write correct answer also. Okay, just giving you one small heads up into what you should be doing. Then the next thing that I would want all of you to know is the variable income bearing securities. Variable income bearing securities is equity shares. Fixed income bearing securities are, once again, fixed income bearing securities are debentures, preference shares, bonds, fixed deposits. Variable income bearing securities are equity shares on which the rate of dividend is not fixed. 1 year 10%, 1 year 15%, 1 year no dividend, 1 year 2 to 3 dividends, anything is possible. Against this, we cannot compute that interest, whatever we used to compute as a fixed amount. Can't do. The day it is declared, we write. The day it is not declared, we can't write. And when we do equity shares, couple of other new adjustments also will come into picture. One is bonus shares, two right shares. I'll teach what to do with bonus shares, what to do with bonus shares, what to do with right shares, and then treatment of dividend. Once we discuss treatment of dividend, right issue and bonus issue, we're done with this variable income bearing securities also. Then we can discuss classification and then go to accounting standard 16. Now, to begin with, let's discuss bonus issue. What do you mean by bonus issue? Free shares. Capitalization of reserves. Company gives the shares free. As an investor, you are doing accounting from whose perspective in this case 13? Investor. As an investor, you don't pay money, but you get shares. You don't pay money, but you still get shares. When you don't pay money, but you still get shares, nominal value of shares will increase. Nominal value of shares will without increasing the amount column. So what you would have to do is pass something like a journal entry, not a journal entry, right? Like a journal entry with amount column 0. Only to increase number of shares and nominal value of shares. Let me show small, cute, sweet little example of what I just mentioned. Bonus. See here, bonus issue, whenever it happens, you hold 20 shares of a company at rupees 100. Company issued 1 share for every 2 shares. If you hold 2 shares, they'll give 1 share as bonus. How many shares do you hold? 20. How many bonus shares should be given? 20 into 1 by 2, 10 shares. You held original holding of 20 shares. Company gives bonus of 10 shares. Cost of original shares is 100. Bonus, no cost, no value. So this 2000 will become the value not of 20 shares but of 30 shares. So when you do 2000 by 30, the cost per share will become less. So number of shares will increase, nominal value will increase, total cost will remain same. So the total cost divided by number of shares, if you do, the cost per share comes down. That's what bonus issue will do. I hope everybody got it. Next we'll discuss right issue. And when bonus shares are sold, always take average cost. Don't take first in first out. Say I've got the shares free. Now when I give, I'll get full consideration as my profit. No. For bonus shares, always compute average price. For bonus shares, when it is sold, always compute average price to find profit. Don't say bonus shares were received free. Full sale consideration is profit. If you write like that, full marks will be cut and then you will be asked to write again. Then talking about right issue. Come on. What is right issue? We've discussed it in EPS. Right issue is issue of shares to existing shareholders. Right issue is issue of shares to existing shareholders. As a shareholder, whenever the right issue happens, I have 3 options. As a shareholder, whenever the right issue happens, I have 3 options. Option number 1, subscribe to right shares. Option number 2, renounce the right shares, sell it to somebody. Option number 3, do nothing. If I subscribe, I pay money and then I buy. I am investor here, I am not the company. I pay money and I buy. We discussed in EPS that the right issue price is slightly lesser than the market price. So whatever price you pay and buy, that will become your cost. Market price is 15, you bought it at 12, it's okay. Number of shares you buy multiplied by 12 will be written in the investment account on the debit side to bank. So many right shares value, amount value you write, that's it. This for right issue where the shares are subscribed. Treat it just like purchase. What if you renounce the rights, sell it to somebody? Whenever you sell that rights, you are selling rights, you are not selling shares. When you sell investment in the form of shares, it will be written in investment account credit side. But when you only sell the right to buy the share, that will not be written in investment account credit side. That will not be written in investment account credit side. What do? Number of rights multiplied by sale price per right, you get the value. Full amount put it in P&L account credit side. Full amount put it in P&L account credit side. This is the thumb rule. You understood? But there is one small tricky part that can be asked, usually not there, but we've discussed this at large in the regular class. You bought the shares just before right issue. Company is announcing right issue, you bought the shares. And after you bought, company announced right shares. And what did you do? You sold those rights in the market and received full consideration. That full consideration will go to P&L as profit? Yes. But after that right issue, market price will drop. When the market price drops, you value your investment at cost or market price, whichever is less. When you do cost or market price, whichever is less, market price is less. So you reduce the cost and book that loss to PL. Just to know, you bought the right shares on 30th of March. 31st of March, they announced right issue. 1st of April, market prices gone down. So you bought it at 100 rupees. But 2 days later, you are reducing the cost of the investment to 80. That's not right. 20 rupees went to P&L account as expense. And sale of rights, 20 rupees is income. So this income is because of this expense. So don't write that sale consideration of rights in P&L account credit. Instead, it can be adjusted against the cost of investment. It is an option. Is it compulsory? No, option. I'll repeat once again. If in case after you bought the shares, the company announces rights, and once the rights are announced, you sell the rights and you receive money, full amount of profit is transferred to P&L credit, then the value of the investments has decreased in the market, and when you do cost or NRV, whichever is less, it becomes NRV, and you book loss, and that loss goes to P&L. Instead of booking loss on valuation of investments on the debit, profit on sale of rights on the credit, to the extent of loss, profit on sale of rights can be adjusted against the cost. Did everybody understand? This is a point to be noted. Then there are no questions on this usually in the study material, but someday if they would want to ask something very difficult, then this can be the case. Because it's marathon revision, our target is not like do 60% of the syllabus or do what's sufficient only to get 60 marks. No, whether it is marathon revision or regular class, we'll ensure to touch upon even those points which can be very rare possibility in the exam, but can still get that mark to you if the paper is of max difficult level. Last point of discussion with regard to equity shares, dividend. You need to remember dividend is income. Dividend is, where do I transfer dividend? P&L account. So I bought some equity shares. On that equity shares, if I receive dividend, it should not be written in the amount column. In the investment account, I should write it in dividend column. I should write it in dividend column. However, if in case that dividend is given out of the profit which was earned before I became the shareholder. The dividend is given out of the profit earned by the company before I became the shareholder. Such dividend is called pre-acquisition dividend. This is the reasoning. People usually tell pre-acquisition dividend means dividend received before earning, dividend received before buying. If you don't buy, then how will you receive dividend? They give dividend to you out of the profit earned by the company during the period during which you are not the shareholder. You bought a dog yesterday, today it gave birth to a puppy. You are not the father. The contribution was there before you bought it. That becomes, how many times will you laugh at the same joke? Come on. So that is pre-acquisition dividend. That pre-acquisition dividend is not income in P&L. That pre-acquisition dividend should be reduced from the cost of investment. Usually dividend income will go to credit side dividend column in your investment account. If it is pre-acquisition dividend, don't write it in dividend column, write it in amount column, reducing the cost of investment. I'll help you understand with the help of an example here. This is this. Let's see. Okay, see this. Dividend is declared on 1st of July. You have bought the share on 1st of May. But dividend declaration date is not our point of discussion. Dividend is declared for 1st of April 23 to 31st of March 24. During this period, you are not the shareholder. You bought it on 1st of May. So you will receive the dividend, but the dividend is pre-acquisition dividend. Meaning that dividend what you received after you purchase the share on 1st of May was out of the profit earned by the company between 1st of April and 31st of March 2024, during which you are not there as the shareholder. So what dividend is it? Pre-acquisition dividend. If you were holding the share on 1st of January 2024, that is part of the period 1st of April 23 to 31st of March 24. Then if you receive dividend, yeah, it is post-acquisition dividend. Sir, what if I bought it on 31st of March? Even for 1 day in the previous year, if you are holding that share, it is post-acquisition. If not, it is pre-acquisition. If it is post-acquisition dividend, it will be profit to be transferred to P&L written in dividend column. If it is pre-acquisition dividend, it will be adjusted against the cost of the asset. I hope everybody understood. Okay. Then after that part, then I would want to tell you certain things. If in case the company makes bonus issue, then additionally issued shares, then makes right issue, then makes final dividend, then makes interim dividend, what to do? On this original shares of 1000, you get bonus. On this original shares plus the bonus shares, you will get this right issue. And on this original shares, this bonus shares and the shares that you purchased and the right shares that you got, no, on that will you get final dividend? No, final dividend is given on the shares which were there last year. On this original shares you get final dividend, on the bonus shares you won't get. On the purchased shares you will get final dividend if those purchased shares were existing previous year. The shares that you purchased can be bonus shares, can be other than bonus shares. On the shares which are not bonus shares, which were there in the company last year also, on those shares you get your final dividend. But when you talk about interim dividend, you get on the original shares, bonus shares, purchased bonus shares, purchased other than bonus shares, right shares, and all of this together you get final dividend, interim dividend. Interim dividend is dividend declared between two final dividends by the board of directors in the board meeting. Final dividend is the dividend declared by the members in the member meeting, which is proposed by the board, approved by the members. I hope everyone understood this. This is with regard to dividend that you would want to know. The last concept that I want you all to not forget but do in the topic of investment is reclassification. Reclassification means initially I classified investment into current, non-current. Am I right? Initially you called some investment as current. Now can you change it to non-current? Yes, you can. Or initially you called some investment as non-current. Can you now convert it to current? Yes. A current investment can be reclassified to non-current. A non-current investment can be reclassified into current. When you classify a non-current investment to current investment, how do you value it? It should be valued at cost or carrying amount, whichever is less. A non-current investment, when it gets reclassified to current, on the classification date, we need to check the cost of non-current investments and its fair market. I should check the cost or its carrying amount if it has been decreased. Whichever is lower is what we apply for the non-current, current investment that we're taking. It is long term. We're taking it to short term. It is long term. We're taking it to short term. This long term investment should be originally recorded at cost. But if the decrease is permanent in nature, it is reduced to carrying amount. Whichever is less will be the value to be assigned to short term investment. Vice versa, if there is a short term investment, if the short term investment is being made long term, it should be valued for one last time at cost or market price, whichever is less. Whichever is less, that will become the cost of long term investment. I hope you understood this. For long term to current, what to do? Cost or carrying amount, whichever is less. For current to long term, what to do? Cost or fair value, whichever is less. By this we can say we have successfully completed all possible things and all possible adjustments on accounting standard 13. I'd want you to keep a note of couple of things for you to try before you say you are ready for the examination. Do at least one question with fixed income bearing securities like debentures or bonds. One question on debentures or bonds. One question on debentures or bonds. And in that question, see weighted average or cost. Weighted average or first in first out, you please observe. Maybe one on first in first out, one on weighted average. Do one question on first in first out, one question on weighted average. Done. Second question that I would want you to solve on investment accounting is, please do solve a question on equity shares with pre-acquisition dividend. On equity shares with pre-acquisition dividend. Bonus issue and right issue I know you'll handle. Minimum pre-acquisition dividend is a must. Repetitively they've asked also in the exams pre-acquisition dividend based questions. I hope you people made a note of it. Pre-acquisition dividend. So these three questions you do. One is debentures or bonds with first out one question, weighted average method one question, and you do question on equity shares with pre-acquisition dividend. Or just glance, bonus issue and right issue. Glance, bonus issue and right issue adjustment. Glance, bonus issue and right issue adjustment. Let's now begin accounting standard 16, which is chapter 5, unit 4, which talks about borrowing cost. The beginning of the standard is with beginning the definition of the word borrowing cost. We usually tend to believe that borrowing cost is interest. Interest is a form of borrowing cost. Interest is not the only thing in borrowing cost definition. Any finance charge, any interest or commitment charges, discount on issue of debentures or premium on redemption of debentures or bonds, amortization of ancillary costs, along with exchange difference to the extent regarded as non-foreign exchange difference, that is borrowing cost, can be considered as borrowing cost. So FIDAE, that's the shortcut. F, finance charges. I, interest and commitment charges. D, discount on issue of debt instruments or premium on redemption of debt instruments, amortization of ancillary costs, exchange difference to the extent regarded as borrowing cost. So all 5 of them are together called as borrowing cost. But all the questions that you get in the examination is on interest only. Can they test on other things? Yes. Will they? I hope not. I don't really see the possibility. The best that they can do is this can come. Exchange difference arising from foreign currency borrowings to the extent regarded as interest. We'll discuss these two only. In fact, entire thing that's in your syllabus is also revolving around only these two things. Have you ever seen a question where debentures were issued at discount and you identified the discount on issue of debentures as borrowing cost and capitalized into the cost of the asset? No. Maybe one fine day they'll add some of these questions in our study material so that our material becomes spiced up, and because advanced accounting syllabus is too small, it will become slightly bigger. That's the hope, fingers crossed. Now, let's talk about borrowing cost. This interest or borrowing cost, so usually it's charged to PL. Where do we charge it to? That's it. No, interest account debit to bank, P&L account debit to interest. But Accounting Standard 16 says, with that interest, if you're adding some value to the asset, meaning that interest is paid because you took the loan to develop an asset, and that asset is going to give you future economic benefit. If that asset is not like ready instantly, if that asset is going to take a lot of time to become ready, in that case, that interest cost incurred on the loan taken for the development of the asset need not be charged to PL, added to the cost of the asset, saying that it is directly attributable expense to bring the asset to working condition. To give you a simple example, let's say I'm constructing a building. To construct the building, I'll take 3 to 4 years. For the purpose of construction, I've taken loan. On that loan, I pay interest. Till the time the building gets completed, 5 years, I have no income from the building, but I'm charging interest to P&L. That interest, it is not 1 year expense for me to transfer to P&L. Yeah, that interest is computed for year 1. But the benefit of that first year interest is not 5 years. Benefit of that interest of 1 year is till the time the building is used. So what I do is that first year interest, second year interest, third year, fourth year, fifth year interest on the loan taken for the purpose of construction of the building, I won't charge it to PL, I will add it to the cost of building. Let's say the construction cost of the building is 1 crore. 5 lakh rupees interest will also be added to building. Building will become 1 crore 5 lakh, and 1 crore 5 lakh will be depreciated over the remaining useful life of the building. By this, what I am doing is interest is incurred today, but it will not be charged to P&L today, because the benefit of that interest is added to the cost of the asset. Until the date the asset is useful, depreciation will be charged on the same. But to do this, asset should be qualifying asset. The asset should be, what do you mean when you say qualifying asset? Asset should be taking substantial period of time to be ready. Asset should be taking substantial period of time to be. It's not like asset is brought, plug connected, press the switch, machine is ready. No, asset will take substantial period for it to be ready to use. Substantial period is not defined in accounting standard. Accounting standard interpretation 1 tells substantial period is usually period of 12 months, but it's not hardcore. It's not like an asset will take 11 months, 15 days, not a qualifying asset. 12 months, 1 day, qualifying asset. No, it's not like that. An asset which takes 11 months can be called as qualifying asset. Some of the assets will take 15 months to be ready, but it can be still considered not a qualifying asset. So 12 is not a rule. It's just interpretation. It is just some asset you took 11 months to complete, but actually it would have taken 13-14 months. But you make people work in 2 shifts and all of that, you give them extra money, you push them really hard, you motivated them, yeah, you put some motivational song in between, like unstoppable, see how you do it, and then you push them to do. They did it in 11 months, 29 days. But actually they should have taken 14 months. It's still a qualifying asset, though you took only 11 months. Some asset, installation can get over in 3 months. They were listening to the songs and they did slow work. They were not listening to unstoppable CR rap song or something. They were listening to some old Kannada melody song, and slowly they worked. And they took 1.5 years completely to complete the installation of the asset. But it could have been over in 6 months. No, just because you took 1.5 years doesn't mean it is qualifying asset. Doesn't mean you add it to the cost of the asset. Just because you take 5 years to do BCom, your BCom doesn't become MBBS. It's still BCom only. You understand? Time is not the only criteria to call it qualifying asset. It is, does it deserve so much time? So qualifying asset decision is based on 12 months, based on interpretation and not based on the actual rule. Accounting standards are not rule based. It is principle based. You get it? Rule means you see red color signal, you have to stop. Principle means hindegade ambulance ide, mundegade red light ide. Hey, munduku ok jaga bidri. This guy will take red ticket. No. So the point is principle there, not rule. You can break the rule if it upholds the principle of helping each other, humanitarian, and a lot of other things. I hope I don't have to talk about it. Yeah, let's go further. So if it is a qualifying asset, the asset takes substantial period to be ready, then the borrowing cost can be capitalized. If it is not a qualifying asset, interest will be, or borrowing cost will be charged to PL. Even if it is qualifying asset, not the entire interest will be capitalized. The moment you start commencing the capitalization, when say development of the asset, you start capitalizing. You stop capitalizing the day asset is ready for its intended use. You start capitalizing when the money is spent. You stop capitalizing when the asset is ready. In between, if you want, you can temporarily suspend. Pause button is also available if the active development of the asset is stopped. Are you getting it? Now, talking about the starting point, there are two starting points. Isn't it the same starting point? No. It depends upon the type of borrowing. If in case the money that you borrowed is specific borrowing, you need to start capitalizing the interest from the date you borrow, not from the date you spend. Whereas, if in case the borrowing is general borrowing, you start capitalizing not from the date you borrow, but from the date you spend. Let's say you borrowed money on 1st of April. You spent the money on 1st of May. If it is specific borrowing, though the money is spent, borrowing is used for construction on 1st of May, interest is computed from 1st of April to the cost of the asset. However, if it is general borrowing, money is borrowed on 1st of April, spent on construction on 1st of May, from 1st of May you capitalize, not from 1st of April. I hope you guys are understanding what I'm trying to tell. Why from 1st of May? General borrowing means you've taken that money just like that. You can use it for any purpose. You need not use it only for construction. You can use it to bet, juju, rummy 11 or fantasy cricket league, anything, under bar, anything you can spend that money. General borrowing. You can use it for your working capital management, giving salary to employees, anything. Specific borrowing means when you took that loan to the bank, you told, I want this loan for this purpose. You should use that loan for that purpose. Can you take specific borrowing and use it for general purpose? Yes, sorry, car only uditare. You would have read, no, in car, one of the points, short-term funds used for long-term purpose. Sorry, long-term funds used for short-term purpose or something. I don't know which class, sir, audit accounts. So one clause is there, no? There you get stuck. It's a good enough point for a qualification. So if you borrow money for short term, you should use it for short term. If you borrow money for long term, you should use it for long term. You cannot raise share capital and use it for working capital management. You understood? You cannot raise short term loan and use it for fulfilling one long term capital gap. That's very important. So general borrowings, money can be used for any purpose. So on general borrowings, you start computing interest to be capitalized from the date on which it is spent. For specific borrowing, you start computing the interest to be capitalized from the date on which it is borrowed. On this very topic, May 2024 examination, question number 1A, new scheme of education, advanced accounting, first question, beautiful question. First adjustment was this. And usually the ICS study material, usually the way of answer solving is there. No? If you follow that, pakka wrong answer. I'll tell you the reason why, and I'll tell you what is the small tweak that I would want you to do in the way you solve the answer. The second point that I want you to notice, interest is computed only till the date asset is ready. Now, asset is ready on 31st of January. February and March, asset is not still under development. Asset is ready, you are using the asset. You pay interest till March, but interest paid till January will be capitalized. Interest for February and March should be charged to PL. In the same May 24 question, this was also put. The asset became ready by 31st January. Usually we have the tendency, 10 by 12, 4 by 12, 3 by 12. You took 12, Dama, gone. You have not taken 12. Why? Asset is ready by 10th month. And usually you run 10 months, 12 months, 12 months, 12 months. Their asset took only 10 months to be ready. So is it not a qualifying asset? It is still a qualifying asset, though it took 10 months. Assumption. When an AS16 question comes, if you assume it is not a qualifying asset, then it is not an AS16 question only. You will write full amount to P&L. You just converted 6 marks question to 1 mark. Don't do that. then your one paper exam will get prolonged by 6 months. So what you should always do is assume that it is a qualifying asset when you're writing the answer, when the question is tested on AS16. Last point before I teach you a couple of example questions. If in case you have made a specific borrowing, the borrowing that you made specifically, that money is not immediately utilized for development of the asset or installation of the asset. That money during its idle period has earned you some interest income. You have made the specific borrowing, it is not used for the purpose of the building the asset. For some period it is idle. During the idle period you earn some interest income. That interest income will not go to P&L. That interest income has to be deducted from the cost of borrowing. Borrowing cost will reduce. Why? Very simple. You borrowed the money on 1st of April. You spent it on 1st of June for the asset. When did you borrow? 1st of April. When did you spend it on the asset? 1st of June. April, May, 2 months it is idle, no? During the idle period, it is just lying in your bank account, it pays you interest. But during those 2 months, you paid interest. That interest is added to the asset. That interest income should be deducted. You're paying 16% interest. It fetched you 8% interest in savings bank. That 8% interest has to be deducted from the borrowing cost. I hope you understood. Read this fatafat. Specific borrowing. Borrowing specifically made for the purpose of obtaining the asset. General borrowing, not borrowed specifically. Sometimes they don't use the word specific borrowing in the question. They will use the word special loan. What is so special about it? Nothing. Specific borrowing is told as special loan. Then rate for specific borrowing will actually apply the actual borrowing rate. For general borrowing will apply weighted average rate. Meaning if there is more than one borrowing, which rate to apply? Weighted average of all of it together. And for specific borrowing, when do you start capitalizing? Date of borrowing, subject to fulfillment of conditions. Then what about general borrowing? You compute it from the date of spending, subject to fulfillment of what condition? The asset should be qualifying asset. You understand all of that. Then idle period. During the idle period, if in case you earn any interest income from specific borrowing, what do? Deduct it from the specific borrowing cost. What about general borrowing? During the idle period, interest cost is there, no? That is not added to the cost of the asset. So during the idle period, interest income is not deducted. During the idle period, specific borrowing interest cost is added to the asset. So during the idle period, interest income is deducted from the borrowing cost. Do you understand? I have borrowed money. I have not utilized it for development of the asset. During that period, what interest we pay is also added to the asset in specific borrowing. So during that period, interest income should be deducted. For general borrowing, during the idle period, interest is charged to PL. So income also should be transferred to PL. I hope you understood. Last one, priority. First use specific borrowing. After that, if it is still left, then use general borrowing. I hope everybody got it. Then we have to discuss the exchange difference part. But before we come to exchange difference, I'll show you a couple of small questions on this part. I hope you are ready to accept this. I'll find a question which we spend the money in installments and specific borrowing goes to more than one. Usually the kind of questions are like this. Usually, I'll tell you the interesting question later. Money spent is 5 lakh, 7 lakh, 5 lakh, 4 lakh. If this is the case, how much is specific borrowing? 4 lakh. Usually 99% of the questions are specific borrowing gets exhausted in first only. It doesn't come to second installment. And I've seen lot of students doing amount multiplied by period. They do product, they find total product and then they allocate specific and general. Don't do it. Don't do it. Very high chances of getting wrong answer in some cases where the specific borrowing comes to second installment. Don't do it. You understand what to do? Individually you allocate. 5 lakh alay. If you want, you can take a screenshot of the question before I proceed with the answer. Have you seen the question? Let me go to the answer. In 5 lakh, see, this is what you do. 5 lakh into 12 by 12, 7 lakh into 8 by 12, multiply it with the period, total weighted average cost. Then you write it into specific and general. Study material also, this is how they've given the answer. This works till the time this specific borrowing of 4 lakh is lesser than the first spending. If this specific borrowing becomes 6.5 lakh, 7 lakh, then first spending is specific borrowing, second spending is also specific borrowing. Then your answer will go for a toss. Why? Because it is specific borrowing, you need to compute interest from date of borrowing. But here you would have counted from 31st of July. So you don't get your answer right. This is your style. My recommendation, do it like this. This much is question. How much is specific borrowing? 5. In that specific, how much is the first spending? 5. In that specific is 4, general is 1. and 7 lakh general, 5 lakh general, 4 lakh general. Write the period, multiply and identify interest here, and then take the total interest to be capitalized. Will it take more time, less time? It will take less time, 3 months. If you understand what I mean. Not 10 seconds save agate, 1 minute save agate. Got it? Then I'll take you to the next question where they would have given you more than one general borrowing, where we would have to take the average. This is interesting. See, money spent is 5 lakh, 7 lakh, 9 lakh, 4 lakh. 4 spendings, 4 different dates. How much is specific borrowing? This is a very good question. I want all of you to focus on this question. People watching it online, you can pause and then take a screenshot of this question. We're going to discuss this in detail now. Okay, I won't spend too much time solving it from the scratch, but we'll straight away deal with the answer. This 5 lakh first expense is specific or general? This 7 lakh is there, no? This is specific or general? 5 lakh is specific, 2 lakh is general. 5 lakh is specific, 2 lakh is. See, when did this 7 lakh get spent? 31st of July. But 5 lakh of it, which is specific, though the money is spent on 31st July, I will compute interest from 1st of April. For the general borrowing of 2 lakhs, I will compute the interest from 31st of July. That's what I've been telling now from such long time. For general borrowing from the date of spending, for specific borrowing from the date of borrowing. Then 30th September, general. 31st of January, general. Why? Specific borrowing is only 10. There are 2 general borrowings. Which one did we use first? Which one did we use next? I don't know. So I'll take average. 6 lakh into 12% interest amount you get. 14 lakh into 11% interest amount you get. Total interest divided by total loan. See, you do like this. 6 lakh into 12%, 72,000. 14 lakh into 11%, 1,54,000. Total comes to 2 lakh 26. Divided by 20 lakh rupees, which is my loan. You get 11.3% as your effective rate of interest or average rate of interest. So, on the first 5 lakh specific, I'll apply 12 months, 10%. On the second spending of 7 lakhs, specific is 5. Money is spent on 31st July, from where it's actually 8 months till the time the asset is ready, but still I'll take 12 months. Specific borrowing. On the general borrowings, I'll apply 11.3%. This is the answer I want all of you to note. We'll take the total interest of 173,450. This will be added to the total cost of the asset. 5 lakh plus 7 lakh plus 9 lakh plus 4 lakh. I'll add 173,450. I hope everybody got this. And if there is interest earned on the idle period on this specific borrowing, no, then that will be deducted from this 1 lakh. Meaning, second 5 lakh of specific borrowing, when did I spend? 31st July. When did I borrow? 1st April. April, May, June, July. 4 months that 5 lakh was left idle. Let's say on that 5 lakh I want some 10,000 rupees interest. What do I do? On this 173,450, I will deduct 10,000 and then write here. So general borrowings, why don't you do? General borrowings, I'm taking it from the date of spending, no. Before that date, I'm not taking interest expense. Before that period, I won't take interest income also. I hope everyone understood. This is the first category questions. Second category question, which has been never asked in CA Inter in the new scheme ever, but will be asked in one attempt whenever the paper becomes tricky, is foreign exchange to the extent to be recorded as borrowing cost. I'll teach you that. Before that, one variety of new question that's been put on the analysis part in the study material. I've beautified it a little. This can come as a case scenario question. I want you to observe this. This is a question. Can I explain? Holding company borrowed 10 crores from bank. Holding company borrowed 10 crores from bank. After borrowing 10 crores from bank, no, holding company has given this 10 crore to subsidiary by way of capital, shares. It gave it to subsidiary and took shares from subsidiary. Subsidiary company spent this money on acquiring an asset. I'll repeat, story starts at the bank. Bank has given loan of 10 crores to holding company. Holding company invested it in the subsidiary in the form of capital. Subsidiary spent this 10 crores in qualifying asset. Now, it is a qualifying asset which takes substantial period of time. Here there is loan, we pay interest. Can that interest be capitalized into the cost of the asset? Interest can be capitalized if the loan is taken. Subsidiary company did not take loan. Subsidiary company has received money by way of capital. On capital, there is no interest. Sir, imputed ಇಲ್ಲ actual ಇದ್ರೆ ತಗೊಳ್ಳಿ, ಇಲ್ಲ ಅಂದ್ರೆ ಇಲ್ಲ. Sir, in imagination, if I would have taken loan, ಅಂದ್ರೆ then I would have given you interest, then you take. Now it is not imagination. In reality, have you taken loan? Subsidiary? No. Subsidiary has taken shares, so subsidiary cannot capitalize this interest. Then you say, sir, holding company actually pays interest. Correct. Can holding company capitalize? Yeah, but is this asset belonging to holding company? No, it is my subsidiary's asset. Holding company's asset is shares, and shares here, it is ready the moment you buy the shares. Is there installation required for the shares? No. Share is not a qualifying asset. So interest is paid by holding company, qualifying asset is held by subsidiary company. Interest cost cannot be capitalized by subsidiary because there is no interest to subsidiary. Interest cost cannot be capitalized by holding because it has interest expense, but it does not have qualifying asset, and investment is not a qualifying asset. They are in trap now. What is it that they should have done? Bank should have given loan directly to subsidiary. Holding company should have given guarantee. Then bank is in the name of subsidiary. Subsidiary would have been able to capitalize. Or holding company borrowed the loan and holding company gave it to subsidiary, not in the form of shares but in the form of debentures. And that money, if it is used by subsidiary, then also it would have been possibility. They are coming to us after they did the entire thing. They should have come to us before. Then as a chartered accountant who knows AS16, maybe would have been able to help them better. Or as a chartered accountant who knows Ind AS 23 would have been able to help them better. Ind AS 23 almost same. You crack AS16 beautifully, in your CA final you will be like cakewalking the Ind AS 23 concept. Several parts of your CA final are completely based on what you learn in your CA intern. Okay, I hope you people are clear with this part. A question can come based on this in your case law. I don't know, I can't guess. Case scenario based question li barbodu. Be careful. Then let's talk about our foreign exchange difference, which can be regarded as borrowing cost. Yeah, see, this is a scenario. In India today, each dollar is rupees 80. After 1 year, we are expecting it to become 87. In India right now, if you borrow money, interest rate is 12%. In USA, it is 3%. You want to buy one asset from US. Now you tell me, when you need $10,000 to buy that asset, you have two options. Either take loan in India at 12% or take loan in USA at 3%. Where would you take loan? You will say USA only 3% interest. USA only 3% interest. So I'll take loan in USA. Very good. Good decision based on numbers. Let's say you take that loan. You pay interest. Is interest borrowing cost? Yeah. Can we capitalize interest? Yeah. At what rate? 3%. Now, when you buy the asset of $10,000 in USA by making the borrowing at 3%, then what would happen? Asset price will be $10,000. Loan taken is $10,000. That asset will be recorded in India and the liability will be recorded in India on the prevailing rate on that date. What is the exchange rate on that date? 80. $10,000 into rupees 80 per dollar. My dear friends, can I say the asset will be recorded at 8 lakh and loan will be recorded at 8 lakh? At the end of the year, you pay interest. Interest will be paid in dollars or paid in rupees? Dollars. On the dollar loan. Dollar loan is 10,000. On $10,000. On $10,000 loan, you pay 3% interest. $10,000 into 3%. $300. 300 interest, is it paid at the beginning of the year or the end of the year? So on $10,000 at 3%, if you do, you get $300. Exchange rate on that date is 87. Multiply $300 with 87. 26,100 rupees will be paid as interest. You have taken loan in USA. $10,000 loan, interest rate 3%, $300 interest expense at the end of the year. Exchange rate at the end of the year 87. If you multiply, you will get 26,100 rupees is your actual borrowing cost to be capitalized into the cost of the asset, assuming the asset is qualifying asset. Everybody is clear? But at the end of the year, your liability is $10,000. Am I right? But exchange rate is 87. We'll discuss this slightly later in this video. Accounting standard 11. Loan is a monetary item to be restated to closing rate. Closing rate is 87. Each dollar is 87 rupees. You have liability of $10,000. Do $10,000 into 87. When you borrowed the loan, liability was $10,000. At the end of the year, liability is $10,000. But rupee liability at the beginning of the year was rupees 8 lakh. Now the rupee liability has become 8 lakh 70. At the initial date, what was the rupee loan? 8 lakh. Now it has become 8 lakh 70. liability increased by 70,000. This is foreign exchange difference. Isn't this foreign exchange difference? There is a liability of 8 lakh at the beginning of the year. Now it is restated to 8 lakh 70,000 foreign exchange difference. As per accounting standard 11, it will be going to P&L. A16 will say, Nilso, 1 second. I somewhere feel this is borrowing cost. Why? Why did you take loan in USA? ಎಷ್ಟು cheap ಅನ್ನಿಸ್ತು ಅಂದ್ರೆ I took loan in USA 3%. Yeah, it is cheaper no in USA 3%. So I took loan in USA. Because I took loan in USA, which is cheaper at 3%, I paid only 26,100 rupees as interest and made it borrowing cost. Because I took loan in USA, my liability is in dollars. Because of that, liability is now restated to 8 lakh 70 and I am generating 70,000 rupees exchange loss. 70,000 rupees exchange loss is coming because borrowing is in USD. Borrowing is in USD because loan is cheaper there and I tried to save some interest here. If I would have kept this asset, I would have not got convinced by this 3% excitement. I would have taken loan in India. Then I have to pay $10,000 to buy the machine. Each dollar is 80. Do 10,000 into 80. 8 lakh is the money that I need to buy the asset. I took 8 lakh rupees loan in India, converted it to $10,000 and then paid my supplier. My liability would have been $10,000. On $10,000, no, apply Indian rate at 12%. 96,000 would have become my interest in India if I would have taken loan in India. Because I took loan in USA, my interest is 26,100. How much interest did I save? Because I took loan in USA, I am paying only 26,100 interest. I am not telling you I borrowed in India. I am telling if imagination, if I had borrowed in India, what would have been my interest? 96,000. How much did I save? 69,000. To save 69,900 rupees by interest, no, I increased my liability by 70,000. If I would have taken loan in India, my interest is 96. So I took loan in USA and paid 26,100. Yes, I saved 69,900. As a result of that, now my liability has gone up by 70. If I would have taken loan in India, beginning liability 8 lakh, now also liability 8 lakh. You understood? So this 70,000 looks like foreign exchange difference. This 70,000, this 70,000 looks like foreign exchange difference, but in that 70,000, 69,900 is actually interest only. Least of increase in liability or savings in interest will be regarded as additional borrowing cost. Whatever you pay as actual borrowing cost is actual borrowing cost. Additionally, increase in the liability or savings in interest, whichever is lesser, will be considered as additional borrowing cost, and that can be capitalized if the asset is a qualifying asset. I hope everybody understood this. The same YouTube channel, if you want, there is a detailed 20-30 minutes video discussing this, but now I have just given a glimpse of this. Has there been any question on this foreign AS11 with AS16 multiverse? No, it's not been there till date. Is it been there in CA final? Yes, they do ask. But now, recently, if you have observed, the trend is that they are so eager, enthusiastic and mindfulness in asking overlapping questions, one standard with another standard. They don't like Captain America, Thor, Loki anymore. They want Avengers. They want movie with 2-3 standards together. Last exam, AS3 question they gave with AS22 adjustment. AS3 with AS7, deferred tax was there in cash flow statement question. The attempt before that, they gave accounting standard 22, taxes on income, deferred tax computation question with accounting standard 7 construction contract adjustment put into it. Total contract revenue method. So they're doing it. I am not telling you I can guess everything, but wherever possible I can tell you this kind of question can come overlapping 11 and 16 together. Be ready. Shock agbadi. Right, whatever you know. Got it? So by this I say accounting standard 16 is done. Now let's go to accounting standard 19. Let's now begin with accounting standard 19 leases, which is chapter 5 unit 5, one of my favorite standards. When we talk about lease, we begin with definition of the lease. Lease is an agreement between two parties, lessor, lessee, to transfer an asset for a consideration. So the lessor gives the asset, lessee receives the asset. Lessee has to give consideration, lessor has to receive consideration. But the consideration is called lease payments. It is not received in lump sum, it will be received in installments. Can it be received in lump sum? Yes, but usually it will be received in broken payments. Lessor is the owner. Lessor has the right on the asset. Lessor has the ownership of the asset. Lessor transfers the right to use the asset to lessee, and lessee receives this asset. Entire accounting in this standard is based upon the type of lease. There are two types of leases. One, finance lease. Two, operating lease. One, finance lease. Two, operating lease. What is operating lease? Operating lease is a lease which is not a finance lease. Operating lease is a lease which is not a. What is finance lease? No, don't tell that. Finance lease is a lease where lessor transfers substantial risk and reward pertaining to the asset to lessee. For example, I am lessor, you are lessee. When I give you the asset, I don't just give you the asset, I transfer the risk relating to the asset, reward relating to the asset in a substantial form to you. Then this lease between us will become finance lease. Meaning, finance lease is nothing but sale. Finance lease is nothing but, on the paper I am the owner, but you have the asset with you for major time. On the paper I am the owner, but you have all the risks and rewards. On the paper I am the owner, but you have the asset for the entire useful life. On the paper I am the owner, but at the end of the lease term, you have a right to buy the asset. So on the paper I am the owner, only on the paper I am the owner. Legality, I am the owner. Reality, you are the owner. So in finance lease, on the paper lessor is the owner, but on the accounting terms, you would have to account it such that lessee will act like the owner. Lessee will charge the depreciation. Lessor is just standing back and then seeing it. If it is operating lease, I am lessor, I give the asset to you, I give it to you only to use. Use to return put okay, not yours, Nandu. It's mine, it will be mine. Useful life is this much, use it only for this period. Useful life is there, no, it is much bigger than the lease period. And at the end of lease period, you don't have right to buy. You have right to use it only for that lease period. After that, I'll give it to somebody else for lease. That is operating lease. I am the owner, you are only user. I charge depreciation, you don't. Operating lease. I hope you understood the difference. How to classify whether a lease is operating or finance is also told by Accounting Standard 19. It says, lessee, that's you will get the ownership of the asset at the end of the lease, finance lease. Second point, lessee, you have the option to buy the asset at the end of the lease for a price lesser than the fair value. Lease term is over, let's say 5 to 6 years. If I give it to somebody else, let's say they'll give me 1 lakh rupees, but I'm offering it to you at only 40,000. What is the fair value of the asset at the end of lease? 1 lakh. Fair means between two people who are not related in an unregulated, uncontrolled market, arm's length price. At the end of 5 years lease for which I've given you the asset, as a lessor, I'll take it back from you. I'll give it to somebody else, they're willing to give me 1 lakh. That is fair value. But I'll offer to sell the asset to you only, but only for 40,000. Then I am actually not interested in taking back from you and selling it to somebody. So I have not sold it to you now. I've sold it to you at the time when I gave it to you on lease only. But now on the paper I'm selling. Then it will become what lease? Finance lease. You understood? Third point, the lease term for which I'll give you the asset covers the substantial life of the asset. It covers the substantial life of the asset. Then it will become what lease again? Finance lease. The last point is the present value of minimum lease payment. Minimum money that you would have to give me as per the agreement. Minimum money what you have to give me as per the agreement. Minimum lease payment, whatever is there, if I find the present value of it. Because when I and you signed the agreement, you told me you will pay me lease rental every year for 5 years. After 5 years, you told that you will buy the asset from me by giving some money. So, minimum lease payment is the money promised by lessee to lessor in the lease agreement. What is minimum lease payment? Minimum money promised by the lessee to lessor in the lease agreement. In the lease agreement, you told you will pay 1 lakh rupees lease rental to me for 5 years. In the lease agreement, you told at the end of 5 years, you will give me 4 lakh rupees as residual value to buy the asset. So 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. 5 years cash inflow. 5th year, additional cash inflow of about 2 lakh rupees residual value. Everything discounted to today's date. If that amount, present value of minimum lease payment, substantially covers the cost of my asset, then it is finance lease. Then it is, did everyone understand this? And last condition is asset is of a specialized nature. Specialized nature means that asset is made to fit you. made to fit your requirement. Somebody else cannot use that asset very easily. If somebody else has to use the asset, I have to make structural changes in that asset. But you can use it very comfortably. If that asset is made to be fit for your use, then that asset, what I have given it to you on lease, is as good as being sold to you. Meaning finance lease. You understood? It is not one of these conditions, two of these conditions, three of these conditions. There is no rule here. It is substance, what to say, substance over form read with professional judgment. When we say substantially covers, when we say major part, there is no percentage criteria here. There is no rule book. Beyond this percentage it is substantial, beyond this percentage it is major. Beyond what percent is it major? 55, 60, 80. There is no percentage. Accounting standards are not rules. Law is rule based. Standards are principle based. Let's understand this with the help of a small example. Come on, I'll show it to you. Let's see this. This is a question. Mr. Noddy takes an aircraft on lease from Boeing. Did you grow up watching Noddy or you have no clue? Should I change it to Bombardino, Crocodile or something? Okay. Okay. So Mr. Noddy takes an aircraft on lease from Boeing. As per the lease agreement, Boeing is the lessor. Okay. Noddy is lessee. Noddy is lessee. Boeing is lessor. Read the agreement. Number one. Boeing gets the possession of the aircraft at the end of the lease. So is the asset with lessee or lessor at the end? Is the asset with lessee or lessor at the end? Lessor takes back the asset. See, Boeing gets the possession. Who's Boeing? Owner. Lessor. Who's Noddy? Lessee. At the end of the lease period, who gets the ownership of the asset? Lessor takes it back. One condition not satisfied. Then go to next one. Lease period constitutes 25% of useful life. It's substantially less. Present value of MLP covers 40% of fair value. Also again less. Aircraft is general purpose. Anybody can use. You can use, I can use, anybody can use. So tell me, is this lease for which the Boeing has given this aircraft to Noddy? Operating lease, finance lease? Operating lease. See, asset not reverting to lessor. So asset is reverting to lessor. Asset is not staying with lessee. Price is not money that you pay, is not more than, money that you have no option to buy only at the end. And lease period does not cover substantial portion. Present value of MLP substantially doesn't cover the fair value. And asset is not of specialized nature. It is operating lease. Another example, BWM or BMW is giving one car on lease to Noddy. Okay. Did you see the terms? First condition. Noddy gets the possession of the car at the end of the lease. Oh, slight inclination towards finance lease. Noddy lease period constitutes only 25% of the useful life. No point in favor of finance lease, but if it is substantially covering the, the entire money, and if it is like he has the right to buy the asset later, it can still become finance lease. See, next one, present value of MLP covers 95%. This Noddy will give no lease payment, lease rental, residual value, everything together at present value covers 95% of the cost of the asset. Then last one, car is general purpose, can be used by anyone. See, finance lease. So if it doesn't fulfill couple of conditions, it is not a rule book. Yeah, it's not 2 out of 5, 3 out of 5, all 5. It's not like that. Majority money is given. He is also getting to keep the asset at the end. He is the owner. From the first year of lease, Noddy will charge depreciation, not BMW. Are you getting it? 99.99% of the times, all the questions that we get in CA inter examination will be finance lease. Operating lease is too easy to account. So they'll ask finance lease. You understand? Operating lease, to Noddy, whatever rent he pays, lease rental, lease expense. To BMW, whatever rent he receives, is income. And BMW will book the depreciation. It's easy. But if it is finance lease, this guy should pay money to this guy. Out of that, some money is repayment of loan, some money is interest. So it actually becomes interesting. So that's the reason they ask finance lease based questions in AS 19 in the exam preparation. Blindly you can take, they'll ask finance lease. But you should just know how to do with operating lease also. There's another example. He buys one cycle. You know this guy, he has a cycle, he has a car, he has a aircraft, he has a girlfriend, he has a pet dog, and cop is his friend. Life can't be better. Nice, read. And he sleeps alone at home. No one wakes him. No one shouts at him. He'll wake up whenever he wants. Takes an aircraft, goes for a round, comes back, takes car, goes around. And if he gets caught also, police uncle is his friend. Mr. Noddy takes a cycle on lease from Hero Cycles. Lease agreement. Number one, Noddy gets possession of the cycle at the end of the lease. One condition in favor of finance lease. Lease period constitutes 10%. Not substantial. Present value looks favorable. Cycle is general purpose and can be used by anyone. So what do you call it? You can still call it finance lease based on two conditions. Based on this and the fact that he gets to keep the asset at the end of the lease term. You understood? This is based on professional judgment only, sheerly. Yeah, I'm cooking another example, Bob the Builder taking JCB on lease. But when that's over, I'll teach it to you, but I hope you wouldn't need it. Now, I hope you guys have understood basis for classification. Next, let's focus on finance lease. Major time we're going to devote only on finance lease here. So, understand this part. I am lessor, you are lessee. I own the asset, you want the asset. I have given the asset to you on lease. I own the asset, you want the asset. I have given the asset to you on lease. When I give the asset to you on lease, I will ask you to sign the agreement. In the agreement, I will mention the amount that you should pay to me. I've asked you for some minimum lease payment, MLP. What does it include? Lease rental. Let us assume 5 years you would have to pay lease rental. 5 years, whatever money you would have to pay, I'll mention there, you would have to pay 1 lakh rupees at the end of each year for a period of 5 years. 5 years is lease period, 1 lakh is lease rental. I'll also write at the end of the lease, you have an option to buy the asset by paying me 1,50,000. So 1,50,000 is the money that you have agreed to pay. I have agreed to receive to transfer the asset to you. It is guaranteed residual value. So as per the agreement, how much money should you give me? 1 lakh for every year over 5 years and 1,50,000 at the end. That's MLP. Don't have to mug up a formula. Minimum lease payment is the minimum money that you should pay that you agreed by way of agreement. Lease rental plus guaranteed residual value. After you sign 1,50,000 as guaranteed residual value, I somewhere believe I can collect more money than that. Let's say that asset what you take, you'll take only certain part of the asset. Certain part of the asset you will not take. That I'm expecting to sell it to somebody else. I'm expecting money from somebody else. But with him I don't have an agreement. There is no guarantee, but I still believe it. That is unguaranteed residual value. What the lessor expects, lessee has not agreed. Lessor expects, but lessee has not agreed. Is it part of MLP? No. So, how much is the money that you should pay me? Lease rental plus guaranteed residual value. That is MLP to you, that is MLP to me. Plus, I expect some money from somebody else. I add that. That becomes my gross investment. To me, it's investment. No, I've invested money in that asset. That investment is going to fetch me rental income or lease rental income. To me, it's investment. Do you agree with me? Specifically, I discussed in AS 13. That's an investment to lessor, but it's not covered under AS 13 because AS 19 overrules. Specific rule overrules the general rule. To me, lessor, I've invested the money in buying this asset. I expect you to give me lease rental. Promised minimum lease payment. Guaranteed residual value. You promised to pay. I'm expecting someone to give me something for the portion of the asset that you don't take. Unguaranteed residual value. Together, all of this is the money that I'll get from this asset. Your lease rental plus GRV plus UGRV is my gross investment. What is it? Gross investment. Gross investment is from whose perspective? Lessor. From lessee only MLP. You understood? Now, you are supposed to pay me lease rental today. At the end of first year, second year, third year, fourth year, fifth year, and GRV at the end of lease period. Understood? You discount it to today, it will become present value of MLP. I need to collect unguaranteed residual value. That also at the end of lease period. Discount it to today, it will become present value of UGRV. Present value of UGRV plus present value of MLP is present value of gross investment. Present value of gross investment is also called as net investment. I need to collect 1 lakh from you for the end of each year for 5 years and 1,50,000 at the end of 5th year as GRV. And I am expecting 50,000 unguaranteed residual value from somebody else. 5 lakh plus 1,50,000, 6,50,000 MLP. 6,50,000 plus 50 UGRV, 7 lakh gross investment. Discount that 7 lakh at some 10% or 8% for 5 years. Let's say it comes to 4,89,346. What is it? Net investment or present value of net investment. What is this? Net investment, gross investment. How much money will I actually collect from you? 7 lakh. 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1,50,000 and 50. 1 lakh, 1 lakh 5 times from you and 1,50,000 residual value and 50,000 from somebody. Together you will collect how much? 7 lakh. Over 5 years. Today, value of it is some 4,83,000 something. Present value 4,83,000. Actual cash flow 7 lakh. Difference is there, no? Interest income. It is my interest income. Today, if I give the asset and collect from you money, I should collect 4,83,000. Because I wait for 5 years, I get 7 lakh. Over and above 4,83,000, whatever I get is my interest income for waiting 5 years. That is not 1 year income. That is 5 years income. As on the beginning of first year, it is called as UEFI, unearned finance income. Why is unearned? Because we are at the inception of lease. When will I earn? Little at the end of each year. At the beginning of the lease, I have not earned it. So it is unearned finance income, which is difference between net investment and gross investment. Net investment is nothing but present value of gross investment. I hope you understood. What if I tell you AS19, any damn question can be solved without using a single formula? All you would have to do is know the concept. It might sound very absurd to you. Hey, no way, sir. I've learned all my life with formulas. How can you make it simple? Very simple. Remember this thing. I'm repeating what I've been telling so far, doing revision within the revision, but I would want you to focus on the next 1 minute. I'm going to tell you what I told in the last 5-6 minutes. As a lessor, I will collect some money from lessee by way of a return agreement, that is minimum lease payment, that will involve annual lease rentals plus guaranteed residual value. Over and above that guaranteed residual value, I might expect something else, that is unguaranteed residual value. As a lessor, what will I collect? Annual lease rental plus guaranteed residual value plus unguaranteed residual value. In these 3 items, first item, annual lease rental plus guaranteed residual value, together is called as minimum lease payment. To minimum lease payment, if I add unguaranteed residual value, I'll get gross investment. This money will be received by me not in the beginning of year 1, but over the lease period. If I discount it, it will become present value of gross investment. Present value of gross investment is nothing but net investment. If I wait for 5 years, I get gross investment. Today I find the present value, which is less. This less amount will become more, and the difference between them is interest, which I'll earn over the lease period. At the inception of lease, I have not earned that interest income, so it is called as unearned finance income. I hope it made sense. You can write the formula. It's there as a part of the chart, but usually when we do answers, we don't usually use these formulas. I hope everybody got it. Come on, let's quickly see a question. Ouch. Maybe we can start with this. Lease asset machinery. Lease period 5 years. Lease rental 2 lakh rupees. Guaranteed residual value 10,000. What to do? Same thing. Write lease rental plus guaranteed residual value. You will get MLP. Write lease rental of 2 lakh, 2 lakh, 2 lakh. Guaranteed residual value of 10,000. These you multiply by this. You will get present value cash flow. And then guaranteed residual value multiply by that 0.621. You get the total of present value of cash flows as present value of MLP. And this is MLP. Here there is no UGRV. There is no UGRV. So I can assume this itself is gross investment and this itself is present value of gross investment. As a lessee, the user, you have to record your asset at present value of MLP 7,64,210 or the original cost of the asset, whichever is less. You would have to record your asset at 764,210 at or original cost of the asset, whichever is less. That will be the purchase price of your asset. And your liability will be 764,210. Keep adding interest of 10%, 10%, 10% every year and keep paying 2 lakh, 2 lakh, 2 lakh, 2 lakh every year. You understood? Let me show another question which has UGRV. See, this is another question. You usually get this sub question. So one sub question minimum lease payment, one question present value, one question gross investment, present value, UEFI. You do one table, you do one formula, you do one more table. No, one table is sufficient to answer all the questions. Okay, this is the question. What is the value? What is the name of the asset? Machinery. What is the lease period? 5 years. Lease rental 2 lakh rupees per annum. Residual value 30. Guaranteed portion is 10. And discounting rate is 10%. When you do that, what do you do? This is the question. I hope everyone understood the question. Quickly write here 1, 2, 3, 4, 5. Lease rental of 2 lakh. Because the amount is same for each year, instead of doing present value factor, you can do present value annuity factor. Compute present value factor for each of the 5 years and total them. You will get 5 years annuity factor. You multiply, you get present value cash flow. And to this you add GRV, you get present value of MLP. And you write unguaranteed residual value, discount it for 5 years, you get present value of UGRV. You add this present value of MLP plus present value of UGRV, you get present value of gross investment. And literally 2 lakh into 5 plus 10,000 plus 20,000, 10 lakh 30 is gross investment. So gross investment and present value of gross investment concept is very simple. I am lesser over the entire lease period. How much money will I collect? 10 lakh 30. How much money will I collect? 2 lakh at the end of each year for 5 years, and at the end of year 5 I will collect 10,000 GRV, 20,000 UGRV. Understood? Then the next point that I want all of you to notice, but the present value of it is only 7,76,630. But you told we'll collect 10 lakh 30. If in case we give an option to lessee to give full money today and walk away with the asset, he'll actually give me 7,76,630. Sir, but why does he give 10 lakh 30? Because he's not giving the consideration immediately, but giving the consideration over 5 years. Over and above 7,76,630, I charge him extra money. Extra how much? 2,53,370. This 2,53,370 is in the nature of interest. It is in the nature of, this interest is income to me. This interest is income to me, and this interest is not 1 year income, 5 years income. How do you find each year income? Very simple. To me, from you, I am supposed to collect 7,76,630. I write 7,76,630, add interest at 10%. Deduct 2 lakh rupees what you give me. Closing balance 654,293. Year 2 again I write 654,293. Add interest at 10%. Deduct 2 lakh what you give. Closing balance. That becomes opening balance again. You do this for 5 years. Each year's interest whatever I get here, total it will actually come to 253,370. Check this. Take calculator quickly just to keep yourself awake. Do this one last thing before we discuss sale and lease back. 77, 663, 65, 429, 51, 972, 37, 169, 20, 886. I hope everybody understood this. Discounting and then compounding back. We just did discounting and compounding it backwards. I hope everyone understood this part. Tell ya. Very good. Operating lease is very easy. It's not this complex. If it is finance lease, you are lessee, I am lessor. You need to record asset in your balance sheet and you should charge depreciation. I am the owner, but by substance over form, lessor will not charge depreciation. Lessee should record the asset and charge depreciation. At what value will lessee record the asset? Lessee will record the asset at present value of MLP or original cost of the asset, whichever is less. And you record the liability. Interest will go to, whenever you pay 2 lakh rupees to me, every year you pay 2 lakh rupees to me. In 2 lakh, 77,663 is your interest expense. That is my interest income. Do 2 lakh minus 77,663. You pay 2 lakh rupees no to me every year. 2 lakh minus 77,663. 1,22,337. At the end of year 1, you lessee pay me 2 lakh. In that 2 lakh payment, 77,663 is interest expense in P&L. And 2,22,337 will be repayment of liability to me. You have liability no towards me. That asset you recorded, you have not given money. Liability also will record. Liability will reduce every year when you make lease payment. When you make 2 lakh lease payment, 2 lakh liability won't reduce. 77,663 will go to interest expense as P&L. 2,22,000 your liability will reduce. You understood your perspective? You being lessee, this being finance lease, you will record this asset at what price? Present value of MLP or cost, whichever is less. Got it? Cost in the sense fair value, whichever is less. You will record that asset at that value. And you pay 2 lakh rupees to me at the end of the year. In that 77,663 P&L account interest expense, 2,22,337 repayment of liability, your liability keeps reducing. Every year you will charge depreciation on the asset that you recorded, it will go to PL. To me, 2 lakh rupees I receive from you, it is like installment received. In that 77,663 is my interest income and 2,22,337 is asset receivable from you, loan given, asset reduction. I keep doing it every year. You keep doing it every year. This is finance lease. If it is operating lease, forget this. We don't need this at all. You give me 2 lakh rupees every year. To you 2 lakh rupees expense, to me 2 lakh rupees income. To you 2 lakh rupees expense, to me 2 lakh rupees income. To you 2 lakh rupees income, to me 2 lakh rupees income. So how many more years? 2 more years. To you 2 lakh rupees expense, to me 2 lakh rupees income. Last year, to you 2 lakh rupees expense, to me 2 lakh rupees income. And give me my asset back. I'll take it back. And throughout the 5 years, I will charge depreciation and then charge it to my P&L. Understood? So usually operating lease based questions won't come. What you get as question is finance lease only. This last part in this standard, which is beautiful concept called sale and lease back. Shall we discuss sale and lease back? Focus. What is sale and lease back? I am a lessor, you are a lessee. In the previous question, now I am not lessor, you are not lessee. What did you do? You bought an asset, not from me, but somebody else. You bought an asset from somebody else. You are using that asset. Now you want money. You want money. What do you do when you want money? You will sell asset, not kidney. You will sell asset. If you sell asset and you get money, then you don't have business only. Why? Asset is only sold. You want money to do business, but if you sell the asset, you don't have business only. So you want asset also. You want money also. What do? You keep your asset as pledge somewhere and then raise money, or you take loan giving your asset as guarantee. Do you agree with me? No one is willing to give you loan based on the asset. So what do? You will come to me and you will sell the asset to me. You will sell the asset to me. Who are you now? Seller. Who are you? I am buyer. Who are you? Seller. I am buyer. You are that B. You see that B green color symbol? That's you. That's a company called Beehive. So Beehive Alts. That's a company which recently is operating immensely in this field of sale and leaseback. So I've taken that as an example. So you are this company B. You have an asset. You sold it to me. You become seller. I become buyer. I don't want this asset. What will I do with this? I don't know. You will tell, don't worry, you will only take it back on lease from me. I will give it back to you only on lease. Your asset, you sold it to me. I became the buyer. You became the seller. I gave this asset back to you only on lease. So asset was there with you. Asset has come back to you. Then what happened? You only took money from me. You only took, it is basically loan taken. But it is fabricated to look like asset is sold and taken back on lease. You understand? You don't want it to be shown like a loan. So what do? You sold the asset to me and I gave it back to you on lease. Now, when you sell the asset to me, you become the seller, I become the buyer. In this sale transaction, you can make some profit. When you become the seller, I become the buyer and you sell the asset to me, you make some profit or loss. How to book that profit or loss? Where should you write that profit or loss? Can you write in P&L? This actually depends upon what is the lease that follows. Transaction number 1, you become seller, I become buyer, you sell the asset to me, I buy. In that transaction, if you make profit, how to recognize that profit depends upon the transaction 2, where I become the lessor and you become lessee. Let's say this lease is finance lease. What lease is it? You become the seller, I become the buyer, I will give the asset back to you. It is what lease? Finance lease. Finance lease means I have sold the asset to you. Finance lease means what? The asset is with you for major part of the useful life. You pay substantially all the money that you should pay. Do you agree with me? In that case, that profit is actually not profit only. Why? Before sale, you are the owner. You sold it to me and I give it back to you on finance lease. Finance lease is as good as sale. So before the transaction, you are the owner. After the transaction, you are the owner. How can you sell it to yourself and then make profit? You cannot make profit. Profit yak bantu? Asset is 10 lakh. You want loan of 12 lakhs. Asset is 10 lakh. You want loan of fair value is 10. If you go give it to anybody, anyone will give you 10. You want 12. I will give you 12 lakh. But I gave you 2 lakh extra. When I give the asset back to you on finance lease, I will collect 2 lakhs extra from you. 2 lakh you pay me extra by way of lease rentals. For the next 4-5 years, you'll have 2 lakh extra expense in P&L account debit side. So this 2 lakh profit what you make now, don't write it immediately to P&L. Write it over 5 years to P&L as income so that that extra expense is compensated by extra income and everything is fine in PL. I'll repeat. What is the fair value of the asset that you're selling? 10. If you sell it in the market, what price are people willing to buy? 10. You ask me 12 lakh. I'll tell you, why should I give you 12 lakh? You'll tell, give me 12 lakh. Later you give the asset back to me. No, in lease rental, I'll give you 2 lakhs extra. Like, okay. I gave you 12 lakhs. Sale price 12 lakh. Cost or fair value 10 lakh. You made a profit of 2 lakh. That profit of 2 lakh don't transfer to P&L immediately. Because later when I give it to you back on finance lease, you will give me extra money. Lease rental. That will become expense. To compensate that, this 2 lakh income is not written in 1 year, but it's written little every year. Read this. If the resulting lease is finance lease, profit or loss to be deferred and amortized in the proportion of depreciation in the next few years. You understood? What if the lease is operating lease? Meaning you were the owner of the asset. You give the asset to me. I buy the asset from you I give it back to you, but on operating lease. Operating lease means what? In operating lease, I become the owner, you become the user. You are the owner, you sold it to me. I give it to you on operating lease. I am not sold, only lease. In that case, to the extent of cost and fair value difference is immediately recognized. To the extent of fair value to selling price difference is deferred and amortized. Your original cost in your books of accounts, it's about 9 lakh rupees. What is the value in your books of accounts? Fair value is 10. You can sell it up to 10. So that 1 lakh is your profit. Book it to PL. But you sold it to me for 12. So 9 ego 10 ego difference is 1 lakh. That is your actual profit. Book it immediately. But if you have sold at 10, you sold it to me for 2 or 12 or 13, that extra is there, no? That amount you need to defer and amortize. So you need to break it into 2 levels. You need to break it into, I am not going to teach you 9 cases. No, 2 points. Between cost and fair value difference, book it immediately. Between fair value and selling price difference, defer and amortize. This topic, questions do come. Between, if the following lease is operating lease, if the following lease is finance lease, what do? Defer and amortize. Sale, lease back. Lease is finance lease. What do? Profit. Profit, defer and amortize. If the lease back is finance lease, what to do? Defer and amortize. If the lease back is operating lease, what to do? Between cost and fair value, immediate recognition. Between cost and fair value and sale price, defer and amortize over the lease period. Okay, but cherry on the cake. If in case this fair value and sale price difference is loss, then there is no concept of deferring. No loss, yeah. Conservatism, recognize it immediately. Got it? There's a question on this in your study material. Please do that. But don't read theory from the study material because it's too much to handle. We'll do one cute, sweet little question just to finish this one and then go to the next one. Come on. Sale and lease back, operating lease. So you are seller, I am buyer, okay, not you. You are taking perspective not of mine, but of the company. You sell it to me, I give it back to you on operating lease, you give me lease payments. You give me lease payments. You understand? Actually, I am the, you are representing me here. No. I become the lesser, you become the lessee. Arrow mark should have been pointed like this. No, correct agide alva. Correct agide. Yeah, correct agide. You give me money. It's fine, it's fine. Now focus. So this is the case. How do you account for it? Second talk. Between carrying amount and fair value, immediate recognition. Between fair value and sale price, defer and amortize. 100 and 0. Sorry. No. Oh, not given. When it is not given fair value, let's assume fair value is 120. When nothing is mentioned, fair value is assumed to be sale price. So 100 and 120, full 20 is immediately recognized. Here 100 and 120. What do we do? 20 will be recognized immediately. 120 and 120, no defer and amortize. 100 and 100, no immediate recognition. And next 100 fair value and sale price of 120. What to do? Profit of 20 will be deferred over the lease period. Case 4, 100 carrying amount, 120 fair value, 20 will be recognized immediately. And case 4, 120 fair value, 130 sale price, profit of 10 will be deferred over lease period. If in case carrying amount is 100, fair value is 120, 20 profit will be recognized immediately. And fair value is 120, sale price is 115. There is loss of 5, which has to be actually deferred over lease. But by conservatism, we will not defer this, we will book that loss here only. When you book that loss here, what happens? 20 profit, 5 loss, it will become like 15 loss to be booked. I hope you, 15 profit to be booked. I hope you understood this. Pakka? I can now say we have successfully completed accounting standard 19. Please do practice questions on this where you are supposed to compute present value of MLP and unearned finance income and gross investment, net investment. One question on MLP, GI, NI and its present value with UEFI. One question. Jan 25 question you can do. One question on MLP, gross investment, present value of gross investment, unearned finance income. One question that way. And do one question on sale and lease back. One question on sale and lease back. One more question, third one. Can I tell the third one? IRR based questions are there where they won't tell, you would have to find. There's one IRR based question, glance it through once. IRR based question. I hope you people will do this much in accounting standard 19. Yeah. I hope you people understood AS 19. Very good. Next, let's go to accounting standard 26, intangible asset. Let's do accounting standard 26, which deals with intangible assets. Very similar in line with accounting standard 10, property, plant and equipment. The point of difference is there is no tangibility, there is no monetary value associated to it. A step. To begin with, let's see what is the definition of intangible asset. Intangible asset is an intangible asset which is identifiable, non-monetary and without physical existence. It is identifiable. You should be able to identify it separately. It should generate future economic benefit other than being dependent upon other assets. It alone should have the capability to generate cash flow. It should not be dependent upon any other asset to generate cash flow. Now, goodwill in isolation cannot generate cash flow. Goodwill plus product will generate cash flow. Now, for example, dosa batter, I'll sell it in my name. Dosa batter is sold it in MTR name. There is difference. If I sell it in my name, what to say, 100 rupees per kg, nobody will buy. If I sell it in MTR name, 500 rupees per kg also people might buy. So goodwill or brand name without the product is not able to generate any cash flow. That is not identifiable. If an asset can generate future economic benefit in isolation, I will come single and I'll earn cash flow. I don't want support of any other asset. Then it is intangible asset. If it is dependent upon other asset to generate future economic benefit, it doesn't have its own identifiability. Then it is not intangible asset. Example, goodwill. Goodwill is not an intangible asset as per AS 26. It should be identifiable. It should be non-monetary, meaning you should not be able to put one price tag on it. You cannot put one price tag. Now, if you say any asset like phone, watch, laptop, cup of coffee, or glass of tea, anything, you can put one price tag to it. To call it intangible asset, you should not be able to tell one number very easily. It will be difficult. It should be difficult to put one price tag, and it should have no physical existence. When I say no physical existence, if it is there in a physical form, that physical form should be non-valuable, or it should not have great value. For example, there is a software. You can say software is an intangible asset. The moment you put that software in a pen drive or you put that software in a CD, now you cannot say, there is physical existence. It's not an Allah. That is not substantial. That CD or pen drive. Now you buy a software by paying 10,000 rupees. They give it to you in the form of a pen drive. Let's assume. Now you pay 10,000 not for the pen drive but for the software in it. That pen drive's value is negligible, so it is still an intangible asset. Nowadays there is no concept of CD, pen drive or anything. You buy a software, you can download it straight away. But previously, even if you buy antivirus software, it used to come in a CD. Leave that. If you buy one MS Office, it used to come in a CD. But now you just download any software. Yeah. Okay. Pen drive and CD are all losing its value. Then without physical existence, it should be controlled by them. It should have a control over that item, and it should be used in production of goods, rendering services, or you should be able to give it on rent or using it in your administrative purpose. This definition looks very similar to that of PPE, but the new points is identifiable, non-monetary, without physical substance. New points. I hope you guys understood. I will give you the meaning of the word identifiable, non-monetary and without physical substance here. If you want, you can read it later. In order to record an intangible asset, it has to fulfill recognition criteria. Initial recognition is done based on number one, definition. Then it should give you future economic benefit and reliable measurement. When we discussed AS 10, we refer the same word, FEB-RM. If there is future economic benefit and reliable measurement, and it has already fulfilled definition criteria, it is intangible asset. Further, if you incur any expenditure after the asset is ready to be put to use or put to use, it can be added to the cost of the asset if it fulfills subsequent recognition criteria. If not, usually it is charged to PL. Let's say you bought some patent by paying 50 lakh rupees. That patent is for 5 years. At the end of 5 years, the law is allowing you to renew the patent for another 2 years by paying 20 lakhs. That 20 lakhs is subsequent cost and it will be added to the cost of the asset because that 20 lakh is going to give you future economic benefit, and that cost 20 lakhs is measurable, 20 lakh. That's the reason it is to be added. If in case it's not like that, it will be charged to PL. I hope you understood. Initial recognition of an intangible asset will happen at cash consideration. Whatever you have paid, including duties and taxes, if input tax credit not available, any directly attributable expenses incurred. There is no installation of an intangible asset, but if it is know-how, The knowledge, if you buy, how to implement that knowledge, how to use that knowledge, you might have to pay some expense. For example, you bought some, let's say some Japanese company's technology you bought for your company. When you buy the technology, you pay them money to buy the technology. They'll tell if you buy our technology, our trainers will come to your company and then train your employees over a period of 3 months as to how to use this technology. The training cost is like installation cost. To install that software and technology into the brains of our employees, we need to pay training cost for 3 months to those Japanese trainers. 3 months training cost, whatever we pay, that will also be added to the cost of the intangible asset. Don't tell 3 months salary I pay will write it to P&L. No, benefit of that installing that knowledge into your brain of the employees will be taken over longer period. That is as good as software cost, technology cost, and you will add it to the cost of that intangible asset. And tangible assets we depreciate, intangible assets we amortize. Same thing, high-fi word for depreciation is amortization. And if there is any trade discount, it should be deducted, government grant will be adjusted. If there is non-cash consideration, same thing what we read in accounting standard 10, same thing we should do here also. And if it is self-generated asset, meaning I only in-house generated one research and development project, from that one intangible asset has come. Can I charge that cost incurred on research and development to the asset, or should I charge it to P&L? That depends. That entire research what I do, that entire in-house development of the asset what I do, that process is divided into 2 stages. 1, research stage, 2, development stage. At the research stage, whatever expense I incur, P&L. At research stage, I am doing the research, I am getting the knowledge, I am still figuring out things. Once I figure out things how to do, I start doing things, that stage we call it development stage. At the development stage, whatever expense is incurred will be capitalized to the cost of the asset, not charged to PL. Can I say 2 years I did research, expense I wrote to PL. At the end of 2 years, now I know how to develop the product. I go to development stage. Can I take back the money what I wrote in P&L and now capitalize? No. Once you transfer to P&L, gone. From now I will start capitalizing. You understand? Sir, I'm in beginning of year 3. I don't know whether I'm in research stage or development stage. I sometimes feel it is research only. I sometimes feel like, no, research is over. Now I'm developing. You doubt is there, research and put it to P&L. If you are still doubtful, you put it to P&L. You will get clarity when you know that your research is over. You have clarity. You will have clarity that you have clarity of developing the asset. But if you don't know what you mean by clarity and when should you start charging it to, when should you start capitalizing it to asset, no? It is given in para 44 of Accounting Standard 26. It will talk about these 6 words. If the 6 words are a tick, this is important part. If in case any theory question has to come, it will be based on these 6 points. They have not been asking theory questions of late in the last 4-5 attempts, but be cautious on this. This is something that you should know from AS 26. This is the prime part. Brothers and sisters who are watching it at 1.5x, bring it to 1x at this point. What are the 6 points? Number 1, technical feasibility. By way of technology implementation and research that you're doing, technology says that you will not meet dead end, you will come out with one product. Technical feasibility. Point number 2, intention to complete. You'll be like, who will do? No, you have intention to complete. You are excited, yes, I will complete this project. Technology is also saying it is possible. You are also saying it is possible. You are like, yes, I will complete. But technology is saying, no way. Then it's not possible. It should be both. Technically, it should be feasible and you should personally have intention to complete. Third point is, after you make that, you should be able to use it. You have the intention to complete. Technology says, yes, you can do it, but there is no use. Then what is the point of that? Is not an asset only. You understand? There should be ability to use that asset, or should have the capability to sell it to someone. Maybe you don't want to use it, but it is useful to somebody else. You will sell it to somebody. So it should be technical feasibility should be there, intention to complete should be there, ability to use it or sell it should be there. Fourth point, in the future there should be some benefit out of it. Should be able to generate some revenue out of it, and adequate resources required to complete should be there with you. You need some raw material, you need some human resource, you need some money. All that should be there with you. And you should be able to reliably measure how much cost will you incur to complete. I don't know. I don't know is not accepted. I need this many units of raw material. I need this many hours of labor. I need this much amount of money. You should know reliable measurement of the resources required to complete. So technical feasibility, intention to complete, ability to use ourselves, future economic benefit, adequate resources, and reliable measurement of the resources required. If all the 6 points are a yes, then we can say we move to development stage and we can start capitalizing the expense on development and not charge it to PL. Go on adding The day the asset is ready, stop adding. That becomes the cost of that intangible asset. From the day it is ready, you start amortizing it to P&L, like how you depreciate a PPE. Understood? Certain expenses are not included. Startup cost, staff training cost, promotional advertising cost, relocation expenses, selling and distribution expenses. Don't add it to the cost of the asset, charge it to P&L. When you do amortization, it is like depreciation, systematic allocation of the amortizable amount to P&L over the useful life of the intangible asset from the date when the asset is ready to be put to use. This is done based on two things. Number one, useful life of the intangible asset. Number two, scrap value, or scrap value will be usually not there. The value of the asset at the end of the useful life. Usually scrap value will be there for tangible assets. For intangible asset, there is no scrap value. See, scrap value means what? At least kg like you will sell. If it is tangible, intangible asset, it has no tangibility. How would you sell it in kgs? It does not have scrap value unless someone specifically by agreement mentions. I'll tell you when will there be scrap value. Let's say you bought one accounting package. You bought one Zoho book lifetime service agreement. Like let's say 10 years license you bought. Or you bought one Tally 10 years license you bought, gold subscription. But you know it for a fact that after 4 years or after 5 years, your business will become so big that that accounting software is of no use to you. After 5 years, you will implement SAP. After 5 years, you will implement SAP. But this license you already have now for 10 years. What will you do? You will sell it to somebody. You will sell it to somebody. When you sell it to somebody, they'll give you some money. That is a scrap value, or what is a residual value of that accounting license that you bought. So accounting package what you bought, no, that's an intangible asset, software. Useful life is 10 years, but your economic useful life is only 5, meaning you will use only only for 5. This license will be amortized over 5 years. You will take the cost that you paid for that license minus the value at which you can sell it after 5 years of usage. Balance will be divided by 5 years and you will amortize. You can follow straight line method, written down value method, or production units method to amortize this. In tangible assets, PPE, useful life can be any period, but here there is one rebuttable assumption, meaning 10 years. An intangible asset by default cannot have useful life more than 10 years. An intangible asset cannot have useful life more than 10 years. I'm not telling everything will be exact 10. I'm telling cannot have more than 10. If you think useful life is 8, 8. If you think useful life is 6, 6. If you think useful life is 12, 10. You cannot have more than 10, at max 10. If you want to say, no, my asset's useful life is 12, prove it. How is it 12? I have license for 12 years. Then okay. I don't have license, but I think under 10 ashte. If you say, I believe maximum 10, not more than 10. You understand? If you want to take more than 10 years as useful life, there should be persuasive evidence. Evidence with which everyone can be persuaded is truth. You understood? That's it. This is with regard to accounting standard 26. On this, please do questions on practicing change in the amortization is there. Such questions you do practice. Otherwise, not very highly likely standard when it comes to exam types. Is that okay, friends? Very good. Next, let's move on to accounting standard 28, impairment of assets. Let's now begin with accounting standard 28, impairment of assets, which is chapter 5, unit 7 of your syllabus. Impairment of assets is decrease in the value of the asset. Whenever you feel using an asset, the cash flows that will generate in the future is much lesser than the carrying amount of the asset. Carrying amount is original cost minus depreciation. That carrying amount of the asset is much more than the recoverable amount. Recoverable amount means you have two things that you can do with the asset. One, use it. Two, sell it. If you use it, it will generate cash flows. All the cash flows that this asset will generate in the future, if you discount it to today's date, it will be called as value in use. You have an asset, you expect to use it for next 4 or 5 years. Using this asset for next 4 or 5 years will generate some cash flows. All the cash flows till the day of removal or derecognition discounted to today's date is called as value in use. Value in use is one option, using the asset till the end of its useful life. Second option is selling the asset immediately. If you sell the asset immediately, what you get is NSP, net selling price. Sale price minus selling expense. You compare value in use with net selling price. Value in use with net selling price. If you use it, if you get more money than what you get from sale, then you use. If you sell it, if you get more money than value in use, you will sell. So we'll take higher of value in use and net selling price. Higher of these two will become your recoverable amount for an asset. This recoverable amount for the asset, if it is lesser than the carrying amount, difference between carrying amount and recoverable amount will be booked as impairment loss. That will be booked as impairment loss. So impairment loss is the amount by which carrying amount exceeds its recoverable amount. What is it? Impairment loss is the amount by which carrying amount exceeds its recoverable amount. Impairment loss is equal to carrying amount minus recoverable amount. Carrying amount is original cost minus accumulated depreciation. And in the past, if you book some impairment loss, you deduct that also. And recoverable amount is net selling price or value in use, whichever is higher. Net selling price is selling price minus selling expense. Value in use is present value of future expected cash flows from the asset till its disposal. And whenever you do impairment, you don't do it asset specific. You do it for smallest identifiable group of assets, which is what we call as CGU, cash generating unit. For instance, individually, whenever we're trying to cash flows, we fail. The bench that you're sitting on, the bench will tell me that people pay 50,000 rupees to sit on me for 6 months. Do you really think the future cash benefit from that bench is 50,000-60,000 rupees? Like, no, people are paying to sit on the bench because that bench is inside the classroom where there is faculty, there is TV, there is speaker, there is mic, there is books given associated to it, and knowledge is shared. If you put the same bench outside, no one will pay money to sit on the bench. For example, there is a chair in the theater. That chair, in order to sit in that chair, you pay 500 rupees for a ticket. That chair will tell people pay 500 rupees to sit on me for 3 hours. Same chair outside the theater is useless. So, if you give 500 rupees to sit on that chair, it is because it's inside the theater. Individually, chair is an asset. Individually, projector is an asset. Individually, sound system is an asset. But unless sound system, chair, TV together comes with that movie that's been played, none of them have any value. So you cannot impair sofa in the theater separately, projector screen separately, projector separately, music system separately. No, all of them together will be identified as one CGU, cash generating unit. And for one CGU, we compute impairment because we will not be able to identify the future cash inflows for that individual asset, but we can easily determine it for the entire CGU. So impairment is done not for individual asset, but for an entire CGU. What is CGU? Smallest identifiable group of assets that generate cash flows independently or largely independently without being dependent upon other assets. I hope you all understood. Similar is the definition for corporate assets, but for now let's keep that aside. And indicators for impairment. Like I told you, impairment means you need to check what is the recoverable amount, that is value in use and net selling price. Take whichever is higher, compare it with carrying amount. If in case carrying amount is more, difference is impairment loss. Can we keep checking it every year for every asset? No, there are certain triggers, what we call as indicators. If any of these indicators are getting triggered, then we check for impairment. What are they? Externally, there is significant fall in the market value of the asset. There is adverse effect in the environment, market wise, legal wise, technology wise, taxation wise, or anything. Or interest rates go up very high, or the carrying amount is greater than the market capitalization. These are external. Internally, the asset is becoming obsolete, poor economic performance of the asset, organization is going for reconstruction, or you are planning to discontinue that asset and its products. In these cases, it is told that impairment might have happened. Check for impairment. So when any of this happen, only then we'll check impairment. It's not like every year we'll check impairment for an asset. When in doubt, check. When any of this gets triggered, check. You understood? So impairment loss is sudden decrease in the value of the asset. It is not like depreciation. It is not like downward revaluation. Depreciation is systematic allocation. Revaluation is estimate. Impairment is not like an estimate. Impairment is based on some factors. You understand how is impairment different from depreciation and downward revaluation? And at the end, impairment is also expense. Depreciation is also expense. Revaluation is also expense. Impairment is charged to PL. Impairment is charged to PL. You credit asset, you debit impairment loss. It will be charged to PL. But before you charge impairment to PL, there is something that will come saving the asset. If in case when you got those group of assets, you also got some goodwill alongside. Then before you shoot a bullet of impairment loss towards P&L, revaluation reserve will come and take it. Before you shoot that bullet towards asset, goodwill will come and take it. There is impairment loss of 2,000 rupees. What is the journal entry? Impairment loss account debit to asset. Then P&L account debit to impairment loss. What are the entries? 2. Impairment loss account debit to asset. Then P&L account debit to impairment loss. Basically, impairment loss is deducted from asset, put it to P&L account. Impairment loss is deducted from the asset and we put it to. But before we deduct it from the asset, no, before we shoot that impairment loss towards asset, someone will come and then save the asset. Say, no, you cannot shoot the asset. If you have to shoot the asset, you have to go through me. Who's that? Goodwill. When we bought that 3-4 assets together, let's say I bought asset number 1, 2, 3, 4 together. 4 assets together will form CGU1 or CGU-A. 4 assets individually 100, 100, 100, 100. 400 rupees is the value of each asset. I should pay 400 to buy, but I actually paid 450 to buy that assets. 50 I paid extra, no, that is goodwill. Asset number 1, 100. Asset number 2, 100. Asset number 3, 100. Asset number 4, 100. Together, what is the market price? 400. But when you buy 4 assets together, you end up paying extra money. For example, I am buying one restaurant. In that restaurant, that kitchen setup, 1 lakh rupees. Lighting setup, 1 lakh rupees. Interiors, 1 lakh rupees. Furniture, 1 lakh rupees. So individually if I pay, I should pay 1 lakh, 1 lakh, 1 lakh. I bought all of them together. Will I pay 4 lakhs? No, I should pay more than 4. Right? There is some goodwill, no? For that business. Chair does not have goodwill. Chair in a restaurant has goodwill. No, I buy MTR restaurant. Just I buy MTR chair, no value. I buy MTR hotel with its furniture. Then there is some value I pay more than the value for the furniture. No, that extra what I pay is goodwill. So 4 assets of 1 lakh each when I buy, they'll charge me 4 lakh 50. If I pay 4 lakh 50 to buy the assets, 4 lakh is towards that individual assets that I bought. 50,000 is towards goodwill. So entire 4 lakh worth of assets together will form one CGU. Using that CGU, I'll identify how much cash will I generate in the future using it in my business. How much cash will I generate if I sell it? Let's say using it will give me more revenue. That revenue will be only 250 lakhs or 2 lakh 50. 2 lakh 50 is the revenue that I'll generate using it. 4 lakh rupees is its carrying amount. How much is impairment loss? 1 lakh 50. 4 lakh is its carrying amount. 2 lakh 50 is its value that it will generate in the future. How much is impairment loss? 1 lakh 50. That 1 lakh 50 will not be charged to any of these assets. Before I charge it to any of the assets, goodwill will shoot me first. You will reduce goodwill 50 to 0. Beyond that 1 lakh what is there will be charged to assets. So before you shoot the bullet of impairment loss to asset, who will take it? Goodwill. And that should be charged to PL, no. Before I charge it to PL, sometimes if I have revalued the asset upward, I would have created revaluation reserve. That revaluation reserve should be first made 0. Only beyond that it should be charged to PL. Underlying point. Number 1, you tell me. Usually, what do we do with goodwill? Sorry, what do we do with impairment loss? Charge it to PL. Charge it to, before charging it to PL, we should adjust it with revaluation reserve. We should charge it against asset, reduce the value of the asset. But before you reduce the asset, you would have to reduce goodwill, if there is any. Understood? Let's do 2 simple questions to understand this. Carrying amount of an asset is 8. Value in use is 8. Sorry, carrying amount is 10. Value in use is 8. Net selling price is 9. If you use the asset, you will get 8 rupees. If you sell the asset, you will get 9 rupees. What is the better option? Sell. You will sell it for 9. Am I right? Right now the asset is 10. You have not sold it. You are expecting to sell. When you sell, how much will you get? 9. So the asset is actually 10. When you sell, you get 9. So 1 rupee loss has to be booked now. Impairment loss. Have you sold it already? No. In the future, if you sell, you will make 1 rupee loss, but you will book it now only as impairment loss. Here, if you use it, you will get 11. If you sell it, you get 9. What is the better option? Use. You will use it. Recovery 11. In the future, you will recover 11 lakhs from this asset. Its carrying amount is 10 lakh. You are going to recover more? No. There is no impairment loss in this asset. What if the usage of the asset is 8, net selling price is 11? You will in fact prefer selling it at 11. Am I right? When you sell it at 11 and its carrying amount is 10, you will make 1 lakh profit. Don't book it now. You will book it on the date when you actually sell. There is no impairment loss in this case. Did you understand how to compute impairment loss? Next thing, I told you treatment of impairment loss. Usually impairment loss will be charged to PL. Impairment loss will reduce the cost of the asset. Did I teach you the journal entry? See the journal entry, impairment loss account debit to asset. What is the entry? Impairment loss account debit to asset. And it should be transferred to P&L. What is the entry to transfer it to P&L? P&L account debit to impairment. What is the entry for loss? Impairment loss to asset. What is the entry to transfer to P&L? P&L to impairment loss. What if I say we won't do this? Instead of charging it to P&L, I will adjust it against revaluation reserve. Instead of charging it to asset, I'll charge it to goodwill. I'll teach you in this question. I think we'll take one question where we have both. No, we have to do two separate questions. Observe. Yeah, how much is impairment loss? 10. We should charge 10 to P&L, but I have revaluation reserve of 12. I'll adjust with revaluation reserve full 10. Nothing is charged to P&L. What will be the carrying amount of the asset? Asset was 10. Asset was 100. I charged impairment loss of 10. Asset will become 90 anyways. Second case, how much is impairment loss? 10. I want to charge it to PL, but I have 8 of revaluation reserve. I will reverse revaluation reserve of 8. I will charge 2 to PL. But anyways, from the carrying amount of 100, I'll deduct full 10 as impairment loss and my asset will be 90. You understood? Before I shoot the asset, who will take the bullet? Goodwill. Before I transfer to P&L, who will take the bullet? Revaluation reserve. That's what I want all of you to get it. Then here, impairment loss is 10. Revaluation reserve is 4. How much will I reverse? 4. How much is further charged to P&L? 6. But how much will be carrying amount? 100 minus 10, 90. Everybody got this? This is with regard to adjustment against revaluation reserve. Next we will see adjustment against goodwill. Impairment loss is 10. Sorry, impairment loss is 10. There is goodwill of 10. What do? You will nullify the goodwill. You will nullify the goodwill. Goodwill will become 0. Asset will become 100 minus 0. 100 will be there. Asset will continue at the same value. Why? Impairment loss, we are trying to shoot it to asset. But in between, who is taking the bullet? Now I have 10 bullets. Goodwill will take 8 bullets. I still have 2 bullets with me which will hit carrying amount. So goodwill will become 8 minus 8, 0. Asset will become 100 minus 2, 98. Are you getting it? Next one, impairment loss is 10. Goodwill is 11. If I shoot all the 10 bullets to goodwill, still goodwill will be remaining 1. Asset has not been touched. Asset will remain at 100 only. Did you all get this? Say something. Yes, before charging the impairment loss to P&L, who will take the bullet? Revaluation reserve. Before I charge impairment loss to asset, who will take the bullet? Goodwill. Okay. This goodwill can be, impairment loss can be adjusted against the goodwill if there is reasonable and consistent basis for allocating that goodwill. When say RCB is yes. If it is not, then the answer is actually different. We need to do 2 tests called as bottom up and then top down approach. But I think the time is not right for that to be taught in the class. Anyways, you don't have such questions in your material. We'll do one proper question and then we'll call it a day for impairment loss. Before that, I'll teach you what is reversal of impairment also. But if you really have time, you can do the topic of top down and bottom up approach. If you have already done this in the past also. Last minute is not the right time to do. But anyways, I'll just give you one heads up to what it is. Now, have a look. So this is the question that I would want all of you to solve. You can take a screenshot of this question. The question is from here to here. People watching it online, you can try and take this question. I'll cover everything in this one question. Complete computation. Whenever we are ready, we can begin. Everyone ready? Can we begin? Noddy bought an aircraft for rupees 50 lakh on 1st of April 2023. He follows written down value method of depreciation at 15%. Aircraft is expected to generate following cash flows over its useful life. Right now we are in the year 23-24. 10 lakh is gone. This is the cash flows it will generate in the future. So what will I do? I will first right now identify the carrying amount of the asset. On 1st of April 23, cost of the asset is 50 lakh. What I bought it at? And we are trying to compute impairment at the end of year 1. So that I need carrying amount at the end of first year, 31st of March 2024, which will be compared with recoverable amount. If recoverable amount is lesser than carrying amount, then there is impairment. If recoverable amount is not lesser than carrying amount, then there is no impairment. Shall we check that? How much is the carrying amount? Depreciation has to be done at 15%. On 50 lakh, you do depreciation at 15%. 7 lakh 50, 42 lakh 50 will become your carrying amount. You understood? On this date, we are testing impairment of this asset. Impairment of the asset is done by comparing the book value or carrying amount with recoverable amount. Recoverable amount is what money will I recover by either selling it or by using it. We will take value in use or net selling price, whichever is higher. If you see the second sub question, we are supposed to compute value in use. Value in use is by using this asset in the future, what cash flows will I generate. I'll take the future cash inflows, discount them to present day factor, that will be value in use. In the future, I'll get 12 lakh, 9 lakh, 8 lakh from this asset. And if I sell this at the end of useful life, I'll get 5 lakh. Observe, year 1, 12 lakh, year 2, 9 lakh, year 3, 8 lakh, year 4, 5 lakh. These are the future cash flows from this asset. Discount them at 10%, 0.909, 0.826, 0.751, 0.751. Again, that's residual value. To write them, multiply and take the total. 28,10,609 rupees is the money or cash flow that you will generate by using this asset for the next 3 years. Everybody got it? This is one option. The other option is, instead of using it till 26-27, I can sell it right now. I can sell it right now. If you sell it right now, what money will you get? See here, if you sell it right now, Ajay Mallya is willing to pay me 30 lakh rupees. But to sell it at 30, I need to incur 1 lakh rupees as expense to make it fully functional. So what will I do? I will take selling price as 30 lakh, deduct the expected selling expense of 1 lakh, 29 lakh will become expected selling price. Recoverable amount is higher of 2, net selling price of 29 or value in use, what we computed here, 28,10,609. Whichever is higher comes out to be 29 lakh. So carrying amount of this asset, what we computed here, is 42 lakh 50. After depreciation, my balance sheet asset is 42 lakh 50. But by using it or selling it, the best thing that I can do, if I do also, I'll be able to take only 29 lakh out of that asset. It's in my balance sheet at 42 lakh 50. Even if I use it to its best, I'll get only 29 lakh. Difference money what I will never recover is impairment loss. This has to be charged to P&L and reduced from the cost of the asset unless there is goodwill and revaluation reserve. If there is goodwill, instead of charging the asset, I'll reduce from goodwill. If there is revaluation reserve, instead of charging it to PL, I'll reduce it from revaluation reserve. I hope you got one good understanding of what is to be done in impairment of assets. Next, I told you that impairment is done not for individual assets but for group of assets. Individual assets we want to say impairment will do it for group of assets. When I identify group of assets together, and then for group of assets if I paid excessive consideration, that becomes goodwill. That becomes goodwill. I'll identify loss, and that loss has to be charged to CGU. That loss has to be charged to CGU, but before I charge it to CGU, I charge it against goodwill. But that goodwill we'd have to check, can it be allocated to individual assets? Can it be not allocated to individual assets? If goodwill can be individually allocated to assets, now I have 3 business segments, one fine dine, one cloud kitchen, one food truck. All 3 of them together is 1 CG. And all 3 of them together I bought, and all the items together, its value is some amount I paid extra. Let's say all of its value is 1000, I paid 1120, so there is 120 lakhs of goodwill created. Now there is one of the factors, one of the business segments as one trigger. Now I can identify impairment loss only for that segment, and instead of charging it to that segment's asset, I can charge it to goodwill. If goodwill can be allocated on reasonable and consistent basis to all the 3 business segments. If there is some basis, 3:2:1, 1:1:1, 4:5:4, some ratio to allocate that goodwill to all 3 assets. If I can do, then what will I do? Allocate this 120 goodwill to fine dine, cloud kitchen, food truck separately. Separately identify, allocate. Then see the total value of CGU, carrying amount. Identify its recoverable amount. Identify its impairment loss and charge it to its respective goodwill. You can do that. You understood? If in case this is not possible, goodwill cannot be reasonably allocated to these assets, then what do? Without allocating goodwill, that department's impairment loss you identify. Charge it to that department's asset. Then you take total recoverable amount of all the 3 segments together, total carrying amount of all the 3 segments together, take the total impairment loss. Total impairment loss will be charged to total goodwill. I'll repeat. How many CGUs do we have? 3. CGU1, CGU2, CGU3. All the 3 CGUs together is purchased at once and I paid excess consideration. That becomes goodwill. Now indicator is required to be comparing impairment. Without indicator we won't compare, we don't check for impairment. Only for first CGU there is indicator. Now we need to check impairment only for CGU1. Am I right? Goodwill is there for all 3 assets together. Total amount goodwill we know. Allocate goodwill to A, B, C, all the 3 CGUs. First CGU you know how much is goodwill. You compute impairment loss for first CGU, charge it to CGU1's goodwill. But if goodwill amount cannot be allocated to all 3 separately, then what to do? Without adding goodwill to this, identify this one's impairment loss. Charge it from this asset. Don't stop there. Take this together carrying amount, recoverable amount, compare impairment loss for all the 3 together, and then charge it to goodwill of all 3 CGUs together. Sir, but these 2 didn't get any trigger. Why are we checking? The mistake with these 2 is they were tagged with this. Together with this first segment, they have goodwill. You understood? This is called bottom up and top down approach. You have these kind of questions in CA final. In CA Inter, theory is there in ICA study material, but there are no questions. If in case you have practiced top down and bottom approach in the previous times in your class, please do practice one question on this. I have told you the base concept. If we will discuss this at large for an hour and a half, I have told it in the simplest way possible. Please try and do problem on top down and bottom up approach if you have already done in the class. If you have not done in the regular batch, don't do it now. Don't do it now. Pray to God, top down and bottom up approach should not come. Pray and don't revise, don't worry, continue with the rest of the syllabus. And probability is quite less on this topic. Probability is quite less. But you guys, if you have done it, you please do it. If not, no. I don't mind doing it in this video, but I don't want to scare you people. Would want me to do, I don't mind. But I would not recommend doing it. What do you say? No? Last point, reversal of impairment loss. Last point, reversal of impairment loss. That's one red flag. I've given it. Not very important for the exam, but if you've done in the class, you can think of doing it. Reversal of impairment loss. You have carrying amount of an asset. That is cost minus depreciation. You have recoverable amount of an asset. What is recoverable amount? Value in use or net selling price, whichever is higher. You compare these two. If carrying amount is more, recoverable amount is less, it is loss. You booked loss. Carrying amount is 100. Recoverable amount is 80. Recoverable amount is 20 lakhs loss. No. You book 20 lakhs loss, you reduce the cost of the asset, charge it to PL, reduce it from the asset, everything done. Now the asset is at 80. Next year, you somehow got the feeling that asset is now being very productive, highly economical, better performance, and 80 is the carrying amount. Recoverable amount became 85. Now what do? Reverse the impairment loss what you booked in the past to the extent of 5. You can do it till the time original cost, not beyond that. Originally cost is 100 and recoverable amount is 80. You bring it down to 80. Now if recoverable amount goes to 105, you take it up to 100, not beyond 100. You understood? And to reverse the impairment loss, it should be clear-cut conditions fulfilled. Like the asset should start working better. Situation whatever had led to impairment should change. It should not be only for discounting factor change. For discounting factor change also, it sometimes might happen that value in use will increase. But that's not the sufficient reason. What should be the reason for reversal of impairment? Market condition has changed. Interest condition has changed. Demand for the product has increased. Performance of the asset has become better. These are the conditions for the purpose of reversal. You reverse the impairment loss booked in the previous year to the extent it was booked in the last year, not more than that, if the conditions have been reversed. You understood? 15, 28, 19 are all standards. Standard. If you have done it in the past, you can revise it. Last minute, you can't do magic in these ones. But I'll tell you what are the questions that you should always practice on AS28 before you go. Practice a question which has value in use NSP computation along with goodwill. Sorry, value in use NSP computation with impairment loss. There are questions where they want you to compute value in use, compute NSP, take whichever is less as recoverable amount, compare it with book value to find impairment loss. One of that. And next one is goodwill and revaluation reserve. Goodwill and revaluation reserve in impairment. If there is a question with goodwill and impairment loss, then how do you deal with impairment loss? For goodwill and revaluation reserve with impairment loss. Goodwill and revaluation reserve with impairment loss. May 25 exam had a question? Yes. Okay. This much if you do, we can comfortably tell AS28 is done to an extent. Can we now proceed to accounting standard 15, which deals with employee benefits? Employee benefits, like what we've discussed in the past. A new entrant. Master? Oh my God. Can we begin with accounting standard 15, which is chapter 6, unit 1 of our syllabus? Accounting standard 15, employee benefits. This is basically any benefit given to the employee who works for us. The definition of employee is also given in this standard. Employee is anyone who can be controlled by you, whose work is answerable to you, or like with whom you have an intention to have an agreement. Look at this. You should have an agreement with them, either written or you should have an intention to create that agreement with them. And you should compensate them for the work that they do. Payment has to be given for compensation. And intent of both the parties is to create that employer-employee relationship. If these three checkboxes are ticked, they are employer-employees, otherwise no. First one, there is an agreement between them wherein one person gets to control the work of the other, one person pays compensation to the other. The intention of both the parties is to create that employer-employee relationship. Let's quickly see one of this. See, laborers or wagers, full-time laborers, they are employees. Part-time laborers, employees. Daily wagers, employees. Full-time employees, laborers, employees. Part-time employees are also employees. Permanent employees, employees. Temporary casual employees are also employees. Money that you pay to them also is part of employee benefits. If you have any interns with you, if you give them any compensation, if you pay them any stipend, they are considered as employees. However, if they are interns working for some certificate but not getting any compensation from you, then they are not considered as employees as per ES 50. If in case you have directors in the company, managing director, non-executive director or independent director, managing directors are employees to the company because they are reportable to you, you give them salary. These non-executive directors and independent directors, they are interested in the company only for sitting fees. They come to board meeting, they take the decisions, they eat biscuit, they drink tea, they go out. That's it. You cannot control their work. They are not obligated for any services to you. So they are not considered as employees. I hope you all understand this. So this is employee benefits. Benefits given to employees for the benefits given by the employees. The service is taken from the employees, for that compensation is given by the company. That compensation what the company gives to its employees is considered as employee benefits. This employee benefits, what is given by the company to the employees for the service given by them, is divided into 4 categories. 1. Short term. 2. Post employment. 3. Other long term. 4. Termination. What are the types of employee benefits? 4. Number 1. Short term, post employment, other long term, termination. Now, number 1. What do you mean by short term employee benefits? The benefits that the company has to give to employees for the service taken from the employee within 12 months from the end of the year in which service is taken is short term. As an employee, you give the service to me this year, July 2025, you give me service. When is the year ending? 31st of March 2026. Within 12 months from the end of 31st of March 2026, meaning 31st of March 2027. Within this time, if I am supposed to compensate you, then it is short term. Short term itself is so long, no? Short term employee benefits is any compensation to be given by the employer to employee within 12 months from the end of the period in which service is taken. When did you give me service? July 2025. Now you gave me 1 month of efforts. 1 month you worked in the company. For that I need to give you some money. Maybe PF, maybe ESI, maybe salary, maybe house rental allowance, maybe healthcare insurance, maybe gratuity, whatever it is, I don't know. Any service that you've given me, for that I need to give you some compensation. That compensation should be given within 12 months from the end of the year in which service is taken. It is short term. But this gratuity is kept out of this, but I'm just giving you an example. Okay, gratuity was the wrong choice of words. Sorry. But I hope you understood short term. The next thing is post employment. Your employment is over. Tata, bye bye, over Bartini. Then you're leaving and going. Then I'll give you some health insurance after retirement. That is post employment. Post employment is different from termination. Termination means what? You get up, leave. We'll ask them to leave the company immediately. Last batch I threw one guy out. I told get up, you leave. He got full scared. I told no. If I tell that is termination. If we terminate an employee in the middle of the employment agreement, if we terminate that employee from the middle of the employment agreement, then we give them some money. That is termination benefits. They become too old, 60 years of age. We'll make them cut the cake, we'll put shawl, we'll put garland, give fruit basket, and then we'll say lifetime achievement award, and then their family will come, all of them will click one group picture, happy retirement to you, everyone will wish. Then post-employment benefit. There is difference between termination and post-employment. Post-employment means employment is over, retire as per the agreement. Termination means either they will leave the company and go, or I will throw them out of the company. You understood? Long term, anything other than short term, post employment and termination is long term. I hope you understood. Let's do one cute little question to understand the difference between these, because I know that you wouldn't understand it comfortably when we do just that. See this salary paid within 5th of the following month, short-term employee benefit. We need to pay it within short time. No. How about bonus payable at the end of the quarter? Short term. Why? That is still within 1 year from the end of the year in which service is taken. It is amount payable within the 12 months from the end of the year in which service is taken. Is short term. Did not understand, sir, but you told it 4 times. That's what I know. Tell ya, within 12 months from the end of the year in which service is taken. Then what is it? Short term. Very good. Pension payable at the end of employment. This cannot be short term. Long term? No. Post employment. Post employment. Gratuity? Post employment. Compensation on VRS. VRS is not post employment. Yeah, VRS is suddenly he leaves the company and then goes termination of the employment. Silver Jubilee payment. Company became how many years? Silver Jubilee is 25 years. 25 years you worked in the company. Congratulations. 25 years of service. I give some benefit. For 20, it is not within 12 years. It is after 25 years. It is long term. What about sabbatical leave? Sabbatical is if you work in the company for 5 years or 6 years. I'll give you 1 month leave. 1 month means 1 month continuous leave. Salary also will be given. Enjoy 1 month holiday. Sometimes they give 1 month leave with the international flight tickets, with stay, everything, spa, everything. What happened here? Everything together when you give, it will become long-term employee benefit. Then, you guys are impossible. In December, now we'll do one more question. One more question. Quick. December 2024, employee joined the organization. We paid him salary in January 2025. What is this? Short term. Why? December he gave, January he gave service. December salary, we gave it in January. December he gave service, January I made payment. Within 1 year. Year is not even over. After the year end, if I pay within 1 year also, short term. Next one, March salary paid in April. Short term. For 24-25, 1st of April 2024 to 31st of March 2025, company has performed well. So I am giving you bonus when? After 6 months, October 2025. Hey, October, 6 months later. If it is paid before 31st March, short term only. Sir, what if I pay after that? If it is payable within 12 months from the end of the year in which service is taken, it is short term, not paid. Payable, this at least you learn no before we finish year 15. Payable within 12 months from the end of the period in which service is taken. Okay, service is taken in 24-25. Year ends on 31st of March 25. 12 months from there is 31st of March 2026. When are we paying? October 2025. Is it within the time limit? Yes, that's the reason it is short-term employee benefit. You understood? Then the next one, you give them leave travel concessions for the services in 23-25, 23-24, 24-25, 2 years he worked well. For that you are giving him LTC in 2028 October. Long term. Why? 23-25 year ended. From 25, 1 year is 2026, 31st March. You are giving the benefit after 31st March 2026. It is other long-term benefit. I hope you're getting it. Then give me example. Give me what about this VRS, voluntary retirement scheme in 2035 termination. Gratuity on retirement, post-employment. I hope you understood. On life cycle, from the first day of your employment to last day of your employment or last day of your life. Like you died, someone else is getting gratuity money. Maybe just giving you an example. Then we have a concept of leaves. Leave in the sense, you have been asked to work for 12 months. But let's say they'll give you 30 days leave. Maja madi. 30 days in a year you can take leave. Meaning you work actually for 11 months. But you get salary for 12 months. If you take that leave, it's okay. What if you don't take that leave? They gave you 1 month leave on paper, but whenever you applied, you're like, no, sorry, I can't give you leave in this month. Team is dependent on you, please work. Next time you apply, no, I can't give you leave. End of the year, you have to work. How can you take leave at this point? No. Exam you ask, no, he's already gone on leave. How can you also go in the leave in the same team at the same time? No, please work. So basically, they gave you 30 leaves, but they never allowed you to take those 30 leaves. So what happened? You ended up working for all 12 months. Now let's say 1 lakh rupees is the salary per month. You work for 12 months. You should get 12 lakh salary. But you are allowed 30 days leave. Technically, you should work for 11 months, you should get 12 lakh rupees. But you work for 12 months and then got 12 lakh rupees. So 1 month leave was there, no, but you did not take. Company will tell 2 things. One, carry it forward to next year and then take. You understand? Next year you take 1 month of next year, 1 month of this year, 2 months leave. 1 month, 2 months. that carry forward option will be allowed. You understand? If that carry forward option is allowed, it is called accumulating leave. You understand? They'll say, hey, availa sir, will not allow. That is non-accumulating leave. And later they say, I will allow you to carry forward that 1 month leave to next year. But maximum I can give you 45 days leave in a year. Beyond that I can't give. So in second year's 1 month leave is there, 30 days. First year's 1 month leave is there, 60 days. They'll tell you can only take 45 days leave. No, sir, what about balance 15? Balance 15 days, you could have taken leave, but you worked. I'll give you cash for that. I'll compensate. If the company says leaves of the current year are allowed to be carried forward to next year, it is accumulating. Leaves of current year are not allowed to be carried forward to next year, non-accumulating. Carry forwarded leaves can be encashed, vesting. Carry forwarded leaves cannot be encashed, non-vesting. You understood? Accumulating, non-accumulating, vesting, non-vesting. Vesting means can be encashed for, can be exchanged for cash. Non-vesting means cash ಎಲ್ಲ extra ಕೊಡಲ್ಲ ಬೇಕಾದ್ರೆ ಒಂದಿನ ರಜೆ ತಗೋ. You take leave, carry it forward to third year, and then take leave only. Leave ಗೆ ಕಾಸು ಇಲ್ಲ. This is the concept. You understand? Here accounting entries will change. Listen to me carefully. 12 lakh rupees is salary per year, but employee is given 30 days leave, so he should work only for 11 months. Am I right? If he works for 12 months, 1 month leave will carry forward to next year. No, the problem is in next year. Next year, let's say accumulation allowed and non-vesting, meaning you are allowed to take leave. Okay, next month he'll take 2 months leave, but we'll still give him 12 lakh salary. Don't you think next month's expense should reduce? Do you agree with me? For that, we'd have to do separate accounting entries. You agree with what I'm trying to tell? That is there in the syllabus. But if you have done this in the class in the past, you do it. Otherwise, you don't do this. So there are some kind of journal entries that you need to pass when the leave compensation is accumulating, leave compensation is non-accumulating, vesting allowed, non-vesting allowed. You do this. There are no questions in ICA study material. No questions at all. This is only theory. This is only theory and nothing else. So what did I do? Recently, I've added some questions on this. There you can see the entire material cover to cover. There are no journal entries at all. Is there a probability of questions? No. But if you already read this in the regular class, revise this once. Very rare, or in fact not possible. Only CA finally you have questions on this. But theory is there, so I put one question. But did you understand vesting, non-vesting, accumulated, non-accumulated? Is to go through the SAP for CA Inter. If you want, you can do some questions on this journal entry. Yeah. Okay. Now let's focus on the next part. I can discuss that in detail, but in the regular class only, when the time is not there, we will say that can be taken lightly. This much theory is sufficient times. But so now it's not a good idea. Can we discuss with the post-employment benefits? The short-term employee benefits is the easiest thing to do. Whenever you pay, you book expense. Khatam, over. When we talk about post-employment benefits, the money that should be paid to the employee for the service given during employment, money will be paid after employment. For the service given by the employee during employment, you will pay the money to him after employment. What is it called as? Post-employment benefits. What is it called as? Post-employment benefits. See, if in case I have very few employees, 5 employees, 6 employees, 8 employees, 10 employees, and I promise my employee that I will give you 1 crore rupees when you retire at the age of 60. That is after 30 years from now. Now, I have an obligation to give him 1 crore, but I don't know how to arrange 1 crore in 30 years. What will I do? I'll go to LIC. I want to give 1 crore rupees to my employee after 30 years. I'll go to PF Institute, Provident Fund Department. PF uncle, I want to give 1 crore rupees to my employee after 30 years. What do I do? They will take calculator, they'll take sheet, they'll do all calculations and say, hey, don't worry. Every month you pay me 30,000. After 30 years, I'll give you 1 crore. Like, Pakka no, I'll give 1 crore. Yeah, I'll give, don't worry. But inflation, you don't worry. I will give you 1 crore. They'll tell. So every month, my responsibility is to take 30,000, give it to PF Institute, and that's it. I can sleep peacefully. My responsibility is to give 30,000 to PF body every month, and that's it. That 30,000 every month what I pay. How to make it 1 crore in 30 years is their headache. In 30 years, they'll make it 1 crore and then give it to my employee. Now, my obligation is restricted to paying 30,000 every month. It is defined contribution plan. What is it called? Defined contribution plan. My responsibility is limited to the amount that I should contribute. Next one, defined benefit plan. What is defined benefit plan? Now, I am not a small person anymore. Number of employees in my company is not 10. I have 1,000 employees. Or I have 10,000 employees. for all 10,000 employees. Why should I give 30,000 to PF Institute? Why should they maintain the money and then they give money to my employee? I will appoint one mutual fund manager. I will give 30. I will ask my mutual fund manager, to all these 1,000 employees, I want to give 1 crore after their 30 years of service. You tell me, how do we plan? He will do planning and tell this much money will invest every month. You give me this much money, I'll invest this much in mutual funds, this much in equity shares, this much in gold, this much in this, that, everything he will plan. And he will tell how to make it 1 crore. It's his take. Here, my liability is not limited to the 20,000, 30,000 that I give him every month. My liability extends up to the date on which I'm supposed to give 1 crore rupees to my employee. This is defined benefit plan. My liability is defined in the benefit that I should give to my employee on termination or on retirement date. Till that date I have liability. I hope you understood. See this. What's happening? Is it raining? Okay. Defined contribution plan. What do? I am company. I give money to EPFO every month and they will give money to my employees. My employees will give me service. I should give them money. I won't give. I will give to PF Institute. PF will give it to them. Here my liability as a company is limited to giving money to EPFO. The moment I give money to EPFO, my liability is over. EPFO's responsibility it is to pay the money to my employees on time. I hope you understood. Next one, defined benefit plan. I am a company, I am receiving services from my employees and I have to give them money. What will I do? I don't pay to any PF Institute. I appoint one fund manager and I give money to this fund manager. This fund manager will invest in assets and he will generate the money, he will give it to me. I will only give money to my employees as gratuity. What is this? Defined benefit plan. Here, my liability is benefit that I should give to my employees later. But in defined contribution plan, my liability is giving that limited money to PF Institute every period. You understand? Now, fixed amount transferred to LIC for gratuity of employee. What is it? Defined contribution or defined benefit? Defined contribution. Determined amount transferred to state PF for gratuity of employees. Contribution. Determined amount to commonly controlled pool. What is commonly controlled pool? It's between these two. Now, if I am a very big entity, what do? I'll plan my own funds. I'll appoint one fund manager and then do. It will become defined benefit plan. If I'm a very small entity, I'll go for defined contribution plan. See, last one. Determined amount transferred to PF fund created by enterprise. Defined benefit. I have the liability of the ultimate amount that I should pay. Now I'll tell you there is something in between. I am an employer. Who am I? Employer. I have not 1,000 employees, not 10 employees. I have 150 or 100 employees. You are another employee. You also have 100 employees. And we have one more close friend. He also has 100, 200 employees. So individually we are going to PF Institute. But we three think, instead of going to PF Institute, all three of us together can appoint one fund manager and he will maintain PF fund of my employees, your employees, his employees together. I alone cannot pay 5 lakh rupees salary to fund manager. But if three of us come together, I think I can pay 1.5 lakh per month salary to fund manager. Because I have about 150 crores to be handled. I think you only have 150. 500 crores is good enough amount to appoint fund manager. We'll appoint fund manager and all three of us will give money together. He will handle. That will become multi-employer scheme. Multiple employers come together commonly to create one pool and they work it out. That's called as multi-employer scheme. Did everyone understand this? Tell something, yeah. Paka. Very good, fantastic. We have learned AQ7. I'm going to say defined benefit plan versus defined contribution plan also. Now we'll see in defined benefit plan how to identify the current service cost and interest cost. Couple of questions. Once we do this, we'll get good hold of this. I think I won't take too much time. I'll do 2-3 more questions, 2-3 more concepts, and then we'll find up this AS15. Okay, focus on this part. Yeah. Right now, my employees have given me service of how much? 1 lakh for the first year. I need to give them retirement benefits after 4 years. What is the amount that I promised them that I'll give? 3 lakh rupees after 4 years of service. Observe this question. I am company. This is my employees. You are thinking from the perspective of company. My employees have given me services worth 1 lakh and first year service that they've given is 1 lakh. And what is the agreement that we have? I should give them 3 lakh rupees after how many years of service? 4 years of service. Now let's see how does this work. What is the current service cost that we just read? Currently, what is the service that they've given me? 1 lakh. And I need to pay them this 1 lakh Not now. I need to pay to them after 4 years. Service is taken now. For immediate service, I give them salary. Gratuity, I will give it at the end of the employment agreement. So 1 lakh rupees worth of service what they've given me. For that, I will give them gratuity after 4 years. Because I'm delaying, I should have paid this at the end of year 1. If I would have paid it at the end of year 1, I should have paid 1 lakh. I'm not paying at the end of year 1. So I need to add interest for year 2. How much interest on 1 lakh? 10% will come to 10,000. Am I right? Did I pay in year 2? No. So year 3 interest I should pay. Not on 1 lakh. 1 lakh plus 10,000. On 1 lakh 10% comes to. On year 4 I pay interest on 1 lakh plus 10,000 plus 11,000. So on 1 lakh 21,000 I pay 10%. How much is that? 12,100. Add them all together. I need to pay 1,33,100 to my employee after 4 years of service. Sir, but you told we should pay 4 lakh. Sir, we should pay 3 lakh. 3 lakh is 1 lakh for year 1, 1 lakh for year 2, 1 lakh for year 3. Oh. But paid after 4th year of service. Okay, not exactly 3 lakh. Like 4 years here 3 lakh, not last year maybe less amount. Something like that. But payment is happening when gratuity at the end of service, 4th year. But in that, how much worth of service has he given me in first year? 1 lakh. So 1 lakh rupees is the amount for which I've taken the service in year 1, but I'll pay it to me after year 4. So I'll add interest for year 2, year 3, year 4, and it will become 1,33,100. Same thing can be presented slightly differently also, like this. Opening balance is 0, service cost for first year is 1 lakh, interest is 0, 1 lakh, second year interest 10, third year interest 11, fourth year interest 12,100. At the end it becomes 133,100. Whatever makes you feel comfortable. Everyone understood this? Okay. For your understanding, service of first year is 1 lakh. On that, interest for first year 10,000, interest for second year 11,000, interest for third year 12,100. Together it will end up becoming 1,33,100. Similarly, second year he will give some service. That money I should have paid second year, but because it is post-employment benefit, I will give it to him at the end of year 4. So on the second year service, I'll pay interest for year 3 and year 4. On third year service, I'll pay interest for year 4. On fourth year service, no interest. Why? Service is taken in year 4. Payment is made at the end of year. This is a stepping stone. I made you do for only 1 year. Next, we can do it for more than 1 year. Observe this. So retirement is after how many years? 7 years of service. How much is the gratuity amount payable after 7 years? 5 lakh. 60,000 is attributable to first 3 years of service. How much is the money attributable to first 3 years of service? Okay, observe this question. I'm an employer. I have employee. I have promised them retirement benefit. The period of employment is 7 years. How much is the gratuity payable after 7 years of service? 5 lakh rupees. For the first 3 years, how much is the attributable amount? 60,000. Let's see how should this be accounted. Amount payable to the employee at the end of year 7 for his employment services during year 1, 2 and 3 is 60,000. How much is the payment? 60,000. 60,000 will include two things. One, service cost plus interest cost. This 60,000 is not this 1 lakh. 60,000 is this 1,33,100. Amount that I pay is 60,000. Amount that I pay, the 1,33,000 will include 1 lakh and 10 plus 11 plus 12,100. 10 plus 11 plus 12,100 is interest cost. 1 lakh is service cost. 1 lakh is service cost. 10 plus 11 plus 12,100 is interest cost. Putting together the payment is 133,100. In this question, I gave you 1 lakh service cost. You added interest to find the total payment. But in the next question, I have given you the amount to be paid. If I have to explain it to you here, amount to be paid is 60,000. This will include service cost for year 3 and interest on that service cost at the end of year 3 for year 4, year 5, year 6, year 7. How to find? Pure FM. Nothing to do with accounts. You understand this? Sir, how do we do this, sir? Discount it, yeah. Discount 60,000 for 1, 2, 3, 4, 4 years. Discount it for 4 years at what rate? 10%. How to do it? Very simple. Please do a present value of 60,000 for 4 years. 1 divided by 1.1 to the power 4. 1 divided by 1.1. 0.909, 826, 751, 683. 683 multiplied by 60,000. 0.683 multiplied by 60,000. 36,000. Sorry. 40,980. That is the cost. 60,000 minus 40,980 is there, no? How much is 60,000 minus 40,980? 19,120. Am I right? 19,120 is interest cost. Not 19,120. 19,020. That is interest cost. Sir, how? Individually you do. First 3 years over. Am I right? Compute interest cost for year 4, year 5, year 6, years. Year 4 is to 40,980 into 10%. 4,098. Year 5 is to 40,980 plus 4,098 into 10%. For year 3 it is 40,980 plus 4,098 plus 4,507 into 10%. 4,959. For year 7, 40,980 plus 4,098 plus 4,507 plus 4,959 into 10%. 5454. Add them all together, it will come to 10,000, 20,020. That is interest cost. Add it to 40,980, you will get 60,000. Okay, if it's too complicated, I'll tell you. 60,000 worth of services have been, 40,980 worth of services is taken from the employee in 3 years of service. He would have done service for 1 lakh rupees. How much service he would have done? 1 lakh. About 60,000 rupees cash, I'll give it to him as salary. 40,980 rupees worth of service what he gave is earned, but I won't give. Why? In India, government believes people are bad at their retirement planning. You give them 1 lakh rupees for 3 years of service, full 1 lakh they will eat that day only. They will buy one iPhone and then sleep. After retirement, what will they do? Simple. Jayanagar Ganesha Temple, Chamarajpet Venkateswara Swami Temple, Devagiri Temple, or some Manjunatha Temple. Somewhere they will sit. You will get prasada over. So government doesn't want people to become beggars after they retire. So government says you worked for 3 years. The employee benefit that the employer should give is 1 lakh. Don't give. Give him only 60. 40,980 what belongs to employee, keep it with you. You add interest and give it to him at the age of 60 when he retires, so that his children or his grandchildren can steal it and then put him on the streets. Example, that's it. You get something for their grandchildren to look forward for from their grandparents. Might be to buy one Parle-G biscuit someday. Something like that. You understand what I'm trying to tell? So 40,980 is the service cost payable to employee for the service taken at the end of year 3, but will be paid by the company at the end of year 7 with interest. 60,000 payment when year 7, earned year 3. How much is interest? Discount 60,000 for year 4, year 5, year 6, year 7. 4 years. 1 by 1.1 to the power 4, you get 4980. If you have to do it here, 4980 is the service cost in year 3. To that you add interest in year 4, interest in year 5, interest in year 6, interest in year 7. Together it becomes 60,000. You understood? Here we did only for 1 year. And we're doing it like service cost is in year 3, payment is in year 7. Imagine when an employee joins at the age of 21 to a company, he is supposed to be paid gratuity at the age of 60. Year 21 to year 60, 30 years, 40 years, we need to do computation. And every year there is some amount added as service cost. And on that amount, from the next year till the date of retirement, you go on adding interest cost. Together, here you should get 1 crore. For example, if the employer says, I will give you 1 crore rupees for 30 years of service. 1 crore rupees is the amount to be paid. Should be split between 30 years of service. Should be discounted and charged as service cost each year. And so much money will be taken out and then deposited in plan assets. Should earn same rate of interest. If the rate of return earning decreases, your contribution should increase. Beautiful standard. CA interview solpa jasti aitu, but they'll ask only basic questions. Discounting, adding, that one. There are 2-3 varieties of questions in the material. Do only that. One of them is this. Now, I taught you concept till now. This is the kind of question that will come in the exam. See this question? Employee is entitled to gratuity of 10 lakh after 5 years. After 5 years, how much money should we give him? 10 lakh. Identify current service cost. Okay, this complexity, it won't come. But I think I'll teach this question and then I'll teach you what is plan assets and then I'll call it a day for ES15. Okay, I can go long, but beda, jasti aitu. This is only too much. Okay, focus. Employee is entitled to gratuity of how much? Is it too much? Yeah. Should we skip this? Can I do? Okay, tell. How much is the gratuity the employee is entitled to? 10 lakh rupees. For how many years of service? When should I give 10 lakh? Current service cost is how much? We should identify. We should identify. Interest cost is how much? We should identify. For 3 years at a rate of 10%. Assume period to be equal for each year of service. Okay. Period cost to be equal. Defined benefit obligation. DBO 10 lakh. Meaning after 5 years of service, what is my obligation for the benefit taken from the employee defined in terms of money? 10 lakh. Period is 5 years. Can I say for each year I should pay him 2 lakh rupees? For each year of service I should pay 2 lakh rupees. I think you'll understand this the best. I should give him 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh, 10 lakh. 10 lakh is to be paid for each year of service. You agree with me? 2 lakh is paid at the end of 5 years employment for the service taken from the employee in year 1. For the service taken by the employee in year. So I'm giving, if first year if you work with me, after 5 years I'll give you 2 lakh. 2 years if you work, I'll give you 4 lakh. 3 years if you work, 6 lakh. 4 years, 8 lakh. 5 years, 10 lakh. I am giving you 2 lakh. This 2 lakh will include service that you gave plus the interest for delay. 2 lakh what I give. Let's say you work for 1 year and you leave the employment. Will I give you 2 lakh? Yes. When? After 5 years. If you work for 2 years and then leave, how much will I give? 4 lakhs. When? After 5 years. But how much money did you, how much service did you give me today? That's what we should do. Discount this 2 lakh for 1, 2, 3, 4. 4 years. This 2 lakh should be discounted for 4 years. This 2 lakh should be discounted for 3 years. This 2 lakh should be discounted for 2 years. This 2 lakh should be discounted for 1 year. This 2 lakh, no discounting. Service kotru, cost is counter. You understood this? Now discount this here. 1 divided by 1.1. Do it is equal to 4 times. 909, 826, 751, 683. 683 multiplied by 2 lakh. 0.683 multiplied by 2 lakh. 1 lakh 36,000. That is the service cost. That is the add compute interest for 1 year 13,660. You understood? Add 1 lakh 36,600 plus 13,660 and compute 10%. You should add both, no? Interest value interest kodbekalva. 15,025, 16,529, 18,181. Are you getting it? So the reason why we do this is 1,36,600 should appear in your statement of profit and loss as current service cost. And first year there is no interest. Second year service cost should be shown separately, interest cost should be shown separately in employee benefit expenses in statement of profit or loss what is prepared as per schedule 3. That way you breathe out makes lot of sense. Employee benefit expenses, you should show how much is current service cost, how much is interest cost separately. That's the objective. If in case you want to write this in the format in which ICA gives the answer, usually it's like this. You will write here 1, 2, 3, 4, 5. How much is the benefit? You would basically write how much amount? 2 lakh, 2 lakh, 2 lakh, 2 lakh, 2 lakh. Discounting factor here for 4 years, year 3 years, year 2 years, year 1 year. Here no discounting. 0.9, 0.6, sorry, I'll write it ulta. You should start from here. Here you will write 1, 0.909, 0.826, 0.751, 0.68. Sir, shall I do it ulta like this? You can do, but that's actually more confusing. No, sir, that's more easy. That is easy in FM. This is slightly different. You multiply, you get the current service cost for each year of service. Then what do you do? Year 1, opening balance is 0. Interest cost is 0. Current service cost for year 1 is 136,600. And you need to pay them 136,600. You won't pay in year 1. Year 2, opening balance is 136,600. Do you pay that money in year 2? No. Interest on that 136,600, 13,660. And how much is the current service cost for year 2? 150,200. 150,200. Add 136,600 plus 13,660 plus 150, 200. 3,04,000. Sorry, 3,04,60. Year 3, opening is 3,04,60. Add interest on 3,04,60. 30,046. Add service cost of year 3, 165, 200. Add all three together, you will get closing balance. Year 4, opening is 4,95,706. On that, interest will be 49,571. Current service cost of year 4 is 181,800. You write the same. Then add all three together, you will get closing balance. Similarly, you would have to do it for year 5. 10 lakh rupees will become the total service cost for each year, along with the interest cost, which is supposed to be paid by the employer to the employee at the end of 5 years, for the service taken over 5 years, including the interest on the amount for the delay. You need to identify, only objective is you need to identify how much is the service cost, how much is the interest cost for each year of service separately. The next point is plan assets. Can I go to the next point? Plan assets. The money what company has to give to employees for the service given at the end of their employment, they invest in plan assets. They invest in investments. That investments are called plan assets. What do we call those investments as? Plan assets. That investments are not regulated by accounting standard 13. You open one ledger like this for them. Opening balance of the asset, amount further invested. Amount withdrawn, closing balance. Opening balance of the asset, amount further invested. Amount withdrawn to pay the employees, closing balance. If in case there is balancing figure here, it is surplus. If in case balancing figure here, it is deficit. See this, during the year beginning, how much was there? 1 lakh. How much was further contributed into plan assets? 30,000. How much is the money taken away from assets to pay? 40. Still, what do you have at the closing? 1,50,000. Can I say opening is 1 lakh, invested 30, withdrawn 40, still 1,50,000. Take the total 1,55,000, 1,55,000 minus 1,30,000, 25,000 is surplus. This is plan assets surplus computation. Did everyone understand this? There can be a question like this also on the plan assets. Be slightly cautious and careful and ready to do this. Ishtu saku. Yeah, there might be some question on expected return. Sir, expected return means they'll expect some 10%, 12% and they'll book already as income. They have already booked as income. You find the balancing figure, excess amount only should be booked as income. Here, see this, 25,000 no income. Throughout the year, there is 1 lakh. They expected 20% return and they've already booked 20,000. Already booked how much? 20. Actually how much? 25. Further 5,000 should be recognized as income. Yeah, actuarial gain or loss on the one small concept. You do this much, it is good enough for accounting standard 15 the day before. I think I'm sorry, I slightly went overboard and then got carried away. It's slightly more than what we should actually do in AS 15. But I hope you people are happy about what we did in AS 15. Not getting scared. Now let's go to the next one. Let's do something jolly, easy, simple. Accounting standard 29. Let's discuss chapter 6, unit 2 of our syllabus, accounting standard 29, which deals with provisions, contingent liabilities and contingent assets. Before that, in AS 15, please do questions with service cost and interest cost. There are questions with service cost and interest cost, computation based question, present value factor and then totaling. Please do that. One variety question is it. Current service cost with interest cost, that question. And do a question on plan assets. Plan assets where you are required to compute actual return. Plan assets where you are required to compute actual return. Ouch. Everybody got this? Come on, let's start with accounting standard 29. A complete theory based standard, but problem has been asked in the recent attempt also, warranty provision computation. It is more of common sense and very less of accounting standard 29. In fact, I'll tell you what to do in such kind of questions. Before that, let's understand the theoretical part. Less likely, usually it used to be theoretical questions that used to come from this. Now we'll do it for the sake of doing. So provisions, contingent liability and contingent assets. Before understanding provision, let's understand contingent liability. A liability is a present obligation. Contingent liability is not a present obligation. It is a possible obligation. There is a possibility that it might end up in an obligation. How do we get to know it will be known to us whether it is a liability or not. It will be confirmed only on occurrence or non-occurrence of one or more events which are in the future, which are not certain, which are not controlled. So a future uncertain and uncontrollable event which would happen in the future will decide whether it is our obligation or not. If it turns out to be our obligation, then it will be liability. Till that time it doesn't turn out to be my liability, it will be contingent liability. There is someone who's filed a case on me saying that they faced some loss because of me. Do I have a liability? Maybe. Do I not have a liability? Maybe. When would I get to know it's a liability or not? In the future, when things will become more certain. Till then, it is future, it is uncertain, and it is uncontrollable. Judgment from the court. If the judgment from the court comes against my favor, then it is a liability. Till that date, it is contingent liability. Similarly, I have filed a case on somebody saying that I have gone through loss and they should compensate me. The compensation that I am supposed to receive from them, if I have a right to receive, it is my asset. Right now, do I have a right to receive? No. Maybe I might receive. Is it an asset? No. It is a possible asset. When do I get to know whether it is my asset or not? In the future. When a certain set of events happen, then it will become my asset. If a certain set of events doesn't happen, it will not become my asset. It is again confirmed based on happening or non-happening, meaning occurrence or non-occurrence of one or more future uncertain and uncontrollable events. I hope everybody understood this. Provision. Provision is present obligation for a past event. Basically, contingent liability and contingent asset should not be written in balance sheet. Asset and liability should be written in balance sheet. For a contingent liability, when it fulfills two important factors: one, probable outflow; two, reliable estimate. I expect this contingent liability to become liability. I am thinking that this is no longer contingent liability. I think it will become liability. This is probably outflow of cash to be paid against a contingent liability, making it a liability. Second one, reliably, I can estimate the money that I might have to pay. Reliably, I can estimate the money that I might have to pay. So when it triggers these two conditions, probable outflow and reliable estimate, for this contingent liability, I will create provision. What is provision? It is no longer possible obligation. Because it has become probable, now it is present obligation as a result of past event with probable outflow and reliable estimate. Now, at the end of each year, I need to identify, do I have any contingent liabilities? What is it that I should identify at the end of each year? Do I have any contingent liabilities? When there are contingent liabilities, I need to see, is there a remote possibility of it becoming a liability, or it is not remote possibility? Remote possibility, meaning there is no possibility of it becoming a liability. Don't even disclose, ignore. Don't even disclose, ignore. But it is not a remote possibility. There is likelihood. Disclose it as contingent liability. This contingent liability, whatever it is not remote, then check, is there reliable measurement and probable outflow? Yes. Then create provision. No reliable outflow, no probable outflow, no reliable estimate. Don't create provision, leave it contingent liability. Next balance sheet date, again check contingent liability. Is the contingency remote or not remote? Remote possibility, very rare case of losing. Don't even disclose, leave it. Not remote, write it as contingent liability. Then check, is there probable outflow, reliable estimate? Yes, create provision. No, don't create provision. Let's say it is yes, you create provision. Next year again you check, again probable outflow, reliable estimate is there. Check whether the estimate is same or different. If the estimate has changed, revise the provision. Either increase the provision or decrease the provision. You understood this? That's what we should keep doing every year. That's what is given here. See, if there is probable outflow, present obligation, check for condition, probable outflow, reliable estimate. Conditions fulfilled, create provision. Conditions not fulfilled, no need to create provision, disclose it as contingent liability. At every balance sheet date, we should check. If in case we think the liability is more than provision, create additional provision. If not necessary, then reverse the provision. You understood? Again, if it is only possible obligation, it's not going to become provision. Remain it as contingent liability. If the possibility is remote, then no disclosure required. If it is not remote, then we would have to create disclosure. Did you understand this? Then there is one question in your study material on warranty. It's one of the past exam questions. So I'll ping that in the comments. I'll ping that one of the questions. So there is sales made by an entity. I sold certain products. When I sell certain product, I need to give service. I've told pre-service, pre-warranty for 2 years. Meaning, if in case the product becomes repaired, I will do repair work without charging you money, pre-repairs. So I incur expense for doing that repair, but I won't charge it to you. That will become my expense. So I will check what is the probability that people come back with defective product. About 2% or something is there. So I create 2% provision on the sales made. I create 2% provision on the sales made. Next year I'll make further sales. So existing provision will be there. Sales in first year, sales in second year, together I need to make 2% provision. Existing provision, okay. Beyond that, whatever is needed, I create additional provision in year 2. Let's say warranty is only for 2 years. Then in year 3, I no longer have to give provision for first year product sales. So I have to make it only for year 2 sales and year 3 sales. So I need to reverse that. I won't reverse it. I'll understand how much provision is to be maintained at the end of year 3. That is year 2 sales plus year 3 sales into percentage. So much will be maintained. If the existing provision is less, I create additional provision. If existing provision is more, I will reverse the provision. This is easy to do question. I can discuss it right now, but I would want you to try it on your own. And anyways, if you just search this same question, I'll share the solution to. In fact, drop a message in the comment if you want solution to this. I'll ping you the link in the comment. Yeah, or that another playlist I told with important questions from every standard when I make. In that playlist, I will add this and then share it across to you people. Is that okay? Pakka? Very good. So it is from Jan 25 or May 25. Jan 25 exam. Just show it to you once. I say study material question, same to same. Jan 25 exam question on now this is the warranty question. I've done it in a very detailed way for each year separately. They've actually asked for only 1 year. In the answer, I've done it for 2 years. The video I've done it for 3 years, but they've actually asked only for 1 year. Answer is very short in the suggested answer. I've done it in detail so that you understand. You can do only for 1 year in the answer, but I've done it for all the 3 years that is there. So this is the solution. We can see it in that separate video. Let's not keep this beyond a point. I hope you got it. Okay, that's one thing that I would want you to refer on Accounting Standard 29. Can we now quickly go to Accounting Standard 4? One of the least probable standards, not very crazily heavy marks loaded standard. Even if it comes, it might come only for case scenario question, or they might overlap this with another financial statement question or somewhere and then give one adjustment of this day. They usually give this dividend adjustment in financial statement question based on years. Can we begin chapter 7, unit 1, Accounting Standard 4, events occurring after balance sheet date? What is events occurring after balance sheet date? Very simple, yeah. If transaction happens between 1st of April 2025 to 31st of March 2026, we write it in this year. If the transaction happens after 31st of March 2025, it will be written in next year. Sorry. If the transaction happens between 1st of April 24 to 31st of March 25, it will be written in this year. If it happens after 31st March 25, it should be written in next year. But if that event happens after 31st March 25, but before the date on which financial statements are approved, then there are certain conditions what AS4 tells, which if it fulfills, though it is happening after March, it need not be written in next year. It can be included in current year only. What are those? That is event occurring after balance sheet date, EOBD. EOBD is a significant event. Significant means what you say material, no? Similar to that, significant. Any random event cannot be EOBD. If it is random, silly event happening after 31st March, write it in next year only. Significant, it is of some importance. Without this, the decision making is different. With this, the decision making is different. So it's a material impactful item. So though it happens after the balance sheet date, it can be included. So it is a significant event. Significant event always doesn't mean favorable. It can be favorable, it can be unfavorable. A favorable or an unfavorable event happening after balance sheet date, but before the financial statements are approved by the board, will be included in the current year financial statements if the condition was existing on the balance sheet date and the event occurring after balance sheet date gives additional evidence. Number one, condition is existing on the balance sheet date and events occurring after balance sheet date gives additional evidence. Meaning on 15th of March, my customers go down, caught fire. I saw my customer crying. He owes me 10 lakh rupees. I somewhere doubted that this guy is in loss. This guy might not be able to pay money is what I guessed. What did I do? 31st of March, on this 10 lakh receivable from this customer, I created 10% provision, 1 lakh rupees. I am doubting that he might not pay money. So I created not full provision. How much? 10% provision. How much is he debtor to me for? 10 lakhs. What happened to him in 15th March? Business caught fire. So I created provision of 1 lakh. I booked expense. 31st March over. I wrote 10 lakh minus 1 lakh provision, 9 lakh. 31st March is over. My financial statements are approved by my board on 30th of June. Meanwhile, in the month of May, he declared himself insolvent. He became bankrupt. He told he will not be able to pay any money. Now that is bad debt. When did it happen? May 2025. Can I say it should be written in the year 25-26 as bad debt? Yes. But if that is a significant transaction, though it is happening in May 2025, it should be included in balance sheet as on 31st of March 25. Why? Significant, unfavorable, transactions condition was existing on balance sheet date. On balance sheet date, I had a doubt. Somewhere this guy might not pay. And event occurring after balance sheet date only gave me additional evidence that he will not be able to pay. So, first 31st of March I have created 1 lakh provision. I will increase the provision of 1 lakh to 10 lakh rupees on 31st of March. If I have to do that, already balance sheet and P&L is prepared on 31st March with provision of 1 lakh. Now we'll change the provision of 1 lakh to 10 lakh. That is adjusting event. What is it? Transactions are over, balance sheet is ready, P&L is ready, year is ended, then something happens. I'll take the transaction. Inge adjust auto, I'll keep the transaction inside. That is adjusting event. Read this. Events occurring after balance sheet date are significant events, whether favorable or unfavorable, happening after balance sheet date but before financial statements are approved by board. Condition is it should be existing on the balance sheet date, and events occurring after balance sheet date give additional evidence. If the conditions are fulfilled, it is adjusting event. I redraft my financial statement. If conditions are not fulfilled, it is non-adjusting event. I will not adjust my current financial statements. I will include it in next year financial statement. I will include it in next year's financial statement. Everybody got this? If events occurring after balance sheet date, questions going concern, then even if condition is not existing on balance sheet date, it will still become adjusting event. Meaning, on 31st of March, I have no condition existing. There is no possibility that I know that that customer's business got fine. Customer's business is all fine on 31st March. I have not created provision. On May 1st, his business caught fire and it completely destroyed. And he told he won't pay money to me. Is it event occurring after balance sheet date? Yes. Was there a condition existing on the balance sheet date? No. But event occurring after balance sheet date gave additional evidence. It is non-adjusting event. I should take it in next year as bad debts. But he is my only customer. If he doesn't give money, then I will die. I am dependent on him. If he doesn't give money, I will die. My business will die. Then, because there is a question mark on going concern, though it is happening after balance sheet date with no condition existing on balance sheet date, still I should provide for that bad debt in my debtors, show that zero. When I redraft my financial statements, I need to remember that there is question mark on going concern. I should restate my assets and liabilities to closing value, net realizable value or settlement price. You understood? Last point that I want you to note. Going concern is fundamental accounting assumption, meaning they will say major fire, major accident. Still think that going concern is not questioned. Entity is a going concern, it will survive. Unless they mention in the question. Question only should mention. Entity's going concern is not there. There is a threat to going concern. They'll mention. Only when they mention, you take, otherwise you don't. There are some questions where they say negotiations were finalized on 31st March, not conditions existing. That does not mean conditions is like to buy a property. Negotiations were finalized on 31st March. They entered into agreement in May and they bought it in May. It is purchased in next year. It is not adjusting event. Why? Negotiation is not sufficient. What if they have entered into sale agreement, consideration is given, property possession is transferred before 31st March, but registration happened after 31st March? Then conditions existing, additional evidence, adjusting event. Are you getting it? Did not understand? It doesn't matter. Negotiation is not sufficient. Agreement is mandatory. You got that? So based on that, couple of theory questions are there. Please do that. I think you can do only if you have time. Yeah, but just become familiar with the language of the answer once. Highly unlikely of a theory question. What is more likely is being asked a question for MCQ. But anyways, in your material you would have written this. This is the answer format that you should write if in case a theory question comes. Standard first paragraph, second paragraph question as it is you write, third paragraph you will write conclusion. This is what you should write if in case a theory question comes. but highly unlikely, like I just mentioned. Can we go to Accounting Standard 5? Let's go to Accounting Standard 5. The name of the standard is Accounting Standard 5, Net Profit or Loss for the period, prior period items and changes in accounting policies. The standard says when you compute your profit by preparing statement of profit or loss, you have written some incomes, you have written some expenses, you have found some profit. Incomes and expenses what you have written inside, if any of these items are extraordinary, exceptional, prior period items, disclose them separately. The objective of the standard is very simple. When you prepare your P&L, there are some incomes, there are some expenses, there is some profit. In the computation of profit, if any item is extraordinary, exceptional or prior period, disclose them separately, write them separately, so that we understand what is the impact of this special item. Without this item, what is profit? With this item, how much is profit? Without this extraordinary item, what is the profit? After this extraordinary item, what is the profit? Excluding this exceptional item, what is the profit? After this exceptional item, how much is the profit? They want us to know. Only for that reason, the disclosure is required. Let's quickly see. What do you mean by extraordinary? What do you mean by exceptional? What do you mean by prior period item? To do that, we should know what is ordinary. Activities that are taken care in the ordinary part of the business or furtherance of the business or incidental to business or ordinary. What is activity? What is ordinary items? Activities that are done in the ordinary course of business, in furtherance, meaning to continue the business, or which are incidental to business. Three keywords: course of business, furtherance of business, incidental to business, or ordinary items. These items need no separate disclosure unless among these ordinary items is some prior period item. What is prior period item? Prior period item means item that is arising in current year PL because you made an error in previous year. Item arising in current year because of an error or omission in previous year. Item arising in current year because of an error or omission in previous year. If you do error or omission in previous year, it will arise in current year. That is prior period item. You understood? Why should we disclose this separately? Very easy. Have a look at this. Prior period item. My profit for last year 10 lakh. My profit for current year 12 lakh. Leave everything. See 10 lakh, 12 lakh. What do you feel like? Understand? What is your conclusion based on this? Profit went up by 20%. Am I right? But in reality, expenses of 4 lakh relating to 23-24 was omitted. In previous year, there is an expense of 4 lakh. You have not written. By mistake, you have forgotten. You realized it now and you wrote it here. If you would have written that expense of 4 lakh in year 23-24, profit would have become 6 lakh. And you have by mistake written in current year. You should have not written. Current year profit of 12 lakh is after deducting 4. Before deducting it, current year profit would be 16. If in case that 4 lakh expense of last year was written last year profit was 6, current year profit is 16. 6 to 16. How much is increase in the profit? 10 lakh, which is 167% increase in the profit. But what did you think? Profit has increased by 2 lakh, which is 20%. So a business which has grown 167% in India, in 1 year, would have been incorrectly interpreted to be, I am right now doing AS5, but I am thinking about AS11 that we'll do next. So India, sorry. So a business which is grown by 20% is the interpretation of yours, but it is actually increased by 167% in 1 year. Wrong, no? So what should you do? You should show profit before prior period items and prior period items, profit after prior period. You should show that prior period items separately. See this here, a prior period item should be disclosed separately. The nature of that item and amount involved should be disclosed separately to perceive the impact on the statement of profit or loss. You understand? Theory is standard. There is no computation in this. You just have to tell, is it prior period or is it not prior period? Is it exceptional or not exceptional? Is it extraordinary or not extraordinary? Focus on the next one. There is an exceptional item. What is exceptional item? There is no concept called exceptional item in accounting standards. Accounting standard 5 only calls it special item. The word exception is given in schedule 3. Companies Act 2013 uses the word exceptional item. In accounting standard 5, what is the word there? Special. What is a special item? This item requires separate disclosure. If you don't disclose this separately, people will misunderstand the financial statements. This is identified as a special item based on size, incidence, nature. Based on size, incidence, nature. In audit, you say timing, extent, nature, no? Yes, sir. TEN is what I know. You like NET, huh? NT. Okay. I used to tell 10, 10, 10. Okay, fine. Sorry. Here. Okay, sir. Come back here, please. So, special items or exceptional items. Meaning what? These items have to be disclosed separately, because if we don't disclose them separately, the kind of interpretation that we do based on them will be incorrect. I hope everybody understood. I'll give you an example for this. Quickly have a look. Exceptional items. Am I right? That's what we were discussing now. Profit of previous year 10 lakh. Profit of current year 12 lakh. How much is the increase in profit? 2 lakh. Meaning how much percentage? 20%. This is where we are wrong. See this? There was one provision created for 4 lakh in previous year. Provision for some repair, provision for bad debts, or provision for some expense. Last year we created 4 lakh expense provision. This year we realize that provision is no longer required. When you create provision, it is expense. When you reverse provision, it is income. You created provision last year, you reverse that provision this year because it's no longer required. If in case you had not created the provision last year profit would have been 14 lakh. Because you reverse the provision this year, profit has become 12. If in case you had not reversed the provision this year, because you had not created last year, the profit of current year would have been 8. So actually last year profit is 14, current year profit is 8. Profit has decreased by 6 lakh. Company has decreased its profitability by 43%. By creating fake provision last year and reversing the provision this year, you made it look like company with 20% more profit than last year. Misunderstanding, no? If you don't disclose this. So what do? Reversal of provision is an exceptional item. Reversal of provision is you should show profit before exceptional item, exceptional items, profit after exceptional items. Where? When we prepare our statement of profit or loss, we write revenue from operation, other income, total income, expenses, profit before exceptional items, profit after exceptional items, to be disclosed separately. If you don't disclose it separately, people will misunderstand the financial statements. Does it make sense? So what to do? An exceptional item, its nature and amount to be disclosed separately to perceive the impact on financial statements. You understood what are ordinary items? It is activities ordinarily part of the business, furtherance of business, incidental to business. What is prior period items? Items arising in current year because of an error or omission in previous year. What is exceptional items or special items? Items requiring separate disclosure, because if we don't disclose them separately, the way we perceive that information is different. Based on size, incidence, nature, it should be disclosed separately. Last item, extraordinary items. What are extraordinary items? These items are not in the ordinary course of business. These and business are having no connection. Because of these extraordinary items also, we might have some profit, we might have some loss. We should show how much is profit before extraordinary, after extraordinary. Example, loss because of earthquake and all of this. Okay, come. Let's quickly see this one. Profit in 23-24, 10 lakh. Profit in 24-25, 50,000. When you look at this, you'll be like, oh my God, last year 10 lakh profit has become only 50,000. Business has become terrible. But see this, during the year 24-25, earthquake happened. Because of that, they made loss of 12 lakh. Do you think earthquake will happen every year? Every year they'll make 12 lakh loss? No, this year it happened. If in case there was no earthquake, their profit in 24-25 would have been 12 lakh 50. And last year profit is 10 lakh. So business has actually grown from last year to this year. Profit has actually become more by 2 lakh 50 because of some extraordinary event like earthquake. You made loss. So what you should do is, when you prepare PL, you should show profit 12 lakh 50. But earthquake lost 12 lakh, so profit 50. You should show how much is profit before exceptional extraordinary items, impact of extraordinary items and exceptional items, profit after extraordinary items. This is the profit, but this is used for deciding the future of the company. Extraordinary means it happens only once, it doesn't keep happening. If it happens every year, then it is ordinary activity. So it has happened this year, I agree. But I will not take my decision to whether invest in the company or not based on 50. I will take decision based on 12 lakh 50. I hope you guys understood. So extraordinary, exceptional and prior period items, their nature and amount to be disclosed separately to perceive the impact of these items on the statement of profit or loss. Okay, nice. Now we have a list of transactions which are ordinary, extraordinary. I have given some. You can see. I'll also take a small breathing break. See the item. I've told, is it ordinary or extraordinary? Just reading. Loss due to enemy action, extraordinary. Sale of land in one city to buy a land in another city, ordinary. Sale of land to pay liabilities, extraordinary. And sale of land to tide over liquidity issues, extraordinary. Sale of investment, and I'm doing investment business, ordinary. Non-recurring loss, ಒಂದು ವಿಚಿತ್ರ ಲಾಸ್ ಆಯ್ತು, ಮತ್ತೆ ಮತ್ತೆ ಆಗಲ್ಲ, extraordinary. And similarly, exceptional and extraordinary are different. Exceptional is ordinary, but based on size, incidence and nature, its impact should be shown separately. Extraordinary, not part of the ordinary activities. I've given some list of transactions and I've told you whether they are extraordinary or exceptional. Maybe you can pause it when you see the recording and then read them through. Last one, whether it is prior period item or not. Prior period item means error. I've given some list of items. You should know whether they are prior period or not. I've given you just some examples for you to revise through. Except what? Simply it's water. You can read through meanwhile. I hope this is good enough. Then the last thing is, I want you to know change in accounting policy and change in accounting estimate. They are not same. They are not same. What is accounting policy? Accounting principle and method of applying accounting principle is accounting policies. It is accounting principles and methods of applying those accounting principles in preparation of financial statements. What is accounting estimate? You cannot assign a value based on the valuation principles. We read no yesterday, historical cost, present value, current cost, realizable value. Using this, you can't assign a value. So you think of your past experience that you have, and you look at the present situation and you will arrive at some number. That is estimate. Now you want to identify the useful life of an asset. You will think of your past old laptop, how much did it survive, and you look at the new laptop's condition and you will tell 5 years. That is estimate. Now after 5 years, you will sell this laptop, you will get scrap value, realizable value. How much will you get? You will think of the past old laptop, at what rate did you sell? You will look at the new laptop's condition, you will tell 20,000. That is scrap value. You understand? That scrap value, what you tell, is accounting estimate. It is accounting. Estimates can change. Why? Experience, whatever you used, you become more and more every year. Better experience or more experience and better understanding of the situation. Based on that, estimates change. When estimates change, you need to give prospective effect. What effect? However, accounting policy cannot be changed. Yeah, it has to be consistent. Accounting estimate, every year we revise. Every year we check whether the useful life is same. Every year we check whether the scrap value is same. Accounting estimates keep changing every year, but accounting policy should be consistent. Why? One of the fundamental accounting assumptions as per accounting standard 1 is going concern, accrual, consistency. Consistency is the key. You cannot keep changing it. However, if there is a requirement in law, if there is change in accounting standard, or for the purpose of better presentation, you are allowed by the accounting standard only to change accounting policy. When you change the accounting policy, it has to be given retrospective effect and not prospective effect. Prospective effect means from that year you change. Retrospective effect means from the beginning you change. You understand? We discussed this in AS 25 also. That's it. We need to disclose the change, the reason for change, and the financial impact, if any, that is arising because of such change in accounting policy. And by this, I can call the end of accounting standard 5. Can I take you all ahead to accounting standard 11, which deals with the effects of changes in foreign exchange rate? Shada. Let's now solve See, let's now discuss chapter 7, unit 3, which talks about accounting standard 11, effects of changes in foreign exchange rates. This standard has three parts. One, foreign currency transaction. Two, foreign operation. Three, forward exchange contract. Foreign currency transaction means you are buying or selling the goods, or acquiring or disposing the assets, or availing or rendering the services, or even borrowing or lending the money, or even having forward exchange contracts in a currency other than the home currency. Buying, selling of goods or asset, borrowing or lending of money, or taking of services, giving of services, or you have forward exchange contract. And this specific transaction, what you told now, no, it has to be settled in foreign currency. And you have to give foreign currency to close this transaction. Then it is a foreign currency transaction. Otherwise, it is not. And initial recognition of the foreign currency transaction should be made at the rate prevailing on the date of the transaction. The date when you made this transaction, buying, selling, giving services, taking services, borrowing money, lending money, whatever, the date when you did this transaction, on that date, whatever was the exchange rate, at that rate, on that date, I'll record the entry. However, on the balance sheet date, you have to restate to the closing rate if it is a monetary item. On the balance sheet date, such a transaction value has to be restated to the closing rate if it is monetary item. Sir, what if it is non-monetary item? Non-monetary item, which is usually valued at historical cost, will remain a transaction rate. If it is a non-monetary item, but it is not recorded at historical cost, you have restated it to NRV, like inventory, cost or NRV, whichever is less, you done something like that. Then restate it to what is a fair value date rate. Whichever day you took that NRV, that is fair value, that day whatever was the exchange rate, that rate you take. For liability, contingent in nature, take closing rate. You got this? And whenever you do this, if the value of the asset is increasing or value of the liability is decreasing, profit credited to P&L. If in case the value of the asset is decreasing or value of the liability is increasing, it is expense, debited to P&L. I hope you understood. How do we say whether an item is monetary or non-monetary? If the asset or liability, its value can be recorded in fixed or determinable amounts of money, it is monetary. If you cannot represent it in fixed or determinable amounts of money, if you convert that to cash, it can become more, it can become less. You are not sure of the amount. That is non-monetary items. I hope you understood. Almost done with foreign currency transactions except for para 46A. But we'll do small bit of question kind of understanding and then go to para 46A. You have purchased good from a supplier in USA to whom you have paid money in rupees. It is not a foreign currency transaction. He accepted rupees. You gave him rupees. Not a foreign currency. Sir, but it is a foreigner. Foreigner. You paid how? Cash rupees? No. Not a foreign currency transaction. You paid him in dollars? Yes. What if you did not pay, but you have to pay in dollars? Yes. You sold goods to a customer in US. He is supposed to give you money. He gave you rupees only. Not a foreign currency transaction. He is supposed to pay. You are supposed to receive, but he will pay in rupees. Not a foreign currency transaction. He will give you in dollars. Yes, foreign currency transaction. Service is taken from a foreign service provider and you need to pay him in dollars. Foreign currency transaction. Services given to a foreign client and is going to services given to a foreign client and is supposed to give you money. You have receivable in dollars. Foreign currency transaction. Borrowed rupee loan from a foreign bank. No. Borrowed dollar loan from a foreign bank. Borrowed dollar loan from an Indian bank. Foreign currency transaction. If the transaction needs settlement in non-home currency, foreign currency transaction. Did you understand? It's not with whom you're doing the transaction. It's at what currency are you doing the transaction. See, person with whom we do transaction doesn't matter. Currency in which we do transaction does matter. You go eat pani puri and then he'll charge you $2. Foreign currency transaction. You go to USA and come by a travel agency which is there here. They will take 2 lakh rupees from you in cash. Not foreign currency transaction. Why you paid in rupees? So it's not with whom you're doing the transaction. It is what is the currency in which we do the transaction. And monetary, non-monetary. Did I explain it to you? When do we call an item as monetary item? When its value can be shown in fixed and determinable amounts of money, monetary. Cannot be shown in fixed and determinable amounts of money, non-monetary item. Example, land and building. Non-monetary. Land and building I've recorded in my balance sheet at one value. If I sell, I'll get different value. How about plant and machinery? Non-monetary. Furniture fitting? Non-monetary. Investment? Non-monetary. Trade receivables? Monetary. If I've recorded some person as my receivable for 1 lakh, he has to give me 1 lakh only. Trade payable? Monetary. Borrowing? Monetary. Inventory? Non-monetary. I've recorded inventory in my balance sheet at 10,000. Can I sell it exactly at 10,000? Illapa. If I have to sell it immediately, I might have to give discount also. Sometimes if there is a demand, I can sell it for higher price also. Intangible assets. Intangible assets, one of the primary conditions is only non-monetary. We discussed, no, it should be identifiable. It should be non-monetary. It should not have physical existence, physical substance. Identifiable, intangible. Yeah, do you remember? Very nice. Cash. Cash itself is money. If cash is not money, what else is monetary? Bank balance, monetary. Expenses. Hey, we do monetary, non-monetary for assets and liabilities, not for expenses and incomes. Balance sheet alone baratte. Those have to be restated, not expenses and incomes. Expenses and incomes are in PL. They've recorded at their transaction value. They remain at the same value. You don't have to restate. Restate means what? They appear in multiple dates. Now, debtors are there on 1st of April, are there on 31st of March, are there on next 31st March also. So you would have recorded at one price, you have to restate it to another price. But expenses, incomes, this year it came purchase, over. Will it come in next year balance sheet? No. So what has to be restated? Assets and liabilities. What should not be restated? Expenses and incomes. Record them at the same value. Why did we classify them into monetary, non-monetary? On the date of transaction, the transaction will be recorded on the rate prevailing on that date. On the year end, items in the balance sheet have to be restated. Monetary items to closing rate. Non-monetary items recorded at historical cost, transaction date rate. Non-monetary items restated to NRV, fair value, whatever date we took NRV, that date rate. You understood? Tell something. Very good. Then the next thing that I would want you to know is inventory valuation as per accounting standard. Focus. Inventory is case 1000. I think if we start doing this, then we'll be out of time here. Yeah, but you understood, no, transaction should be initially recorded at transaction date rate. If it is a monetary item, trade receivables, trade payables, cash, bank, restated to closing rate. If the asset increases, profit. If the asset decreases, loss. If the liability increases, loss. If the liability decreases, profit. Book it to P&L account as exchange difference. I'll bring you to another beautiful point called as para 46 and 46A. Very, very practical case. What happened? It so happened in a single year, exchange difference became buduk too high. As an entity, you have taken foreign currency loan. You have $1 lakh loan. Exchange rate was 60. Suddenly, exchange rate became 80. Your liability was $1 lakh into 60 lakh rupees. Within 1 year, exchange rate when it becomes 80, your liability will become $1 lakh into 80 lakh rupees. Liability increase from 60 to 80. When the liability increase from 60 lakh to 80 lakh, 20 lakh increase, no? You rate 20 lakh to P&L account. When you rate 20 lakh to P&L account, profit barta or PL loss agate. Till now your P&L was showing profit. Now suddenly because of this 20 lakh loss, P&L will become loss making P&L. If this is problem of one company, okay, this became the problem of several companies. If all the companies start showing loss, everyone will start exiting. And everyone exits, Sensex falls, country's economy falls. People will be confused, don't know what to do, panic attack. So government told, hey, wait. What is happening? Exchange rate, all of it. Once in 15-20 years, suddenly that spike happens. And unfortunately, you are there at the time when this is happening. I don't want you to book so much loss to P&L. If you book so much loss to P&L, you will start showing loss. I don't want all of you to show so much loss. Nifty 50, top 50 companies, everything in loss. That's big headache. We should not let that happen. So to stabilize our economy, I will bring in one new paragraph. Hey, para 46, you come this side. Para 47, you come this side. In between, 46A. New paragraph was added. We cannot add no 46 point. They added one new paragraph, 46A. What does this para 46A says? You have taken loan. What did you do with that loan money? You bought some asset, no? You bought some asset. Here, 60 lakh loan became 80 lakh because exchange difference went from 60 lakh to 80 lakh. 20 lakh, don't charge it to PL. That 20 lakhs added to this asset. Added to this asset becomes 20 lakh more. Depreciated over the remaining useful life. Easy. foreign currency, monetary item. What is it? Loan. You have loan in foreign currency, which is $1 lakh. Exchange rate was 60. Exchange rate became 80. Liability increased from 60 lakh to 80 lakh. 20 lakh increase in liability. We will not charge it to P&L. We will add it to the cost of the asset which was bought using that money. Now the asset increase, depreciation will increase for remaining years. So sudden impact is not there in P&L. Little impact for the next few years. Okay. Sir, what if I don't have any asset that I bought from that money? I took that loan for working capital management. Don't worry. You keep that exchange difference 20 lakh itself as one asset. It is not for some asset. It itself is an asset. 20 lakh will be written in the balance sheet asset side as foreign currency monetary item translation difference account, PIC-MID-DA. And this PIC-MID-DA will be transferred to P&L account little, like how you do depreciation. This also transfer little to P&L account over the period, over 5 years or something like that. That is what is given here. And it is not compulsory that you should do. It is an option given. I hope you understood this. Okay. Very nice. Then we'll go to foreign currency operation. What is foreign currency operation? You have a branch, you have a subsidiary, you have an associate, or you have a joint venture in foreign country. And that foreign entity, that subsidiary, associate, or joint venture has prepared its financial statements in non-home currency, in dollars, pounds, riyal, yen, or where foreign currency they have created. What you would have to do? You would have to incorporate it into your financial statements. If it is branch, we need to consolidate it into your subsidiary, also should do consolidation. Associate, joint venture also, you need to prepare that consolidated statements. Then what to do? You need to check whether that foreign operation, is it integral operation? Is it non-integral operation? Integral means what? Integral means that is there, no, namde. The name is different. Extension of my own business, controlled by me. I decide what price should they buy. I decide what price should they sell. Whom can they buy from? Whom should they sell to? I decide everything. That is integral foreign operation. Non-integral means it is entity on its own. It is independent. It can do whatever it wants. It can do business with whoever it wants at whatever price it wants. It can appoint anyone. It can take decisions on its own. It is just that I have given it capital. Non-integral. If it is integral operation, what you do is you will translate their financial statements into our currency. The financial statements in their financial statements will be in foreign currency. I'll translate it into my entity. Same like how we did foreign currency transactions. We will translate. Sir, if there is exchange difference, then what to do? Whatever difference that will arise will be charged to P&L account. You understand what I'm trying to tell? That's it. No. Whatever difference that will arise, items in financial statements, translation depends upon this. Then what do we do if it is non-integral foreign operations? Exchange difference is not transferred to P&L. If it is non-integral, what do? We don't transfer it to P&L. We keep it in one reserve called FCTR, Foreign Currency Translation Reserve Account. It will stay there only till the time I have that as subsidiary, associate, joint venture, or branch. That day I close it. That day I transfer to P&L. Till that day I don't transfer. I'll repeat. Foreign operation will be classified into two categories. Integral means extension of my own operations. Non-integral means not my control. It's on its own. We translate that foreign operations financial statements into home currency. When we translate, we apply different rate for different things. Like how we applied in foreign currency transactions. Difference will arise in trial balance. That difference for integral operation is transferred to P&L. For foreign currency transaction, which is there made by a non-integral foreign operation, which is originally there in foreign currency, when I translate that financial statements to home currency, any exchange difference will be transferred to foreign currency translation reserve account. I hope you got it. For property, plant and equipment, we'll take purchase date, rate, cost and depreciation. For inventory, we'll apply actual rate. I'm just giving you example of rates. And if you know these many rates, it's sufficient. All the problems are covered just in this. And for non-integral operation, monetary items closing rate, non-monetary items closing rate, income and expense transaction rate, goodwill closing rate, contingent liability closing rate, exchange difference will be transferred to FCTR. You understand? Just remember these many rates, that will be good enough. You guys get that? Last part, forward exchange contract. What is the last part? Forward exchange contract. What is forward exchange contract? It is a contract between two parties about two currencies to be settled in future date. I'll repeat. What is forward exchange contract? It is agreement between two parties to buy or sell two currencies to be settled in future date. I want $10,000 today. No, after 3 months. So I want to buy it from you. You tell me at what rate will you give me $10,000 after 3 months. We both agree and write one rate today only for a fixed date for a fixed amount, $10,000 on 31st of August. How much rate we will write? That is forward exchange contract. Why am I entering into this contract? Two purposes is what I can have. Purpose number one, I am a trader. I am doing speculation. You gave me 80 rupees per dollar. I think it will be 75 rupees per dollar. It will not be 80. So what will I do? I will sell you $10,000. I will sell $10,000 to you. You wrote what rate? 80. I am thinking it will be 75. Do I have $10,000 with me? No. That day in the market, I am expecting rate to be 75. I will buy at 75 and sell it to you for 80 and make profit. I am a speculative trader. You understand? Second intention. I am planning to buy $10,000 from you. You know why? I have one foreign currency loan. That foreign currency loan has to be settled. Or I have purchased goods from a foreign supplier. I have to give him $10,000 after 3 months. For that I need $10,000. You are selling me $10,000. I am buying it from you. You told me 80 rupees. I agreed. On 31st of August, what will I do? I will give you $10,000 into 80, 8 lakh rupees. You will give me $10,000. I will give it to my foreign supplier or foreign bank and then close my liability. Two purposes, two different peoples. You understood? If my intention is speculation, if my intention is I'm a trader, I don't have foreign currency liability, I don't have foreign currencies, I don't have to pay money to anybody, I am guessing one price, you are telling me one price, I am entering into one forward contract with you. If this is the case, today no entry, end of the year no entry. On that date when we settle, that day I'll write profit or loss. Actually that day I will not buy dollars from you, you will not sell dollars to me. You wrote the rate as 80. If that day exchange rate is 82, if the exchange rate is 82, you would have to buy in the market at 82 and give it to me at 80. So to you 2 rupees loss. 2 rupees into 10,000 you will give it to me. That's it. What if that day in the market the rate is 75? You will buy in the market at 75. You will sell it to me at 80. 5 rupees profit you make. No, I will give you 5 rupees into 10,000. So we'll only deal with the exchange amount. We are bluffing, we are trading, we are speculating. There is no base for the transaction. So profit or loss that is made by the trader will be booked on the date of closing the forward exchange contract. In between year end comes, no entry. On the date of transaction, no entry. But if you are hedging the risk, what is it that I am doing? I have a foreign currency payment to be made 10,000. I entered into contract with a forward exchange dealer. He agreed to pay 80. He agreed to give me each dollar at 80 rupees. Today the exchange rate is 70. I am agreeing to buy at what rate from him? 80. I am agreeing to pay 10 rupees extra. That 10 rupees is premium. 10 rupees I am paying for $10,000. 1 lakh rupees. And what for what period? 3 months. That $10,000 into 10 rupees 1 lakh will be written as expense in my P&L for 3 months. For 3 months. What if in that 3 months? 2 months is 1 year, 1 month is 1 year. 2 months out of 3 months expense for 1 year, 1 month out of 3 months expense for another year. That's what we do in forward exchange contract entered into for hedging the risk. And in this standard, when you do questions, please do questions on foreign currency transactions. They'll give some transactions, loan taken or assets purchased, creditors, journal entry based questions are there. Journal entry for goods purchased, journal entry for goods purchased involving restatement at year end. That one variety question you do. And second variety is please do questions on forward exchange contract involving hedging the risk. Forward exchange contracts involving hedging the risk. Forward exchange contract involving hedging the risk. And there is one translation question. Trial balance is given in foreign currency. You need to translate it to home currency. Translation of trial balance for integral operation and non-integral operation. Translation of trial balance for integral operation and non-integral operation. Translation of trial balance for integral operation and non-integral operation. Will you do that? Fantastic. To just show it to you. See here, transaction date rate, forward contract rate, difference between these two will be written as premium or discount to be transferred to P&L account. over the contract period. However, forward contract rate and settlement rate difference is there, no? That is the speculation profit or loss to be transferred to P&L on the date of settlement in speculation transaction. I'll repeat, transaction date rate and forward contract rate difference is called as premium or discount to be transferred to P&L over the forward contract period. Forward contract rate and settlement date rate difference is speculation difference that will be transferred to P&L account on the date of settlement by the trader. I hope you understood this. Please do practice a question on this, where transaction is entered this year, transaction gets settled next year. Let's start with Accounting Standard 22, Tax on Income, which is part of our Chapter 7, Unit 4. When we talk about taxes on income, usually we know that the word taxes mean both direct and indirect taxes. But in the context of Accounting Standard 22, what we talk about is only direct tax. We have no reference to indirect tax anywhere in this Accounting Standard 22. Also, when we talk about Accounting Standard 22 direct taxes part, the way we do computation of profit for the purpose of accounting as per Companies Act 2013 with accounting standards is very different from how we compute profit for the purpose of tax under Income Tax Act 1961. Under accounting provisions, the profit, whatever we compute, that is net profit, is a starting point to determine the tax amount. So we start with net profit as per P&L account, add back some items which are disallowed, expenses disallowed, deduct some expenses which are not charged in P&L but are actually allowed. We do that and then we'll arrive at taxable profit. On the taxable profit, a percentage of it is the tax amount. Now, accountant is of the opinion that his profit is correct, and tax consultant is saying that the tax what he compute on the profit that he computes is correct. Now, in the middle of this fight, the conclusion is given by Accounting Standard 22. It says that on the accounting profit, whatever the profit is there, on that if we apply tax percentage, whatever tax that we arrive at is the tax expense. But on the taxable profit, when we apply tax percentage, whatever tax we get is the amount to be paid. And this is the extent to which we create provision. This is the extent to which we make payment. Difference amount will end up being debit balance or credit balance. If that ends up being debit balance, it is deferred tax asset. If that difference ends up being credit balance, it is deferred tax liability. Now, talking about the same, see, accounting profit is profit before tax as per statement of profit or loss. On this accounting profit, you apply tax percentage, you get tax expense. And taxable profit is computed as per Income Tax Act 1961. On that, if you apply tax percentage, you get the income tax to be paid. That tax is called current tax. So tax expense and current tax difference should be because of a temporary difference. If it is because of a permanent difference, that doesn't lead to creation of deferred tax. If the difference is arising because of temporary factor, then it will be considered as a deferred tax item. What is the reason for difference? When do we call it permanent? When do we call it temporary? If the difference arises in 1 year and it reverses in the subsequent year, it is temporary difference. If the difference arises in 1 year but it doesn't get reversed in the subsequent year, that will remain a difference. That's permanent difference. For instance, whenever you make a payment without deducting TDS, as per 40A1 of Income Tax Act 1961, 30% of the amount will be disallowed as expenditure. But the same 30% what is disallowed in the current year will be allowed in the next year when the TDS amount is actually paid. So in the next year you get 30% payment. This year, let's say the payment is 1 lakh. In this year the expense is 70. Next year the expense is 30 as per Income Tax Act. As per accounts, full 1 lakh is expense in first year. So what do? You start with net profit as per P&L account, add back 30,000 or you add back 1 lakh, deduct 70, either ways, and you find the taxable profit on the tax percentage. On the accounting profit, when you apply tax percentage, whatever you got is tax expense in statement of profit or loss. But on the taxable profit, when you apply tax percentage, whatever you got, that is the amount you pay. Difference will become deferred tax asset or deferred tax liability. Now I give you example of a temporary difference. What is permanent difference? If in case you make contribution to unapproved gratuity fund, or you transfer any donation to a private trust, or you make payment in excess of 10,000 in cash, 40A2, or you make 40A3, if in case you pay excessive payments to related parties, 40A2. So these amounts will be disallowed permanently. According to accounts, they are still expenses. According to income tax, they are not. So because of these temporary differences, if in case there is difference between accounting profit and taxable profit, on the accounting profit, you will apply tax percentage and that will be expense. On the taxable profit, you apply tax percentage, that will be paid. Difference will be deferred tax asset or deferred tax liability. There are several ways to account for this. I'll tell you easiest shortcut that you can always remember. Remember the shortcut is A, tell. A, tell means A, E, A. In accounts, if the expense is more, asset. Accounts, expense is more, asset. In the tax, if the expense is more, liability. What liability? Deferred tax liability. What asset? Deferred tax asset. Alternatively, you can do that tax expense is equal to current tax minus deferred tax asset. Tax expense is equal to current tax plus deferred tax liability. Tax expense is accounting profit multiplied by the tax percentage. Current tax is taxable profit multiplied by tax percentage. Let's say tax expense as per accounts is 10,000, but current tax payable is 12,000. So you have to pay 10. According to accounts, expense is 10, but you end up paying 12. You pay 2,000 more. That becomes deferred tax asset. You pay something less. Let's say as per accounts, the expense is 10, but you end up paying only 9. 1,000 whatever you pay less will become deferred tax liability. You got it? So that takes us to another method. If the expense is more than the payment, deferred tax liability. If the expense is less and payment is more than the expense, it will become deferred tax asset. I hope you guys got this. The next thing that I would want you to know is how to write the accounting entry for deferred tax asset, deferred tax liability. Remember the story. First, you call up the tax consultant and ask him, how much tax should I be paying? Tax consultant will tell one number. Whatever the number tax consultant tells, to that extent, you create provision. You will first call the tax consultant and ask the tax consultant how much tax is supposed to be paid. They will tell one number. To that extent, pass the entry. Debit expense, tax expense account debit, and then credit provision for tax. You have created current tax. This is the amount to be paid. Then you ask your accountant, is this the amount that we should pay? Let's say your accountant says, no, we should pay more. Then further extra amount will be debited to tax expense, but it will not be credited to tax provision for tax because it need not be paid. That excess amount will become deferred tax liability. If in case the accountant says, hey, are you mad? So much is not the expense. Reduce the expense. Then what to do? You credit the tax expense and you don't have to reverse the provision because so much amount has to be paid here. That excess amount, whatever you had booked as expense now reversed, will be debited to deferred tax asset. We'll see this with the help of a question so that you understand it slightly better. Remember the differences will be only for temporary differences we create deferred tax, not for permanent difference. Depreciation, temporary difference. Excessive payments 48.2 permanent. Cash payments beyond 10,000 48.3 permanent. Preliminary expenses if you pay 1 lakh, 1 lakh is fully expense as per accounts, but as per income tax 150 is allowed every year. 20,000 first year, 20,000 second year, 20,000 third year, 35D. That's temporary difference. Donation made to private trust, permanent difference. 43B disallowance. Certain payments are allowed as an expense only when it is paid. Interest. Let's say interest is accrued, due, but not paid. Accounts it's expense, accrual concept. Tax it is not. As per tax it is expense only when it is paid. So though it is current year expense, if it is paid next year, expense is allowed in next year. Then 40A1, that TDS not done, 30% is postponed to next year, no? Temporary difference. I hope you understood. Temporary permanent difference. Then come to this question. This is GP, which is 1 lakh, and depreciation is 20, other expense is 20, and we arrived at net profit of 60. And as per Income Tax Act, depreciation is 30. As per accounts, it is 20. So where is the expense more? Income tax or accounts? As per income tax, the expense is more. Do you get it? So tax expense just see there. In tax, the expense is more. Deferred tax liability. On what amount? On the difference amount. 30 and 20 difference amount is 10,000. On 10,000 you apply 30%. 3,000 deferred tax liability. So I have a different way of teaching the same thing in the regular class. Ultimately we have to create deferred tax liability of 3. You can alternatively do this also. The solution method to formula approach or expense and amount paid approach also is okay. Now, as per accounts, the profit is 60,000. This is after booking depreciation of 20. What do you do in income tax? To this 60,000, you add back this depreciation 20, you deduct this depreciation 30. 60,000 net profit, you add back depreciation 20, you deduct depreciation 30. See this? Net profit as per P&L 60, add back 20, deduct 30 as per income tax. You will get 50,000 to be the taxable income. On the taxable income of 50, you will compute 30%, that becomes 15,000 tax. This is as per tax consultant. But as per accounts, the profit is 60. On 60, 30% tax comes to 18,000. If you ask accountant, how much is the tax? What would he tell? 18. If you ask the tax consultant, how much is the tax? What would he tell you? 15,000. Now you tell me, which is correct? Expense is 18, but the payment is 15. Expense is 18, but the payment is 15. Out of 18,000 what you booked as expense, you pay only 15. 3,000 what you don't pay will become deferred tax liability. First we need to ask the tax consultant, what will he tell? 15. So I should write journal entry for 15. I'll write income tax expense 15 to provision for tax 15. Income tax expense 15 to provision for tax 15. Then I'll call my accountant. Accountant will say, sir, no sir, it's not 15, it is 80. Then what do? I would have to increase my expense. I had booked expense of 15. I'll increase my expense of 15 to 18 by creating additional expense of 3. Here I credited 15. Now I am not going to credit provision for tax by 3. Why? Payment to be made is only 15. So provision needed is only 15. So I've created additional expense of 3 which need not be paid. So that expense, what we don't pay, will become outstanding expense. That is nothing but deferred tax liability. I hope you understood. First we'll ask the tax consultant, create the provision. Ask the accountant, create further expense by booking it to deferred tax liability. If in case the accountant had told, sir, it's not 15, sir, it's 14, then what would have I done? I would have credited income tax expense by 1 and debited deferred tax asset by 1000. You understand? We create deferred tax liability in the current year. However, if there was deferred tax asset existing, instead of creating deferred tax liability, I will reverse the deferred tax asset. I'll repeat, we will create deferred tax liability. However, if there is an existing deferred tax asset, we will reverse the deferred tax asset instead of creating deferred tax liability. I hope everybody understood this. Then that's it. Payment will be made and the rest of it. And how to show this in the balance sheet. These questions are not there in the material, but I just extended it slightly further. The next thing that I would want all of you to notice, if in case the difference between two items is permanent, there will be no DTA, DTL created. For example, observe, as per books, how much is depreciation? 160. As per income tax, how much is it? 140. You remember my shortcut? Yeah, tell. In accounts, if the expense is more, asset. In the tax, if the expense is more, liability. Where is the expense more? Account. So asset or liability? Asset. So should create deferred tax asset. 160 minus 140 into 40%, 8 lakh deferred tax asset we will create. You got it? Have a look at expense. Previous year expense disallowed, now allowed 20. This is also a temporary item. Here also we create deferred tax. Okay. Expense. Previous year it is disallowed. So in accounts it is expense in previous year. In tax it is expense in current year. In current year accounting expense is 0. In tax expense allowed is 20. Where is the expense more? Tax. So again tell liability 20 lakh into 40%. 8 lakh. Here we should create 20 lakh into 40%. 8 lakh. 8 lakh what? Deferred tax asset. Here we should create deferred tax liability. So 8 lakh asset, 8 lakh liability, net will become 0. There is this item. Provision made to, donation made to private trust. For this, no deferred tax. Why? Permanent difference. So for this, we create deferred tax asset of 8 lakh. Here we create deferred tax liability of 8 lakh. Am I right? See, deferred tax asset 8 lakh, deferred tax liability 8 lakh, net deferred tax is 0. For this permanent difference, we create nothing. You understood? If in case MCQ question comes, no, this shortcut will be very handy. Yay? Tell. That's the first part that you should know. The second part on which questions can come in Accounting Standard 22 is those questions on MAT. Those questions on MAT. What is MAT? Minimum alternate tax. Lot of times, no, company when it shows its results to users, it has lot of profits. But when it comes to income tax returns, it will show loss. How can you have profits to show to investors, but you have loss when it comes to income tax? Because you're taking advantage of all the exemptions that are available. So Income Tax Act says, yes, I have given you allowances. Yes, I have given you exemptions. I know I have given you deductions. But what I want you to also see is, you pay some tax to me. If you don't give me tax, how will I build a bridge? How will I do a scam? So how will I build a bridge? How will I conduct election in the country? How will I put road? All of that if to do, I need tax money. So what I want you to do is, I want you to pay minimum tax. Even if you take all the exemptions and deductions and your amount becomes very less, I want to pay some minimum. I want you to pay some minimum tax. For example, to users you've shown 1000 crores as profit. How much profit? 1000 to shareholders. But taxable profit is only 200. So to users you're giving 1000 as the profit figure. When it comes to income tax, you're telling profit is only 200. On 200 you will pay 30% tax. No. How much is 30% of 200? 60. Government says 200 will 30% normal tax. I know. But on 1000, before any deductions or exemptions, you should pay 10%. On 1000, 10% is 100. This is the minimum money you should pay. Sir, but normally it is 60. You pay whichever is higher. On the profit before exemptions and deductions, 1000 crores. On that 10%, very low, 10% only, 100. Or after all the deductions, taxable profit 200 into 30%, 60. Whichever is higher has to be paid. Sir, but actually normal tax is what I should pay. No? Okay, normal tax 60, but I'm asking you to pay 100. 40, whatever you pay extra. MAT credit. You have paid extra. minimum alternate tax. In the next year, if MAT becomes 100 only, if your normal tax becomes 120, then you're actually supposed to pay whichever is higher, no? Normal tax is how much? 120. MAT is how much? 100. When you pay whichever is higher, you're actually paying 120. You'll say, no, last year I paid 40 extra, or last year I paid 60 extra. You can take benefit of it and pay only MAT. Can you pay lesser than MAT? No, no, no. MAT is minimum. What is to be paid is whichever is high, normal tax or MAT, whichever is high to be paid. But if normal tax is more than MAT, so that excess whatever is there, so much you can take MAT credit. You can take MAT if it is already there. But MAT credit cannot bring the tax payable below MAT. You understand? MAT credit is asset. MAT credit is, when will this MAT credit come? If the MAT amount, minimum alternate tax payable, is more than the normal tax, such excess amount paid is called as MAT credit asset. To recognize that MAT credit as asset, you should fulfill asset definition. There should be future economic benefit. There should be reliable measurement. Meaning, in the future, you should believe that there will be ulta. Normal tax will be more than MAT. Only then you should recognize. Otherwise, book it full as expense. So, how to get to know whether the question is on MAT? Very simple. They'll give 3 profits, 2 tax rates. They'll give 3 profits, 2 tax rates. Sometimes they'll give 2 profits, 2 tax rates. Then it is MAT. The beauty is when they give MAT question, they'll give MAT with the deferred tax. They'll give MAT with the deferred tax. I'll tell you how to do. First finish off deferred tax and then start with MAT. First finish off deferred tax, then start with MAT. Can I explain you deferred tax first and then go to MAT? Come on. I would show the question that we're going to solve. This is only introduction of MAT. Okay, just to explain. Look at this. Normal tax is 100. Minimum alternate tax is 120. I should pay which is higher. I'll pay 120. Whichever is higher ends up becoming MAT. So what do I pay? 120. Reasonable certainty, if it exists, then I'll take 20 as MAT credit asset, 100 as expense. If there is no reasonable certainty in the future that it will reverse, then I'll book full 120 as expense and asset will be 0. This asset is MAT credit. If you think in the future you can take benefit, then record it as asset MAT credit. If you don't think you can take benefit in the future, don't record it as asset. Got that? Then look at the next part. This is the question with, this will not do. Yeah. We'll go to straight away question with, okay, this, okay, this is a good one. This is a good one. Have a look at this. Whatever is in the red is the question. People watching it live online, you can take a screenshot of this question. This is what we're going to solve now to understand DTA and DTL together. Book profit as per section 115 JV. That is the section which talks about MAT. Is how much? 100. This will be considered in MAT, not for deferred tax. Accounting profit is how much? 120. Taxable profit is how much? 20. MAT is 10%. For now, ignore this and this. These two should be ignored. Why? Those two are important for MAT. Those two are not relevant for deferred tax. Right now, our focus will be only on accounting profit, tax profit, and normal tax rate. Will everyone help me now? Please take your calculator. Accounting profit of 120 multiplied by 30.9%. Accounting profit of 120 multiplied by 30.9%. That is tax expense. That is tax expense. Next, do taxable profit of 20 multiplied by 30.9%. 6 point. That is tax to be paid, current tax. What is tax expense? 120 into 30.9. 120 into 30.9. What is 120 into 30.9? Tax expense. Tax. What is 20 into 30.9? Current tax. Current tax is the amount to be paid. Current tax is the amount to be, and 120 into 30.9 is the tax expense to be booked. Difference. Expense is more, no? Payment is less. Deferred tax liability. There is a portion of expense what you create, but you don't pay. Observe, same thing what I thought you. 120 into 30.9, 37.08, you create expense. 20 into 30.9, 6.18 is the current tax that you pay. You book expense for 37.08. You make payment of 6.18. The amount that you don't pay will become deferred tax liability 30.9. Everyone understood? We're done with deferred tax. Now come to MAT. On the normal taxable profit of 20, you computed 30.9. How much is that? 6 point. That is normal tax. You should pay this 6.18 or book profit of 100 multiplied by 10.3. 10.3. You should pay whichever is higher. Observe here. Normal tax as per normal provisions is 20 into 30.9, 6.18. MAT is 100 into 10.3, 10.3, whichever is higher is 10.3, you pay 10.3. But normally you are supposed to pay 6.18, but you actually pay 10.3. 4.12 what you paid extra will be called as MAT credit, minimum alternate tax credit, to be carried forward to future years. First you will write expense for this 6.18. Tax consultant, we'll call the tax consultant. They will tell one amount. For that amount you write the entry income tax expense to provision. Then you will call your accountant and ask how much expense. What will you tell? 37.08. You already booked expense for 6.18. How much is the further expense you should book? Do 37.08 minus 6.18. 30.9 will be debited to income tax expense, but it is not payable. So you won't credit provision for tax, you credit deferred tax liability. But when it comes to payment, you credit not 6.18. What do you credit? MAT 10.3. You end up paying 10.3. But your provision for tax that you created is only 6.18. That difference will become MAT credit. What will be the difference? MAT credit. It will become an asset. I hope everyone understood this. That's with regard to MAT. The last concept that we have is that of tax holiday in Accounting Standard 22. I'll tell you in short, there are no lengthy questions on tax holiday in your syllabus. There can only be theory based questions which can come. I'll tell you how does tax holiday work. It is some years during the during the business period where the government will tell you don't have to pay tax. To promote a startup culture, they'll tell you need not pay tax for 5 years. Which 5 years? Any 5 in the first 10. Can be 1, 2, 3, 4, 5, can be 2, 3, 4, 5, 6, or can be 3 to 8 or 4 to 9 or 5 to 9 or 6 to 10, your choice. 5 years. Now, during this period, there is no need to pay tax, but differences will arise now, which will get created now and get reversed later. So, though you don't have to pay tax, you have to still file return. You will compute accounting profit, tax expense, taxable profit, tax payment, and you create deferred tax asset, deferred tax liability based on the difference in temporary items. That deferred tax should be created only if the deferred tax get created in tax holiday gets reversed after tax holiday. If it gets created and reversed within tax holiday, don't create. I'll repeat. How many years is tax holiday? 5. Let's say you create deferred tax liability in year 2. It will get reversed in year 6. Then create it. Created in year 2, reversed in year 6. What if it gets created in year 2, reversed in year 4? Here also no tax payment. Here also no tax payment. You are creating deferred tax liability here, reversing deferred tax liability here. Instead, here don't create only. If it gets created in holiday, reversed after holiday, create. If it gets created in holiday, gets reversed within holiday, don't create. This is a simple common sense point that you should know when it comes to tax holiday. There's a beautiful question that I can help you do, which we usually do in a regular class, but I don't think it's the ideal scenario to do it in the revision class. I'll just show the glimpse of it once to you as to how does it look. See this. This green color part is the question. Here deferred tax liability is getting created. Here deferred tax liability is getting created. Here deferred tax asset is happening. Basically, we reverse the deferred tax liability created in year 1 in year 3. But all the 3 years are in tax holiday. So because it is getting created in year 1, getting reversed in year 3. In year 1, I won't create only to that extent to which it gets reversed during tax holiday. If you have already done the concept of tax holiday, please do revise it. If you have not, don't put your head onto it. Well, let's go to next accounting standard. Before that, I'll tell you a couple of questions what you should solve. Yeah, write down. You should solve the question on creation of deferred tax asset and liability when they give difference in expenses. Creation of DTA, DTL with difference in expenses and journal entry. Learn journal entry for the same, okay? Expense provision, DTA or DTL creation entry, payment entry. 3 journal entries will be there. Please revise that. First part. And the second is do one question on MAT. One question on MAT. M-A-T. MAT. One question on MAT. Third one, in the study material there is one theory question on tax holiday. If you want to search study material on your mobile phone in the PDF, search tax holiday. You will get one theory question. Read that theory once. So if in case in a case scenario question they ask you, you will be able to answer if you read that theory part. Okay. Standard is small yet very effective. Small yet very effective standard. Now please do this. Don't skip for the exam. Let's go to accounting standard 7, which deals with construction contract. What does construction contract talk about? Very easy. Yeah. Whenever you sell goods and then receive money, it is sale for that year. Whenever you give services and then receive money, it is for that year. Construction is one place where the goods are sold or the service is rendered, but the service is not rendered on one day, but it is over a long period of time. Let's say you are a construction contractor who's constructing a building in my site. For that, you are charging me 15 crore rupees. I'm paying you 15 crore rupees. You give me construction services, but the service is not given on 1st of August. Construction service is not given from 1st of August to 31st of August. Construction service is given over 5 years. So the 15 crores what I give to you revenue, you should not book to your P&L in year 1. You should not book to your P&L in year 5. You should book it over 5 years. How much should you book in each year? Simple, sir. Divided by 5. No. It is not like same amount of construction is happening in each year. No. Some years more construction, some year less construction. So you need to identify how much revenue to recognize in each year, how much expense to recognize in each year. Why do you want to recognize revenue and expense? Because you want to identify profit for each year. How to do that? This is allowed to be done based on a method called PCM, percentage completion method. What is the method? Percentage completion method. This percentage completion can be computed using multiple methods. But what we follow for our exam is cost incurred to total cost method. What is it called? Cost incurred to total cost. At the end of each year, we'll identify how much cost is incurred divided by total cost. Let's say I've incurred 8 crores. Together I was supposed to incur 12 crores. How? 8 is already incurred. 4 is to be incurred. 8 divided by 8 plus 4. 12. That becomes the percentage to the extent which contract is complete. 8 crores will become expense in P&L account debit side. That percentage multiplied by revenue will become revenue in P&L account credit side. Difference will become profit for that year. So this is how we do percentage completion method. This has to be done in cumulative basis. This has to be done in, we don't identify how much work is completed in year 2. No, we'll identify how much work is completed till the end of year 2. How much revenue should be recognized till the end of year 2. How much expense should be recognized till the end of year 2. Once we do that, we'll deduct the revenue already recognized in first year to identify second year income, or already expense whatever is recognized in year 1 is deducted from total expense to identify expense for year 2, and that difference between that year income and that year expense will become that year profit. I hope you all got it. Very good. And the contract price can be two methods. One, fixed price, other one is cost plus. Fixed price means you are a contractor who's constructing the building. From your perspective, the entire standard is seen. I am contract T. So between me and you, there is an agreement and we've written one number and we've frozen it. That is fixed price contract. Cost plus is we both have not agreed upon a fixed number. We both agreed upon a fixed percentage, 12%. Meaning how much ever cost you incur, so much cost I will reimburse. On that, I'll still pay you further 2% or 12%. So that becomes your profit margin. So that is two varieties of contract: fixed price contract, cost plus contract. Further, the next thing that you should actually notice, revenue. Contract revenue is the money that I have to give you. That will be price that we agreed in the agreement, subject to 4 things: variation, claim, incentive, penalty. What is variation? After I and you enter into agreement, I'm changing the scope of the construction. I'm telling this building you move little this side. In this floor you put one extra extra room. In this building you put swimming pool. I'm asking you for some extra things. When you do that extra, which was not in the initial scope, I will have to pay you extra. That is variation. Incentive, very simple. You did above standard performance. I had given you 5 years to complete. You finished it in 4 years, 6 months. Full happy. I gave you 15 lakhs extra. Incentive. Penalty. I asked you to complete it in 5 years. You took 6 years. You took 1 year extra. I have charged 10 lakhs to you. Penalty. Or you breached some law. Some electric cable you spoiled. Because of that, the electricity supply board has charged me money. I paid them money because of your mistake. I will deduct it from the money that I'm supposed to give you. So that's variation, incentive, claim and penalty. To the initial contract price, whatever we agreed here, we will make changes for variation, claim, incentive and penalty, and ultimately we'll arrive at the contract revenue. I hope everybody understood this. Very nice. Then contract expense, I told you how to take. Now let's quickly see one question now. Come on. I'll show you a question where we need to identify the percentage of completion. I'll take you to this question. Look at this question. This is the question that we're going to solve. Will you please look at this question? If you want, you can take a screenshot for those who don't have the question, and I will start. Can I? In year 1, we have incurred 15. We are expecting to further incur 85 to complete. Can I say year 1 expense already incurred is 15. Expense estimated to be incurred is 85. Total cost becomes 100. 15 out of 100 is incurred. 15% of the contract is complete. In year 2, I've incurred 55 up to year 2. How much is incurred until year 2? 55. How much is further expected to be incurred? Can I say 55 is incurred, 50 is expected to be incurred, total cost will become 105. Sir, you had initially estimated to be 100. Estimate, you are only telling prospective change. Don't have to rework this. That is correct. Now only focus on this. 55 by 105. 52.38%. 52.38% of the contract is complete in second year. Third year, how much is the expense incurred? 110. How much is the cost to be incurred? 0. Can I say total expected cost will remain 110? 100% of the contract is complete. How much of the contract is complete? 100% of the contract is complete. Now, contract revenue that I should book is like this. 1, 2, 3. How much percentage complete first year? 15. Second year, 52.3. Third year, 100. This is the percentage at which contract is complete. How much is my contract revenue? 125 crores. In 125, I'll take 15% as first year revenue. 18.75. This is my current year revenue. Second year, I will do 125 into 52.38. This is not second year revenue. This is revenue for first year, second year together. Can I say in 65.48, 18.75 is already recognized first year revenue? So second year revenue is 65.48 minus 18.75, which is 46.73. By the end of third year, 100% of the contract is complete. Full 125 should be booked as revenue. But out of 125, I have already recognized 18.75 in first year, 46.73 in second year. Together I have booked 65.48 already. So out of 125, if you deduct 65.48, 59.52 will become the revenue for year 3. It will become revenue for year 3. Did you all understand this? Very good. So you can do it in the form of a PL also. You can write first year revenue 18.75, first year expense 15, first year profit will be 3.75. You can do that way for second year and third year also. That's the important point that I want you all to note. PCM. The next thing is para 35 of Accounting Standard 7. What does para 35 of Accounting Standard 7 say? Para 35 of Accounting Standard 7 says that at any point of time, if the total contract cost exceeds total contract revenue, total contract cost exceeds total contract revenue. You are expecting to incur 110, but you will get only 100 as revenue. It's exceeding, no? Book full loss. Sir, but percentage completion, nobody cares. Book full loss. Why? Conservatism. Look at this, para 35. What does it say? Recognition of loss. At any point of time, if the total contract cost exceeds total contract revenue, entire loss should be booked, irrespective of three things. Number one, whether or not the contract has been commenced. You just signed, you didn't even start the work, full loss you should book. You just signed, okay, 100 is the revenue, but you are expecting to incur 110, full 10 lakh loss you should book. 0% complete work, but full 10 lakh loss you should create by provision. Irrespective of stage of completion, irrespective of profit from other contract. Remember these 3 points, whether work commenced or not, irrespective of percentage of completion, irrespective of profit from other contracts, you have to write full loss. But if the contract is 10% complete, we'll write 10% revenue, 10% expense. Only 10% loss will come now. How to write 100% loss? Balance 90% we have to create provision. Balance 90% we have to create. Can I show you the discussion of this part? Come on, have a look. Let's see para 35. See this. Contract revenue is how much? Contract cost expected is how much? How much is already incurred? How much is to be incurred? Okay, 40 is incurred. 40 plus 90 is expected to be total cost. 40 plus 90, 130. 40 by 130. Can I say 30.76? Tell ya. How much is the revenue? 125. I'll write 125 into 30.76. 38.45. How much is contract cost incurred? 40. Right here, 40. 40 and 38.45 difference is how much? 1.55. Am I right? Why is that? See, total cost is 40 plus 90, 130. How much is total contract revenue? So total contract when you complete, how much loss will you incur? 5. You have incurred 40, you should still pay 90 to complete. Total cost becomes 130, but the revenue you recover is 125. Can I say the loss is 5? Do 5 into 30.76%, 1.5 something. Am I right? 1.55. That's what you get as balancing figure here. 30% of the total loss. You're getting 30% of the para 35 says don't write 1.55, write full 5. Full 5, 100% of the loss. Sir, but the ledger doesn't get closed. 43.45, 43.45, 3.45 provision. 3.45. This provision is booked for the balance 70% of the loss which is not yet complete. 30.76% complete, no. Do 100 minus 30.76%, 69.24%. 69.24% of 5, 3.45. This is the extent to which construction is not made. Loss is not to be booked now. Loss is actually to be booked when the construction is complete. But by conservatism, we make provision for that loss now only. Did you all understand this? Paka? The last point that I want you to note in accounting standard 7. That is, have we collected extra money from customer or have we collected less money from customer? How to find this? Very, very simple. From the customer, we have to recover the amount that we have incurred, expense, plus profit that we have earned. What should we recover from the customer? Cost incurred plus profit. If it is loss, minus loss. Remember, cost incurred plus profit minus loss. When it is loss, no, full loss. So only 20% complete. Then full loss, 100% loss should be deducted. Sir, it is profitable contract, only 20% profit you should have. Profit will take in percentage, loss will take full. Profit will take it in percentage, loss will take full. They say no, happiness sucks you in private, but sadness kisses you in public. Never seen that. When something happens good to you, it will happen when there is no one around. But if something happens bad to you, it will happen in a very vulnerable position when you are exposed to so many people. Like that. If it is profit, you take percentage complete only. When it is sadness, when it is loss, full 100% loss, you take it straight away. Cost incurred plus profit minus total loss, if any. This is the amount that we should charge to customer. If you charge it more than that, excess money collected will become liability. If you charge it less than that, money that you have not collected will become asset. Remember, cost plus profit minus loss minus progressive billing. If the resulting number is positive, asset. If the resulting number is negative, liability. If the resulting number is positive, asset. Negative, see this. Contract cost 200, contract revenue 200, percentage completion, percentage completion 60%, progressive billing 130. See this? Everyone understood this? This is the question. I'm going to solve this question now. If you want, you can take a screenshot of the question. Amount to due from customer means assets, amount to due to customer means liability. You've done this question in our regular class. For those who are seeing it for the first time, you can take a screenshot. Can I begin? Come on, yeah. Let's start. 250 is the contract cost. 200 is contract revenue. We are making 50 loss. We're making 50. How much of the revenue have I earned? The revenue that I have earned is 200 into 60%. How much is 200 into 60%? 120 worth of revenue I earned. Okay. Contract expense incurred is how much? 250 into 60%. 150. I made how much loss? 30. The moment there is loss, can I apply in percentages? No, full loss should be recognized. Total contract if I complete, I'll get how much revenue? 200. But to complete total contract, how much cost should I incur? 250. So together I'm making how much loss? 50. I have recognized 30 loss based on percentage completion. 20 I have to create provision. 20 I have to create. This is the same thing that we've learned till now, para 35. Now let's talk about how much is the asset or liability. How much is cost incurred? 150. Cost incurred till date. Total contract cost is 250. If it is 60% complete, how much cost have I incurred? 150. How much is the profit from the contract? Profit Allah, last esto. Full 50 we should take. 150 is the cost that I have incurred. 50 is the loss from the same. So 150 minus 50. I should charge my customer how much? 100. But I've already charged him 130. I've charged him extra 30. That's liability. How to get it? Simple. Cost incurred plus profit minus loss minus progressive billing. You got minus 30. Minus 30 means liability. Minus 30 means, did everyone understand this? We'll do one more and then proceed to next concept. 250 is the contract cost, 300 is the contract revenue. Now, how much percentage is complete? 60%. Take 60% of 300. Can I say 180 is contract revenue earned? Help me identifying how much is contract expense incurred. 250 into 60%. So your total contract revenue is 180 earned. Contract expense incurred is 150. Can I say you made 30 profit in the contract? No, don't try to create provision for the balance profit. Provision is created for loss, not for profit. So how much should you recover from the customer? 150 cost incurred, 30 rupees profit. Together you should charge him 180. That is the revenue that you earn. But you billed how much? Only 130. Positive 50. The amount that you have not yet billed will become your asset. Once again, let me tell, how do we find contract asset or contract liability? Simple. Cost incurred plus profit minus total loss minus progressive billing. If you get the resulting number as positive, asset. If you get the resulting number as negative, liability. Ashte. Everyone got this? Say something. That's it, guys. That's what you should know with Accounting Standard 7. Let me tell you what is it that you should practice in Accounting Standard 7 when you start doing questions. Do question where you need to compute PCM and revenue and profit for 2-3 years. Computation of percentage completion, revenue and profit or loss. Percentage completion, revenue and profit or loss for 2 or 3 years. Did you guys get the first part? Then the next part that you should do questions on is amount due from customers or amount due to customers. Amount due from customers or amount due to customers. There's one more concept called escalation clause, but that is English. When you read it, you will get it. At a certain point of time, they'll tell if the total expected cost goes up by 5%, then revenue also will go up by 5. We will check how much has it increased. If it goes up by certain percentage, will increase. In a regular class, we do. In marathon, if I try to fit in anything, marathon will become regular class. Expected 12 hours will become 200 plus hours. That's the only thing. In the regular class, we do that escalation clause computation. See, escalation clause 5%, cost incurred is this. We add, check whether it is increased by certain percentage, and then but can't do now. I hope you people understood. Very nice. Let's go to Accounting Standard 9, Revenue Recognition. Ready? Accounting Standard 9 talks about revenue recognition. What do you mean by revenue recognition? Nothing. ಒಳ್ಳೆ ಮುಹೂರ್ತ ಹುಡುಕ್ತಾ ಇದ್ವಿ. ಯಾವುದಕ್ಕೆ? Sales entry ಬರೆಯೋದಕ್ಕೆ, service entry ಬರೆಯೋದಕ್ಕೆ. We have sold goods to customer. Because we sold, we have earned revenue. I should write no entry, sale account credit. When to write that sale account credit? When to book that as revenue income? This depends upon several factors. When did we manufacture the product? When did we sell the product? What is the type of the product? When did we get the advance? When do we have right to several things? That's discussed at large in this standard. In this standard, we'll identify how to recognize revenue for sale of goods, rendering services, and some special items like interest, royalty, and dividend. When to book sale entry, when to book service entry, when to book entry for interest, royalty, dividend. That's what we learn. With regard to sales, the general rule is this: whenever the risk, reward, effective control is transferred, book the sale entry. Whenever the risk, reward, effective control is transferred, book the sale entry. But certain items are unique. The product is a special order, customized order. Then though the asset is not transferred to the buyer, the moment the goods are ready, book the sale entry. Why? They have told you to make a bed which is round shape. Now usually rectangle, king size, queen size bed will come. Someone saw 2-3 movies, they got excited, they told carpenter to make one round bed. You will do. But after you do like, illa sir, dimbi hakondirodu antane gottagta illa. Where do you keep dimbu? And you can't even sit. Where do you sit? All sides there is no headboard, no. There's a problem. So what to do? The moment you give the order, that furniture uncle will tell, full money you give. Because he is scared, what if you don't buy later? And then he told, sir, you can never sleep. Yeah, you saw some movie, song, shoot and all, you're like, okay, ಹಿಂಗೆ ಮಾಡಬೇಕು ಮಾಡಿ ರಾತ್ರಿ ಹಾಲಲ್ಲಿ ಮಲ್ಕೊಳ್ತೀರಾ, ಬೆಳಿಗ್ಗೆ ಬೆಡ್ರೂಮ್ ಅಲ್ಲಿ ಬೆಳಿಗ್ಗೆ ಅಲ್ಲ, you will wake up in a different place. Why? The bed will be moving, no, like this. You sleep and then you move like this and the bed will move. So that's kind of a thing. So what do they say in this case? The moment the product is ready as per your description, we will book the sale entry, special order, customized. Okay. Then installation. Certain assets are subject to installation. Now you buy AC. The moment you buy AC is not sold. I would have to install it. I would have to drill 2 holes, hang it here, make the hole, take that vent outside, put the what I don't know what you call AC vent only, no? That outside, and then a water pipe outlet. All of that has to be done. Only when the installation is complete, I'll book the sale entry. Till then I cannot. Certain items are subject to inspection. Inspection means AC only. It is subject to inspection. After we install, we'll turn on the AC and it should work. If it works, you'll take. Otherwise, you'll take your AC and go. I won't give you money. If it is not a technical item, electrical appliance, installation. If it is an item which needs certain performance, then based on inspection. Till the date it is inspected to be working in the desired way, you will not book revenue. The day it is inspection is complete, that day you should book the revenue. Then next one is sale on approval basis. So there is an option. You can give the goods to customer and then say, you don't have to give me money. If you sell, you give. If you don't sell, you give it back. In that case, it will not be booked as a sale entry when you give. It will be booked as a sale entry when they approve. Or when the time to return exists, I would say lapses. You tell them I will give it to you. You don't have to buy. You sell it to somebody. If somebody buys it from you, then you give me money. If nobody buys, you give it back to me. But within 30 days, beyond 30 days, I won't accept return. I'll accept only cash. If you can't sell, return it to me within 30 days. This concept is called as sale on approval basis. What is it called as? Sale on approval basis. Did you all understand this? The next thing that I want you to know is buyer requiring delayed delivery. So I am your customer. I ordered the product. You are about to deliver. Hey, beda sir ivattu. Now Tirupati ಹೋಗ್ತಾ ಇದೀವಿ ಒಂದು ವಾರ ಬಿಟ್ಟು ಡೆಲಿವರಿ ಮಾಡಿ. Then what will you say? You will deliver it a week late. But it is subject to customer's delay. So according to you, it is sold today only. You will write the sale entry today, though it is delivered to the customer after a week. I hope you all understood. Say something. Very good. This is with regard to sales. Next is with regard to service. With regard to service, if it is one activity, the moment that activity is complete, it is sold. If there is more than one activity bundled together, proportionate basis, whenever the service is complete, proportionate revenue should be booked. For example, for some spa treatment, 5 sittings together, you pay 10,000 rupees. One spa visit 2,000. 5 spa visits 10,000. You pay 10,000. And you visited once. The spa uncle should book revenue for once. 2,000 rupees revenue to be booked. 8,000 is advance received, which is not revenue. Whenever you visit second time, another 2,000 revenue. 6,000 rupees is money received in advance. That should be carried forward to the next year, if in case that membership is carried forward to next year. I hope you understood. So proportionate service method has to be applied to recognize revenue for service. 3 beautiful things. Interest, book revenue based on time. P into T into R. Time basis. You bought some investment. On that interest is earned. It will be paid to you on 31st July. You bought it on 1st of January. 31st of March. Book 3 months interest income. So but you'll receive only in July. You receive in July. You earned it by end of March for 3 months. So you bought it in January. You will receive interest in July. 31st of March, write 3 months interest income in your P&L account credit side. That is what we mean when we say time basis. Next one is royalty. Royalty is for this intangible asset, patent, copyright, book, all of these things based on the agreement, but keep in mind accrual. Last one is dividend. If you have invested in shares of a company, book dividend income only when it is declared. Only when it is company proposed a dividend. Can you record? No. Proposal can be denied later by the members in the general meeting. So dividend will be recognized as income only and only when it is declared, not when it is proposed. Did everyone understand? Let's say there is some uncertainty about the revenue, meaning you sold the product to your customer, but looking at the customer, you somehow feel I might not recover the money. Then what to do? Don't recognize revenue. Don't write sale entry, though you have given the product, because you expect no money. Don't write sale entry. Sir, what if I sold? I did not have doubt. I wrote the entry sale. Now I have the doubt of recovery. Then you would have to create provision. But if you have doubt at the time of sale only, don't recognize revenue. Defer the concept of postpone the concept of recognition of the revenue till the date there is significant certainty. See, significantly certain, then recognize. Significant uncertain, don't recognize. Postpone it till the date you get certainty. You understood? If already recognized, then create provision. Create provision, reversing the income. You will book expense. I hope everyone understood this. Very less likely. Don't spend too much time on this standard for solving questions. Be ready to solve some questions on MCQ based for case scenario. Otherwise, don't do any. In that case study book issued by ICI, I've created a chart. I'll share it with you people later. What I've done is I marked all the questions and I've told which question covers what accounting standard. For example, there are about how many 35 case scenarios in the book that's given. So for each case scenario, I've told what accounting standards are covered in that case scenario. For example, case scenario number 7 covers AS9, AS11, AS5, AS23. Because one common thing that I've heard from students is, sir, case scenario question yav AS involved with don't even know which one. So this I'm solving. Some of them are ready. Some of them I just want to present the answer in my style. See, not many, about 24 to 35, about 10, 11. And these are all theory ones, what is pending. Numbers which are practical, I've already solved it in our way of solving in the class and I've kept it ready. I'll share one PDF of this. PDF is solution to the questions given in the case scenario booklet. Okay, once this is ready, and I'll share one playlist also. Each video is about 5 minutes, 6 minutes, 5 minutes, 6 minutes. You know, the 10 is pending. I'll record those 10 and then I'll share. So don't have to do all of them at once. Maybe do whenever you are bored, you're studying some subject, you are bored, you're walking, do one case scenario. Maybe one in the morning, one in the afternoon, one in the evening, one if you don't get sleep at 12 o'clock. Just like that, randomly you do one case scenario. By then you will be good with 30-40 cases. You can do this much case scenarios, no? More than sufficient for the exam. And that's with regard to accounting standard 9. Can we go to accounting standard 12, government grant? Let's now begin chapter 9, unit 1, accounting standard 12, which deals with government grant. Any grant or assistance given by any government agency, municipal government or local government, state level government, national government or even international government together is called as government grant. This will exclude normal trading with the government, wherein you give goods to government and government giving you money, or tax holiday or tax exemption given by the government, or certain benefits given by the government to everyone in general. That is not counted. To you specifically, government gives some grant or assistance or cash, that will become a government. How to account for that government grant is what we're going to discuss here. The grant will be recognized only when there is reasonable assurance that you will receive and there is certainty that you will collect. Reasonable assurance of the fulfillment of conditions, certainty of collecting the money. When both are there, you should recognize the revenue. Even if one of those two is not there, you should not recognize the revenue. Whenever you receive grant, it can be monetary grant or it can be non-monetary grant. What is monetary grant? Government gives you money in the form of asset or reduce the value of the asset, all of that. If the government gives you asset free of cost or at concessional price, non-monetary grant. If the government gives you cash to buy the asset, cash because you incurred some expenditure, or government gives you cash as promoter contribution, it is monetary. If there is a machine of rupees 1 crore, government gives it to you free, what is it? Non-monetary grant. If there is an asset of 1 crore, government will tell, I'll give it to you, but you pay me only 30 lakhs. It is non-monetary grant, asset given at concessional price. Government will tell, you buy that asset paying 1 crore, I will give you 30 lakh rupees later. Then it will become monetary grant. Government will tell, you have paid employee's salary and this category of employees you have taken in your organization, I will give you 10 lakh rupees. Monetary grant. You got it? Government will tell, beautiful idea. You start this project, I will give you 5% of that project money as contribution from my side. Then it is monetary grant. Did you understand monetary, non-monetary separation? Okay, now let's focus on non-monetary grant. Whenever an asset is received at concessional price, what do? To record the asset at such concessional price. To record the asset at such, machine is 1 crore rupees. Government gave it to you for 30 lakhs only. What is the value of the asset that you paid? 30. At what value will you record? 30 lakh only. Sir, can you record at 1 crore and rate like 70 lakh as income? Illa. You paid 30 lakh, the cost of that asset is 30 lakh. What if the government gives the asset to you free? 1 crore is the value of the asset. Government gave it to you free. Can you record it at 1 crore? No. It should be recorded at 0. No. If you record at 0, then the asset is not there only, no. So we'll record it one nominal value. Sir, nominal value means how much? Depends upon the entity. Let's say in your entity, when you prepare balance sheet, you're writing amount rupees in lakhs. You're writing amount rupees in, if you're writing all the rupees in lakhs, 1 lakh rupees is your nominal amount. Let's say in your entity, when you prepare balance sheet, you write rupees in crores. Then that 1 crore will become nominal amount. To a very big company, 1 crore will be nominal amount. To some companies, 1000 rupees will be nominal amount. It varies with entity to entity. It varies with. So if the asset is received at concessional price, we should record it at concessional price. If the asset is received free of cost, we should record it at nominal value. You understood? Further, when the asset is recorded at nominal value, don't depreciate. Don't 1000 rupees ಬರೆದ್ಬಿಟ್ಟು ಮತ್ತೆ ಡೆಪ್ರಿಸಿಯೇಷನ್ ಮಾಡಿ 0 ಮಾಡಿ. Don't do it. Leave it like that only. Credit that amount to provision for depreciation. Provision for depreciation 1000, asset 1000. No depreciation. Continue using that asset. The day you sell, credit the asset, debit provision, and then sell. I hope you understood. What do you do when the asset is received at concessional price? Record at concessional price. If it is received free, record it at nominal value. Got it? Then let's talk about monetary government grant. Shall we see monetary government grant? Monetary means what? You have purchased the asset for 1 crore. You paid 1 crore. You bought the asset. Government, you click the picture of the asset. You showed the functioning of the asset. You gave the bill. You gave a request letter. Government later gave you 30 lakh rupees. Now 30 lakh rupees received is monetary grant. This monetary grant received can be treated in 2 ways. One, you can use it to reduce the cost of the asset. 1 crore was the asset, no? Asset account debit to cash. Now write cash account debit to government grant. Government grant account debit to asset. Reduce the asset by 30, recording the asset at 70 lakh and depreciate 70 lakh over the remaining useful life. First option. Second option, 30 lakh government grant received, don't reduce it from the asset. Keep it separately as DGG. Cash account debit to DGG, 30 lakh. Asset is at 1 crore, grant is at 30 lakh. Every year you depreciate the asset 10 lakh, 10 lakh, 10 lakh. 30 lakh, you will start charging 3 lakh, 3 lakh, 3 lakh to PL, income. Income 3 lakh, expense 10 lakh. Net impact is 7. Instead, that 30 lakh could have been reduced from 1 crore value of the asset. Asset would have become 70. Then it would have depreciated. It would have been 7 lakh, 7 lakh, 7 lakh only every year. So, when the monetary grant is received against a specific asset, which is depreciable, how many options do we have? 2. Reduced cost approach, deferred income approach. Reduced cost approach, what do? Grant is shown as a reduction from value of asset. If it results in depreciation, it will be reduced as depreciation. It will be reduced from the cost. Reduced cost of the asset is depreciated over the remaining useful life. If in case you follow deferred income approach, what do? It is not reduced from the cost of the asset. It will be booked as DGG, and that DGG will be transferred to P&L account over the remaining useful life of the asset in the pattern of depreciation. Everyone understood this? Fantastic. See, this is okay if you're following depreciable asset. What if the asset is not a depreciable asset? If the conditions are already met, then that entire grant received will be transferred to capital reserve. If the conditions are to be met in the future, you have some uncertainty, then what do? Grant is deferred and transferred to P&L account in the ratio over the period during which you fulfill the conditions. If the asset that you got is not a depreciable asset, you bought that asset, you showed that asset, and then you claim the government grant. Government gave you the grant. Full grant money, you write it to capital reserve. If conditions are met. If conditions are not met, little conditions will be met, little it will be recognized to P&L. Are you getting it? What if it is given to you because you incurred some expense? That expense what you incurred will be reduced because of this grant. Let's say you paid electricity bill of 10 lakh. State government gave you back 2 lakh as grant. That expense is 10. Reduce that expense by 2. Make it 8. Or write this 2 as income. Either way is same. Last point, promoter's contribution. If the government gives you grant as promoter's contribution, liking your idea, not asking share in the company. Government, if it says, I'll give you 10 lakh rupees, give me 2% equity in your company. That is not government grant. Government grant is when government gives you money without expecting anything from you. Sir, if they expect something under the table, that's not on paper. If the government expects nothing from you in return, government says you do your business, you create employment opportunity, you raise the economy of the country, promote the GDP, make the per capita income better, remove unemployment in the country, I will be happy. If government tells that, then it is grant. If government tells, I will give you 1 crore rupees, give me 5% equity in your company, no, then it's not government. If that promoter's contribution to promote your idea, government contributes money, it is usually a percentage of the total capital outlay. This will be received and recorded in capital reserve. This will be received and recorded in capital reserve. This will be usually not refunded. Usually, I hope everyone got this. If in case some conditions that you thought you have fulfilled in the beginning is now breached, government can ask, give me back the money that I have given. It can ask. That is refund of government grant. As per Accounting Standard 5, this is extraordinary item to be disclosed separately. Whatever you have done in the past, reverse it. Previously, when the grant was received, you have reduced the asset. Now add back the asset. Previously, when the grant was received, we have not reduced the asset. We have kept it in DGG. Now what do you do? Reduce DGG. Sir, but DGG is only 4 lakh. Refund is 10 lakh. What happened to balance 6? I have already transferred to PL. 4 lakh is there in DGG, make it 0. 6 lakh you charge to PL and give back 10 lakh as refund. Sir, previously when I received government grant, I've reduced expense. Now increase expense. Previously when I received government grant, I wrote it in capital reserve. Now reverse capital reserve. Promoter's contribution will be usually not refunded. But if that is refunded, you turned out to be a fraud company. Then they ask, give me back my promoter contribution. That promoter contribution received would have been in capital reserve. Now reverse capital reserve and pay it back to government. That's with regard to refund of government grant. Understood this? Please do ensure that you do questions on accounting for government grant on capital asset under both the approach. What is it? Reduced cost approach and deferred income approach, right? Grant on asset. Grant on asset. Grant on asset. Reduced approach, asset reduced approach and DGG approach. Do one question on this and do one question which involves refund. Do one question which involves refund of government grant. Like 2-3 years you use the asset and now you are supposed to refund. Refund under both. Refund under reduced cost approach. Refund under reduced cost approach and one more approach is reduced cost approach and deferred government grant income or deferred income or deferred government grant approach. Done. Everybody? Very good. Let's now go to a beautiful accounting standard. Accounting standard 21, which deals with consolidation. It's a little tricky as to how to do this in a marathon revision. I'll tell you what will I do. The pattern of solving what I do usually in the class is different from what you might have otherwise learned if you are not part of our class. So I am going to stick to my way of solving. I hope this will help. I am giving you the disclaimer in the beginning and then watching and then telling you, you watch it at your ease. Try listening. If this makes sense, watch it to that. If not, you can skip page 21, join me at page 23. Yeah, but trust me, I skipped consolidation as a student because I never understood step 1, step 2, step 3, step 4, step 5. Now, after I've started teaching, I actually no option. I have to learn. I had to learn. I ended up learning to teach. This is now a favorite chapter of mine. I love teaching this chapter. And what I've observed is a lot of students, other than some people like, some people do like. A lot of them actually do like. And 14 marks in the exam is being asked in the last 4 attempts consistently from consolidation. Skipping this is not something that you should ever do. And if you practice really well, it is doable. Yeah, you can do a consolidation question in 20 minutes, 25 minutes. 14 marks, 25 minutes is a good deal. It's a pretty good deal. And now anyways, they cannot ask 20 marks questions on consolidation. So previously people used to do consolidation, skip amalgamation, all that. No, consolidation also question will come. Amalgamation also question will come. Internal reconstruction also will come. Financial statements also will come. So effectively if you learn these 3-4 topics correctly, only you get easily 45, 50, 60. Provided you are good at it. And then this is excluding that first 30 marks MCQ. So then what did you do for the last 8 hours or something? That is syllabus. And you never know in which attempt will they not give consolidation question and then give 6 mark question on construction, 8 marks question on AS12, 10 marks question on AS10. I don't know. But be ready. One attempt will come sometime down the lane where module 3 will be very less important in the exam. Module 1 and 2 will be highly important in the exam. I don't know. Okay, let's begin. Accounting standard 21, consolidation of financial statements. See, consolidation is to provide the complete financial picture of an entity along with its subsidiaries and everything. Entire group as a whole. If you prepare one balance sheet, that's consolidation. Is consolidation mandatory? Yes. Whenever you are a holding company, you have to prepare consolidated financial statements after the individual subsidiaries and individual holding companies balance sheet and P&L is ready. I hope you got that point. So the second point what I want you to notice, if in case The holding company is become the holding company temporarily, meaning you bought 60% shares, but not with an intention of long-term holding. The share price went down, so you went on buying. You didn't even realize you bought more than 50. Then you don't have to do consolidation because you have no intention to exercise control on that company. The second point where you don't have to do consolidation is you have intention to have control, but government restrictions in the long term are such that you can never have control over your subsidiary. Then, though you have more than 50% stake in that company, you still don't have to do consolidation. Why? You can never have control. When the control is temporary or control is not possible because of long term restrictions, though you have more than 50%, you can still not do consolidation. And it is called your subsidiary not just when you have more than 50%, it is called as your subsidiary even when you have control over the composition of that board of directors of that company. Everybody understood this? Now let's begin. Consolidation can be two things: consolidation of balance sheet, consolidation of P&L. Consolidation of cash flow, there are no questions in ICA study material, but towards the end I'll still mention one line how to do consolidation of cash flow. If some weird attempt, someone like, okay, let me screw students and they make question paper, I'll tell you how to unscrew that question paper. Can I? Let's begin with balance sheet. Part A of the topic, let's discuss how to consolidate balance sheet. Holding company, subsidiary company are two different entities, both prepare financial statements separately. In our imagination, we're preparing balance sheet if subsidiary is no longer subsidiary and subsidiary is part of holding. Because in the holding company, in the investments, we have investment in subsidiary. In the subsidiary, there is share capital. Holding company's investment is subsidiary company's share capital. We'll eliminate both. Include all the assets of subsidiary into my balance sheet. All the liabilities into my balance sheet. How will my balance sheet look? Consolidated balance sheet. That's what we're trying to do. I'll tell you item wise. Start with share capital of the holding company. Share capital of the holding company will belong to holding company, that should appear in consolidated financial statement as it is. However, share capital of the subsidiary company, don't take it to consolidated balance sheet, take it outside consolidated balance sheet and split that into two parts. How much of it is held by holding company, how much of it is held by other than holding company, that is minority. Understood the point? Number one, share capital of the holding company will go to consolidated balance sheet untouched. Share capital of the subsidiary company will be split into how much is held by holding, how much is held by minority, and we identify the percentage of holding and minority. This is later needed for reserve analysis. Got that point? See, holding company to appear in consolidated balance sheet, subsidiary to be split into holding and minority. And this, when we split it, whatever holdings portion is there, no, that is nominal value of the investment made by holding company. What is it? Nominal value of the investment made by the holding company. You take it out into one separate box. This box is called as cost of control. What is this box? Cost of control. They will write nominal value of investment this much. You understood? Later this will be compared with the book value of investment. That is, in the balance sheet asset side of the holding company, we've written investment. This and that will be compared. Difference will become goodwill or capital reserve. Nominal value of the investments represent liability. Share capital of subsidiary divided part holding, that is nominal value of investment, liability. Holding company's balance sheet asset side, whatever we take is book value, that is asset. Asset and liability will be tested in cost of control. If asset emerges more, goodwill. If liability emerges more, capital reserve. That's what we call cost of control. I hope you understood. And that minorities portion, we'll keep it in one separate box called minority interest. To that we add minority share in reserves, both capital and revenue, add them all together and write minority interest in my consolidated balance sheet. The next point to remember, whenever a company makes bonus issue, especially subsidiary, reduce subsidiaries reserves, increase subsidiaries capital. Reduce subsidiaries reserves, increase subsidiaries capital. That increased capital is there, no, that capital again belongs to holding and minority in the same ratio in which the share capital is held. You split that bonus shares into holding, minority. Holding part, you add it to holding nominal value and write in cost of control. Minorities portion, you add it in minority interest. I hope you all understood. Instead, do one thing, add this to share capital and then split it between holding, minority. That's an easier thing to do. Next, let's talk about reserves. When we talk about reserves, reserves of holding company will appear in consolidated balance sheet. Reserves of holding company will appear in consolidated balance sheet. In this, we might have to adjust two things. One, post-acquisition dividend to be included. After the holding company acquired the subsidiary, but before we do consolidation, if the subsidiary company declares dividend, and that dividend is declared out of the profit after the holding company started becoming the holding company, then it is post-acquisition dividend. We've discussed in AS13 that post-acquisition dividend declared by the subsidiary should be included in profit of holding. Post-acquisition dividend declared by the subsidiary should be added in the profit of holding. Next point is unrealized profit. If the holding company has sold goods to subsidiary, if the holding company has sold goods to, and those goods have been not sold by subsidiary to outsiders, and if it is still part of the inventory, on that inventory, whatever is the profit which is not realized has to be deducted from the holding company's profit. I'll repeat, holding company is seller, subsidiary company is buyer, holding has sold goods to subsidiary at profit, subsidiary has not sold these goods to outsiders. On that stock lying with subsidiary, will identify the profit which is booked by the holding, it will be eliminated from holding's profit. This is downward. This is holding to subsidiary will be eliminated from holding's profit. So subsidiary, if it has sold goods sold, that will tell later. So holdings reserves and surplus will go to consolidated balance sheet. It is subject to two adjustments. One, post-acquisition dividend to be added. Next, unrealized profit on the goods sold by holding to subsidiary if any to be deducted. I hope you understood this. Then look at the points with regard to subsidiaries. Subsidiaries profit should be split between holding minority. No, before that we'll split subsidiaries reserves into two categories. How much is it as on the date of acquisition? How much is it after the date of acquisition? Let's split it into two. How much is it on the date of acquisition? How much is it after the date of acquisition? Any profit earned by the subsidiary till the date of acquisition is pre-acquisition profit. After the date of acquisition, whatever they want is post-acquisition profit. Pre-post have to be then divided between holding and minority. First, split the profit as pre-post. Pre should be further split between holding minority. Post should be further split between holding and minority. How to do this is, first write all the results. Write pre-post, pre-post, pre-post. Then take pre together. Post together. And that you share between holding and minority in percentage. This percentage is what we found here. Understood? And that percentage you share the reserves. Whatever is the holding company's share, now pre-post are there. Now let's talk about pre. Pre-profits split between holding minority. Holding company's share in pre-acquisition profits should be deducted from the cost of investment. In the balance sheet, asset side of the holding company, we will written no investment in subsidiary. In the liability side of the subsidiary company, we will written share capital. Share capital, holdings share, nominal value of investment. Asset side, book value of investment. We compare these two in cost of control to find profit or loss. That book value of investment should be written in inner column. Deduct the pre-acquisition reserves, pre-acquisition dividend from this. Only then goodwill or capital. Sir, what about holding company's post-acquisition share? Directly take it to reserves and surplus in consolidated balance sheet. Sir, how about minority share? Minority share in pre, minority share in post, both will be written together in minority interest and taken to consolidated balance sheet. Once again, full reserves revision. Holding company's reserves will go to holding company's consolidated balance sheet subject to two adjustment. Post-acquisition dividend to be added. Second one, unrealized profit on the goods sold by holding to be deducted. Subsidiaries reserves split into pre-post, then split between holding minority. Holdings portion in pre deducted from book value of investment in cost of control. Holdings share in post will be taken to reserves and surplus. Minorities pre, minorities post together will be added and written in minority interest, which will be later posted to balance sheet. I hope everyone understood. Next points to note. Acquisition if it happens in the middle of the year. Acquisition if the holding company acquires the shares of the subsidiary not at the beginning but in the middle. Then what to do? Reserves and all is easy. P&L balance. Assume it is evenly spread throughout the year. If they've given P&L account, current year profit 1 lakh. 1 lakh is evenly spread throughout the year. If the acquisition happens after 6 months, 6 by 12, 50,000 pre, 6 by 12, 50,000 post, divided based on months. But be careful, this is only for normal profit. What if there is some abnormal transaction, abnormal loss, abnormal profit? That should be taken for that specific period to which the transaction belongs. From the profit earned during the year, eliminate the abnormal item. Normal item, you split it based on the period. So that abnormal profit or loss, whichever date the transaction happened. If the transaction happened in the pre. If the transaction happened in the post. So please do that question on abnormal thing. It is one of the exam questions also, abnormal profit. Then revaluation. We'll come to this once again also. The assets can be revalued in the process of consolidation. The holding company can tell subsidiary, hey, your asset value is not correct, increase it. hey, your asset value is not correct, decrease it, can do. So when we do that, if in case an asset value is increased, that will lead to creation of revaluation reserve. If an asset value is decreased, that will lead to creation of revaluation reserve, debit balance. Revaluation reserve is always created on consolidation, but it is for the period prior to consolidation. So revaluation reserve created on consolidation process is always pre. It's always pre. But after the revalued portion, we recompute the depreciation on the asset. That will be always post. Now asset is 1 lakh. You revalued it to 1 lakh 20. So the 20,000 upward revaluation is pre. 1 lakh 20,000 depreciation. We book depreciation. The depreciation should be deducted from post acquisition profit, not from pre. Why? On the consolidation day you do revaluation. After that you charge depreciation, which is post period. Did you understand revaluation and depreciation? Only on the revalued portion you charge depreciation in the post acquisition profit. 1 lakh worth of asset is revalued upward by 1 lakh, upward to 1 lakh 20,000 upward. Only on 20,000 you should charge depreciation. On original 1 lakh they would have already charged. On 20,000 you charge depreciation from the post acquisition profit. If it is downward revaluation, only on that revaluation portion you compute depreciation, add it back. Where? In the post acquisition part. I hope you guys are getting it. If the company has made bonus issue, you deduct that profit, you deduct that reserve from the, you deduct that reserve to the extent required to create bonus. That will be usually deducted from pre. Only if pre is not sufficient to deduct from post. I hope you understood. Very nice. For the sake of uniformity in accounting policies, if in case you change the value of any asset, then that value of change in the asset will anyways go to your P&L only. Then next one is dividend. Whenever dividend is supposed to be given to preference shareholders or something in the process of consolidation, please do deduct it from our reserves and then pay it in cash and then do consolidation. Some questions are there where they want us to do updation and then do consolidation. That's when you'll have this dividend based adjustment. I hope you got it. Some questions will have long-term borrowings debentures also. What to do with long-term borrowings debentures? Very simple. If the debentures are there in the holding company, write them as it is in consolidated balance sheet. If the debentures are there in subsidiary company, ask, are these debentures held by holding? If the debentures are not held by holding, it is all held by some private person, write the debentures as it is in consolidated balance sheet. But if a small portion of debentures is held by holding company, treat it like share capital. Bring the debentures of subsidiary, split it. Held by holding company, not minority, others. Debentures of subsidiary company will be split into two categories, held by holding, others. Whatever is held by others, not minority, write it as it is in consolidated balance sheet, long-term borrowing. Whatever is held by holding company, that is nominal value of investment. We got it from the liability side of subsidiary. Asset side of holding will get book value. Compare both. If book value is more than nominal value, goodwill. If nominal value is more than book value, capital reserve. This goodwill or capital reserve that arised in book value nominal value comparison of debentures will be consolidated with goodwill or capital reserve that arised in comparison of nominal value or book value of share capital investment, and together whatever goodwill or capital reserve comes, that will be posted to consolidated balance sheet. Am I making sense? If you've done the questions in our style, now every adjustment will start clicking. If not, you'll be like, okay. Step 2 na step 3 na idu step 2 no alla 3 no alla. Okay. Payables and receivables. What to do with payables and receivables? Subsidiaries payables, holdings payables, together total payables in consolidated balance sheet. Subsidiaries receivables, holdings receivables, together we'll write it in consolidated balance sheet. But if the payable to holding is receivable to subsidiary, or receivable to holding is payable to subsidiary, eliminate. Did I tell the same thing 2 times? Sorry. If the receivable to holding is payable to subsidiary, or receivable to subsidiary is payable to holding, correct? Eliminate the cross connection. Let us say cross holdings, or what is a mutual indebtedness. Eliminate it from the receivable, eliminate it from the payable in the process of consolidation. Remember, all the adjustments that we are doing are only in the process of consolidation. In the standalone balance sheet of holding, that receivable will be still there. In the standalone balance sheet of subsidiary, that payable will be still there. But only in consolidation, we will eliminate. These calculations only for the purpose of consolidation. There is no journal entry. There is no change in the actual value in standalone financial statements. This is only for the purpose of consolidation. You understand? There might be some adjustments where holding company has some bills receivable which it has received from subsidiary. Subsidiary's bills payable given to holding is 10,000. Only 6,000 of it is there with holding. Why? Subsidiaries bills payable is 10. It gave to holding. Holding had 10, but 4,000 it got it discounted or it has endorsed. Only 6,000 is with them. Then mutual indebtedness is only 6. In mutual indebtedness, trade receivable of holding, trade payable of subsidiary, whichever is less will be adjusted in both. Or trade receivables of subsidiary, trade payables of holding, whichever is less will be adjusted in both cases. Don't deduct some amount here, some amount there. Balance sheet will not tally them. Come to the next item, PPE. Property, plant and equipment of the holding company will be posted as it is to consolidated balance sheet. That of subsidiary can be revalued upward or downward. If you revalue upward, increase the value, and then increased portion will go to revaluation reserve. If it is decreased portion will be written in revaluation reserve as minus side. Later further split between holding, minority, pre-post, all that. But whenever you change the value, from the date on which acquisition happens, that change happens. From the date of acquisition till year end, we need to adjust that depreciation on that revaluation portion. That should also be adjusted to PL, post acquisition. Remember that with regard to PP. Then investment. Holding company has some investment. Check, is that investment in subsidiary? If it is not in subsidiary, write that investment as it is in consolidated balance sheet. What if that holding company's investment is investment in subsidiary? Don't write it to consolidated balance sheet. Write it as book value of investment. Compare it with holding company's share in subsidiaries share capital, which is nominal value of investment. If asset is more, it will become goodwill. If liability, nominal value is more, it will become capitalism. Same thing I'm repeating third time. Within revision only, we're repeating it 3 times. So some adjustment wherever it's connected, I'll tell repetitively. It's okay to repeat some things 3 times because you don't want to repeat some things 2 times. Reading 3 times is okay. Writing exam 2 times is not. So it's okay. Revise it. And that's it. Subsidiaries investment will straight away go to consolidated balance sheet. Luckily, you don't have such questions where subsidiary has some shareholding in holding, holding has some shareholding in subsidiary. You don't have those. Before it became subsidiary, what if it had already bought some shares? Those can be retained. After they become holding subsidiary relationship, you can't buy. After it becomes holding and subsidiary, they cannot further buy each other's shares. Before this company became subsidiary of this, it had some 10% shares in that company. Is that possible? Yes. But such questions are there? Is it there in your syllabus? No. But if it's there, it will become really interesting. But those are not there in your syllabus. You would have to solve one simultaneous linear equation. Why? Holding company has 60% shares in subsidiary. Subsidiary has 10% shares in holding. So holding gets 60% of the subsidiary's reserves. In that reserves of the subsidiary with 60% belongs to holding, in the 10% belongs again back to subsidiary. Arthak Veda. That's not required. And in that 10% what they take, again 60% belongs to holding. That would have to adjust in such way, but that's not there in syllabus. Don't worry. You don't have a cross holding and triangle holding, chain holding is not there in CA inter syllabus, at least as of now. Final it's there. At least as of now it's not there in inter. Okay, let's go to next one. Inventory. Inventory of holding will be returned to consolidated balance sheet after adding with inventory of subsidiary. See, holding and subsidiary to be posted to consolidated balance sheet if in case there is any mutual indebtedness and unrealized profit. Unrealized profit meaning holding has sold goods to subsidiary or subsidiary has sold goods to holding. The one who's bought it has not sold it to outsider. Then what to do? On that unsold inventory, profit has to be deducted. Profit of the selling company has to be deducted before we do consolidation. Remember this. Sometimes there might be some reconciliation and rectification also, which is required to be done in consolidation process. Meaning, holding company has 10,000 receivable from subsidiary. Subsidiary company should have 10,000 payable. They have only 8,000 payable. How is it that they have 10,000 receivable? They have 8,000 payable. They have booked 2,000 interest income, which they have not booked as expense. In that case, there is rectification of error needs to be done in one of the party, whoever has done the mistake. Do rectify, then reconcile. When the balances match, then do consolidation. That should not be asked. When they give you a question on consolidation, all the rectification, reconciliation should be done because you do only consolidation. But sometimes they become creative. They'll ask you to update the balance sheet and then do consolidation. When this was introduced in CA Intermediate May 2019 for the first time, there was a question where holding company's balance sheet is on 31st March, subsidiary company's balance sheet was 31st December, and they're given transactions that happened in January, February, March. You are supposed to incorporate those transactions in January, February, March to 31st December's balance sheet and then do straight away consolidation. But I made students do updation and balance sheet on 31st March and then do consolidation so that they understand. And then I told you can do straight like this also. But that question was removed in very next edition of the material. That was question in CA final FR which was straight away adopted. But anyways, you don't have such. We'll have 2-3 small rectifications. Please do learn them. Then minority interest. That share capital of the subsidiary we split, no, holding share, other than holding share is minority. Reserves of the subsidiary we split, no, pre-post. Then pre-post we split between holding minority, minority, add them together. Share capital, add it together. Bonus issue if it's there, they're also minority, add it together. Everything together will become minority interest, and this minority interest will be posted to consolidated balance sheet as a liability. There is a separate line after shareholders funds, before non-current liabilities. It's a separate line item, minority interest. That item is not there in schedule 3 balance sheet, but that's only in the case of consolidated balance sheet. I hope you all understood. Minority interest cannot be zero. Cannot be negative. If in case minority interest becomes negative, write it as 0. That negative amount is borne by the holding company. Holding company's reserves you adjust, but don't write minority interest as negative. I hope you all understood, because limited liability concept, no, in company. Just because there is loss, you cannot collect money from the minority. It won't work like that. By this, we are done with part U of consolidation, which actually deals with consolidation of balance sheet. Shall we now begin with consolidation of statement of profit or loss? Very simple. Revenue and expenses. All expenses, all incomes, all, like I would say, everything, revenue from operation, other income, depreciation, purchase of stock and trade, changes in inventory, everything, holding subsidiary, add together and then write. If holding has sold goods to subsidiary, eliminated from holdings revenue from operations, subsidiaries purchase of stock and trade. So what if subsidiary has sold it to holding? Eliminated from subsidiaries revenue from operations, holdings purchase of stock and trade. Similarly, if there is unrealized profit, eliminated from the closing inventory in the process of changes in inventory computation. Then the next point is interest. One entity might have paid interest to another. For one it is finance charge, for the other it is other income. Eliminated from other income, eliminated from interest charge. And it can also happen like holding company has charged consulting fee, maintenance fee, management fee to subsidiary. To holding company it is other income. To subsidiary it is other expense, eliminated from both places. I hope you're getting it. And if in case there is dividend received by the holding company, if there is dividend received by the holding company, you should check, is it post acquisition dividend or pre acquisition dividend? If it is post acquisition dividend, it's okay, it's part of other income. If it is pre acquisition dividend, it should not be part of other income. If it is part of other income, then that is an error. We should rectify it. We should eliminate it from other income and use it to reduce the cost of investment in balance sheet assets. I hope you all understood. Any expense income mutually eliminate. Any intercompany sale purchase eliminate. Adjust that unrealized profit in inventory. The next thing that you would have to notice, tax. Don't try to adjust tax on the consolidated entity in the new tax amount on the new profit. No. Tax of holding, tax of subsidiary together is the tax of consolidated entity. Deduct the same. And appropriations, we would have adjusted it there only, where in the reserves and surplus. But what we would have to do is, once you identify the profit of the consolidated entity, from that we need to give percentage share to minority. That will be not on the consolidated profit, on the standalone P&L of the subsidiary. Listen to this carefully. On the standalone P&L of the subsidiary, whatever profit we get, on that we apply percentage of minority. The amount that we get is the minority share in the subsidiary's profit, eliminated from the consolidated entity's profit. Balance of the profit will be carried forward to reserves and surplus. I'll repeat. Holding subsidiary together, you prepare consolidated PL. In that consolidated PL, whatever profit you get is for entire entity. Some money belongs to minority. Don't apply 30% on consolidated entity's profit. No. On the standalone P&L of subsidiary, before eliminating intercompany transactions, whatever profit is there, on that you apply 30%. That amount, whatever you get, that has to be deducted from the consolidated entity's profit to find the profit in the consolidated entity's P&L account, which belongs to holding company, which is transferred to reserves and surplus in the consolidated balance sheet. This is how you do consolidation. We do a lot of kutti questions, but that kutti questions only will take 10 hours and we won't be able to do. We will like easily I've increased the number of questions from the last time. I think it's now trending at 25. 25 questions. We do small ones and then we do big questions later. Last point, consolidated cash flow. Theory is there in the study material. There's been no questions. If in case they ask, add. Operating of holding, operating of subsidiary together. Investing of holding, investing of subsidiary together. Financing of holding, financing of subsidiary together. Opening together, closing together. And if the holding company has paid cash to subsidiary company has paid cash to holding, eliminate it from the respective items. You got it? What if the holding company has paid cash to subsidiary for purchase of goods? For both, it will be in operating only. Eliminate from both the companies operating. Holding company has paid, subsidiary company has paid interest to holding. For subsidiary, it is financing outflow. For holding, it is investing inflow. From investing inflow, you eliminate. From financing outflow, you eliminate. Such kind of questions are not there, but just giving you heads up. They would have to give the adjustments very clearly on the face. You eliminate the impact and consolidated cash flow should be ready by that. Next, let's go to Accounting Standard 23, Investment in Associate. Let's start with Chapter 10, Unit 2, which talks about Accounting Standard 23, Investment in Associate. If you invest 50% or more shares in a company, that becomes your subsidiary, we do consolidation. If you invest 20% or more in a company, that becomes your associate, you become investor. You will still be minority. There's somebody else who can hold 80% in that company and they become the holding company and they can take complete assets and liabilities of that company into their balance sheet. So what is it that you would have to do? You would have to ensure that you cannot write all of their assets. Let's say I am the holding company, there is a subsidiary company here. I'll write all the assets of subsidiary into my balance sheet, all the liabilities of subsidiary into my balance sheet, but that assets and liabilities doesn't completely belong to me. There are people who hold it 20%. So what do? I'll compute percentage that belongs to minority and write it as liability. 100% of the asset doesn't belong to me, only 80% belongs to me, but I write 100% of it, write 20% as liability. That's what we do in AS21. In AS23, what I do is, I am a company, I hold 20% in this company. I cannot write all my assets, all their assets into my balance sheet and write 80% as majority interest. No. What I do is, I have investment. I identify that company's assets minus liabilities, basically net assets. That company's net assets is assets minus liabilities or capital plus reserves. I'll identify the net asset value of that company. In that, I hold 20%. I'll compute 20% of it. How much money did I pay? How much value am I getting? Difference is goodwill or capital reserve. I'll show investment that I have made in that company as to two categories. One, net asset value of the company that I'll get plus goodwill or minus capital reserve. This is the logic. I have paid 1 lakh rupees to get 20% equity in that company. For 1 lakh, I get that company's 20% net assets. No, what is their net assets? I'll say that company's net assets is, let's say, 2 lakh 40. In that 24 lakh. In that 20% comes to 4 lakh. Net assets percentage of that company's total assets, let's say it comes to 1 lakh 20. I've paid 1 lakh. I'm going to get value of 1 lakh 20. So I'll show 1 lakh split 1 lakh 20 minus 20, 1 lakh. 1 lakh 20 net assets I get, 20,000 capital reserve, 1 lakh is my investment. I show that split. What if I get only 80,000 worth of net assets? I'll say 80,000 net assets I get, 20,000 is my goodwill, together it becomes 1 lakh. I show that split. So that's what we do in this case. Let me straight away take you to one AQ and then explain. That's when you'll understand this better. This is the company in which I have invested money. To compute this company's net assets, I can take its share capital plus reserves 15, or I can take its total assets 20 minus its outside liabilities 5. So when I do 20 minus 5, that is its net assets. Alternatively, share capital plus reserves, that is also its net assets. You understood net assets computation? Net assets can be share capital plus reserves or assets minus liabilities. This is only introduction. This is not the kind of question that you get. This is something that you should be cautious about. In this question, I'll tell you how to compute goodwill or capital reserve in the investment that you made in an associate. Are you ready? How much is equity capital? 5 lakh. How much is reserves? 2 lakh. This is the capital extract of associate. I own how much in that company? 40. If I hold more than 50, it becomes my subsidiary. If I hold 20 or more, but not more than 50, it becomes my associate. So what do? That company's capital is 5 lakh plus 2 lakh, 7 lakh is its net assets. In 7 lakhs, can I say, in 7 lakhs, 40% belongs to me, which is 2 lakh 80. So 2,80,000 is the value of the investment that I've made. But how much did I pay to get that investment? 3 lakh. So I paid 3 lakh to buy the investment. But from that associate company, I get only 2,80,000 worth of benefit. I paid 20,000 extra. Or 20,000 what I've paid, I'm not able to see any asset in that company. So that 20,000 what I've paid extra is goodwill. Did you understand? What if it's like this now? Can I say investor has invested 40% in associate limited? Do you agree with me? Equity share capital is 5 lakh, reserves and surplus is 2 lakh 50. Their net assets is 7 lakh. On that 7 lakh, 40% is 2 lakh 80. 2 lakh 80 is net assets of that company, but I paid 2 lakh 50,000 only. Ooh. I paid 2 lakh 50 to get the shares in that company, but that company's value worth I'm getting is 2 lakh 80. I'm getting 30,000 more. That 30,000 is capital reserve. Sir, why did we compute this? Very easy. In the first case, how much is my investment? 3 lakh. How much is my investment? In the consolidated balance sheet that I prepared, I should not show 3 lakh. I should show like this. I should show 2,80,000 net assets, 20,000 goodwill. Sir, total is 3 lakh. Yeah, total 3 lakh. But I'll not write 3 lakh. I'll say 2,80,000 net assets in associate, 20,000 goodwill. Sir, in this case, I'll write net assets 2,80,000, capital reserve minus 30, total outer column will be 2,50,000. I've invested 2,50,000 only, but to show 2,50,000, I would have to show 2,80,000 minus 30 and then show 2,50,000. Everybody understood this? Say something, some Pakka? Very good. This is computation of goodwill or computation of capital reserve. This is one question that I want you all to see. Once you see this, it's good. We can go to next one. So have a look at this question. Those of you who don't have this question when you're watching it on YouTube, if you want, you can take a screenshot also. Volume down button, but with power button. Or some people will do 3 fingers like this. Yeah, if you do 3 fingers like this, screenshot baratta hai. You tell how to take phone shot, screenshot in your phone. Some people do like this also, like complete palm. If you do like this, you get screenshot. Some phones. Okay. In iPhone, you need to click on that dot and then click screenshot. Or you just blink your eyes like this. Not funny. Okay. Equity share capital is 5 lakh of associate. Reserves and surplus is 2 lakh. During the year, they have earned 1,50,000 profit, and during the year, that associate has declared dividend of 50. They have declared dividend of 50. And in that company, you have 40% stake, and you paid 3 lakh rupees to get that stake. Then how to compute goodwill or capital reserve? Very simple. You have paid 3 lakh. That company's share capital is 5 lakh. Reserves and surplus is 2 lakh. Add them together, you get 7 lakh. 40% of it is 2,80,000. Can I say 2,80,000 is the net assets you get? 3 lakh is the money you paid. 20,000 is goodwill that you paid extra. Sorry, you did not consider current year profit and dividend. You understood till here? To this, you add current year profit. Sir, 1,50,000. I have only 40% stake. No, 60% belongs to somebody else. Add profit, deduct dividend. So reminds you of something? Partnership. Profit earned during the year is added to partner's capital. Drawings made during the year is deducted from the capital. Ultimately, we get the carrying amount of closing capital. Dividend is like drawings. Remember, profit is not drawings. Dividend is part of the profit given to the shareholder, drawings. So first, take share capital of the associate, reserves of the associate, add them together, that is net assets. On that, you apply the percentage that you hold, you get percentage of net assets you own. This you compare with book value of investment. If book value is more, goodwill. If book value is less, capital reserve. When you prepare consolidated balance sheet with interest in joint venture, you need to show net assets plus goodwill or net assets minus capital reserve as your cost of investment. To this, add the current year profit to the extent you hold 40%, 20%, 30%. From the deduct dividend that is declared out, you will get the closing carrying amount of investment to be shown in consolidated cash flow statement for interest in joint venture. This 3,40,000 is what is to be shown. I hope everyone understood this. Any doubt? Okay, that's it. Then there are some questions where you need to do it for more than 1 year, but I think this will be good. And there is one question where there is current year loss, pre-acquisition dividend adjustment. So that's good enough. Yeah. Make a note, kind of question to do on this one. Computation of capital reserve or goodwill and carrying amount of investment. Computation of goodwill or capital reserve. Computation of goodwill or capital reserve with carrying amount. Okay. Two adjustments to refer. One, pre-acquisition dividend. Pre-acquisition dividend. Adjustment number one. Adjustment number two, loss in a year. There is a question where there is a loss in one specific year. Loss in a year. Loss in a year. Will you do refer these adjustments when you are revising? Can I take you all to Accounting Standard 27? Chichi Standard. Joint venture. Joint venture, highly unlikely. If it comes, it's blessing. Bonus. Because the easiest to do. There are three varieties of questions in study material. Do all the three varieties. You don't have to solve. Just see, you will understand. Simple to do. Joint venture is where two people have come together to create one new entity, or they have jointly controlled some assets, or they are jointly controlled operations. In either of the cases, whatever is the balance sheet value of joint venture, you divide it among the each venture, co-venturer, and then split. Each income, each expense, each profit item, each asset, each liability will be split and then written. I don't want to spend too much time on this. This is a topic which was there. Similar one was a topic which was there in CA Foundation at one point of time, joint venture. Then it got removed. It's here. Study material has about 3 questions. Please do revise those 3 questions. What is there? Yeah, they will give one balance sheet and then you need to split it between 2 entities and then absorb it into the other entities. Please try revisit these 3 questions. One rare attempt if they ask will be good. There are 3 questions in the study material. All the 3 you just revise. You should not take more than 15-20 minutes for this topic. Final revision, anytime revision. So that's it. Timestamp starts, timestamp ends. Yes, 27. Can we begin? Chapter 11, Unit 1. Financial statements of company. This is one topic where isolated question on financial statements is less likely, but they will put in one AS4 adjustment, dividend adjustment, or a couple of other disclosure based requirements adjustments, and then ask you a question. Questions do come, but it is not based on computation. It is based on presentation. It is about how to prepare financial statements of company. Marks are given not because your balance sheet tallies. Marks are given because you have taken care of all the disclosure requirements that are associated to this question. Let's quickly one question on balance sheet with PL and do at least one question on dividend, maximum dividend that can be declared. Maximum dividend that can be declared. It is there in one of the past exam questions only. Maximum rate of dividend. May 24 there was one question. I think there was one question recently also. You can do that. See, your account teacher might have taught you how to do differently. Your law teacher might have taught you differently. Presentation. Answer is same. Whichever presentation you are comfortable. Both of them would be right. Both of them would have simplified it in their own style. Whichever you find comfortable, you stick to it and practice the same. Because interpretation of law, you can write it anyway, but interpretation will be same at the end. Answer will also be same at the end. You understood? Whatever makes more sense to you. Don't practice both the methods and then go to exam like ida ada. Eradu gottagta illa. Confuse. Idu start ಮಾಡಿ ಅದು end ಮಾಡಿ ಮಧ್ಯಕ್ಕೆ ನಿಲ್ಲಿಸ್ಬಿಟ್ಟು ಬಂದ್ಬೇಡಿ. You understood that? Okay. That's with regard to financial statements of company. Let's start cash flow statements. Let's get back to cash flow statement. This is chapter 11 unit 2 as well as chapter 4 unit 1. Both talk about cash flow statement. What do you mean by cash flow statement? Why do you prepare cash flow statement? See, the financial statements definition that is given under section 2 subsection 40 of Companies Act 2013 also includes the word cash flow statement. That's the reason we prepare cash flow statement. I hope you got that. Now, cash flow statement is to be prepared by every company, but there is exception. 3 companies need not prepare cash flow. What are the 3 companies? 1-person company, small company, dormant company. These 3 entities need not prepare cash flow statement. The objective is to provide enough information to the user so that they can take right decision. It is not always the profit, P ratio, EPS, and then beta, the reason to invest in the company or not. Cash health of the company is also very critical. If the cash is not well managed, you cannot stay invested in that company. And the way the cash flows are running, if you can draw a chart, that talks a lot about the financial health of a company. So what we do is we prepare a statement because the cash book what we prepare is not good enough to give us good understanding about the company's financial health. In cash flow statement, cash and cash equivalent are to be seen utmost priority. Cash. When we say cash, no, cash includes cash in hand and also includes demand deposits with bank. Demand deposits with bank means basically the money that you kept in the form of savings bank deposit, which you can withdraw at any point of time. You demand and the money will be taken. But when you say time deposit, this is the money which can be withdrawn only at the end of a specific time period. Like you keep RD, recurring deposit, you keep fixed deposit, that is all time deposits. So fixed deposit is not part of cash, whereas if you have savings bank deposit, if you have cash in hand, that is considered to be cash. What is cash equivalent? Cash equivalent represents investments. These are investments but still considered to be equal to cash. When will they be considered to be equal to cash? They will be considered to be equal to cash if they are short term, highly liquid, and then significant risk is not there associated to it and readily convertible into cash. So RISH is the acronym, which gives 4 conditions. If all of these 4 conditions are satisfied, then such an investment will be called as cash equivalent. If one of these 4 conditions is not satisfied, it is not cash equivalent, but it is treated as investment. What are the 4 conditions? R, readily convertible. I, insignificant risk. S, short term. H, highly liquid investments. It, for example, is a listed debenture which is due for redemption within 3 months. Short term means 90 days or less, 3 months. You get it? And shares cannot be called as cash equivalent because they carry risk associated. Because they are listed in the stock exchange, the price will keep moving. And to be calling it cash equivalent, it has to be listed. An unlisted document cannot be called as cash equivalent. Why? There is no market to sell. No, it is not readily convertible. I hope everyone understood this. Then cash flows. Cash flows represent cash coming in, cash going out, receipt and payment in an entity. And these will be categorized into 3 activities: operating, investing, financing. And we need to write all the operating cash flows, all the investing cash flows, all the financing cash flows together, and that is decisive in telling whether the company is heading in the right direction or not. Is the company progressing or company shutting down? Now let me tell how to categorize the activities into operating, investing, financing. Very simple. The moment you get an idea, you want to start doing the business. In order to do business, you need to get money. You get money from your own pocket capital. You borrow money from bank. You borrow money from public, debentures, shares, cash, bank, loan, everything together. That's financing activity. Using that money, you buy assets, investing activity. Finally, you buy inventory, you appoint people, you pay salary, you pay rent, you pay expense, you sell goods, operating. After that, you pay interest on loan, you pay dividend, you redeem preference shares, you redeem debentures, you buy back equity shares, financing. Assets have become old. You will sell assets, investing. You buy assets, investing. You sell assets, investing. Buy assets, investing. Buy goods, sell goods, pay expenses, operating. Borrow money, lend money, borrow money, repay the debt, pay interest, pay dividend, borrow further money, issue shares, redeem preference shares, buy back equity shares, financing. I hope you understood how to do the basic classification. In order to prepare this cash flow statement, there are 2 methods. One is direct method, other one is indirect method. Under direct method, what do we do? It is cash book cut into 3 parts. Operating, investing, financing. How do we do? Receipt side, payment side, opening, closing. That's how cash book is. All the receipts will be divided into operating, investing, financing. Operating, investing, financing. Operating, investing, payments. Operating, investing, financing. Segregate them. All operating inflows, all operating outflows together. All investing inflows, all investing outflows together. All financing inflows, financing outflows together. You will get inflows from operating, investing, financing. Added to opening cash and cash equivalent, you will get closing cash and cash equivalent. I hope you understood how to get the entire cash flow statement. This is direct method. This is direct method. It is same cash book presented slightly differently. But the interesting part is indirect method. How is indirect method different? Indirect method is same when it comes to investing activities and financing activities. Investing method is, operating cash flows and investing cash flows and financing cash flows are all found under direct and indirect. Under direct method, we do all 3. Under indirect method, we do all 3. But investing and financing, whether you do under direct or you do under indirect, it is same. The point of difference between direct method and indirect method is in operating activities. In operating activities under direct method, we write inflow minus outflow. Under indirect method, what we do is we come to this understanding that in our cash flow, in our financial statements, balance sheet liability side, whatever is there, is more or less representing financing activities. Asset side is more or less representing investing activities. If you look at P&L statement, there is expense, there is income, there is purchase, there is sale. Everything is actually representing operating. And if you observe closely, all the incomes is inflows, expenses are outflows. I'll repeat, incomes are inflows, expenses are outflows. Inflow minus outflow will give us net cash flow. Here that is income minus expense, profit. So I will say, hey, cash flow from operating activity and net profit is same, but just before I say like, no. They are very similar, but they are not. They are very similar. What are very similar but not same? Cash flow from operating activities and net profit as per P&L account. Cash flow from operating activities and net profit as per P&L account are similar but not same. What are the reasons why they are not same? The reason is in statement of profit or loss, yes, we write operating income. Yes, we write operating expenses. We write income and expense on accrual basis whenever they accrue, not when they are paid. Sometimes some incomes are earned but not received. We write it in P&L. We write expenses in P&L which they are not yet paid. Are you getting it? And P&L is not the place only for operating items. We write some non-operating incomes also, some non-operating expense also. But still, almost DNA is matching, like that of rat and a human being, 99% same. We just need to eliminate that 1% difference and we'll end up with cash flow from operating activities starting with net profit as per PL. So I'll start with net profit as per profit and loss account and eliminate the impact of non-operating and non-cash items in PL. There are some non-operating items, there are some non-cash items in P&L. We eliminate their impact from net profit. That's how we'll get cash flow from operating activities. If there is some non-operating income, what do we do? Eliminate that non-operating income. Eliminate that non-operating income. How? That income has increased the profit. Minus. If there is some non-cash income, because of that income, profit has gone up. Eliminate that income. Profit will become cash flow from operating activity. If there is any non-operating or non-cash expense debited to P&L, because of that expense, profit has decreased. No. If that expense is no longer there, profit will become cash flow and it will become more. So non-operating or non-cash expense which was previously debited to P&L will be added back. Non-operating or non-cash income which was previously credited to P&L will be deducted. I'll repeat. Non-operating or non-cash income credited to P&L minus non-operating or non-cash expense debited to P&L add back. By doing that, you will transform net profit as per P&L account to cash flow from operating activity. Observe points of difference. Net profit is excess of income over expense. However, net cash is receipt over payment. Expenses are recorded in P&L on accrual basis, but in cash flow it is cash basis. Profit or loss will include financing and investing items also, not just operating. Current assets and current liabilities, that will come later. So what do we do? Cash flow from operating activities can be found starting with net profit by removing impact of non-cash and non-operating items in P&L from net profit. You understood? So we'll start with net profit, add back non-operating and non-cash items debited to P&L, deduct non-operating and non-cash incomes credited to P&L, we'll get cash profit. But that's not cash flow from operating activities. The reason is P&L you did adjustment. Come to balance sheet. I agree, liability side represents financing activities, asset side represent investing activities, but on the liability side current liabilities, on the asset side current assets actually are representing operating items. So there are some items on the liability side which are actually not financing. There are some items on the asset side which are not investing, which are actually operating. For this current liability and current asset which affects operating activities, we need to include it in our cash flow statement. Difference between current liability and current asset, no, we call it changes in working capital. In them, no, there are so many transactions. Debtors, there are hundreds of transactions. Bills receivable, there are hundreds of transactions. And current assets means prepaid expenses and all will be there. Current liabilities, bills payable, creditors, outstanding, too many transactions. It's difficult to identify cash. So you know what do we do? Take the net difference between them. How to take net difference? Simple, yeah. The common sense or the shortcut will be, for current assets always do opening minus closing. For current liabilities always do closing minus opening. Current asset A is the first letter, opening letter, do opening minus closing. Current liabilities, CL means closing minus opening. Sir, why do we do that? Very simple. Current asset is increasing, meaning you have purchased that asset. Opening current asset is 10, closing current asset is 12, meaning you purchased 2000 worth of current asset. When you purchased, you paid cash, so cash is going out. Cash is going, opening 10, closing 12, 10 minus 12, minus 2. That's the reason I told always do opening minus closing. So what if opening is 10, closing is 9? You have sold current asset worth 1000 and you would have received cash. When you do 10 minus 9, you get plus 1. Opposite works for current liabilities. So simple thing to do, don't use your brain. Current assets you do opening minus closing. Current liabilities you do closing minus opening. I'll explain the format to you once again. What is it that you would have to do? Start with net profit as per P&L account. Add back non-cash and non-operating expenses debited to P&L. Deduct non-cash or non-operating incomes credited to P&L. Once you do that, you get net operating profit before working capital changes. Then you please do changes in working capital. How to do? Current assets opening minus closing. Current liabilities closing minus opening. Current assets opening minus closing. Current liabilities closing minus opening. Once you do that, you will get cash flow from operating activities before tax. Deduct the tax paid during the year. Show extraordinary items separately. You will get cash flow from operating activities. You understood? Financing and investing, what we do under direct method, what we do under indirect method, both are same. Cash flow is a topic which needs too much of problem practice. I'll share another list of questions that you can do to ensure that you get problem practice on this, but I'll cover some important adjustments which can be asked to you as a part of your cash flow question. You know, when will it be called as cash equivalent? It should fulfill RISH, readily convertible, insignificant risk, short term and highly liquid. Readily convertible means willing buyers. Insignificant risk means if you sell, you should almost realize the same value. Short term means it is held for 3 months or less, 90 days. Highly liquid means it is redeemable or it is listed in the market, which can be sold like this. And next thing that you would have to do is practice some transactions. See whether it is operating, investing or financing. Are you able to identify them? This is an interesting one. I want you to pay attention on this. Now, when I do business, my business can be a product, my business can be money. Let's say I buy and sell mobile phones, I buy and sell watches, I buy and sell TV, I buy and sell raw material. Basically, I have a product to sell. I am a non-financial enterprise. Money is used in my business. Money is not my business. To me, if in case I pay interest, it is financing activity. Any interest I pay is what activity? Financing activity. If I receive dividend, if I receive interest, all that becomes investing activity. My business is not borrowing, lending. I borrowed money to invest in my business. So borrowing is financing. And if I invest, investing is not my business. Excess money I have invested. You got it? This is if I am a non-financial enterprise. But if I am a financial enterprise, my business itself is money. I take money at lower interest rate, I invest money at higher interest rate. Then interest paid, interest received will become operating activity. But one thing will be always financing. What is it? Dividend paid. Whether you are a financial enterprise or you are not a financial enterprise, dividend paid, whether on equity or on preference, is always financing. Is always, everybody got this? Very good. See here, dividend paid is always financing. Dividend received is operating if your business is financial business. It is investing if you are in non-financial business. Everybody got this? Pakka? Come on, let's go to the next one. So this is CFS under direct approach. Cash flow, I'll just change it to a different mode and that will end up becoming my cash flow statement. Cash book, I'll just show it differently and it will become cash flow from operating, investing, financing, and dividend. It will become cash flow statement. This is not what we should spend our money, time and energy on. I'll show how does indirect approach and direct approach work. In indirect approach, what I do is I will start with net profit as per P&L. How much is net profit as per P&L? 7. 7 will become my starting point. See, I'll start with 7. Net profit as per P&L. I hope everybody is understanding this. I'll mark it yellow. This I have taken. Then have a look at my P&L here. Here, income, revenue from operations, absolutely fine. Dividend received is there, no 2000. This is investing item. This is included. Because of this 2000 income, this is 12 and this is 7. If I don't write this 2000 income, my net profit would have been less. So what will I do? Here I will deduct that dividend income of. Come back. What else do we have here? 2 over. Cash purchase operating item. Let it be. Depreciation is non-cash expense debited to P&L. P&L it should be there. But if I have to find cash flow, this should be not there. After charging depreciation, my profit has become 7. So what will I do? I will add back. Observe here. I will add back depreciation expense 1000. If I do that, my operating profit actually became 6. You understood? Instead of doing it like this, I can do it differently. See, this is my cash book. Cash sales is operating. Cash purchase is operating. 10 minus 4. 10 is inflow. 4 is outflow. 10 minus 4. 6. See, this is direct method. This is indirect method. However, this is simple. For this, you need to add changes in working capital. Add or less. If you do that, you will get the same thing. I think you're able to bridge the gap between direct and indirect methods. Okay, that's one thing that I would want you to note. See, net profit is a starting point. In some questions, they give P&L statement in the question. If they give P&L statement, that profit will be the starting point. If in case they don't give P&L statement, We usually start with net profit as per P&L account to compute cash flow from operating activities. In some questions, they'll give P&L statement. So you take that net profit and start. If in case they don't give P&L statement, then what do you do? Very simple thing, yeah. They would have given reserves, general reserve, capital reserve, P&L reserve, open ledger account, right? Opening balance on the credit side, closing balance on the debit side. They will tell the list of transactions that has happened. Give impact of those transactions. Once you give the impact of those transactions, then you will find net profit as balancing figure in that ledger. So in the question which gives P&L statement, you don't have to prepare ledger. The question that doesn't give P&L statement, you have to prepare ledger for every item where they've given opening closing balance and they are not same. Every item for which there is difference, except current assets and current liabilities. Why? There we don't try to do ledger, no, we try to difference between opening and closing straight away is written. I'll repeat. When they give P&L statement, it's quite easy. Take that P&L statement's net profit and start. If they don't give that, you should open ledger for P&L reserve to identify the net profit for the year. Similarly, when they give balance sheet for the opening and closing amounts, if they are not same or when they have adjustment, you have to open ledger to see what is the non-cash items in that ledger or cash items in that ledger which will affect cash flow statement. You will open ledger for all the assets and all the liabilities except current assets and liabilities. Why? Because current assets and liabilities we straight away take them as changes in working capital. But for proposed dividend, provision for tax and cash equivalent. Proposed dividend, provision for tax, cash and cash equivalent. These three might be there in that current liability category, but still you would have to open ledger. Why? Cash and cash equivalent you cannot open ledger. Yeah, that will be the item for which you are doing cash flow statement. Provision for tax and proposed dividend you have to open ledger, because usually in a ledger opening and closing balance difference is one item. For provision for tax, opening provision will be paid during the current year, closing provision is provision created during the current year. Similarly for dividend, opening proposed dividend will be declared and paid during the current year, closing proposed dividend is a dividend proposed during the current year. I hope you all understood. So for P&L reserve, you need to open a ledger like this to find net profit. This will be the last ledger to be closed in your working notes because this is the first thing to come in your answer. The next thing that I mentioned to you is with regard to opening the ledger. Okay, let me explain that part to you. Changes in working capital you understood, no? You should always do opening minus closing for current assets, closing minus opening for current liabilities, but for provision for tax, proposed dividend and cash, don't consider them in working capital changes. Don't consider them in working capital changes. I hope you understood that. Then the next point that I want you to note. Yeah, this we just discussed. Provision for tax. I told you, provision for tax you would have to open ledger. This is because opening provision, whatever is there, is the amount that will be paid during the current year. Closing provision, whatever is there, will be the provision that will be created during the current year. If not for provision for tax, in a ledger with opening balance of 80, closing balance of 95, you can assume 15,000 is the provision created during the year, but that's not like that. 80,000 provision created last year is paid, 95,000 is the provision created during the current year. That's the understanding. I hope you all got it. Say something here. Fantastic. And what do? This 80,000 is tax cash outflow operating. And how about this 95,000? This is non-cash expense debited to P&L. Add it back in that list of items that you add back. Similarly for proposed dividend, I'll show the dividend part. Dividend. Dividend is also similar thing. I don't think, where is it, dividend, provision for tax over. But you understood the dividend adjustment, no? Okay, come on. I'll teach you the next part. If in case there is any extraordinary item because of which you are having cash flow, that should be disclosed separately. You need to write cash flow excluding extraordinary items, cash flow because of extraordinary items, cash flow after extraordinary items. Why is it that you should disclose this separately? It has to be disclosed separately because Accounting Standard 5 wants you to disclose extraordinary items separately. I hope you got that point. Proposed dividend. See, last year proposed is 50. Opening proposed dividend. Closing is 45. Proposed dividend, I'll write here liability. How much? 50. Balance carried down. Closing liability is 45. This means last year's proposed dividend is 50. 50 is paid during the current year. Financing outflow. And you have proposed dividend of 45 in the current year deducting from P&L. So this will be written in P&L as appropriation, and that will help us in finding our net profit. How much is financing outflow? 50. How much is reduction of reserve because of proposed dividend? 45. This is what you should keep in mind. And if in case there is current investment in the question, don't take it in changes in working capital. Because it is current investment, it's not working capital. Though it is current investment, it is investment, investing activity. If you purchased it, investing outflow. If you sold it, investing inflow. If you want interest on it, then also it's investing inflow. I hope everyone got that. That's what I would want you to keep in mind when we do cash flow statement. Some adjustments are there with regard to sale of asset also. When you sell the asset, they'll tell the loss, they'll tell the cost of the asset. You might have to end up finding the sale consideration to be written. Sale of asset, purchase of asset, both are investing activities. Yeah, I want you to keep that in mind. Will you do that? Please do couple of questions on indirect method in the cash flow statement. Couple of questions on indirect method. And when you do those couple of questions on indirect method, pick that one question has statement of profit or loss in it and one question does not have statement of profit or loss in it. When you do two questions on cash flow statement as practice on the day before or last 2-3 days, at least one question should be with the statement of profit or loss in the question. One question should be without statement of profit or loss in the question. Do both ways so that you will have some good exposure. Can I now say cash flow statement is done? There's one question involving deferred tax in May 2025 exam which was asked. It is uploaded as a separate video in the same YouTube channel. If you just search CA Rajavardhan or Accountsman May 2025 paper solution cash flow, you will get that video link. You please watch the deferred tax statement in cash flow statement video. I won't touch that here because it's a 15-16 minute video that might end up eating a lot of time of ours here. Let's do chapter 12, buyback of securities. Buyback is opposite of issue of shares. In the event of issue, as a company, I collect cash, I give share. In the event of buyback, I take the share back, I give the cash back. You understand? Buyback is opposite of issue of shares. Buyback or any form in which the company's capital will reduce is actually not allowed by Companies Act 2013. Not just buyback, redemption of preference shares, anything that will reduce the capital is not allowed. Companies Act clearly says a company's capital cannot reduce except reduction of preference shares under section 55, reduction of capital as per the provisions of the act, buyback of securities. There are 3 exceptions, meaning these 3 ways are the ways in which you can reduce the capital provided you comply with other provisions of the act. What is it? Let's discuss. Now, buyback cannot be for investment. Company cannot invest in its own self. Like I have invested all the shares of myself. I am my own boss. No, that doesn't work like that. When you buy your shares back, it should be for cancellation. You pay money, you get the shares back. You cannot keep it as investment in balance sheet. That should reduce your share capital. You got it? And why does a company do this? Company has some extra cash. It doesn't know where to keep. So give it back to shareholders and tear the share certificate in their hand. Usually company do this to increase their EPS, avoid hostile bid or takeover, support the falling market price, or lets the shareholders realize the gain and the company doesn't know what to do with the money. Provisions of Companies Act relating to this are given under section 68 of Companies Act. Shall we see what does section 68 say? Section 68 of Companies Act tells that buyback is like a wedding. For the wedding to happen, you need to look fair, so typical Indian attitude. So you need to apply sunscreen whenever you go out. Sunscreen with higher SPF. SPF in this represents sources of funds for the purpose of buyback, which is security premium, proceeds from fresh issue and pre-reserves. These are the only 3 sources from where you can do buyback. Second one, for the buyback, for the wedding to happen, you need to take consent from your relatives, both sides. So basically you need to pass a resolution. That resolution, what kind of relatives should you take permission from? Only is it your parents or is it your parents, your cousins, uncles, aunties, everything's consent? Depends upon the percentage. If the age gap between the bride and groom is up to 10 years, it's okay. You just take the close circles up, I would say approval and it is good. If the age gap is up to 20, more than 10, but up to 25, then you need to take social consent. Everyone in the society should tell yes. If not, you will become a meme content. Yeah, everyone will look, that guy looks like, I want to say grandfather, this girl looks like his grandchild and they're getting married. Not like that. For that not to happen, you should make it a social, like everyone in the society wants they both to get married. Oh my God, such a great love story. Love is blind, love doesn't have age. You need to prove that. Similarly, when the buyback is up to 10%, board resolution is sufficient. If the buyback is more than 10, up to 25 is allowed. For that you need special resolution, meaning number of votes for should be 3 times number of votes against. You guys understood? Sir, more than 25 years of age gap wedding, hey, meaning more than 25% buyback is not allowed. You got that? Then you will say, sir, I am 25 years old. That means my wife is not yet born. No, it's weird. So, not allowed. And for the next thing that you should notice, child marriage is not allowed. Meaning, if the share is partly paid up, you cannot do buyback. If there is 10 rupees share, 8 rupees paid up, no buyback. First make the call of those 2 rupees. Let that share become fully paid up. Then you do buyback. Sir, why do we wait for share to be fully paid up? If in case you make the call and the shareholder doesn't pay the money, you don't have to pay the money to do buyback. You can do forfeiture of the shares. So in order to buy back the share has to be fully paid up. And wedding is such a big decision in life. Whenever you're taking such big decisions, you need to review the decision. Decision review system. No. DRS test. The only review system. D. Debt equity ratio test. R. Resource test. Yes. Share outstanding test. This has to be done. D. Debt equity ratio test. R. Resource test. Yes. Share outstanding test. When you do debt equity ratio test, the ideal debt equity ratio is 1:2. Meaning 2:1. If you write debt equity ratio is 2:1. Equity debt ratio is 1:2. If you want to borrow money from somebody, you keep 1 rupee in the business, then you take 2 rupees loan. For every 2 rupees you borrow, at least 1 rupee should be yours. You get it? If you want to borrow 10 rupees, first keep your 5 rupees. So your equity cannot be less than half of the debt. Your equity cannot be less than half of the debt. Your debt cannot be more than 2 times the equity. Your debt cannot be more than 2 times the equity. Your equity cannot be less than half of the debt. When you do buyback, equity drops. No, check that it doesn't drop below half of the debt. That's what I am trying to tell when you say debt equity ratio test. If such buyback is going to take your equity below half of the debt, then such buyback is not allowed. You cannot do. You get it? Next one, resource test. Resource means money that you're going to use for the purpose of buyback. Money that you're going to use for the purpose of buyback cannot exceed 10% of paid up capital plus free reserves. You cannot use more than that. And lastly, share outstanding test. Share outstanding test says that at max you can buy back 25%. You cannot buy back more than 25% of the shares. Sir, which condition should we fulfill? All three. Sir, if they tell different shares, right? Debt equity ratio test, maximum buyback permissible. Resource test, maximum buyback permissible. Share outstanding test, maximum permissible buyback. Whichever is less. That is the permissible buyback complying all the three conditions. Let's see this in terms of law now. Sources of funds, 3. Security premium, proceeds from fresh issue, free reserves. Next, conditions. There should be power in AOA. It should be fully paid up. Resolution for buyback. Up to 10%, board resolution. More than 10, up to 25%, special resolution. Buyback subject to fulfill 3 tests. Debt equity ratio test, resource test, share outstanding test. Did I tell 25% or 10% then? By mistake, yeah, dividend 10%. PUC plus FR. I got confused. 25%. Yeah, check. Sorry. People who earned 1 minute ago 10%, you go 1 minute back. That's not 10%. That's 25%. I don't know how to edit, but tell yourself 25%, 25%, 3 times, 25%, 25%, 25%. Debt equity ratio test. Minimum debt to be, minimum equity to be half of the debt. Maximum debt to be 2 times the equity after buyback. Then resource test. Resources used for the purpose of buyback should be lesser than or equal to 25% of paid up capital plus free reserves. And number of shares bought back should be 25% or less. I hope you understood that. And once you do buyback for next 1 year, no more buyback. People are smart. They'll say, you told maximum 25%. Today I buy back 25. Tomorrow I'll buy back one more 25. It's not allowed. You understood? They're telling 1 year gap should be there before you do another buyback. Okay? Marriage. Okay. Then last point, section 69 subsection 1. Be very careful. Whenever you do buyback, share capital of the company will reduce. For reduction of capital, if you have freshly issued preference shares, no problem. If you have not freshly issued preference shares, if you use cash reserves that you have and then pay, capital has reduced. Capital of the company cannot reduce. You have to create CRR, capital redemption reserve, to the extent capital has reduced to bring it back to the original level. And that CRR will be used for the purpose of bonus issue. I'll explain what I'm trying to tell. Whenever the buyback of equity shares is 1 lakh and I freshly issued preference shares of 1 lakh, then there is no problem. Why? Equity share capital reduced by 1 lakh, preference share capital increased by 1 lakh. On the whole, there is no decrease in capital. However, if equity share capital bought back is 1 lakh, preference shares issued is only 80, capital decrease 1 lakh, capital increase 80, on the net there is 20,000 decrease in capital. That is not possible. Take free reserve, general reserve P&L and create CRR, capital redemption reserve. This CRR can be used only for the purpose of bonus issue. Later when you make bonus issue, capital will raise back by 20,000. So totally the capital of the company cannot reduce. You create CRR not just when you do buyback of equity shares, you create CRR also when you do redemption of preference shares. You create CRR also when you do buyback of preference shares. Did you all get this? Fantastic. Now, The journal entries for the purpose of buyback are pretty simple. When the buyback is due, debit share capital, credit shares to be bought back. If in case you have to pay any premium, which is obviously you would have to pay, debit it to premium on buyback. Don't write straight away security premium. Please split it to 2 entries. 4 mark ಕೊಡ್ತಾರೆ 4 entry ಬರೀರಿ. Share capital account debit, premium on buyback debit, 2 shares bought back. Then payment, shares bought back account debit, 2 cash out back. After you pay, that premium on buyback, whatever is there, it should be adjusted. As per section 52 of Companies Act, security premium can be adjusted for premium on buyback. But security premium cannot be adjusted for premium on redemption of preference shares. Remember that? So adjust it again, security premium. Write the entry, security premium to premium on buyback. Sir, what if security premium is not sufficient? Then you can use general reserve, P&L, free reserves can be used. But first priority, security premium. Then, because the capital has reduced, we have to create CRR. We have to take the money from general reserve, take the money from P&L account, put it into capital redemption reserve. Where do we put it into? Capital redemption reserve. Did everyone understand that we'll create CRR using that money? CRR can be used only for the purpose of bonus issue. If in case you issued some preference shares during the year, to that extent we don't have to create CRR. Only to the extent capital is decreasing, we create CRR. I hope you people understood what is the extent to which we create CRR. Sometimes in the question they will not tell preference shares are issued. They would have already passed the preference share entry and then given you the buyback option. And in the capital, preference share capital, they'll write issued 3 months ago for the purpose of buyback. That extent we don't have to create CRR. Remember that. That's one adjustment question that we have. Be cautious with it. I have complete trust you will be able to do buyback related question. Do one question with all the journal entries. But I'll tell you where will people find it tricky. You will find it tricky when they don't mention number of shares to be bought from. They will ask you to find how many shares can I do buyback of. They will ask you to find how many shares can we do buyback of. When they ask you to tell how many shares can we do buyback of, in that case you would have to do a simultaneous linear equation solving as per ICA study module, but don't have to do that. I'll teach you how to do in simple ways. See, this is the way you do it. Paid up capital plus free reserves plus security premium. This is equity. This is equity. How much can we buy back? More than 50% of the debt if it is there, buyback allowed. Less than 50% of the debt if it is there, you can't. So deduct 50% of the debt. I'll take paid up capital plus free reserves plus security premium. Equity minus 50% of debt divided by buyback price plus nominal value. Sir, buyback price plus nominal value yake? Whenever you do buyback, no, nominal value is there, no, to that extent share capital will decrease. In buyback price, there are two things, nominal value and premium. Premium will reduce security premium and nominal value will reduce free reserves because you need to create CRR. So whenever you do buyback, share capital will decrease at nominal value, free reserves will decrease at nominal value, security premium will decrease at premium. So nominal value plus premium. That's nothing but nominal value plus premium is buyback price and one nominal value. So don't have to solve, assume this to be X, assume this to be Y, solve for X, not required. Paid up capital plus free reserves plus security premium minus 50% of the debt divided by buyback price plus nominal value. That's it. You will get the answer. I'll tell you what kind of a savior is this. Sometimes they will give case 1, debt is 80 crores, case 2, debt is 60 crores, case 3, debt is 50 crores. You need to do 3 times simultaneous linear equations. And in the last to last attempt, case law question, case study question for 3 sub questions, 6 marks was just based on debt equity ratio. Other than that, resource test and other things. So 6 marks was just on this. So if in case you don't know how this shortcut works, no, you would have to end up writing simultaneous linear equation 3 times, 15 minutes for 6 marks. This 1 minute for each mark, 1 minute for 2 marks. So you'll end up spending 3 minutes and get 6 marks. And the extra time that you save can be used in solving branch question or maybe amalgamation question or consolidation question. I hope you understood. Simple. For debt equity ratio test, please do PUC plus FR plus SP minus 50% of debt whole divided by buyback price plus nominal value. You understood? Outstanding dividend, dividend declared but not paid, share applications accepted, pending allotment, all of them are debt. Long-term borrowing, short-term borrowing, both are debt. Bank overdraft, debt. You understand? Employee stock options outstanding, if it is there, it's not part of capital. Capital is only capital. Free reserves means general reserve and P&L account. Remember this. If there is any other reserve that they say it is available for the purpose of distributing dividend, that is free reserve. Remember these small adjustments. Resource test, very simple. Take paid up capital plus free reserves plus security premium. That multiplied by 25%. When you multiply by 25%, you will get the maximum amount that can be utilized for buyback. When you get the maximum amount that can be utilized for buyback, divide that by buyback price. When you divide that by buyback price, you will easily get maximum number of shares that can be bought back. Everyone got it? And the last part is share outstanding test. What does share outstanding test say? Very simple. It says maximum number of shares that can be bought back is 25% of the shares that is there. Take number of shares that is there, multiply it by 25%, we'll get maximum number of shares that can be bought back. Take all three, whichever is less is the permissible shares for buyback as per Companies Act 2013. But just because Companies Act allows you to do buyback so many shares, you might not be able to buy back so many shares. You should also have sufficient cash. Compare that with the cash available. In the cash available, check how much cash do they want to maintain. Sometimes they say cash available 1 lakh, but they want to maintain balance of 20. Then cash available for buyback is only 80. Take 80,000, divide it by buyback price, we'll get number of shares. This number of shares or there whichever is less. Compare both and then tell number of shares that can be bought back. I hope you understood this. This adjustment is not there in any of the questions, but can come any day. One day when it comes, that day we should not be like a new adjustment has come. Yeah, इस बार का एग्जाम बहुत मुश्किल था, नया adjustment है buyback में, बहुत आसान चैप्टर में बहुत मुश्किल सवाल पूछ लिया ICA ने. Don't tell such things and then don't make YouTube videos then. Now only you figure out that this is something that can be asked one fine day and be ready. That day you tell, yes, I was prepared for that question too. Okay, this is something that I would want you to know when it comes to buyback, and that's it. Shares with differential rights has been removed from syllabus. It's no longer there. Let's now start with chapter 13, revision. Accounting Standard 14, Amalgamation of Companies. Accounting Standard 14, as per para 3A, tells amalgamation is amalgamation as defined under Companies Act, and it will also include merger. But amalgamation is not defined under Accounting Standard 14. Then we'll go to Companies Act and ask, Companies Act, what is amalgamation? Companies Act will tell, hey, no, I won't define amalgamation. No, go. So there is no definition of amalgamation in Companies Act. Then we'll ask what to do. Then Income Tax Act defines not amalgamation but merger. It says one or two companies coming together to form a new company is merger. So actually, we are talking about Accounting Standard 14 amalgamation with no definition of the word amalgamation anywhere, either in Accounting Standard or in Companies Act or in Income Tax Act. But we know merger. But in the business world, generally three things are very relevant and they are together called as corporate restructuring. Amalgamation, absorption, external reconstruction. What is amalgamation? One company, another company together form a new company. Amalgamation. What is absorption? One big company acquires another small company. Absorption. What is external reconstruction? One company incorporates another new company, transfers its assets and liabilities to that new company, and this will die. You understood? All three of them together with internal reconstruction is called as corporate restructuring. This is business language. But if you talk about Accounting Standard 14 amalgamation, Accounting Standard 14 amalgamation covers amalgamation as per corporate restructuring business term. It will also include absorption. Further, it will also include external reconstruction. Amalgamation, absorption, external reconstruction, all three together are called as amalgamation for the purpose of Accounting Standard 14. Did everyone get this? In the process of amalgamation, there are two parties. Small company which is winding up and giving its asset to another company. Big company which is acquiring all the assets. The big company which is acquiring all the assets is called as transferee. The small company which is winding up is called as transferor. The company which is receiving Eascolo company is really EE irutte. The company which is collecting all the assets will have EE in their name, transferee. The company which is giving will have RR in their name. Now, Accounting Standard 14 is actually applicable to transferee company only. Transferor company, there is no Accounting Standard. AS 14 will tell, if you are going to be there, I'll tell you how to live your life. If you are dying, you die however you want to die. Why do you need my suggestion? Should I give you a suggestion that you should mix poison to the milk and then drink? You should jump from the top of the building. You should hang yourself to the fan. You should go to RCB match celebration and then die. No, I will not tell you how you should die. Dying is up to you. You die however you want to die. But if you are going to live, I'll tell you the art of living. There is nothing called art of dying. You got it? So, Accounting Standard 14 amalgamation is applicable only to transferee companies, not to transferor companies. And AS 14, for the purpose of accounting, divides amalgamation into two categories. One, amalgamation in the nature of merger. Two, amalgamation in the nature of purchase. I'll repeat, for the purpose of Accounting Standard 14 accounting, amalgamations are divided into two categories. One, amalgamation in the nature of merger. Two, amalgamation in the nature of purchase. Amalgamation in the nature of merger ಅಲ್ಲಿ transferee company will follow pooling of interest method. In amalgamation nature of purchase, transferee company will follow purchase method. When do we call it merger? When do we call it purchase? When do we call it merger? When do we call it purchase? Very simple. Accounting Standard 14 will give 5 conditions. Accounting Standard 14 will give, if all the 5 conditions are satisfied, it is merger. Even if 1 out of 5 conditions is not satisfied, it is purchase. If all the 5 conditions are satisfied, it is merger. Even if 1 out of 5 is not satisfied, it is purchase. Did everyone understand? What are the 5 conditions? Number 1, assets and liabilities of the transferor company should be taken over by transferee company. Okay. Assets and liabilities of the transferor company should be taken over by transferee company, including reserves and surplus. Condition number 2, minimum 90% of the shareholders of transferor company should continue to be shareholders in transferee company. Condition number 3, consideration to shareholders of transferor company should be settled by way of equity shares in transferee company, except fractional shares. That ratio, if it sits, it will become shares, will become decimals. You can't share the share now. Already it is a share. How will you further share? So for the decimal, you give cash. Then condition number 4, the business of transferor company should be continued by transferee company. The last condition is assets and liabilities of transferor company, what is taken over by transferee company, should be taken over at book value only, except if you change the accounting policy from one entity to another to bring in uniformity. If you change the value of the asset, okay. Otherwise, change is not allowed. If all the 5 conditions are satisfied, merger. Even if 1 out of 5 not satisfied, purchase. If it is merger, transferee pooling of interest method. If it is purchase, transferee purchase method. Everybody got this? Now, next let's discuss purchase consideration. What is PC? In this company, what is there in between? No, see this one here. There are 3 groups of people who are interested: equity shareholders, preference shareholders, debenture holders. The assets and liabilities in this company belongs to these people. In this gap, I will go get all their assets and liabilities and come out. Can I come out? Ishtu jana ashte alva, they will circle and then like they will kill me. So I should give them take. I should give them something. So I will give something to equity shareholders, preference shareholders, and debentures. But what I give to equity and preference shareholders is PC. What I give to debenture holders is not PC. To equity shareholders of transferor and preference shareholders of transferor, whether I give cash, whether I give debentures, whether I give equity shares or preference shares, it is PC. To debenture holders of transferor company, even if I give equity shares, it's not PC. So what really matters is whom we give, not what we give. To people who love you, even if you give something which is not so nice, they'll be happy. To people who don't like you, even if you give something best, they won't appreciate. Life lesson beda. Amalgamation, come back. So what I'm trying to tell you is, what really matters is whom we give, not what we give. Whatever way you give money to equity and preference holders, it is PC. But to debenture holders, no matter what you give, it is never part of your purchase consideration. Understood? That purchase consideration can be actually computed in 4 ways. Before that, one more point to know. If the transferee company pays liquidation, dissolution or realization expense of transferor, that's not part of PC, my friends. Not part of PC. Purchase consideration can be found under 4 methods: lump sum, payment, net asset, intrinsic value. Lump sum, payment, net asset. What is lump sum method? Lump sum method, big lump sum money put to pay. The total amount is mentioned in the question. Lump sum. Payment, I will not tell total money. I will tell, I will give you these many equity shares, these many preference shares, these many debentures, this much cash. They tell individually all the payment sources. Add them together, PC. Payment method. Net asset method, I will not tell how much I give. I'll tell what is the value of the asset at which I'll take over. I'll take over this furniture, I'll take over this land, I'll take over this building, but at this value. I'll take over this inventory, but at this value. I'll take these 2 liabilities, I won't take this liability. They'll give information like that. All the assets taken over, all the liabilities taken over at agreed value. If you write, you get net assets taken over value. That net assets taken over value, whatever is there, is the basis to determine PC. You can pay same amount, or you can pay slightly more, or you can pay slightly less. You can pay same amount or slightly more or slightly less. If you pay slightly more, that is extra paid is goodwill. If you pay slightly less, that shortage paid is capital reserve. Finally, we have one more method called as intrinsic value method. Under intrinsic method, what you do is, it is like NATO only. Transferor companies assets taken over at agreed value, liabilities at agreed value. You get NATO. That is also called as intrinsic. And this intrinsic value is the PC. Is the PC. Now, how will we give it? By shares of transferee. Their share value also should be found. So what I do is transferee companies assets, take assets at agreed value, liabilities at agreed value. I'll find transferee companies net assets, transferor companies intrinsic value, transferee companies intrinsic value. I'll find exchange ratio and then swap. That will become the exchange ratio for issue of shares. One method, one way. Another way is transferor companies assets, agreed value, liabilities agreed value, net assets taken over, also called as intrinsic value. Transferee companies intrinsic value. Divide by number of shares. You will get intrinsic value per share. This is the issue price. This is the PC. If you divide like this, you will get number of shares to be given. Two ways, either of the ways you do, you will get the same answer. Whatever you remember in the exam, please do that. Or whatever you practiced in the class, please do the same thing. Got that? Next, we have to see accounting entries in the books of transferor and transferee. Let's begin with accounting entries in the books of transferor. Let's begin with accounting entries in the books of transferor. I am transferor. I am transferor. I am closing my books. Remember the story. I am sad. I am shutting down my business. I will take all my assets. I'll put it into one box. I'll take all my liabilities, put it into one box. All assets and liabilities, whether he is willing to buy or not. Close the box, put the tick. Take the box, give it to transferee. And then I'm waiting there. He will give me money, equity shares, preference shares, debentures, cash. Take everything. I'll turn. And I'm about to come. I'll hear the noise that he threw the box. I'll go check the box. If there is any asset that is not taken over, I will sell it. If there is any liability that is not taken over, I will pay it. And then I'll come back for going, coming, packing. I'll incur some expense. Finally, I pay money to my preference shareholders. Then completely I'll remember the story and then check if there is any profit or loss. That profit or loss will belong to equity shareholders. And equity share capital, reserves and surplus also belongs to them. Whatever is left in my hand after all of this, I give it to them. That's it. My business closed. Steps are like this. Transfer all the assets to realization account, whether taken over or not at book value. Entry is realization account debit to assets. Cash and bank, if taken over, you transfer. If not taken over, don't transfer. How do we get to know whether taken over or not? They'll mention in the question. Sir, if they don't mention, then check PC. In the PC, if cash is there, then cash is not taken over. In PC, if cash is not there, then cash is taken over. PC, they give no equity shares, preference shares like that. If they give cash also, then cash is also not taken over. You understood? If they don't give cash in PC, then cash will be assumed to be taken over. You understood this? Okay? But usually they'll mention. And when you transfer assets and liabilities, assets to realization, don't transfer accumulated losses, preliminary expenses. This will be transferred to shareholders later. After transfer all the assets, then you should transfer all the liabilities. What is the entry to transfer all the liabilities to liabilities to realization? Simple. Liability account debit to realization. Liability account debit to, this transfer should be at book value. This transfer should be at all outside liabilities, whether taken over or not, should be transferred to realization at book value. All outside liabilities, whether taken over or not, should be transferred to realization at book value. So exception is share capital and reserves. Share capital will be transferred to shareholder later. Reserves and surplus will also be transferred to shareholders later. So don't transfer them. Then PC view, I give the box to transferee. He has to give me money. So when he has to give me money, I will write his name. Transferee company account debit to realization. That box is realization. This entry should be passed for PC amount. Whichever method it is, compute that and then write it here. Next one, receipt of PC. I'll receive PC from my transferee. However, I receive equity shares in transferee, preference shares in transferee, debentures in transferee, cash, bank, debit to transferee company account. Don't try to segregate nominal value and security premium here. This entry is written at issue price. This entry is written at, then come to selling assets not taken over. I come back, then I hear the noise that is throwing the box. In that, if there is any asset, I will sell that asset. When I sell the asset, don't write asset cash account debit to asset. Why? Asset is no longer there. Asset is now replaced with realization. Entry is cash account debit to realization. Cash account debit. When I settle a liability, entry will be realization account debit to cash. That is the entry. Don't try to account for profit on sale, loss on sale. No. Everything, write it. Selling price should be rated to realization. Profit or loss would automatically get adjusted. If nothing is mentioned, assume asset will realize 0 rupees. Conservative approach. If nothing is mentioned, assume liability will reduce. Liability will be settled at book value. If nothing is mentioned, assume liability will be will be settled at book value. You got that? Then realization expenses. See, I am transferor. My business is getting liquidated. I pay realization expense. Entry will be realization account debit to cash. They pay realization expense. I will not write entry. I pay realization expense and they reimburse it to me. When I pay realization to cash, when they pay me, cash account debit to realization. I hope you understand. If they pay, I will not write any entry. I hope you understood. Any expense whether or any expense should be debited to realization account only. Any income should be credited to realization account only. Don't use P&L account anyway. Why? Business is getting closed. We will not prepare P&L again. Hero P&L close ಮಾಡ್ತೀವಿ. I hope you all understood. Very nice. Then the next point is, after this we should settle our preference shareholders. First, debit preference share capital, credit preference shareholder. When I do this, if I have to pay premium to preference shareholders, don't write premium on redemption of preference shares account. Write realization account. Preference share capital debit, realization account debit to preference shareholder. Very rare, if in case there is discount, credit realization, but this won't be there. Then settle preference shareholders. Debit preference shareholders, credit whatever you give them. You give them equity shares, credit equity shares. You give them preference shares, credit preference shares. You give them debentures, you credit debentures. This is all what we received in PC entry. And if you give them cash, credit cash also. Don't have to account for security premium separately. Don't have to account for security premium separately. Everything is written at issue price. I hope you all understood. Once we do this, we are done with settlement to preference shareholders. In the first entry, when we transferred asset, in the second entry, when we transferred liabilities, when we gave the box, when we paid realization expense, when we paid premium on preference shares, every place I've used realization. That ledger should be closed. Close that realization account. If in case there is debit balance, it is loss. If in case there is credit balance, there is profit. Whether it is loss or it is profit, transfer to equity shareholder only. Loss entry will be equity shareholder to realization. Profit entry is realization to equity shareholder. Transfer that realization profit or loss, then settle your equity shareholders. How do we settle them? Debit equity share capital, debit reserves, what is there? Credit equity shareholder account. What is the entry? Equity share capital account debit, reserves and surplus account debit to equity shareholder. I'll repeat, equity share capital account debit, reserves and surplus account debit to equity shareholder. If there is accumulated losses that will have debit balance, to credit it to reserves and surplus. Ultimately, equity shares in transfer, preference shares in transfer, debentures in transfer, cash, whatever is there, everything you give it to them and then settle once for all. That's it. Done. Settlement entry. By this, all ledgers will get closed. And here everything is at issue price, not at nominal value. Don't write premium separately. Got that? Then the next thing that I want you to notice, accounting in the books of transferring. They can ask ledger or they can ask a journal. Be ready. If they ask journal, write journal. If they ask ledger, think of the journal entry, write it in the ledger. Okay. In the books of transferring, accounting entries vary. If it is purchase method, that is amalgamation nature of purchase, entries are different from how the entries will be if the amalgamation is the nature of merger, where we do pooling of interest with it. Let's first discuss how to do accounting if in case amalgamation is the nature of purchase. Amalgamation is the nature of purchase, where we follow purchase method. Where we follow purchase method. Shall we do this? Now come on, quickly, everyone understand? Story first. I am transferee. I am buying the business now. So my story starts from calling bell when he brings the box. Even if he's packing and everything, I am not involved. So he rings the bell. I open the door. He'll give me the box. I'll keep the box. He's still waiting. I will open the box. I will take the assets. I'll keep it here. I'll take the liabilities. I'll keep it here. I will put hand into my pocket. Take the money, equity shares, preference shares, debentures, cash, any form. I'll give him money. Now that liquidator of transfer company will go. Then I'll throw this box from the window. After that, yes, I purchased business. Celebration. Drums. D-R-U-M-S. D-R-U-M-S. Drums. D. D. Debenture adjustment. R. Realization expense. U. Unrealized profit. M. Mutual indebtedness. S. Statutory reserve. D. Debenture adjustment. R. Realization expense. U. Unrealized profit. M. Mutual indebtedness. S. Statutory reserve. Maximum 5 adjustments can come. Check whether that adjustment is there in the question. If it is there, you write. If it is not there, you don't write. Okay, let's understand the journal entries for this. First, when I receive the box, that box according to transferor is realization. That box according to me is business purchase. I receive the box, business purchase account debit to, I need to pay money to liquidator. Liquidator of transferor. See, transferor is giving box to transferee. To the extent possible, I've used my creativity to show the graphical representation so that there is something nice to see in the book. Okay, business purchase account debit to transferor, liquidators of transferor company account debit. Then I'll open the box. Assets will come out. Assets debit. Liabilities will come. Liabilities credit. Business purchase box will go. Credit business purchase. Asset account debit to liabilities to business purchase. When I write this, assets will be recorded at agreed value. Liabilities will be recorded at agreed value. Assets at agreed value minus liabilities at agreed value will be NATO. Assets at agreed value minus liabilities at agreed value will be NATO. Credit business purchase will be at PC. NATO PC difference will be goodwill or capital reserve. If it is goodwill, debit it to goodwill account. If it is capital reserve, credit it to capital reserve. Did you all understand? Box open, asset liabilities recorded. Now he is waiting. Let's give him PC. How will we give him PC? Several forms: equity shares, preference shares, debentures, cash, everything. Debit liquidators of transfer company account debit. Credit equity share capital, preference share capital, debentures, cash, bank, everything that you give, you credit. Security premium also will be credited. Security premium also will be credited. Remember, here when we write equity share capital, preference share capital, debenture, everything will be written at nominal value. It will be written at what value? It will be not written at issue price. But initially we write issue price. Now we write only at, everybody is getting this? Very nice. Then after that, DRUMS, trumps. D, debentures. When we acquire that company's assets and liabilities, in these liabilities, debentures of transfer company have come. These debenture holders have debenture certificate of transfer, but that company is only not there. So what do? You tear it. Debit debentures in that company. You can give them equity shares, preference shares, debentures, security, whatever you want, cash, you can give anything. You can give that premium or you can give it a discount, your choice. Remember, agreed value of those debentures is nominal value plus premium on redemption. That company's nominal value plus premium on redemption will be agreed value. Agreed value will be the value at which I will credit that debenture liability here. When I write here, I will debit it at agreed value, not at nominal value. This premium is premium on issue of such debentures, not premium on redemption. This premium is premium on issue of such debentures, not premium on redemption. I hope you people get that. D over, next is R. What is R? Realization expense. See, realization expense is of transferor. They should pay. If I pay them, I cannot write it as my expense. Their expense, I paid it on their behalf. So I'll debit goodwill account and credit cash. Entry is goodwill account debit to cash. D over, R over, next U. U is unrealized profit. There is some inventory that I have sold it to them or they have sold it to me. Whoever is bought has not sold it to third party. Till the time we are two different companies, it is okay. But when there is a merger or amalgamation and we become one company, inventory is there in the same company, profit is also booked in the same company. So we reduce the inventory, we reduce the profit. We reduce the inventory by crediting inventory or stock, debit will be made to goodwill account. So entry for removing unrealized profit is goodwill to inventory or stock. You understood? D over, R over, U over, M. Mutual indebtedness. We owe each other. I owe money to them or he owes money to me. To me asset, to him liability. Or to me liability, to him asset. When we are two different companies, it's okay. And it becomes same company. In the same company's balance sheet, you can write debtor. You cannot write debtor and creditor. In the same balance sheet, you cannot write bills receivable, bills payable. In the same balance sheet, you cannot write trade receivable, trade payable. What to do? Eliminate trade payable, eliminate trade receivable. How? Debit trade payable, credit trade receivable. Debit trade payable, credit trade receivable. You understood this? This is the concept of mutual indebtedness. Last one, statutory reserve. DRUM over, yes. Subsidiary company. This is not this. This is just promise. Subsidiary company. Transferor company, because of some legal restriction, they were supposed to maintain reserve to certain period. But what are they doing? Their company is being wound up. No, because I acquired that company, now that legal condition is on me to maintain the profit for a certain period. Reserve for a certain period. They don't give me anything, but I have to still maintain that reserve. So I'll credit statutory reserve, export profit reserve, investment allowance reserve, workman compensation reserve, whatever. I'll credit it. Debit will be amalgamation adjustment. It's a funny adjustment. This statutory reserve, whatever you credit in the amalgamated balance sheet, reserves and surplus, you'll write it. This amalgamation adjustment, whatever you have debited, will appear in the same reserves and surplus as a negative item. Previously, there was a place for amalgamation adjustment in the balance sheet asset side. Now there is no such place. It will be written in reserves and surplus only as a negative item. Everybody got this? By this we are done with statutory reserve. TRUMS. This is accounting for amalgamation in the books of transferee under purchase method. When the amalgamation is the nature of purchase. Amalgamation can be in the nature of merger. If amalgamation becomes in the nature of merger, we follow pooling of interest method. What method do we follow? Pooling of interest method. When we follow pooling of interest method, what will be changed? I'll tell you the changes. First entry, business purchase to transferor, same to same. When we open the box and we write assets and liabilities, wherever there is star, that is new. Asset account debit, liability account credit. But asset account should be at book value. Liability account should be at book value. Can it be at agreed value? Yes, it can be at agreed value only for that uniformity in accounting principles. Otherwise, no. And you credit business purchase at PC amount. Difference cannot be written to goodwill or capital reserve. You should not write. Can you write? No. It should be written to reserves. It should be written to reserves. Did you understand that it should be written to reserves and surplus only? Goodwill or capital reserve cannot arise. Why? One business is not buying the other. Both are same. And when you write assets and liabilities, you don't just take over their assets, liabilities. You take their reserves also. Except capital, everything will be written. Except capital, everything will be written. Assets, liabilities, reserves. Asset debit, liability credit, reserves credit. And business purchase account credit for PC. Goodwill or capital cannot arise. If goodwill or capital arises, when you say the difference arises, it will be adjusted with this reserves of the transferor that have taken over. You understood? And the next thing, discharge of PC. Same entry, liquidated debit to equity share capital, preferential capital, debenture, cash bank, same, no change. Then comes debenture settlement. I'll debit debentures in transferor company and I'll give them same to same. Any difference? No difference. Understood? Then comes our DRUMSLE R, realization expense. In purchase method I write goodwill, no. If it is amalgamation nature of merger, I cannot have goodwill. It will be adjusted against reserve. Unrealized profit, I wrote no goodwill account debit to inventory. I cannot write goodwill account debit. I'll write reserves and surplus account debit. D over R over U over. Next I'll tell M, mutual indebtedness. If it is mutual indebtedness, same entry, trade payables to trade receivables. Finally, yes, statutory reserve entry will not come. Why? See, initially in first entry only you taken reserves, no. Why to write separately statutory reserve? So basically there will be no entry for statutory reserves. I hope everyone understood this. That's it. This is with regard to amalgamation of companies. Please do solve question on accounting entries in the books of transferor, one question. Accounting in the books of transferee, one question. Accounting in the books of transferor, one question. Accounting in the books of transferee with balance sheet, one question. When you do transferee books, no, do one under merger, one under purchase. One under merger, one under purchase. And do one question involving PC at intrinsic value. PC at only PC question at least you do. PC at intrinsic value. Do one question having at least purchase consideration with intrinsic value. You guys got that? And balance sheet one practice madi. If you're doing PC with intrinsic value, there is one question, Sun and Neptune, Sun, Neptune, Jupiter question study material, maybe that should be good. And May 25 exam, there was May 24 exam, there was one amalgamation question. That's again a good question that you can try. I'll anyway share that separate playlist with regard to certain questions that I would want you to do. Maybe playlist or add them onto one video and share. What would be ideal? Playlist would be good, not add them to one video. Video will be too big to watch. Okay, we'll share one playlist saying you must try questions before exam. Let's now quickly revise the topic of internal reconstruction, which is chapter 14 of your syllabus. A company will go through internal reconstruction when it is on the verge of being liquidated. The assets are overvalued, the payments are due, the liabilities are not paid on time, expenses have also not been paid, creditors have stopped supplying the goods, debtors have stopped paying the money, and the company has huge accumulated losses and net worth is also negative. Only option in front of the company is liquidation. In that point of time, if they want to revive themselves, the option that's available is internal reconstruction. Like I mentioned, the situation has huge accumulated losses, overvalued assets, overdue payments, unsettled liabilities. The process is they will reconstruct themselves by revaluing the assets, bringing them to the most realistic value, restating the liabilities by actually negotiating with the debenture holders, creditors, and people to whom they owe money. They will negotiate and ask them to decrease the liability to the extent possible. And we'll reorganize the capital. We'll reduce the capital if possible, subdivide the shares or consolidate the shares, convert them to stock, whatever is best possible. We are basically doing a major surgery inside to revive the company's balance sheet and make it look much cleaner with assets at presentable value, that is reduced value, liabilities at settlable value, write off the liabilities to the extent possible. And in this process, we take one big bandli with us or big bucket with us wherever we go to pick. That is called capital reduction. Ma, please give something. Shareholders will put something. And then asset, we whatever that we accumulate, no, debentures will put something, creditors will put something. That pegged fund, credit, whatever is there, will be used to write off the overvalued assets, accumulated losses. And if there is still something left, that will be capital profit, capital reserve. And this entire process is very closely monitored by three important sections of Companies Act. Section 48, which talks about variation of rights. Section 61, which talks about alteration of share capital. Section 66, which talks about reduction of share capital. Variation of rights, to start with, talks about changing the rights of the shareholder without changing the share capital. For example, the best example or the most logical and practically done example in the class is changing the dividend rate of preference shareholders. There are preference shareholders to whom you have not paid 3 years of dividend, arrears of preference dividend 10%, but you don't have money to pay. What do? You request them, Anna, please write off that 3 years of arrears of preference dividend. Why? If that dividend outstanding goes on for longer, your business is affected. That's a liability in the balance sheet. You'll ask them to write off. But we need to give them something, no? We'll tell, from now I'll make more profit, I'll give it to you. So I will change your 10% preference share capital to 15% preference share capital. Meaning you will now have 15% dividend. I'll convert your normal preference shares to convertible preference shares if you want. I'll convert your preference shares to cumulative or participating preference shares. I'm variating the rights which is there with those shareholders, and that's variation of rights. And this is done in order to strike a deal in reorganizing the capital. This is what Companies Act Section 48 talks about. There is reorganization with regard to voting rights also. With regard to a shareholder, you can give them extra voting right, or you can reduce the voting rate of a specific shareholder. But that's not a transaction. For that, there would be no journal entry. But the journal entry what we pass for variation of rights under Section 48 is preference shareholders dividend rate being changed. The next section of Companies Act what we need to learn about is Section 61 of Companies Act. Here again, there is no reduction in share capital. There is no decrease in share capital. Share capital will remain the same, but we are altering the share capital. What are we doing? Very good. Alteration of share capital can be done under 4 types. Number 1, subdivision. Number 2, consolidation. Number 3, conversion of shares into stock. Number 4, conversion of stock into shares. We'll discuss one at a time. To begin with, subdivision, which is also called as splitting. Under splitting, we split one share of higher value or higher denomination into shares of lower denomination. Let's say we have one share of rupees 100. The company wants to divide one share of 100 into 10 shares of rupees 10. It's like 100 rupees note being exchanged for 10 notes of 10 rupees. Do you guys get this? So this is called subdivision or splitting of share. Share of a higher denomination is divided into more number of shares of smaller denomination. This the company does so that it will help them in reorganizing later. They can opt for share surrender later or any of that thing. So this is what we mean when we say subdivision or splitting. Remember, in this there is no decrease in share capital. The company had 1000 shares of 10 each, 10,000 rupees. Now it is converting it into 10,000 shares, 1000 shares of 10 each, 10,000. It is dividing it into 1 share into 10 if they divide. It will become how much? 10,000 shares of rupees 1 each, 10,000. 1000 shares of 10 each, 10,000 is now divided. 1000 shares. Each share is divided into 10 shares. It will become 10,000 shares of rupees 1 each, 10,000. Share capital before subdivision 10,000. Share capital after subdivision 10,000. Number of shares before subdivision 1000. Number of shares after subdivision 10,000. Nominal value per share before subdivision 10. Nominal value after subdivision 1. So number of shares will become more. Nominal value per share will become less. Multiply madre product amount will remain same. That is subdivision. Next we have consolidation. This is opposite of subdivision. In subdivision, one share will become many small shares. In consolidation, many small shares will become one share. Let's say the company has 1000 shares of 10 each coming to 10,000. Company will convert those 1000 shares of 10 each, 10,000 to, let's say, 10,000 shares of rupees 1 each. Sorry, 1 share of rupees 10,000 each. Are you getting it? So number of shares will be merged together to make 1. So let's say 10 shares will become 1 share. There are 10 shares of rupees 10 each. Company will convert 10 shares of rupees 10 each into 1 share of rupees 100 each. That is consolidation. Company might want to eliminate small shareholders who doesn't want to be taking risk. They want lesser number of people on the board to take a very risky decision. So in that case, company can go to consolidation. Again in this case, pre-consolidation, post-consolidation. Share capital amount remains same. Just that pre-consolidation number of shares were many. Post consolidation, number of shares will become less. Pre-consolidation, per share value was small. Post-consolidation, number of shares value will, per share value will become more. Multiplicand, whatever you get product amount, that will stay same. Next one is conversion of shares into stock. Whenever we talk about share capital, it will have fraction and denomination. Meaning 10,000 shares of rupees 10 each. 10 each is denomination. 10,000 shares is fraction. So 10,000 shares into 10, 1 lakh. The company wants only 1 lakh. It doesn't want that fraction of 10,000 shares. It doesn't want the denomination of rupees 10. So it will convert 10,000 shares of rupees 10 each, rupees 1 lakh share capital into share stock of 1 lakh. There is no number of shares, there is no denomination. This is conversion of shares into stock. The company, when it has not decided what way to subdivide or what way to consolidate, it has not taken the decision, but it wants to freeze the trade in the market. It will convert shares into stock. Later it can decide what denomination it wants, what fraction it wants. Then it can convert the stock to shares. Stock is rupees 1 lakh. There is no number of shares, there is no per unit value. Then they can later decide 1 lakh rupees to be divided into 10,000 shares of 10 each, or 1,000 shares of 100 each, or 10 shares of 10,000 each. That's up to them. That is conversion of stock into shares. And during this entire process, like I mentioned, the share capital will remain same. It will not reduce. In alteration as well as variation in rights, the share capital doesn't change. And to do this, company must have power in articles of association, and it should also pass an ordinary resolution in its general meeting. And the last section of Companies Act 2013 relevant for our internal reconstruction is section 66. This section comes because as per the provisions of the act, the company's capital should never reduce. That is the reason we create CRR whenever we do buyback or redemption of preference shares. In this chapter, we are reducing the capital. It should be within the purview of Companies Act 2013. So section 66 says that reduction can happen in two ways. There is more than two ways, but they are not practical, very theoretical, and practically also not viable. Exam also it's not there. So we'll do only two. Number one, reduction only in paid up value. Number two, reduction in nominal value as well as paid up value. What do you mean by reduction only in paid up value? The company has shares of rupees 10 each. They are going to reduce shares of rupees 10 each fully paid up to shares of rupees 10 each, rupees 8 paid up. So nominal value of the share remains 10. Paid up value is reduced from 10 to 8. This is reduction only in paid up value. When they do this, journal entry will be share capital debit to capital reduction 2 rupees. We'll write the entry only for reduction. Why does the company do this? Later, when the company wants cash, company can make that partly paid up share fully paid up by making the share call and collecting cash from the shareholder. However, the company can choose to reduce not just the paid up value but also nominal value. Why would the company do this? The company would do this to reduce the free up the capital within the authorized limits so that it can give shares to somebody. Even if a 10 rupee share fully paid up has been reduced from 10 rupee share fully paid up to 10 rupee share rupees 8 paid up, authorized capital limit is met andre they cannot make further issue of shares to debenture holder or creditor for settling liability. In this case, what the company does is shares of rupees 10 each fully paid up will be reduced to shares of rupees 8 each fully paid up. Here we are not just reducing the paid up value, we are reducing the nominal value also. The beauty of this case is that 2 rupees need not be called from the same shareholder. We can issue a fresh share to another person for cash or to settle a liability. This is what we mean when we say reduction in nominal value as well as paid up value. Instead of going for reduction or alteration, company has an option to go for share surrender. Share surrender is a case where you go to the existing shareholder and ask him to give some shares to the company. Donate. A shareholder has 10 shares. You will ask him, please give 2 shares of yours. When you take 2 shares from that shareholder, share capital is decreasing. Debit share capital account, credit share surrender. Share surrender is a dummy account. And these shares surrendered will stay there. They can be kept in the equity form in which you took the surrender, or you can convert them to preference shares. If you do conversion of the surrendered equity shares to preference shares, there will be no journal entry. Later, you can use this share surrendered to settle. You can give this to debenture holders. You can give this to creditors. Let's say I have some shares surrendered from my equity shareholders. I wrote the entry equity share capital to share surrendered. After this, I am asking my creditors to be taking these surrendered shares and settle their liability. When I settle, debit your creditors account because it is decreasing. Don't credit share surrendered or equity share capital. Credit capital reduction and close that creditors account. I repeat, Share surrendered entry, share capital to share surrendered. When the creditors are settled by share surrendered, write the entry creditors account debit to capital reduction. Close the creditors account. And out of the share surrender, you give shares to creditors. There the entry will be ulta of what you wrote when you got the share surrendered. When you got the share surrendered, share capital to share surrender. When you issue these to somebody, share surrender to share capital. That credit share capital can be equity or preference. Understood? So when surrendered shares are given against liability, that liability should be first transferred to capital reduction, and share surrender entry, share capital to share surrender, issuing from that surrender entry, share surrender to share capital. If there is any balance in share surrender account at the end, let's say you took surrender of 10,000 rupees worth shares, you issued only 8,000. 2,000 balance in share surrender should be closed by transfer to capital reduction account. And throughout any profit, any loss, any expense, any income, any change in the value of asset, any change in the value of liability, settlement difference, everything will be routed not to P&L but to one account called capital reduction account. And in the capital reduction account, whatever balance is there after all of this and after transferring share surrender also will be utilized to bring the assets to realistic value. If the asset is overvalued, we will write off that overvalued portion to bring it down using capital reduction. We use this to write off accumulated losses, P&L debit balance, preliminary expenses, share issue expenses, or any other expenses which is there which is not written off. We'll use it to write off. After all of this, if still some part of capital reduction is pending, it will be transferred to capital reserve. We can use this to write off intangible assets which don't exist anymore. Patents, goodwill was there when the company is good. When the company is not good, it's not required. No, we can write off overvalued assets, intangible assets, accumulated losses, and excess will be transferred to capital reserve. And once you do all of this and then prepare the balance sheet, in the balance sheet for the next 5 years, whenever you prepare balance sheet, in the name you should write unreduced as on followed by the year date, just to make the user understand that this company has gone through the process of reconstruction. However, court can tell you don't have to write, but whenever you seek the permission of the court usually asks you to include these statements. Understood? That's internal reconstruction. Come on guys, let's now discuss chapter 15 of your syllabus, which is branch accounting, one of your favorite topics which has hardcore accounting to it. Let's begin. So in this topic of branch accounting, to do accounting, we divide the branch into two categories. One, branch which is situated within the geographical boundaries of the country. That's called as inland or domestic branch. The branch which is outside the geographical boundaries of our country, which we call as foreign branch. We'll discuss foreign branch towards the later part of our discussion. Right now, our focus will be concentrated inland or domestic branch. Further, inland or domestic branches will be classified into two categories: dependent and independent. Dependency is in the business world seen slightly different from the accounting. The business world, it is based on the operative and financial decision making. The branches depend on the head office for goods. The branches depend on the head office for money, decision making, sale price fixation, hiring employees, location of business. Then it is dependent branch in business world. But in this topic, we are only focusing on accounting. In this topic, we decide a branch as dependent branch if the branch does not have accounting. And accounting of the branch should be done by head office. Then it is dependent branch. On the other hand, if the branch has an accountant, the branch can do its accounting on its own. The branch will not be called as dependent branch. It will be called as independent branch. Right now, our discussion is now focused to dependent branch. Later, we'll come back to independent branch. Further, for the purpose of accounting, this dependent branch can be classified. This classification now this time is based on the rate at which head office will choose to send the goods to branch. If the head office decides to send the goods to branch at cost price or invoice price, treating the branch like a debtor, it will be treated as accounting to be done under one of the three methods: debtors, stock debtors, and final accounts. However, if the head office treats itself as a wholesaler and treats the branch as a retailer and sends the goods to branch by booking the wholesale profit, then we'll apply another method called as wholesale price method. Now we'll focus on these three methods: debtors, stock debtors, and irrespective of the fact whether you use debtors method, stock debtors method, or final accounts method, end up getting the same profit as R. To begin with, let's see debtors method. Under this method, head office will treat the branch as a debtor and branch owes money to head office. Head office in its books will open one ledger which is like debtor, but it will be called as branch account. That branch will be one separate ledger for every branch. Let's say I have 4 branches: Chennai branch, Hyderabad branch, Mumbai branch, Pune branch. I will open one ledger for each of them.
Chennai branch account, Mumbai branch account, Pune branch account, Hyderabad branch account. We'll open 4 separate branch ledgers. Each branch account, debit side, I'll write the opening balance of assets in the branch. It can be stock, it can be furniture, it can be any other asset, cash balance, bank balance, debtors, everything that's there at the branch as an asset is mine, and I'm supposed to receive it from the branch. So in my branch account, I would write all the opening balance of assets on the debit side. All the closing balance of the same assets will be written on the credit side. See, branch asset, branch debtor, branch cash, branch petty cash, branch stock, all of them. If in case at the branch there is some liability, opening balance on the credit, closing balance on the next, whatever I send to branch will be debit side. Whatever the branch sends to me will be written on the credit side. Then if I find the balance in figure, that would be my branch. And in this process, throughout the accounting, when it is done, head office is treating branch as a debtor. If you send something to branch, value at the branch will increase, debit the branch. If you receive something from the branch, value at the branch will decrease, credit the branch. Basically, branch is your debtor. That's what I did mention. And next thing that you would have to have is assets, debit side, opening balance, closing balance, credit side, liabilities, opening debit balance, credit balance, closing debit side. And there are certain transactions which are ignored. If the transaction is happening between branch and third party, head office will not do accounting. This is because accounting is done for the branch, but by the head office. Accounting is done for the branch, but it is done by the head office. This is debtors method. I can discuss journal entries, but I'll keep it pending for now. What will I do? I'll teach you stock debtor system, and we'll see debtors and stock debtor system journal entries simultaneously. Flip to stock debtor system. Under stock debtor system, what we do is we'll treat the branch as a debtor, but there is a small upgrade. This method is improvised version of debtors method. Under debtors method, like I mentioned in the ledger, we write opening balance of assets on the debit, closing balance of assets on the credit. In that opening balance of assets, it is not asset but assets. There are several items: debtor, stock, furniture, cash, petty cash, so many things. Now for each of them, we'll start opening separate ledger. That improvisation will shift it from debtor to stock. We'll cut that one big branch account into 4-5 ledgers. That will become stock debtor. Under debtor system, I told you certain transaction which involves branch and somebody else. We used to not write entry, here we write entry for. Let's see the transactions and the entries for. To begin with, if the goods are sent to branch, under debtors method, the journal entry is branch account debit to goods sent to. However, under stock debtor system, it will not be branch, it will be branch stock account debit to goods sent. Later, this goods sent to branch will be deducted from the purchases of head office, so the entry is GSB to purchase. That's the follow through. Then, if the expense is incurred at the branch, it can be paid by head office or it can be paid by branch. If the expense which is incurred at the head office, if the expense which is incurred at the branch is paid by head office will write the entry branch to cash under debtor system. If it is stock debtor system, we will not write branch, we will write more specific name. We will write branch expense account debit to. And later this branch expense should be transferred to branch P&L. The end. I'll teach you the entry for that. If in case the same branch expense is not paid by head office, but it is paid by branch, under debtor system will not write any entry because this transaction affected between branch and third party. However, if the expense of the branch is paid by branch and we are maintaining stock debtor system, we do write entry. Here we don't write because the entry will be branch to branch. But here it is not branch. Branch expense account debit to branch cash. We don't write entry for this under debtor system because under debtor system, one ledger what we open, that ledger itself has expense account, that ledger itself has cash account. So it will be reflecting both debit and credit aspect in the same ledger. So we ignore it under debtor system. Under stock debtor, that one ledger is cut into 4-5 ledgers. So expense is debited in expense ledger, cash is credited in a different ledger. So we can do write a journal entry. Next, if the goods are sold at the branch, it can be credit sales or cash sales. Under debtor system, for both cash sales as well as credit sales, there would be no journal entry because this transaction is affected between branch and third party. However, if it is stock debtor system, we usually write journal entry for credit sales, debtors to sales. Here we will not write debtor to sales, we'll write branch debtor to branch stock. Sales account is not maintained, we call it branch stock. If in case it is cash sales, our usual journal entry is cash to sales. Here we will not write cash to sales. We will replace cash with branch cash and sales with branch stock. That would be the accounting entry. Sale of goods on cash and credit, for which actually there is no entry under debtor system. Next, in case we are doing collection of cash from debtor, under debtor system there is no entry. Why? Cash is also there within branch account, debtors is also there within branch account. So two items, debit credit, are in the same ledger. However, when you do stock debtor, it's broken into several ledgers. Usual entry for collection is cash to debtors. It will be branch cash to branch debtors. And next, what if there is bad debts or discount alone? Again, under debtor system, there is no transaction, no journal entry, because it is transaction affected between branch and third party. Or if you have to write that bad debts or discount is identified as profit or loss impactful item in branch, debtors is also there in the same ledger, so you don't have to write it separately. If you write opening and closing balance of debtors, closing balance after deducting cash collected, bad debts, discount, automatically the difference will impact our profit. However, under stock debtor system, we do have to write an entry. We can write it as branch expense account debit to branch debtors. Usually we write bad debts to debtors. Bad debt is replaced with branch expense, and you can credit branch. As a shortcut, instead of writing branch expense, you can straight away post it to branch PL. That will save your effort in opening one ledger. Next, we have with us goods returned by branch. Whatever goods we had sent to branch, branch is returning it back to us. We will reverse the entry what we had passed here. Here we wrote the entry branch to GSB or branch stock to GSB when the goods were sent. When the goods were returned, we will reverse it and write GSB to branch or GSB to branch stock. Next is goods sent by one branch to another branch. When the goods are sent by one branch to another branch, it should be treated like goods are sent by branch to head office and head office to another branch. Same entry for GSB return. If you see GSB to branch, GSB to branch, GSB to branch stock, GSB to branch stock. Next we have with us branch remits cash to head office. Branch is giving cash to head office. Head office is receiving cash. Head office will write cash account debit to. Under stock debtor system, we will not credit branch, we will credit branch cash. The cash is paid directly by debtors or outsiders to head office or the sales made by branch, then it will be same entry like what we wrote before, cash to branch under debtor system. Under stock debtor system, we write cash account debit, but it is not reducing branch cash, it is in fact reducing cash. Credit will be given to branch debtors. Next we have with us goods sent to branch but not reached branch yet. The goods are sent to branch. Head office has written the entry goods sent to branch to branch to goods sent to branch is sent. But that branch cannot sell the goods, branch cannot keep the stock in its closing. So we would have to write it in an account called Gita, goods in transit account debit to branch. In branch ledger, we'll write on the credit side, Gita. And in stock debtor system, it is not Gita to branch, goods in transit to branch. It should be written as goods in transit to branch stock account. Next, we have with the same thing can happen with cash. Cash is sent by head office, not received by branch. In the branch debtors account, it will be written as Sita to branch. Or you can write Sita to branch cash. And normal loss, abnormal loss, usually there is no entry under debtor system. Under stock debtor system, we just have to still write the entry. It will be debited to branch adjustment where we usually remove load, credit branch stock because stock is decreasing. However, if it is abnormal loss, then we'll write branch adjustment account to the extent of load, branch P&L account to the extent of cost, and total invoice price will be credited to branch. And then we have insurance claim. If in case on this abnormal loss, if you have insurance claim, and if insurance claim is received by branch, head office will write no. In this case, we can still write cash account debit to branch P&L, branch cash to branch P&L. If head office receives it, it will write cash to branch under debtor system. Under stock debtors, it will write head office cash to branch P&L. Understood? Ultimately, all of this is done to determine profit. Once we find profit, that profit will be transferred from branch P&L to head office P&L under debtor system. Head office P&L will be credited, branch P&L will be debited. And one thing that you would notice in stock debtor system, to identify profit, close every ledger, close debtors, close cash, close expense, close petty cash. In this, if there is any balancing figure missing, find that number and then close it. After you close all the expense ledgers and then post it to branch PL, then you close branch PL to determine the profit. Hope you guys got this. And another thing that you should note in branch debtors and branch stock debtor system is, what if the goods are sent by head office to branch, not at cost, but at invoice price? In your debtors, opening balance of stock will be on the debit, should be there in the branch stock account at cost. It is there at invoice price. On the credit side, we should remove load. See, branch stock in the debtors account will be there at cost. It is at invoice price, we remove load on the credit side using the name stock reserve. In the credit side, closing stock should be at cost. If it is at invoice price, we remove the load on the debit side using the word stock. Exactly similar to this, if in case our branch goods sent by head office, if it is at invoice price, still goods sent to branch. If it is at invoice price, load is removed on the credit. And similarly, on the goods sent to branch return, if there is invoice price, load is removed on the debit side with the same thing. Opening stock, closing stock, goods sent to branch return in the debtors ledger should be at cost. If it is at invoice price, remove the load on opposite side. On opening stock, load removal on credit side. On closing stock, load removal on debit side. And GSB, load removal on credit side. GSB return, load removal on debit. Opening and closing stock, load is removed by the name stock reserve. On GSB and GSB return, load is removed by the name same name. This is under data system. Under stock data system, if you have to remove load, something what we do is very easy and simple. Whatever the item is there in branch stock account, if it is at a higher price, for example, opening stock, load will not be removed in the branch stock account credit side. We'll write it in branch adjustment account credit. In the stock account, closing stock is at invoice price. Load is removed on the debit side, not of branch stock, but in branch adjustment account. PSB in branch stock account, if it is there at invoice price. Then on this, the load will be removed on the credit side, but not in branch stock, but in branch adjustment. Goods into branch return, what is there in the credit side of your branch stock account will be removed on the debit side, but not of branch stock, but in branch adjustment account. This load on goods. Load will not be removed on sales. Load will be removed only on opening, closing, goods into branch and goods into branch. By doing this, you will be done with your debtors and stock debtors method. Then comes the third method, which is called final accounts. This is our traditional approach, preparing trading account and P&L account. Usually what do we do? Trading account, opening stock, purchases, sales, closing stock, GP. GP you bring to P&L account, expenses, income, GP, NP. Same thing we'll do in branch. But in the trading account, stock items like opening stock, purchases, closing stock should be always at cost price. Sir, what if we've sent the goods at invoice price? Something very simple. Remove load. Right? Opening stock, inner column invoice price, minus load, outer column cost. Purchases won't be there. Goods sent to branch will be there. Goods sent to branch at invoice price, less load, outer column cost price. Closing stock at invoice price, inner column, minus load, outer column cost. Find GP, bring it to P&L. That's it. That's how you do problems under stock data system as well as final account. Let's proceed on to the next method, that is wholesale price method. Wholesale price method is followed when the head office will treat itself as wholesaler, it will treat branch as a retailer. Head office will transfer the goods to branch at wholesale price, branch will sell the goods to customers at retail price. This is similar to invoice price, but it has its differences. Head office, usually if the cost was 100 and if it was sold to end customer at 150 by the branch, head office used to book 50 rupees profit through the branch. Cost 100, branch sold it for 150, branch will book 50 rupees profit. Head office used to book branch profit in its P&L account. But under wholesale price method, it is different. Head office will tell my cost 100. If any other retailer comes, I'll sell it to him at 130. He will sell it to customer at 150. It will treat branch as a retailer, head office as a wholesaler. Head office on every unit sent to branch, head office will record 130 rupees sale price, booking 30 rupees profit. Later when the branch sells the goods to customer at 150, branch will book 20 rupees profit. So same 50 rupees profit under data system, stock data system, final account system. Branch used to book full 50 profit and that was later transferred to head office. Under wholesale price method, head office books 30 rupees profit, sending the goods of 100 to the branch at 130 wholesale price. When the branch sells that 130 rupees goods to customer at 150, branch will book 20 rupees profit. Later the 20 will come back to head office, but 20 will come to P&L of head office. 30 will be there in trading account of head office. That is wholesale price method. Under wholesale price method, head office sends the goods at wholesale price to branch, branch sells the goods at retail price to customer. Cost plus wholesale margin or load is what we call as wholesale. This wholesale margin is profit booked by head office. Wholesale price plus retail margin is retail selling price. This retail price is the profit booked by branch, which is anyways later transferred to head office. And because as I am head office and I have sent goods to you at 130, if you sell it, you book 20, I book 30, no problem. If head office has sent the goods to branch at 130, branch has not sold that goods and it is remaining in closing inventory, it will be there at 130. So head office has booked 30 rupees profits on goods sent to branch. The branch has not sold. Like how we do in amalgamation and consolidation, we can call it unrealized profit. On the closing stock remaining in the branch, profit which is already booked by head office should be reversed. Unlike debtor, stock debtor, final account system, where we remove load on opening, GSB, closing, everything. Here, we remove load only on closing. Closing stock is there in the branch account on the credit side at wholesale price. On that load will be removed on debit side, not in branch account. Head office P&L account. Fine. Head office has booked profit no on that sale. I recorded that 130 rupees as sale and I book 30 rupees profit in my P&L. It has come to my trading to my P&L, it's come, but you have not sold that goods. So to you cost is 130, but you are ultimately extended part of my business. I should reverse that 30 rupees profit. So 30 rupees, that is unrealized profit on the stock lying unsold at the branch, will be written on the debit side in P&L account of head office. That, my friends, is wholesale price. The ledger will look somewhat like this. We'll prepare a proper trading account. Opening stock should be at wholesale price, goods into branch at wholesale price, and then we'll write goods into branch returned at wholesale price, sales at selling price, closing stock and abnormal loss at wholesale. We'll determine profit. This GP, what you get, it is not total profit. It is not 100 and 150. It is 130 wholesale price and 150 retail price. 20 rupees profit at the branch. And we'll write branch expenses and then transfer. And whatever here closing stock is remaining at the branch, on this stock, load will be removed in head office P&L. And on the opening stock, previous year's closing, it was, the load would have been removed last year. That will come in credit side in head office P&L. Remember, in head office P&L, on the opening stock, load will come on the credit. On the closing stock, load will come on the debit. Previous year's unrealized profit is realized this year. Current year is unrealized profit is postponed to next year. In P&L account of head office, previous year's unrealized profit, opening stock's unrealized profit is booked as profit. On the current year closing stock, will reduce the profit by debiting it, postponing it to next year. That's our wholesale price method. Let's begin with independent branch. Under dependent branch, accounting of the branch is maintained by the head office. Accounting for the transactions made by the branch recorded from head office perspective. Whereas in this case, accounting is done for the transaction of the branch from the perspective of the branch. Accountant is sitting in the branch and it does accounting. Two parts has to be learned. First part, how to do accounting. Next part, how to consolidate this into head office. To consolidate, we have two methods, abridged and detailed. But to begin with, let's discuss how to account for transactions in the branch. Let's begin with. So whenever we're doing transactions at the branch, we need to see what is the corresponding transaction entry in the head office entries, head office books also. For the goods sent by head office to the branch, head office should record the entry branch account debit to goods sent to branch. Same entry what we discussed in the past. In the branch, we have to record goods from head office account debit to head office. Throughout, in head office books, we'll have branch account. In branch books, we'll have head office account. In the head office, if you have debited branch, in the branch, you will have credited head office. At the end of the year, head office account balance in branch books, branch account balance in head office books should match. If they don't, something is wrong. We need to rectify and reconcile, only then we'll do consolidate. Next transaction. The goods are purchased by the branch, not from head office. Directly, it is purchased from somebody. Payment can be made by branch, payment can be paid by head office. The payment is made by branch, goods are purchased by branch, head office will write no entry. The payment is made by head office, then head office will, if the payment is made by branch only, branch will write the entry purchase account debit to cash, just normal entry. Independent books, normal entry. What if the goods are purchased by branch? Payment is made by head office. Very simple. Branch will write purchase account debit and it will inform the head office to credit cash. And in the head office books, we will debit branch, in the branch books, we will credit. Because it is like branch has received money from head office. So branch owes money to head office, it will credit head office. Head office has paid money to branch, is supposed to recover that money from branch. So head office will debit branch. Got it? What if expenses of the branch are paid by the branch? The office will write no entry. Branch will write expense to cash. What if the expenses of the branch are paid by head office? In that case, head office will write cash account credit, branch will write expense account debit. Branch has debited expense, head office has credited cash. In branch, credit is missing. In head office, debit is missing. So head office will debit branch, branch will credit head office. Branch will credit head office because branch owes money to head office. Head office will debit branch because head office is supposed to receive money from. Next, what if the goods are sold at branch? The office writes no entry because branch has to pass. If it is cash sales, cash to sales. If it is credit sales, debt has to sales. If you collected money through check, you can write bank to sales also. Entries in the books of branch are very independent, just like any other separate entity. If the goods are sold to branch, sold by the branch to the debtors on credit, and the money is collected by the branch. Basically, money is collected by the from the debtors by the branch. There will be no entry in the books of branch will write the entry cash to. However, if the goods are sold by branch to the customers, and these credit customers, debtors, they paid money to head office straight away, then what will happen? Head office has received money, head office will debit cash. Branch debtors have decreased, branch will credit data. So cash account is debited in head office books, debtors account is credited in branch books. There is missing debit in branch books, which will be head office. There is missing credit in head office books. That head office has collected money on behalf of branch. Branch is supposed to recover that money. So you debit head office account in branch. Branch has basically, head office has collected the money on behalf of branch. So head office will credit branch account. But this, it's like they have collected money from the branch. Branch as an asset will reduce. What if the goods are returned by branch to head office? Goods are returned by the branch to head office. So then you will reverse the entry that you had previously passed. In the books of head office, the entry is goods sent to branch to branch. In the books of branch, the entry is head office account debit to goods from head office. See this? The goods were sent, where entry was branch to goods into branch. Now we'll write goods into branch. Previously it was goods from head office to head office. I will write head office to goods from. Going further, assets are maintained at branch. The branch can say, I am incompetent to maintain asset entries. I don't know. You maintain asset. When I say maintain assets, no, head office is maintaining asset ledger, not the asset. Asset is installed at the branch. Asset is used by the branch. But ledger account of asset is maintained by head office. In that case, what would be entries? If the asset is purchased and the amount is paid by branch, the asset is purchased and the amount is paid by branch. Who's maintaining the asset? Branch only. In this case, who's maintaining the asset? Branch. So branch will write the entry asset to cash. The office will write no entry. What if, begin with the heading again, asset is maintained by branch, asset is purchased, but the payment is made by head office. Then branch will write asset account debit. Head office will write cash account. In branch, credit is missing. In head office, debit is missing. Head office will debit branch because head office has paid money to branch. Branch will credit head office because branch has collected cash from head office. And depreciation entry will not be passed by head office. Entry will be passed by branch. Branch will write the entry depreciation account to asset. Depreciation because it's an expense. Asset account credit because it is the asset. This is the entry. The assets are maintained by branch. If in case the assets are maintained by head office, then wherever asset is there, the debit credit should be done by head office. Asset is maintained by whom? Head office. And the asset is purchased. Payment is made by branch. If the payment is made by branch, branch will credit cash account. Head office will debit branch account, asset account. Asset account debit is recorded by head office. Cash account credit is recorded by branch. So in the missing debit, we'll write head office in branch. Missing credit will be branch in. What if the asset is maintained by head office? Asset is purchased and payment is made by head office. The payment is made by head office. Then what do? Branch will write no entry. Why? It did not make the payment. It is not maintaining the asset ledger. Asset ledger is maintained by head office. Head office will debit branch. Payment is made by head office. Head office will credit cash. Got it? But who's using the asset? Branch. Where is the asset situated? Branch. If there is depreciation on this, that expense has to be debited in branch books to find the correct profit. But asset credit branch cannot. Why? Asset ledger is maintained by head office. So head office will write branch asset. Got it? The missing credit in branch books is head office. The missing debit in head office books is branch. Ultimately, the amount will be remitted by branch to head office. Head office receives cash. If the head office is receiving cash, cash to branch. If the head office is paying cash, branch. And the opposite entry will be passed in the books of branch. Similar to this, there was one question in the recent examination. Again, I have shared it with you people. You can check in the description. You can try that question. So far, the questions in the examination on branch have been pretty simple. Not 4-marker and 6-marker questions. In the old syllabus, they used to be pretty lengthy. Now let's discuss updation, or what we call as consolidation. Branch has maintained its records independently. These records have to be now brought into head office books and then merged with head office books. How to merge them? There are two methods of consolidation. One, abridged consolidation. Two, detailed consolidation. One, abridged. Two, detailed. What is the difference? The detail in the difference lies with the accountant who's there at the branch. I'll tell you theoretically as well as practically. Now, practically what happens is, in the case of the branch, if the accountant at the branch is smart enough to prepare trial balance, ledger, journal entries will be passed, he'll prepare ledgers and he'll prepare trial balance. And the accountant at the branch doesn't know how to go further. So what will he do? He'll dispatch the trial balance to head office. Head office prepares accounting. That is called as detailed consolidation. Head office has to detailedly take item by item from trial balance, add it into their trial. However, branch accountant is slightly smart and the branch manager wants to know the profit at the branch. not from head office, but he wants to hear it from the branch manager. So in that case, branch manager after trial balance goes one step forward and he'll prepare final accounts of the branch at the branch. Once the final accounts of the branch is prepared at the branch will send final accounts to head office. Head office does not take trial balance to update or consolidate. Head office will take final accounts of the branch and update it into the head office record. That is abridged. Here we are not taking detailed trial balance, we are taking abridged. Final accounts is summary, trial balance is detailed. Detailed line by line item will take from trial balance. Detailed. I'll take balance sheet and P&L and then abridged. The difference. Everything that's there in trial balance will be added to head office or corresponding item. Every asset will have debit balance. Credit that asset, debit head office. And later you take it to respective. Every liability will have credit balance. Debit that liability, credit head office account. This is the entry in branch books. And in head office books, it will receive asset, debit the asset, credit the branch. For asset received. For liability received, credit the liability, debit the branch. I repeat, for every asset transferred by the branch to head office under detailed consolidation, branch will write the entry asset credit, debit head office. Asset transferred to head office. Head office will write asset received, asset account debit to branch. For liability transfer, branch will write the entry liability debit to head office. Head office will write the entry branch account debit to liability. For each asset and each liability. Same is done for expense and income. Expense will be usually having debit balance. Branch will credit the expense, debit head office. Head office will debit the expense, credit branch. And incomes, sorry, this is detailed consolidation. And incomes will be usually having credit. Branch will debit the income, credit head office. Head office will debit the branch, credit the income. That way you transfer each expense, each income, each asset, each liability into your trial balance. Then you will prepare balance sheet, trading account, P&L account for both head office and branch. This is detailed. In the case of abridged, head office doesn't take each asset, liability, expense, income. It will straight away take the profit of the branch and then include it. It will take trading account items and then include it. It will take P&L account items and then include it. That is abridged consolidation. By this, we are done with consolidation. Now it is. I have given in detail the entries in abridged and detailed. Next up, we have with us foreign branch. But I have done a little bit of this reference in accounting standard 11 as well, pretty much the same. Foreign operations is the name under accounting standard 11. So the operations of foreign branch can be categorized into two. One, integral, two, non-integral. Integral is extension of the head office operations is there in foreign. Non-integral is branch is treated as a separate entity. Does this matter? It definitely does. Based on the fact whether it is integral or non-integral, we will do accounting. If it is integral operations, we will try to translate opening stock at actual rate. Actual opening stock rate. If not available, we'll take transact. We'll take the opening rate. Closing stock will be tried to be translated at actual rate of the stock, the date it was purchased. If not available, we'll get closing. If it was non-integral, opening stock opening rate, closing stock closing rate. So what is this rate? Trial balance of the foreign branch will be in foreign currency. The trial balance which is there in the foreign currency should be converted into home currency. Only then you can draft final. So the trial balance of the branch which is there in the foreign currency, how do we convert it into home currency? We should apply exchange rate. What exchange rate to apply? That depends upon the fact whether it is integral operation or non-integral. Integral, for opening stock, try actual, if not available, opening rate. For closing stock, try actual, if not available, opening rate. For non-integral, opening rate, closing rate. Got that? And goods sent to branch, we will not apply any rate to transfer. Why? Goods sent to branch is there in the foreign branch account in foreign currency. But Indian head office account, we know the Indian rupee value of it. Write that Indian rupee value. Actual value of the goods sent by head office is available in head office books. Write the same value. Don't try to write the branch value which is in dollars or some foreign currency. Then with regard to revenue items, that is expenses and incomes, these are there throughout the year. We cannot apply actual rates, so we'll write average. We'll write average both in case of integral as well as non-integral. And monetary items and non-monetary. What do you mean by monetary items? Items which can be expressed in fixed and determinable amounts of money. For example, cash, debtors, creditors, loan, borrowing are all monetary. What are non-monetary? Fixed assets, investments, inventory. All of these are non-monetary. So if it is monetary item, under integral operation as well as non-integral operation, we will record it at closing rate. However, if it is non-monetary income, under integral operations, we will write it at original rate, that the transaction date rate. If it is non-integral, we will write it at closing rate. And then we have head office balance in branch account, branch balance in head office account. This will be recorded at the actual value. If I am head office and you are foreign branch, in your branch of records, my name is there. In my books, your name is there. In my books, your value is there in Indian rupees. In your books, my value is there in foreign currency. I don't want your foreign currency value. I have Indian rupee value, that will be recorded. But before you take that, if there are any errors, we need to rectify. Finally, when you draft this trial balance of the foreign branch, is there in foreign currency, when you convert it into home currency, the new trial balance in the home currency will not tally. Why? We did not multiply everything with same rate. Different amounts we multiplied with different rates. The trial balance won't tally. If it is integral operation, such difference in trial balance will be posted to P&L account of head office. P&L account of head office. Remember, if in case it is non-integral branch, such difference in trial balance will not be posted to P&L. It will be kept in a reserve called FCTR, Foreign Currency Translation Reserve. Foreign Currency Translation Reserve. This foreign currency translation reserve will be maintained in head office books till the time the branch is there. Next year, difference also will be adjusted against it. At the end, when we close the branch, like we are closing this video, that FCTR will go to general reserve if there is some balance. I hope this was helpful when it comes to branch accounting. As a bonus, I have added some 3 questions, one on data, one on stock data, one on final accounts, as well as on foreign branch. One of these questions, if you can do, you will be done with foreign branch as well as every aspect of branch. Please do check the description for that video. And I hope this entire revision of branch accounting was helpful.